Let's begin CMA Inter exclusive marathons for June 24 or December 24 exams. This introduction of mine is going to be a common intro for all the CMA marathons. So here I just want to give a couple of instructions. Please kindly watch these instructions and then only start watching from the respective timestamp. Don't hurry up. I know you are thinking to skip this introduction and want to directly go and watch. Please have patience. If you want to succeed in life, you have to follow certain instructions. That instructions I'm going to give you. The first and foremost instruction, kindly watch these marathons at standard speed. Don't increase the playback speed. Please, when you are listening to the class, your purpose is not to finish the class. The purpose is to absorb something, to get something, to connect with the subject, to absorb something. Absorption is important. When you listen to the class at standard speed, you require very, very, very less time for revision. When you listen to the class at higher playback speed, you require lots of time for revision. Getting it? And when you listen the class at higher standards, higher playback speed, generally you will not get that command on the subject. Getting it? That's it. Now, we are going to upload for all the CMA Inter, all the 8 subjects related marathons. So we will be uploading it from 11th of May onwards. We'll be uploading for June exams. Even for December students also can absolutely use these marathons. So until May end, we will be keep on uploading whenever one marathon is completed, we'll be keep on regularly uploading. So P5, our faculty Subramaniam sir will take this marathon, law, and Radhika Gelot from Pune. So she'll be handling industrial and commercial laws. Company law and ethics, Subramaniam sir will handle. And P6, financial accounting will be by Sai Babu sir. By the way, you can just open our YouTube channel, see a Ram Harsha. Inside that playlist you open, you see the playlist, first playlist, CMA Inter June 24 marathons or strategies. So CMA Inter playlist you will find like this. So inside this preparation strategies, 3/4 preparation strategies. What is 3/4? Very simple. A student need not study 100% of the entire syllabus to qualify. In order to get 50, 55 plus, if you are very good at 3/4 of the syllabus, that's more than enough. So for every subject, the faculty has given guidance on which 3/4 syllabus you must be very strong at. So you watch that, you will understand. So, and coming to, by the way, in this marathon, we have used materials, right? These materials that we used in this marathon can be downloaded from Open Srestha CMA website. Inside the CMA Inter, you open PDF resources. Just click on the PDF resources, open CMA Inter. So below, group 1, you just see here. So law, taxation related, accounts related, tax related, and cost accounting, everything, even marathon notes and all also. If at all we have a marathon notes, that also we will insert here. You will find it here. Getting it? So there you can download the materials. Financial accounting by Sai Babu sir, direct taxes by Bhaskar sir, IDT by Pavan sir, cost accounting by Ganesh Bharadwaj sir, and the same Ganesh Bharadwaj sir will handle management accounting as well. Paper 11 part A, financial management by Funny sir, analytics by Mahmood sir, P10 auditing by Mahmood sir, corporate accounting by Sai Babu sir of our Srestha faculty, and operational management by Subramaniam sir, who is actually handling corporate law, and strategic management by Harish Krishnan sir. We will be uploading all these marathons as and when completed, and we try our level best to upload all these marathons, within this May month itself. Getting it? So make use of it. And even RTP videos also we will be uploading very soon for each subject. So just make use of these resources and do well in the exams. And while you're listening, just post your appreciation, whatever. After watching the marathon, please post your appreciation, whatever, as a comments, and like this video, especially importantly, because it will recommend to other CMS students as well. All the very best. Thank you. Continue watching, by the way.
Hi dear students. In today's session, let us start with the first concept, time value of money, as part of our fast track session. Okay. Yes. So straight away, I'm going to the concept, time value of money. Simple, my dear students. The value of money changes with time. So what is the meaning of the term time value of money? The value of money changes with time. Here, time means generally we have past, present, and future. So at different points of time, I have to calculate the value of money. Time value of money means what? The value of money which changes with time actually. At different points of time, the value of money will change. So we don't care about this past value. We care about present value and future value. So in this particular chapter, time value of money, we are always trying to calculate present and future values only. That's what the important point we need to remember. Yes. So the simple definition of time value of money is the worth of a rupee received today is different from the worth of a rupee to be received in future. So that is a simple definition. That means if I offer you 1 lakh rupees today or 1 lakh rupees after 1 year, generally you'll prefer today's 1 lakh rupees rather than future 1 lakh rupees. That's what the time value of money. The worth of a rupee received today is completely different from the worth of a rupee to be received in future. So why, sir? Why everybody will prefer today's money rather than future money? There are some reasons. Let me tell you. The reasons are, the important reasons are, the first and important reason is inflation. See, if I offer you 1 lakh rupees today, you can buy some articles. With the same 1 lakh rupees, the same articles you may not buy after 1 year. That means the prices may rise. That means the purchasing power of money may fall down. Because of this reason, everybody will prefer today's money rather than future money. This is the first reason why everybody is preferring today's money, inflation. And the second one is the risk or uncertainty. The future money is always uncertain. So that because of that reason, everybody will prefer today's money rather than future uncertain money. This is the second reason why today's money is having more value than the future money. And then third one, preference for present consumption. Preference for present consumption. That means everybody will prefer to consume today only, not in the future. That means if I give you 1 lakh rupees today, you can consume such money immediately. You can satisfy. Now itself you can satisfy by using that money. You don't prefer future consumption. This is also one more reason why everybody is preferring today's money rather than future money. And the fourth important point is the investment opportunities. See, dear students, if I give you the money today, you can invest anywhere. Say for example, if you have your own business, you can invest this money and you can earn some amount of profit. If you don't have any business, you can invest that money in a bank and you can earn some rate of interest. If you can deposit that money in a company, that means if you buy the company's shares or if you buy the company's debentures or preference shares, accordingly you'll get some amount of income like equity dividend, preference dividend, interest, like that you can earn some amount of income. That means based on the investment opportunities available to the investors, they can earn any rate of return. And this is also one of the reason why everybody will prefer today's money rather than future money. That means if we can give money today, they can invest on their own. They can invest some amount. They can invest and they can earn some rate of income in the future. And because of these reasons, today's money will have more value when compared to future money. Okay, so what are the four reasons? Inflation, risk, preference for present consumption, and the investment opportunities availability. So because of these four reasons, every investor or everybody will prefer today's money rather than future money. Yes. Okay, now let us go for the text here. And they have given some reasons: risk, preference for present consumption, and investment opportunities. They have not covered inflation. Even inflation is also one of the reasons. Now, dear students, because of these factors, since the investors are facing inflation and risk in the future, investors are facing inflation, risk and risk in the future, they will expect some compensation for these two factors. And such compensation is simply known as the return. In technical terms, the return. In layman language, I'll call it as interest. So simply, interest is a compensation for inflation and risk. So because of this reason, I have to calculate the value of money at different points of time, especially present and future. That means the present value and future value, that's what I need to calculate. Okay. So right in this particular chapter, time value of money, I need to cover these concepts called future value, present value, future value of annuity, present value of annuity, present value of perpetuity, present value of growing perpetuity, and compounded annual growth rate. These are the concepts I need to cover in this particular chapter, time value of money. Yes. Let us understand one by one. And before going for this, just have a look on this particular tree diagram, time value of money. Look at this chart, time value of money. These are the concepts I need to cover. Compounding, future value. Discounting, present value. Yeah, I'll tell you what is compounding and what is discounting. Look at this. Under compounding, future value, I need to cover these concepts. Single flow, multiple flows, annuity. Yes, we need to understand these three concepts. And then discounting, single flow, uneven multiple flows, annuity, and perpetuity. Yes. These are the concepts we need to cover in the under the chapter time value of money. Yes. Now, let us understand what is compounding and what is discounting. Today's value is present value, and the future, we have future value. Say for example, I am taking 1 year period. If you convert your present value into future value, then that is known as compounding. Conversion of present value to future value means compounding. For that, I am going to use one factor called 1 plus r whole to the power of n, which is known as FVF, future value factor. And in a similar way, if I convert future value into present value, the reverse computation, I am converting future value into present value. This is known as discounting. For this, I am going to use one factor called 1 by 1 plus r whole to the power of n. 1 by 1 plus r whole to the power of n. This is known as PVF, present value factor, also known as discounting factor. So this is a simple way of understanding. Conversion of present value to future value means compounding. Conversion of future value to present value means discounting. Let me tell you one important point, my dear students. Compounding means addition. Discounting means subtraction. Compounding means you are adding some return to the present value to get future value. Discounting means you are deducting some return from future value to get present value. This is what the simple way of understanding. Okay. So conversion of present value to future value means compounding. It's an addition of return. Conversion of future value to present value means discounting. It is nothing but subtraction of some return from the future value. Yes. Now, let us understand these two formulas in simple way. The first one is future value. And I am talking about conversion of single future value into present value. Sorry, I'm talking about the conversion of single present value into future value. Single present value into future value. Say for example, I am converting 100 rupees today into future. After 1 year, I want to know about the value after 1 year. And this is what the future value. This is what the future value, and this is the present value. Yes. So what is the formula for future value? The formula for future value is present value into 1 plus r whole to the power of n. This is a formula for future value. Yes. Now just substitute the numbers here. Let us take the interest rate is equal to 10% for the sake of understanding. 100 into 1 plus 10% means 0.10 whole to the power of 1, because we are talking about 1 year period. 100 into 1.1, I'll get 110. This is my future value. So 100 rupees becomes 110 rupees after 1 year. So simply I've added some return 10% rate of interest to the present value of 100 rupees to get a future value which is 110. Yes. So now what is the formula for future value? Present value into 1 plus r whole to the power of n. This is what the present value factor, PVF. So what is the formula? Future value is equal to present value into the second formula, future value factor. This is not present value factor, future value factor r comma n. Okay, so future value is equal to present value into 1 plus r whole to the power of n. 1 plus r whole to the power of n is nothing but future value factor. So the simple formula is future value is equal to present value into future value factor r comma n. Yes, this is what compounding, conversion of present value to future value. Now let us understand the discounting concept, present value. I told you already, conversion of future value to present value means discounting. Present value means you are doing discounting. Discounting means you are deducting some return from future value to get the present value. See, from the future value itself, I can calculate the formula for present value. Future value is equal to present value into 1 plus r whole to the power of n. And from this mathematically, I can write the formula present value is equal to future value into 1 by 1 plus r whole to the power of n. Simple formula. See, here is a formula for present value, future value into 1 by 1 plus r whole to the power of n, and I can rewrite this formula as present value is equal to future value into this 1 by 1 plus r whole to the power of n is known as present value factor r comma n. Yes, it's a simplified formula. Now dear students, this is a discounting factor and the previous one is a compounding factor. This is a compounding factor which will add return, and this is a discounting factor. Yes. Now let us take one example. Let me take 2 years time period. After 2 years, I am going to receive 1000 rupees. The discount rate is 10%, and I want to convert this 1000 rupees future value into present value. So what is the value? Simple. Present value is equal to future value 1000 rupees into 1 by 1 plus 0.10 whole to the power of 2. Yes. How to get it, sir? 1 by 1.1 is equal to, I got 0.9090, again is equal to 0.826. This is a factor you must use, my dear students. 1000 into 0.826. I'm taking the approximate factor here, 0.8264 into 1000. I got 826.4. This is my present value. So my dear students, the present value of 1000 rupees that I am going to receive after 2 years is simply 826.4. That means I have deducted 2 years return of 10% from the future value of 1000 rupees which I am going to receive after 2 years. Okay. Yes. Now, let me revise the formulas. Future value is equal to present value into 1 plus r whole to the power of n. And the present value is equal to future value into 1 by 1 plus r whole to the power of n. But in the study material, they have given you different scenarios. Single flow, multiple flows, annuity. Single flow means converting single value. Multiple flows means converting multiple values. Annuity means converting multiple but equal values. Okay. And we have another one, single flow. Under discounting we have single flow, uneven multiple flows, annuity, perpetuity. Like that we have several concepts here. Let me talk about one by one. Let me talk about the every concept separately. Yes. Now the first one is future value. See, under future value I have to cover single flow, multiple flows and annuity. And these are the concepts I need to cover. Okay. The first one, future value. We have a table in our study material and even in our material, Shasta material. Look at the context here. Future value of single and multiple cash flows. The first one is annually single cash flow. Multiple times says number of times compounding done. Cash flows of different amounts over the years, that is a series of payments. Yes. Okay, the first one, annually single cash flow. Sir, what is this annually? Here the context is annually means annual compounding. So actually, what is the formula for future value? Present value into 1 plus r whole to the power of n. This is a formula where r is equal to interest rate per annum in this context. N is equal to number of years. That means I am doing compounding on annual basis. When the compounding is done on annual basis, then I'll apply this formula. Future value is equal to present value into 1 plus r whole to the power of n. Instead of this, if you are doing compounding not on annual basis but on semi-annual basis, quarterly basis, monthly basis, daily basis, like that, if your compounding frequency is more than once in a year, then I cannot use this formula. This formula is applicable only when we are doing compounding on annual basis. That means the R is interest rate per annum, N is number of years. In case if your compounding frequency is like this, compounding on half yearly basis or compounding on quarterly basis, then in such a case I need to modify this formula. So how I can modify this formula? Simple, nothing new here. Just I am going to change R and N here. See, the first formula is about annual compounding frequency. Now look at the second situation. Multiple times says m number of times compounding done in a year. The formula will be future value is equal to present value into 1 plus r whole to the power of n. That remains same, but I am going to change 1 plus r by m whole to the power of m into n. So what is this m? M means number of times compounding done in a year. So let me write the formula clearly on the screen. If the compounding is done more than once in a year, so what will happen? Simple. The formula will be future value is equal to present value into 1 plus r by m whole to the power of m into n. This is a formula. See, where m is equal to number of times compounding in a year. The compounding frequency, and n is equal to number of years. Now let's say for example, if the compounding frequency is half yearly, then in such a case m will be 2. If the compounding frequency is quarterly, then in such a case how many quarters in a year? 4. If the compounding frequency is for every month, then it will be 12 times compounding. If the compounding frequency is for more than, like 12 for every day, then in such a case it will be 365 times. If the compounding is done on half yearly basis, m will be 2. Quarterly basis, 4 quarters 4 times. Monthly basis, 12 months 12 times. Daily basis, 365 times 365 days. N remains same number of years. Say for example, if the compounding is done on half yearly basis and number of years are 2 years, then m and n. M means number of times compounding 2 and 2 years, 2 into 2, 4 I have to write, and m remains 2 times, like that. Okay, so this second formula is applicable when we are applying the compounding on compounding for more than once in a year. Okay, the multiple times compounding, I can say multiple times compounding. This is the second formula. The general formula, first formula is applicable for annual compounding, and the second formula is applicable for multiple times compounding in a year. Okay, and the third one, cash flows of different amounts over years, that is series of payments. Yes, this is also important formula, one of the important formula. See my dear students, The first formula and second formula both are converting single value into future value, but the compounding frequency may change. The first formula is applicable when you are doing compounding once in a year, annual compounding, and the second formula is applicable when you are doing compounding for more than once in a year. Then you should apply second formula. See, instead of this, if you are converting multiple values into future, you are not converting single present value into future value, you are converting multiple values into future value. Say for example 1, 2, 3, but the values are not even, these are uneven actually. Uneven numbers means unequal numbers. Let us take one example to understand this. Say for example, you are converting 100 rupees of first year, 150 rupees of second year, 200 rupees of third year. Then what will happen? I have to convert all these values into third year ending value. Here also I am calculating future value, but I am not converting single value, I am converting more than one value, and that too unequal values. Say for example interest rate 10% per annum. So why you are taking every time 10%? Because that's an even number and comfortable for understanding. Okay. Now first year ending 100 rupees should be converted into third year ending. 2 years return should be added. 2 years interest should be added. Second year ending value should be converted for 1 year. 1 year interest should be added, and third year ending value, I don't get any kind of return. 200 remains 200. So how I can get this value, sir? Simple. Future value is equal to 100 into 1 plus the interest rate is 10%, 0.10 whole to the power of 2 plus 100 into 1 plus 0.10 whole to the power of, the second year value is 150. 150 into 1 plus 0.10 whole to the power of 1, and the third value 200 into 1 plus 0.10 whole to the power of 0. No interest will be added. So what will happen? 1.1 into 1.1, 100, I got 121, and 150 into 1.1, I got 165, plus 200 into 1, 200. So if you add these two numbers, 121 plus 165, 121 plus 165 plus 200, and you will get 486 rupees. Okay. See, I have converted multiple values into future value, and all the values are unequal. Okay. And for that they have given you one formula. For this actually we don't need to apply any kind of formula. This is a regular computation, and they have taken values like this. Future value is equal to present value 1 into 1 plus r whole to the power of 1, present value 2 into 1 plus r whole square. Don't apply this formula. My suggestion is, if you are converting multiple values into future value, do it manually. Don't apply any kind of formula. Okay. You don't need to remember this formula. That's my suggestion. Okay. Just simply convert the values into future value. If you have completed the chapter capital budgeting, this is very easy for you to convert the values into future. Okay. So in the later session, capital budgeting chapter, I'll tell you how to convert the values into future value under two concepts actually. Okay. Now dear students, my suggestion is just remember these two formulas, and the third formula is a simple mathematical formula, but you don't need to remember this. Simply whenever you're converting different amounts, different cash flows into future, simply do the computation manually instead of applying this difficult formula. This is my suggestion. Okay. With this, the future value of single and multiple cash flows are covered. Now let us go for the next concept. Present value of a single flow. Yes, already we understood the formula called present value of a single flow. Present value is equal to future value into 1 by 1 plus r whole to the power of n. This is a regular formula applicable only when we are doing the discounting on annual basis. But if the situation is discounting for more than once in a year, nothing but multiple times discounting. Multiple times discounting, as generally we don't apply this particular formula in our regular scenario, even in the entire subject financial management, or even in at final level CMA final also, we are not going to use this formula, but they have given you one formula. Just need to try to remember this. That's it. Nowhere I'm going to apply this formula. Even in the problems also, we don't need to apply this particular formula, because multiple times discounting is very rarely applied concept. Actually, it is in most of the cases the annual discounting only is applicable. See, just like for compounding, we have multiple times discounting here. The regular formula only. See, this particular first formula is applicable when you are doing discounting on annual basis. This is for annual discounting. Annual discounting. If the discounting is done more than once in a year, then I am going to apply one formula called present value is equal to the same formula I am going to apply, but with some modification. 1 by 1 plus r. R means r by m whole to the power of n into m. That's it. The same formula, if you remember. M means number of times discounting in a year. M means number of times discounting in a year. Look at the second one. Multiple times, say m number of times discounting done. The formula, future value into 1 by 1 plus r. 1 by 1 plus r by m whole to the power of n into m or m into n. Okay. The PV means present value, FP means present future value, r discount rate, n number of years, m. This is the term you need to remember. M means number of times discounting in a year. Say for example, if you are discounting on quarterly basis, then m will be 4 times. If you are discounting on half yearly basis, m will be 2 times. If you are discounting on monthly basis, m will be 12 times. If you are discounting on daily basis, m will be 365 times. The same logic which I have applied in the compounding, the same logic you have to apply here also. Okay, right. This is regarding present value, conversion of future value into present value for annual discounting. The first one is annual discounting, the second one is multiple times discounting in a year. Now the third one, cash flows of different amounts over the years. This is a simple formula. Actually, you don't need to remember this formula. Throughout the chapter capital budgeting, do this one only. Present value of multiple cash flows. So what is this, sir? Say for example, if I'm going to convert the future value into present value, you know how to apply the formula. Present value is equal to future value into 1 by 1 plus r whole to the power of n. That's a regular formula. But instead of this, if I am converting multiple unequal values into present value, say for example I am converting 1000 rupees first year ending, 1500 second year ending, 2000 rupees third year ending cash flows into present value. Sir, what is the formula? My suggestion, you don't need to remember the formula. Just do discounting. Sir, how I can do this? Let us take the discount rate is equal to 10%. A round figure I am taking here. The formula will be present value is equal to 1000 rupees into 1 by 1 plus r. Because I am converting future values into present value, I must use the discounting factor or present value factor. The formula is 1 by 1 plus r whole to the power of n. So r means 10%, 0.10 whole to the power of 1 plus 1500 into 1 by, sir, why you have taken 1 year? Because I am converting first year ending value. And for second year ending value, 1500 into 1 by 1 plus 0.10 whole to the power of 2 plus third year ending value 2000 into 1 by 1 plus 0.10 whole to the power of 3. Now calculate these values. I am converting 3 values into present value, 3 future values into present value, and all are unequal values, and you don't need to remember the formula for this. Simply apply discounting concept instead of remembering that particular formula. That's my suggestion, my dear students. 1000 into 1 by 1.1, it will be 909.909. That's it. Round, if I take the number 909 plus 1500 into 1 by 1.1, yes, that is 1239. 1500, see, 1 by 1.1, 0.826 into 1500, I got 1239 plus 2000 into 1 by 1.1. Yes, 2000. I got 1502 or 1503 round. If I take the round figure, 1503. Yes, 909 plus 1239 plus 1503. It is 3651. That's it. See, I have converted multiple unequal future cash flows into present value. Okay, my dear students, we understood the concept of present value also now. Present value also. The third formula, my suggestion, you don't need to remember this formula. Simply apply the concept of discounting. Okay. Yes. Now let us go for the next concept called annuity. So what is this annuity? First of all, let me say annuity means series of equal payments. It's a series of payments. That two equal payments. Equal payments or cash inflows. So whenever you are seeing the term annuity, simply recollect or remember one term, series of equal payments. Annuity talks about series of equal payments. The payments or cash flows must be equal. That's what the point, important point you need to remember. Okay, keep that point in mind. Now, this annuity is of two types. One is the future value of annuity. Second one is the present value of annuity. Future value of annuity and present value of annuity. So, what is this future value of annuity and what is this present value of annuity? Simple. 1, 2, 3. If you are converting 3 years equal values into future, say for example 100, 100, 100. So these are series of equal payments. I'm not trying to convert all these values into present value. I'm converting all these values into future. So let me convert these values into future, nothing but third year ending. For converting, I need a compounding rate, say for example 10%. So what is the value? See, converting these multiple equal values for number of times, by doing this compounding for number of times, that's a difficult task. That's a cumbersome work. Instead of this, I can use the formula for future value of annuity. I can use a formula for this, and that is future value of annuity. Sir, what is the formula for future value of annuity? We have a formula. See, periodic payment into 1 plus r whole to the power of n minus 1 divided by r. This is a formula. And sometimes people say, instead of periodic payment, they'll use the term A, amount, periodic payment. Every time I can make some payments. That's what equal payments are simply known as periodic payment or amount A. This factor 1 plus r whole to the power of n minus 1 by r is known as FVAF, future value of annuity factor r comma n. Okay. See, now you can apply this formula here. 100 is your periodic payment. 1 plus 0.10 whole to the power of 3 minus 1 divided by 0.10. I'm just trying to calculate the future value here for 3 years period. For 3 years series of equal payments. 1.1. 100 into 1.331 minus 1 divided by 0.10. 1.331 minus 1 divided by 0.10, and this is 3.31. This is my annuity factor, 100 into 3.31. So I'll get 331. This is my future value of annuity. Even if you can calculate the individual amounts, if you can convert individual amounts into future value, if you sum up all those numbers, definitely you're going to get this number 331. Instead of doing that particular cumbersome work, my suggestion is apply the concept of future value of annuity. So what is the formula for future value of annuity? Periodic payment or amount of payment every year into 1 plus r whole to the power of n minus 1 divided by r. So this is a formula for future value of annuity. So I have converted series of equal payments into future here. Okay. Now we have another concept called present value of annuity. So what is the formula for present value of annuity? The present value of annuity means the same logic applicable here. 1, 2, 3. 100, 100, 100. And the discount rate this time is 10% again. And this time my objective is not to convert these series of equal payments of 100 rupees into future value. This time I am going to convert these values into present value. And I am going to use the discount rate of 10%. So what could be the value? And this time this present value is not a single value. This is the present value of annuity. I can do discounting concept. I can apply discounting concepts for individual amounts separately. But since the numbers are equal, I don't need to use that cumbersome work. I can use the simple formula, simple mathematical formula, because the beauty of mathematics is it simplifies so many computations. And one of such computations is present value of annuity. The formula for present value of annuity is periodic payment into 1 minus 1 plus r whole to the power of minus n divided by r. So what is the formula? This periodic payment is also known as a amount of payment or amount of cash flow. So what is the formula for present value of annuity? Periodic payment into 1 minus 1 plus r whole to the power of minus n whole divided by r. I can simplify this formula and I can write another formula. So people will use different formulas for this, and the same formula, it reflects the same formula actually. Okay. So present value of annuity is equal to periodic payment into 1 minus 1 plus r whole to the power of minus n whole divided by r. Let me apply this formula here. For my example, the periodic payment is 100. 1 minus 1 plus 0.10 whole to the power of minus 3 divided by 0.10. Now 100 into 1 minus 1, I can write this number as 1 by 1.1 whole to the power of 3 divided by 0.10. So try to simplify this factor like this. 1 minus 1 by 1.1 whole to the power of 3. You know how to calculate that? Yes, 0.7513 divided by 0.10. Yes, 1 minus 0.7513 divided by 0.10, and the factor is 2.487, and this 2.487 is simply known as PVAF, present value of annuity factor. So 100 into 2.487, I got 248.7. So successfully I've converted multiple future equal values into present value, which is known as present value of annuity, and I got 248.7. So annuity is a concept of series of equal payments. If you convert such series of equal payments into future, that is future value of annuity. The formula is periodic payment into 1 plus r whole to the power of n minus 1 whole divided by r. And if you convert such series of equal payments into present value, then that is known as present value of annuity. The formula is periodic payment into 1 minus 1 plus r whole to the power of minus n whole divided by r. Okay. See, these two formulas are applicable only when the future values are equal. In case if the future values are unequal, you should do these computations independently instead of applying this simplified mathematical formula. That's what I need to say. Okay, remember that. See, for several situations, we'll apply several formulas. Okay. So look at the formulas here. Annuity A. Yes, we have used periodic payment, and also I can use annuity 1 plus r whole to the power of n minus 1 divided by r, and they have simplified the formula again. And for present value of annuity, they've used the formula like this: periodic payment into 1 minus 1 by 1 plus r whole to the power of n whole divided by r. They have just simplified the formula. Instead of writing 1 plus r whole to the power of minus n, they've written the formula like this: 1 by 1 plus r whole to the power of n. Okay. So instead of that, you can use my formula. Yes. With this, we understood the concept of present value of annuity and present value of future value of annuity and present value of annuity. Okay. And they used one word called ordinary annuity. See, my dear students, ordinary annuity means such periodic payments must be made at the end of the period, at the end of each year. Only when the payments are made at the end of each year, I can apply this formula. Otherwise, I cannot apply this formula. I have to apply another formula, and that is not covered in your material. Okay, then at the end of the session, I'll give you such formulas also. Now, let us go for the next concept called present value of perpetuity. Present value of perpetuity. Sir, what is this present value of perpetuity? Perpetuity is also about series of equal payments, but that is for perpetual period, indefinite period. It is also a kind of annuity, but not for definite period, but for indefinite period. If I use the word indefinite period, immediately the term that comes into picture is perpetuity. So what is this present value of perpetuity? Now, dear students, if you see, say for example, if I'm going to get first, second, third, fourth, up to indefinite period. Every year I am getting 1000 rupees. Every year I am getting 1000 rupees cash inflow. For how many years, sir? Indefinite period. And I want to convert these indefinite period future equal numbers, future equal cash flows into present value. I'm not trying to convert definite period, say 10 years or 15 years future equal values into present value. Then that is known as annuity concept. But here I am trying to convert equal future indefinite period numbers. Okay, equal future numbers for indefinite period. That's why we are using the word perpetuity. And if you are converting these perpetual numbers into present value, then that is known as present value of perpetuity. You know, my dear students, again the beauty of mathematics comes into picture actually. See, for this perpetual period cash flows discounting, I'm going to use one simple formula called, the beauty of mathematics, it simplifies every formula. The formula is C by R. See, for complicated expressions, they'll define simplified formulas. Okay, this is a complicated expression actually, but for that they have simply given one simple formula called present value of perpetuity. The formula is C by R. What is this C, sir? C means cash inflow, R means discount rate. Where C is equal to cash inflows per period. Generally here, for every year, R is equal to discount rate. R is equal to discount rate. Now, let us take the discount rate as usual 10% because that's a round figure. For the sake of understanding, I am taking this present value of perpetuity. I am trying to convert perpetual cash inflows of 1000 rupees into present value. So C is 1000 divided by R is 10%. So if I discount indefinite period 1000 rupees cash flows that occurs at the end of each year at 10%. So simply it is 1000 by 10%. I got 10,000 rupees. This is my present value of perpetuity. So the present value of perpetuity here is 10,000 rupees. Okay. Now we understood the concept of present value of perpetuity. What is the formula? C by R, where C is equal to cash inflows per period, R is equal to discount rate. That's it. Now look at the formula here, perpetuity, present value of perpetuity, cash inflows divided by interest rate. Interest rate, instead of interest rate, you better use the term R, rate of return. Okay, that's what the concept of perpetuity. Perpetuity is an annuity that occurs for indefinite period. If it occurs for indefinite period, then that is not annuity, that becomes perpetuity. Okay, yes. We have another formula which is not given in the study material that I'll give you. Present value of growing perpetuity. So what is this present value of growing perpetuity? See, my dear students, if the future cash flows occurs for indefinite period, but such cash flows are not equal cash flows, growing cash flows that follows constant growth rate. Say for example, I got 100 rupees at the end of first year, and at the end of second year, a growth rate of 10% is added to your cash flow of 100 rupees, and I am going to get 110 rupees at the end of second year, and again 121, apply 10% again growth rate, it will be 121, and then for fourth year I am going to get 133.1. like that for indefinite period I am getting these cash flows. And have you observed one thing? These cash flows are following one constant growth rate of 10%. So when the cash flows are occurring for indefinite period by following a constant growth rate, and if you want to convert such growing cash flows, future growing cash flows into present value by using one of the discount rate which is available to you. Say for example, in this context, I'm going to take another discount rate, R is equal to 15%. If you want to convert this growing cash flows, future growing cash flows that occurs for indefinite period into present value, then that is known as present value of growing perpetuity. So what is the formula for present value of growing perpetuity? Present value of growing perpetuity is equal to, the formula is C1 by R minus Z. C1 by R minus Z, where C1 is equal to cash inflows at the end of year 1 or period 1. Okay. And then R is equal to discount rate. Discount rate. G is equal to growth rate. G is equal to growth rate. Let us apply the formula for the above example. Present value of growing perpetuity is equal to, present value of growing perpetuity is equal to C1. Your cash inflow at the end of first year is 100 rupees divided by R is 15%, G is 10%. And let me apply the formula, 100 by 5%. And I got 2000 rupees. This is your present value of growing perpetuity. So what is the difference between perpetuity and growing perpetuity? Under perpetuity, the future cash flows, the indefinite period cash flows are always equal. Whereas under growing perpetuity, the future cash flows are not constant. Those are growing cash flows following constant growth rate. That's what you need to remember. If the growth rate is fluctuating from one year to another year, you cannot apply this formula. This formula is applicable only when the growth rate is constant from first year ending to indefinite period. That's what you need to remember forever. Okay. Now, present value of growing perpetuity is equal to C1 by R minus C. Yes, we have one formula which is pending under this chapter, time value of money. See, the formula is compounded annual growth rate. Okay, compounded annual growth rate. So what is this? What is the formula for compounded annual growth rate? Compounded annual growth rate, CAGR. Compounded annual growth rate means, see, generally I've invested some money in one of the land and which worth 10 lakh rupees today. And I left it, and after 5 years, by seeing the market value of this land, I found that the value of this land after 5 years is 25 lakh rupees. So my investment value has been appreciated to 25 lakh rupees after 5 years. That means there is an appreciation here. There is a growth to my investment here. Such growth should be calculated on compounded basis. So every year, how much values has been appreciated? That's what I need to calculate. Compounded annual growth rate means for every year on compounding basis, how my value of the land has been appreciated. That's what I need to calculate. Like this, for land and for my investment, like say for example, I have invested my money in one of the company shares, and the share price has been increased, and there is a growth applicable to my share price also, and on compounding basis I have to calculate such growth rate, compounded annual growth rate, for several investments, for equity shares investments, and for land investments, or for business investments, for several category of investments. Since the value of investments are appreciating over a period of time, say for example, say for 5 years or for over a period of 10 years, the investment values will be increased, and on annual basis how the value has been appreciated, and on compounding basis I have to calculate such rate, and that rate is simply known as compounded annual growth rate. So that means I have to calculate the growth rate of your investment, on annual basis by using the concept of compounding. Okay, compounded annual growth rate. For calculating compounded annual growth rate, we have one formula. We have one formula. Let me apply that formula. CAGR is equal to EV divided by BV whole to the power of 1 by n minus 1. This is a formula. What is the formula? EV divided by BV whole to the power of 1 by n minus 1. You can see here they have used one word called U actually. So what is this U? U means 1 by n actually. 1 by n, nth root is applicable here. Okay. So what is this EV? EV means ending value of the investment. BV means beginning value of the investment. So at the beginning of the period, I should know the investment value, and at the end of the period, I should know the value of the investment at the end of the period. N means number of years for which your investment is made. Number of years of investment. Okay. This is a formula for compounded annual growth rate. So what is the formula for compounded annual growth rate? Ending value of the investment divided by beginning value of the investment whole to the power of 1 by n minus 1. Okay. See, my dear students, actually I can say like this: nth root of EV by BV minus 1. The question is how to calculate this nth root, sir. See, say for example, let us take ending value of my investment is, in our discussion, it is 25 lakhs. Fifth root, 25 lakhs divided by, I have invested 10 lakh money. That's what the example we have taken, 5 years period, minus 1. 25 by 10 means 2.5. Fifth root of 2.5 minus 1. Sir, how to calculate this 2.5? Fifth root of 2.5. We have one method for calculating this, nth root formula. Step number 1. For the number which is in the nth root, you should apply square root for 15 times. Step 2. Step 1 minus 1. Step 3. Step 2. Divide by n plus 1. Step 4. Into is equal to for 15 times. If you can apply this process, you can get nth root of any number. Square root of 15 times. See, for 2.5, apply square root 15 times. 2.5, type 2.5 on your calculator. Apply square root for 15 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Minus 1 is equal to, divided by n. N means number of years. Here it is 5 years. Divided by 5 plus 1 is equal to, into is equal to 1, into is equal to 2, like that for 15 times. 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. I got 1.2011. 1.2011 minus 1 into 100. I got 20.11%. This is my compounded annual growth rate for my investment value of 10 lakh rupees. Like that, you have to calculate nth root of any number by using this process. Okay. With this, the concept compounded annual growth rate is completed, dear students. Okay. See, and with this we understood all the concepts of time value of money. The first concept, present value, future value. The second concept, present value. And under those concepts, we have covered multiple cash flows, compounding of frequency for 1 year, once in a year, more than once in a year, discounting once in a year, more than once in a year. And also we have covered the concepts called converting multiple uneven values into future, converting multiple unequal values into present. And those are the concepts we have covered. Along with that, we have also covered the future value, as the future value of finity and present value of finity. And finally, we have covered present value of perpetuity, present value of growing perpetuity. So the last concept is compounded annual growth rate. With this, we have covered all the concepts in the chapter time value of money. So we need to cover few problems related to this concept so that we can complete this chapter. Okay, I'll take one or two sums just for the sake of practice. You need to solve all the problems, but this is a fast track session, I'll try to cover 2 to 3 problems at least. Okay, right, fine. Good evening, dear students. The previous session we understood all the formulas related to time value of money. Now let us apply such formulas to few problems. I'll take few problems only out of many problems just to understand the concept. Okay. Now look at illustration number 1 here. If a person invests 1,50,000 rupees in an investment which pays 12% rate of interest, what will be the future value of the invested amount at the end of 10th year? So after 10 years, what is the value of 1,50,000 rupees that you are investing today? Interest rate is 12% rate of interest here. Okay. Now let us apply the formula called future value. Future value is equal to present value into 1 plus r whole to the power of n. So you're investing 1,50,000 into 1 plus r. Interest rate is 12% whole to the power of how many years? Now look at the question. Number of years or 10 years. Okay. Power 10. Yes. Now just calculate this. Then you'll get future value. 1.12 into is equal to, I got second year factor, third year, fourth year, fifth year, sixth year, seventh year, eighth year, ninth year, 10th year. So dear students, I got 3.1058. This is a factor I got. Now you just try to get it. 1 plus 0.12 is equal to, you'll get 1.12. Again apply like this, into is equal to, then you'll get second year factor. Again type is equal to, then you'll get 1.404928, like that. This is your third year factor. So you have to do like this. 1.12 is equal to I got third year factor, fourth year again, fifth year, sixth year, seventh year, eighth year, 9th year, 10th year. So successfully I got 3.1058. This is my factor. 3.1058 into 1,50,000. So the answer is 4,65,877. 465,877. This is my future value. So this is regarding problem number 1, dear students. Now look at the next problem. Illustration number 5. Find the present value of 1,000 rupees receivable 6 years hence. That means after 6 years. If the rate of discount is 10%. Discount rate is 10%. The life is 6 years. That means after 6 years, I am receiving 1,000 rupees and I want to know the present value of such 1,000 rupees today. Okay. So the formula here, I should apply the formula called present value. Present value is equal to, what is the formula? Future value into 1 by 1 plus r whole to the power of n. So my future value is 1,000 rupees and at the end of 6th year I am getting, and the discount rate is 10%. 1,000 rupees into 1 by 1 plus 0.10 whole to the power of 6. Yes. After 6 years I am getting it. So now how to calculate this factor? That's the question. 1,000 rupees into, see, this is your present value factor actually at the end of 6th year at 10% discount rate. Now let us apply this formula here. Let me calculate this factor. 1 by 1.1 is equal to, you must get 0.9090. This is your first year ending present value factor. If you press is equal to, again you'll get second year ending factor 0.8264. Third year, fourth year, fifth year, sixth year. I got 0.56. double four. This is my factor. Okay. So now multiply this number with 1000 rupees and the value is 564 rupees. Okay. So just like that you have to apply present value formula. I can convert any future value into present value. Okay. Right, with this the application of present value is over. Now let me go for the next concept, future value of annuity. Look at illustration number 10. Ascertain the future value and compound interest of an amount of 75,000 rupees at 8% compounded semi-annually for 5 years. See, this is not related to future value of annuity. So just go for the next question. The future value of annuity is illustration number 9 actually. So illustration number 9. A person is required to pay annual payments of 8,000 rupees in his deposit account that pays 10% interest per year. So a person is making equal annual payments of 8,000 rupees in his deposit account and that is paying 10% interest per year. And we need to calculate find out the future value of annuity at the end of 5 years. I've given you one formula related to future value of annuity. You just need to apply such formula. Simply you'll get the answer. Okay. Problem number. Yes, here is the question. Illustration number 9 hit us. What is the formula for future value of annuity? Future value of annuity is equal to, I've given you the formula, periodic payment into 1 plus r whole to the power of n minus 1 divided by r. Here is a formula. Now, how much payment I'm making annually? 8,000 rupees. This is my periodic payment and interest rate is 10% per year and the term is 5 years. Okay, 8,000, 10%, 5 years. $8,000 as my periodic payment. Interest rate is 10%, 1 plus 0.10 whole to the power of, it is 5 years term, right? Yes, it is 5 years. Power of 5 minus 1 divided by 0.10. Just apply this. 8,000 into, you need to calculate this factor which is known as future value of annuity factor. Okay, this is future value of annuity factor. Let me calculate it. 1.1 second year, third year, fourth year, fifth year. 1.61051 minus 1 divided by 0.10. Minus 1 divided by 0.10 and I got 6.1051. This is my present value of annuity factor. Let me confirm it again. 1.1, 1, 2, 3, 4, 5 minus 1 divided by 0.10. I got 7. Sorry. 1.1. This is first year, second year, third year, fourth year, fifth year. Minus 1 divided by 0.10. I got 6.1051 into 8,000 rupees. Just apply it. You'll get 48,840. This is my future value of annuity. So what is the formula for future value of annuity? Periodic payment into 1 plus r whole to the power of n minus 1 whole divided by r. So with this we understood the application of future value of annuity. Now look at 11th problem. This is related to present value of perpetuity. An investor expects a perpetual sum of 5,000 rupees annually from his investment. So I am getting a cash inflow of 5,000 rupees annually for how many years? For perpetual years. What is the present value of the perpetuity if the interest rate is 10%? Now dear students, this 10% is your discount rate. This is your discount rate. And you know that what is the formula for present value of perpetuity? C by R. Present value of perpetuity is equal to C by R. That's a simple formula. Present value of perpetuity is equal to cash inflows divided by R. R means discount rate. In this context, my cash inflow is 5,000 rupees annually. I'm getting for perpetual years and the discount rate is 10%. Simply substitute the numbers 5,000 by 10%. The value is 5,000 divided by 10%. I got 50,000 rupees. This is my present value of perpetuity. That's it. Now we have one more application in this chapter, time value of money, that is simply present value of annuity. I'll show you one problem related to present value of annuity. Here is the problem, illustration number 4. Look at the question. The ABC Limited company expects to receive 1 lakh rupees for a period of 10 years from a new project it has just undertaken. Okay, fine. The company is getting 1 lakh rupees cash inflow for 10 years period. From the new project it has just undertaken. Assuming the rate of interest is 10%, and I can consider this 10% as a discount rate. How much would be the present value of this annuity? See, what is the question is about present value of annuity. My dear students, present value of annuity means I must get series of equal payments here. Here I am getting series of equal payments of 1 lakh rupees from the one of the project for how many years? 10 years. So this is a clear case of present value of annuity, because I am getting series of equal cash flows here. Okay. Now what is the formula for present value of annuity? That's the question here. Present value of annuity is equal to periodic payment into 1 minus 1 plus r whole to the power of minus n whole divided by r. And this is known as present value of annuity factor. Now apply this present value of annuity factor. I am getting 1 lakh rupees cash inflows every year from the project, which is known as periodic payment or amount, or I can say amount. And now I should identify the discount rate and all. 10% is the discount rate. Term is 10 years. Okay. 10% is the discount rate. 1 minus 1 plus 0.10 whole to the power of minus 10. Term is 10 years. If I am not wrong, let me confirm it again. Here is the term 10 years. Okay. Both are 10%. 10%, 10 years. Now, calculate this factor, present value of annuity factor. 1 minus, I can rewrite this number as 1 by 1.1 whole to the power of 10 plus 10 whole divided by 0.10. Just try to simplify the formula. 1 lakh into 1 minus, I'll get 1 by 1.1 is equal to, this is first year factor 0.9090, second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year, ninth year, 10th year. The 10th year factor is 0.3855. I'm just taking 4 decimals only, divided by 0.10. That's okay. You can take 4 decimals to get the answer. That's not an issue. Don't bother about it. You don't need to take all decimals every time, because that's a time consuming factor. Okay. 0.3855. 1 minus 0.3855 divided by 0.10. I got 6.145. Multiply this factor with 1 lakh rupees, and I got 6,14,500. This is my present value of annuity. Simple. So try to calculate this present value of annuity factor every time and multiply that number with your series of equal cash flows, nothing but single cash flow, so that you get present value of annuity. Okay. With this, we understood all the concepts of time value of money, and with this we have completed the chapter time value of money. Now we can enter into the new area called risk and return. Okay, right. Okay, dear students, now our new chapter, risk and return. Okay. See, in simple terms, what is the meaning of the term return and what is the meaning of the term risk? See, the chapter name is risk and return. In simple terms, return means for every investment, one has to get return and he should face risk also. So what is the return? It is a principal reward. Simply, since you are investing some amount of money, and for such investment you'll expect some reward. Such reward can be in the form of income, or it can be in the form of gain, or both. So for every investment, the investor should get a reward, and that reward can be in the form of income and in the form of gain, or in the form of both income and gain. This is what the principal reward from every investment, which is simply known as return. So return is nothing but it's a principal reward for the investor for his investment, which is in the form of income and gain. Since he is getting some income, there is a scope for variability from the expected return. Such variability is simply known as risk. So risk means variability, the deviation from our expectation. This is what the simple way of understanding what it exactly means. So return is a principal reward for our investment. Risk is the variability of the expected return. Okay, then fine. Now just go for the theory here. Return and risk are the two critical factors in investment decisions. They are closely linked. If high risk is involved, the required return on the project should also be high. If the risk is high, the return will be high. If the risk is low, the return will be low. That's a regular sentence. And in fact, it is one of the core objectives of the subject financial management, risk return trade-off. So the level of risk is measured first and then the level of return generally. Okay, fine. So let us understand the term return first of all. What is a return? It's a principal reward. Principal reward means the investor that is getting from the investment. So what he is getting? A periodic cash receipts and or income on the investment, either in the form of interest or dividend. So the first form of income is interest or dividend, and the second component in the principal reward is change in the price of the asset. So the price of the asset will be changed, and that results in either capital gain or capital loss. So these two components decides the return for the investment. So which is this particular change in the price of the asset is commonly known as capital gain or loss. So my dear students, just now we understood for every investment there will be a principal reward which is known as return, and that return is in the form of two components. One is income. It can be expressed as interest or it can be expressed as dividend for most of the investments. And then the second one is the price change over the period, the price change over the time horizon or period, and this price change results in either capital gain or capital loss. Yes. Now dear students, this return can be a realized return. That means the past return, the return that we have earned in the past, or expected return. That means the return that I am expecting in the future. It is purely probability based calculation, expected return. So your return is classified into two parts, the past return and future return. Past return means realized return, future return means expected return. Okay. Now dear students, technically we can consider these past and future returns as ex ante return and ex post return. Ex ante return is an expected return, ex post return is a realized return, or means realized return in the which is earned in the past. So ex ante return is an expected return that I can earn in the future. Ex post return is a realized return that I have already earned in the past. Okay, then now we understood the basic meaning of the term return. Now let us calculate the rate of return. How I can calculate this return? Yes, you can see here we have a formula here, total return. It's a general formula applicable to every investment. So what is the formula? Cash payments received plus price change over the period divided by purchase price of the asset. This is a formula for total return from any investment. So what is the formula? The cash payments that I am receiving annually or periodically. The periodic cash payment that I am receiving in the form of interest or in the form of dividend or in the form of any other income, plus the price change over the period for that particular investment or asset, divided by the purchase price of the asset. Purchase price of the asset is nothing but investment, our investment value. This is a basic formula for calculating total return of any investment. Yes. Okay. Yes. Thank you. Now dear students, in most of the cases, I'll try to calculate rate of return for a company share, because that is very important for us. Now let us understand how to calculate rate of return for a company share, because that is also one of the investment. If I put some amount of money in one of the company shares, that is my investment, and from such investment, periodically I want to calculate return. Generally, annually, we are going to calculate rate of return from our investment. So what is the formula for rate of return? The formula for rate of return from equity shares is D1 plus P1 minus P0 divided by D1 plus P1 minus P0 divided by P0 into 100. This is a formula. So what is D1 and what is this P1 minus P0? First of all, D1 means expected dividend per share at the end of year 1. P1 means, first let me write P0. P0 means current market price per share. Let us say market price per share at the beginning of the year. And P1 means market price per share at the end of first year. At the end of year 1. So this is a formula for calculating rate of return from one of the company's share. Okay. Let us take one example to understand this. I'm taking 1 year holding period of one of the company's share. And at the beginning of the year, I purchased a particular company share at 100 rupees. This is considered as P0. And after 1 year, the price has been increased to 110. This is P1. And at the end of the first year, I got a dividend of 5 rupees. Now, have you observed one thing? This is my investment, 100 rupees. And for this investment, I'm getting some rewards here. So what are the rewards? I'm receiving dividend, cash dividend. And at the end of the first year, my share price has been increased to 110. This is the price change over the period of 1 year. 100 rupees to 110 rupees means I got an increase of, I got some extra amount of 10 rupees in the form of price appreciation. And this is also one of the gain or income to me, and which is known as what? Capital gain actually. This is my extra income, or I can say extra gain. Okay. So if you can apply the above formula for this so that you can calculate rate of return. So what is the rate of return here? D1, the cash payment that I am receiving, the cash income that I am receiving, 5 rupees. And the price change over the period of 1 year, 100 rupees to 110 rupees. P1 110 minus P0 100. This is the capital gain divided by 100 rupees is my investment. So 5 rupees is cash dividend and 110 minus 100 is 10 rupees is capital gain. This is my investment. These are the two rewards here for my investment of 100 rupees. So 5 plus 10 divided by 100 rupees, that gives me the rate of return. 15 by 100 and I'll get 15%. Yes, you don't need to calculate it, you can write it directly. Rate of return is 15%. Now, so what is the formula for rate of return from one of the company shares? D1 plus P1 minus P0 whole divided by P0 into 100. What is D1? Expected dividend per share at the end of year 1. Sometimes if the dividend is given for the last year, the last paid dividend or just paid dividend, then you should add growth to your dividend. Okay, generally if the growth rate is given, you should add growth to your dividend to get dividend at the end of first year. Most of the cases they'll give you first year ending dividend only for calculating rate of return in this particular chapter. And P0 means today's market price per share, which is known as current market price per share. P1 means market price per share at the end of first year. So if you can substitute all these numbers in the above formula, you will get rate of return from one of the company share. This is 1 year holding period return. This is 1 year holding period return. Remember that. Okay. So now we understood how to calculate rate of return. That's what they've given here. Dividend plus capital gain divided by initial investment. You can apply simply D1 plus P1 minus P0 whole divided by P0 into 100. Yes. Now dear students, this is 1 year return, but I need past few years return. if I can take past few years returns, then that is known as average annual return. Let us say I'm taking past 10 years returns for estimating the return for the next year. So just to know the return, just to calculate the expected return for the next year, I need to take the past few years data because the trend will be continued in the future. So for that I am going to calculate average rate of return by taking past few years returns. See, this past few years returns, by taking these past few years returns, I can calculate average rate of return either by using arithmetic mean, that means simple average, or by using geometric mean, that means compounded average rate of return. See, in most of the cases, the first one is as a regular application, arithmetic mean. In very rare cases, I am going to apply this geometric mean. In every problem, we always try to apply the first formula, arithmetic mean. Okay, arithmetic mean means what? Say for example, if I am taking past 10 years returns, I'll simply sum up all those 10 years returns divided by 10 years. That gives me what? Simple average return, which is known as arithmetic mean. So you know that the total of all returns divided by number of years, that gives me simple average. So average annual return means what? The average of past few years returns, that can be calculated by using arithmetic mean, simple average, or by using geometric mean, compounded average rate. Okay, this is what average rate of return, average annual rate of return. Now the second one is expected rate of return. So you can calculate average annual rate of return from the past few years, and that return can be expected in the future. Or else you can calculate expected rate of return by applying the probabilities. See, I can estimate the market conditions, and based on market conditions I can get different rates of returns. Which market condition prevails in the future, I cannot decide. So that I am going to assign probabilities to the respective market conditions or economic conditions. Accordingly, I am going to calculate expected return from one of the company's share or one of your investment. So what is the formula for expected rate of return? It's a simple one. Simply multiply the probabilities with the respective returns. Say for example, I am going to get 20% return with a probability of 50% chance, 0.50, or I may get 30% return with a probability of 30%, or I may get 50% return with a probability of 0.20, 20% chance. So which return you are going to get? I am not sure. There is a 50% chance of occurrence to get a return of 20%. There is a 30% chance of occurrence to get 30% rate of return. And there is a 20% chance of occurrence to get 50% rate of return. Which one I am going to get? I am not sure. So here I am going to take the expected return. Simply multiply the returns with the probabilities to get what? The expected return. So 20 into 0.5. Return into probability, 20 into 0.5, so that you'll get 10, 30 into 0.3, 12, 50 into 0.2, 10, 30 into 0.3, this is 9, yes. So how much it is? 29%. This is my expected return. So they've given you one formula. Just look at that. R1 into expected return here is equal to R1 into P1. R1 means return, first probable return into the first probability. R2 into P2. That means the second return into second probability. R3 into P3. Third return into third probability. R4 into P4, fourth return into fourth probability, like that. Rn into Pn, nth return into nth probability. So simply if you sum up all these numbers, you'll get expected return. So what is the formula for expected return? By applying the probabilities, R1 into P1 plus R2 into P2 plus R3 into P3 plus R4 into P4 plus and so on, Rn into Pn. It's a simple mathematical formula. Instead of that, if you can define the table, write the returns, write the probabilities, multiply the returns with the probabilities, and that is the last column. The sum will be your expected return. It's a simple way to calculate expected return instead of remembering this particular formula. Okay. Here is the example for calculating expected return. See, they have taken 4 economic conditions: growth, expansion, stagnation, and then decline. For all these 4 economic conditions, the probable returns are given here. I may get 18% under growth situation, under expansion 11%, stagnation 1%, decline condition economic condition, I'm going to get a negative return of -5%. And with the respective probabilities, see, there is an equal chance of occurrence for every economic condition. That's okay. Multiply the returns with the probabilities so that I'll get expected return. 2 into 3 they have taken like here. Okay, 2 into 3 means return in rate of return into probability. If you multiply these two numbers, you must get these numbers. The total will be what? The expected rate of return. So we understood how to calculate the average rate of return and expected rate of return. Average rate of return means it is the average of past few years returns. Sum up all the past few years returns and then divide by number of years. That gives a simple average, which is nothing but arithmetic mean. And in that way, I can calculate average rate of return. And coming to expected rate of return, apply the probabilities, multiply probabilities with the rate of return to get expected rate of return. So we understood, with this we understood average rate of return and expected rate of return. Now let us go for the next area called expected return on portfolio. Sir, what is the meaning of the term portfolio? That's what you need to understand. First of all, this is a new term for you because we don't have any chapters related to portfolio. We have a chapter called portfolio management at CMA final level that I am going to cover at final level. But here they have given you one formula related to this portfolio, that means for calculating expected return from the portfolio. First of all, let us understand what is the meaning of this term portfolio. Portfolio means, in simple terms, group of securities, a group of assets. If a person is holding one company shares, then he is holding an investment. If a person is holding more than one company shares, more than one type of investment, then he is said to be having a portfolio. So in simple terms, portfolio means it's a group of securities or group of assets. Don't think that every asset will give you same rate of return. Different assets will give you different rates of return. Say for example, in my portfolio, I am holding 3 securities or 3 investments. Investment number 1, investment number 2, investment number 3. From every investment, I am getting different returns. Say for example, from investment number 1, I am getting 20% return. From investment number 2, I am getting 30% return. And from investment number 3, I am getting 25% rate of return. Now my question is, for my whole portfolio, that means for my whole amount of investment in all these investments, what is my average rate of return? That's what I want to calculate. In such a case, I cannot simply take the simple average of all these 3 returns. I should assign weights here, not probabilities, it is weights. That means what are the proportions of investments in each of these given investments? How much proportion of money have been invested in investment 1 and investment 2 and investment 3? You need to take the data, multiply such proportions with these returns. Say for example, I have invested 1 lakh rupees totally. Out of this 1 lakh, I have invested 30,000 in investment 1 and 20,000 in investment 2 and 50,000 in investment 3. So have you observed one thing here? Out of 1 lakh, 30,000 investment 1, 20,000 investment 2, 50,000 investment 3. So if you take the weights here, out of 1 lakh, 30,000 means it is 30%. That means 0.3 actually. The weight is 0.3. I can take 0.3 weight. This is my weight. And from 1 lakh rupees, I have invested 20,000 in investment 2. So that weight is 0.2, 20,000 by 1 lakh. And here it is, in investment 3, I have invested 50,000 rupees. That means 0.5. So instead of taking simple average, multiply these weights with the respective returns and sum up these numbers. The total will be the expected return from the portfolio, ERP. The expected return from the portfolio or return from the portfolio. Okay. So how to calculate return from the portfolio? Identify the proportion of investment in each of the securities or each of the investment. Such proportions are also known as weights. Multiply such proportions or weights with the respective investment return and sum up all the numbers. That means the proportion into return, the column should be added. That means that you should get the total of all these numbers. The total will be your return from the portfolio or expected return from the portfolio. So they have given you one formula here by taking 2 securities into the portfolio. Say for example, if you have 2 securities in the portfolio, they have given you one formula. I am not taking this formula. Let me take my own formula for calculating expected return from the portfolio. The expected return from the portfolio, if your portfolio consists of 2 securities, WA into ERA plus WB into ERB. WA means the proportion of investment in security A. ERA means expected return from security A. WB means proportion of investment in security B. ERB means expected return from security B. This is a simple way of understanding. Expected return from the portfolio when your portfolio comprises of two securities. If your portfolio consists of more than two securities, then they have given you one formula. Simple. The weights will be increased and the returns will be increased. Simple. That's what the next formula actually. Yes, here is the formula. Expected return from the portfolio when the portfolio consists of more than one security. Summation of WN ERN. That means I can simply write WA into expected return on A plus WB into expected return on B plus WC into expected return on C. Like that it goes on. Okay. If your portfolio consists of 100 securities, then you'll get 100 terms. Sum up all those returns by multiplying the respective weights, then you'll get expected return from the portfolio. It's a simple way of understanding. Multiply the weights with the returns plus weights into returns, weight into return, weight into return. Like that, if you apply for all the securities, the sum will be expected return from the portfolio. It can be calculated in the tabular form also. Tabular form also you can calculate. So let us apply the formula from the above for the above example. Calculation of expected return from the portfolio. The columns will be security, proportion of investment, nothing but weight, proportion or weight, return, nothing but expected return, proportion into return or expected return. Okay. What are the securities we have taken? 3 investments if I am not wrong. Investment 1, 2, 3. Security 1, 2, 3. So what are the proportions we have calculated? 0.3, 0.2, 0.5. Multiply the proportions with the returns. Okay. 20, 30, 25. So 0.3 into 20, 6, 0.2 into 30, 6, 0.5 into 25, 12.5, 24.5. This is my expected return from the portfolio, above portfolio. The portfolio which comprises of 3 securities. Okay. Like this, like that in tabular form also I can calculate expected return from the portfolio. If you don't like this, you can apply the formula. Simply weights into returns plus weights into returns. Like that, if you can apply, you can get expected return from the portfolio. Okay. Yes. Hi dear students, good evening all of you. In the last session, we understood the term return under the chapter risk and return. Now we are entering into the next area called risk. What is the exact meaning of the term risk? Risk means deviation from expectation. In our context, deviation from our expected return from one of the company shares. Say for example, I am expecting a return of 20% from X Limited share. Are you 100% sure that you are going to earn this 20% return? No. My actual return may deviate from this expected return. So whatever the deviation that you are expecting from your expected return is nothing but risk. Say for example, either I'll get some extra 10% return, that means my actual return can be 30%, or the actual return can be reduced by 10% return, that means my actual return can be 10% after deducting 10% reduction. That means my actual return can be 10% more or 10% less from my expected return. This could be the possibility of deviation from my expected return of 20%. See, whatever the deviation you are talking about, such deviation of 10% either in upward trend or in downward trend is nothing but risk. So this is a simple way of understanding. So when you are expecting some return from one of the company share or from one of the investment, if there is a scope for deviation from your expected return, such deviation is simply known as risk. Now, this is a simple way of understanding. Now, this risk is analyzed into different terms actually. Look at this chart. The risk is simply classified into two parts: systematic risk and unsystematic risk. Sir, what is the meaning of the term systematic risk and unsystematic risk? See, if you can manage a portion of risk, then that is known as unsystematic, which is firm specific. If you cannot manage a portion of risk, then that is known as systematic risk. That means you cannot eliminate this portion of risk. Systematic risk is being influenced by external factors that one cannot manage. But every investor can manage unsystematic risk because this is firm specific. So now under systematic risk, the external factors that could affect your investment return or market risk. This is first risk, market risk. So when there is a deviation from market risk, when there is a deviation from the return of market, then automatically your security return will deviate. Second one is interest rate risk. See, interest rate risk means when there are fluctuations in the interest rate in the market, then there is a scope for deviation from your expected return. Purchasing power risk, nothing but inflation risk. If the inflation is changing, then automatically that affects your actual return. So these are the three risks. Systematic risks are nothing but the risk which causes because of external factors like market risk, which is generally it is going to influence every company in the world or every company in India. And then interest rate risk, nothing but the fluctuations in the interest rate. And the third one is purchasing power risk, nothing but inflation risk. So these are the external factors that nobody can eliminate this portion of risk. That's why systematic risk is also known as non-diversifiable risk. That means which is unavoidable. Okay. Then the second part is unsystematic risk. So what is this unsystematic risk? What is this unsystematic risk? The unsystematic risk is nothing but firm specific risk, business risk. See, the nature, this risk is purely dependent on the nature of the project that you're handling. Financial risk. Financial risk means the risk which arises because of debt financing. This is purely based on your capital structure decisions. Default risk. This risk is purely related to bankruptcy and insolvency risks. That means when you are not able to meet your obligations like repayment of debt and repayment of principal related to preference share capital or any payments related to current liabilities. If you are not able to meet your long-term and short-term obligations, then so whatever the costs that you are incurring related to bankruptcy and insolvency, then such risk is simply known as default risk. See, this is all descriptive part. So if you ask me regarding the problematic part, so we should understand important terms, nothing but application of statistics. Okay. So now I'm going to measure the risk. See, just now we understood the term risk. Risk means deviation from expectation. Such deviation can be measured with a statistical measure called standard deviation. So I can say standard deviation is a measure of risk, which is denoted with sigma. Standard deviation is a measure of risk. We have a formula for this standard deviation. Standard deviation sigma is equal to square root of summation probability into x minus x bar whole square. This is what the formula for standard deviation. So what is the exact formula for standard deviation? Standard deviation is equal to square root of summation probability into x minus x bar whole square. So where P is equal to probability, X is equal to the return for different probability distributions. X bar is nothing but mean return, nothing but this is the average return. So by using this formula, I can calculate standard deviation. So what is the formula for standard deviation? You just remember the formula. When we are applying this formula to the problem, you can understand how you can use this formula. So standard deviation sigma is equal to square root of summation probability into x minus x bar whole square. P is probability, x is return, x bar is mean return. Yes. Okay. Now we have another formula called variance. See. Sir, what is the meaning of the term variance? Variance is nothing but standard deviation square. Variance is equal to SD square, or I can say sigma square. Okay, this is nothing but sigma square, standard deviation square. This is what variance. So you just remember the formula, that's it, nothing new. Okay, so standard deviation is equal to square root of summation probability into x minus x bar whole square. Variance is equal to standard deviation square. Okay, yes. We have one more formula called coefficient of variation. Coefficient of variation. This is a relative measure. This is nothing but standard deviation divided by expected return. This is a formula for coefficient of variation. So what is the formula for coefficient of variation? Standard deviation sigma divided by expected return. See, the standard deviation represents risk. Say for example, if we get an answer of 10% standard deviation. So just now we understood expected return is 20%. Now just now I got standard deviation of the securities return is 10%. So what is this 10%? Simple. There is a deviation of 10% from my expected return, either in upward direction or in downward trend. So either it could be upward potential or downward risk. So what exactly it means? Actual return is equal to expected return plus 10%, or actual return is equal to expected return minus 10%. Under adverse conditions, your return will be reduced by 10%. Under favorable conditions, your return can be increased by 10%. So the point is very clear. The standard deviation can be in upward trend or in downward trend from your expected return. This need not be in downward trend only. Risk doesn't mean that you're always getting negative factor. Risk means either you can get abnormal positive return or you're going to face abnormal loss, okay, from your expected return. That's what the standard deviation. So what is the meaning of the term standard deviation? Deviation from my expectation. So if I got 10% standard deviation, then there is a scope for 10% deviation from my expected return, either in upward direction or in downward trend. Okay. Now what is the next term? Coefficient of variation. Standard deviation is an absolute measure, whereas coefficient of variation is a relative measure. So what it means? This is also one of the measure of risk, but in a different situation. You are going to apply this formula. Standard deviation, if the standard deviation is 20% and my just now we understood, if the standard deviation is 10% with an expected return of 20%, so it results in 10 by 20. 10 by 20 means 0.5. So what is the meaning of the term? What is the meaning of this number 0.5? 0.5 by 1. That means for every 1% of expected return, there is a scope for deviation of 0.5%. So in simple words, coefficient of variation, standard deviation both are same, but coefficient of variation measures risk per unit of return. So for every 1 unit of return, what is the scope for deviation from our 1 unit of return? From 1 unit of return, how much return can be deviated? That's what coefficient of variation. Here, for every 1% of expected return, my return can be deviated by 0.5%. So in simple terms, coefficient of variation means risk per unit of return. This is a simple way of understanding. So what is the formula for standard deviation? Square root of summation probability into x minus x bar whole square. And I need to explain this application of the standard deviation to the problem. And P is probability, x is written, x bar is mean return. Whereas coefficient of variation is standard deviation divided by expected return. Yes. Now, what is the next formula? I need to understand one important formula called beta. The term beta. See, this beta is dependent on two important factors. The standard deviation of security and market and the correlation between security and market. Standard deviation of security and market means sigma S and sigma M. Correlation between security and market means R of SM. Don't bother about these new terms. And if you can apply the formula, you can easily get the answer. Okay. So that's not an issue actually. Just remember these terms. That's it. Okay. Beta is dependent on two important factors called sigma S and sigma M. That means standard deviation of security and market portfolio. And the second term is the correlation between security and market. So we have some formulas related to beta. First of all. So what is the exact meaning of the term beta? Beta measures the sensitivity relationship between security return and market return. If the market deviates by 1%, how much percentage of return of the security can be deviated? So that relationship can be established with the term beta. And for such beta, I am trying to give you one formula. And such formula is dependent on these factors. Standard deviation of the security and market and correlation between security and market. Yes. So before writing the formula, if your beta is equal to 2, which means for every 1% deviation in the market portfolio's return. Say for example, see in India, Sensex and Nifty are the best representatives of market portfolios because top class securities will be considered under Sensex and Nifty. So such portfolio, Sensex and Nifty, as a market portfolio which is a representative of BSE and NSE. So if you consider the return of those portfolios, market portfolios, there is a scope for deviation. So if such market portfolio return deviates by 1%, then your security return will be deviated by 2%. That's what beta is all about. So if beta is equal to 2, see beta will be generally calculated for a security. If your security means your share. So if your one of the company's share beta is 2, which means if market portfolio return deviates by 1%, then your security return will be deviated by 2%. That means your security risk is twice of market portfolio's risk. So that's what the understanding. So we are just trying to establish the relationship between market portfolio and security. Now this beta can be calculated by using these formulas. Beta is equal to covariance of security and market divided by variance of market portfolio. This is what beta. And then beta is equal to sigma s by sigma m into R of Sm. This is one more formula for beta. So what are the formulas for beta? Covariance of security and market divided by variance of market. And the second formula is sigma s by sigma m into R of Sm. These are the two formulas for beta. Yes, we understood. Now, we have one more formula in the study material that you need to remember. Look at the formula. covariance of security and market is equal to, and this one, covariance of security and market is equal to correlation between security and market into sigma s into sigma m. This is the formula for covariance between security and market. This formula also you need to remember. Okay. Yes. So with this we understood the formulas of beta. Now they have given you one table. If the values of beta are in different ranges, generally your beta can be more than 1, less than 1 or equal to 1. Sometimes it can be negative also, sometimes it can be 0 also. So 0 and negative are the two abnormal numbers, but for most of the securities the beta ranges between like less than 1, more than 1 and equal to 1. Okay, less than 1 means your beta can be 0.8, 0.5, 0.7 like that. More than 1 means 1.5 to 2.5 like that maximum. You don't get a beta of 30, 40 times. Okay. So let us consider the numbers. If your beta is less than 1, that means your security is less riskier than market portfolio. If your beta is equal to 1, that means the market portfolio's risk and your security's risk both are same. It is known as normal beta security. Okay. So just now we understood. When security beta is equal to 1, then if market moves up by 10%, then security will move up by 10%. That means the same deviation. Okay. If market fell by 10%, then security also tends to fall by 10%. The same deviation if your beta is equal to 1. If your beta is more than 1, what it exactly means? More than 1 means your security is much riskier than market portfolio. And which is generally known as, if your securities beta is more than 1, then such security is generally known as aggressive security or high beta security. Aggressive security, it is deviating more. Okay. So a security beta 2 will tend to move twice as much as the market. If your market went up by 10%, then your security tends to rise by 20%. That means the risk of the security is twice of market portfolio's risk. If market fall by 10%, then your security fall by 20%, 2 times. So these three numbers, less than 1, equal to 1, more than 1, these are the regular numbers. Whereas this 0 and less than 0 are the two abnormal numbers. Less than 0 means negative beta. Negative beta means when market is moving in the upward direction, but your security return will go move in the downward direction. That means, say for example, if beta is equal to some minus 1, if the market deviates by 1%, that means if market is moving up by 10% return, then your security return will be deviated in the downward direction. That means if market return is increased by 1%, then your security return will be decreased by 1%. If your market return is decreased by 1%, then your security return will be increased by 1%. Just like that. Okay. Negative beta means this market movement and your security movements are in the opposite direction. Generally, it won't happen for most of the securities. In very rare cases, the security and market will move in the opposite direction. That is a case of negative beta. Okay. Now equal to 0. Equal to 0 means there is no systematic risk at all, because beta is a measure of systematic risk. If your beta is equal to 0, which means there is no systematic risk. Generally, if your beta is equal to 0, that means that's a clear case of risk-free security. Only for risk-free securities, the beta will be equal to 0. Yes. The next one is capital asset pricing model, which is covered in the chapter cost of capital. This is going to be covered in cost of capital chapter, but still I'm going to give you the formula for CAPM. Under CAPM, what is the formula for cost of equity or expected return? See, for calculating the return from the equity share, I can use CAPM formula. Expected return means the expected return from the equity share. Formula is RF plus beta into RM minus RF, where RF is risk-free return, generally the return that you can earn from risk-free asset. The best examples of risk-free asset in India, Indian treasury bills. Beta is systematic risk factor, which is a sensitivity relationship between security and market portfolio. RM means average market return or return on market portfolio. Just now we have considered the example Sensex and Nifty. So whatever the average return that you can earn from the top 30 securities in the Sensex or top 50 securities in the Nifty, then that is known as average market return or return on market portfolio. RM minus RF is market risk premium. RM minus RF is market risk premium. So this is the formula of expected return under CAPM. Just remember the formula, that's more than enough. Yes. So these are the formulas covered. So all the formulas were covered under this chapter, risk and return. Now we can handle one or two sums to understand this risk and return. By that, this chapter will be over. Okay. Yes. Okay, dear students. Now, if you look at illustration number 13, you can understand the expected rate of return, variance and standard deviation at a stretch. X Limited has forecasted returns on its share with the following probability distribution. They have given you the returns with their respective probability distribution. Say there is a 5% chance of probability to get a return of minus 20%. To get a return of minus 10%, there is a chance of 5% probability. Like that, they have given you one probability distribution. Find out the following: the expected rate of return, variance and standard deviation. Yes. So the same formula that I am going to apply, but with the help of a table. So this is a calculation that I need to do for illustration number 13. Calculation of expected rate of return, variance and standard deviation. The standard columns are return, probability, return into probability, deviation, x minus x bar, deviation square, x minus x bar whole square. Okay. So write the returns order wise, which is given in the problem, just like this, and then write the probabilities. So multiply the return with the probability. So if I consider minus 20 into 0.05, I got minus 1%. Like that, multiply returns with the probabilities, and sum of those numbers, return into probability column total will be your mean return x bar, expected return. This is a first requirement, expected return. How to get expected return? Multiply return with probability. The total will be expected return x bar. The next one is deviation, x minus x bar. See, this return is nothing but x. Minus x bar means expected return. So minus 20 minus 11, I'll get minus 31. Minus 10 minus 11, minus 21. Like that, you have to calculate deviation, which is nothing but x minus x bar. Okay. After getting deviation numbers, square it, apply square. Then the term will be x minus x bar whole square, nothing but deviation square. Say for example, minus 31 whole square, 961. Any minus or plus symbols will be eliminated by applying square. So I'll get only positive numbers. So these are the deviation square numbers. The sum. So after getting deviation square numbers, then please multiply d square with probability. Multiply d square with probability. I'll get pd square. So say for example, 961 into 0.05, I'll get 48.05. Like that, multiply the probability with the deviation square. So the sum will be summation pd square. This summation pd square can be written as summation p into x minus x bar whole square. This is nothing but variance, dear students. This is nothing but variance. That's what I've written here, variance. So my variance is 150. So if you can apply square root to variance, then you'll get standard deviation, because I told you already standard deviation, the variance is equal to standard deviation square. Variance is equal to standard deviation square. Nothing but standard. So if you can apply square root to variance, then I'll get standard deviation. In simple terms, this is nothing but variance, apply square root to this, then you'll get standard deviation, or else you can apply formula also. So I got variance of 150, square root of variance 150, square root of 150, I got 12.24%. This is my standard deviation. So you are expecting a return of 11%. From 11%, either you'll get extra 12.24%, or your return can be reduced by minus 12.24%, upward potential and downward risk. So with this we understood expected return, standard deviation and variance terms. Okay. Now the next requirement is to calculate beta. Look at 15th problem. From the following data, compute beta of security X. So they have given you a few terms here. Sigma X, sigma M, R of XM. Sigma X by sigma M into R of SM. That's what the formula for beta. 12 by 9 into 0.72. That's a simple application actually, dear students. So let me show you the solution for that problem. Illustration number 15, sigma s by sigma m into r of sm, 12 by 9 into 0.72. So I got a beta of 0.9599 or 0.96. Say, I told you already, it's a simple application. So just substitute the numbers, calculate it, you'll get beta. Okay. Logics and all, the conceptual understanding, the deep explanation, all these parts will be covered in the chapter called Portfolio Management at CMA Final SFM subject. Okay. I'll discuss there actually. Okay. This is regarding illustration number 15. Now, look at this term. For problem number 14, look at this term, 14th problem. Consider two securities A and B whose normal probability distribution over 1 year returns have the following characteristics. Security A, expected return 8%, standard deviation 6%, coefficient of variation 0.75. Just check it. So what is the formula for coefficient of variation? Standard deviation by expected return. So 6 by 8. So I got 0.75. Similarly for security B, it is 0.33. So which security is having highest amount of risk? Security A, because the risk per unit of return, coefficient of variation is more. Comment on the above information. So which one you're going to prefer? I'll prefer security B, because for 1% of return that I'm earning, that is a deviation of 0.33% only. That's what coefficient of variation. So generally we are going to select the security with least coefficient of variation, just like standard deviation. So I'll select the security with least standard deviation. In the similar way, I'm going to select the security with least coefficient of variation. Okay. So that's regarding coefficient of variation. Now, I need to give you another formula for standard deviation. Sir, what is the formula for standard deviation? For probability distribution, the formula is square root of summation probability into x minus x bar whole square. We have another formula for standard deviation in case of simple average. The formula is square root of 1 by n minus 1 into summation x minus x bar whole square. This is another formula for calculating standard deviation. Just write it and apply if required. Okay. Square root of 1 by n minus 1 into summation x minus x bar whole square. This is a formula you need to remember. See, generally in regular scenario, we have to use 1 by n into summation x minus x bar whole square. But in CMA materials, everywhere, even in final also, they are using n minus 1 actually instead of n. Okay. Just remember this formula. With this, we understood the topic risk and return. Thank you. Hi dear students, yes, we have completed the chapter risk and return in the previous session. Now we are entering into the next area called capital busting. This is the 5th chapter in your study material. Yes, the name of this chapter is also known as investment decisions. So the other name is investment decisions. Okay, we have 3 types of decisions. If you remember, financing decision, investment decision and dividend decisions. Financing decision means how we are raising the capital. Dividend decisions means how much dividend should be distributed to the equity shareholder. Now we are talking about investment decisions. Investment decisions means how you are utilizing the fund which you have raised through equity and debt. Actually, after raising the fund, you should invest the fund in the projects or business. So the ultimate objective of this chapter is effective utilization of fund, nothing but selection of the best projects in the market in such a way that the shareholders' wealth should be maximized, their profit should be maximized, their wealth should be maximized and the risk should be minimized. This is the objective of this chapter, capital busting. So this is the essence of this chapter. So in this chapter, what we need to do? See, look at these things actually. These are the capital busting decisions we need to take. expansion decisions, nothing but business expansion, selecting the new projects, expanding the existing business or selecting the new projects. Selection of new projects means diversification. Expansion means existing business expansion. Diversification means selection of the new projects. And sometimes I'll go for replacement of the existing assets. And the next one is buy or lease and research and development. See, in most of the cases, in the problematic session, I always deal with these three areas only because we don't have any problems related to buy or lease and research and development. Okay. Yes. Now, so what to do? Actually, in this chapter, we have to take investment decisions, nothing but selection of the project. Whether a project should be selected or rejected can be decided by using several capital busting techniques. So before understanding such capital busting techniques, first I should define the costs and benefits associated with the projects that you're going to select. So in this particular chapter, capital busting or investment decisions, we are going to evaluate several projects or business alternatives. Nothing but we have to define the benefits and costs associated with that particular business alternative or project. So technically speaking, we will always use the word project for evaluation purpose. So we have to define benefits and costs of every project. Benefits are simply known as cash inflows, and I mean just now you can see here cash flows. Cash flows means, the cash flows are classified into two types. One is cash inflows, other one is cash outflows in simple terms. Now, dear students, we have to do cost benefit analysis. What we need to do? Cost benefit analysis. So what is the meaning of the term cost and benefit? Cost means cash inflows. Cost means cash outflow. Benefit means cash inflow. So benefits are denoted with cash inflows and costs are denoted with cash outflows. And we should do cost benefit analysis. Nothing but for every project that you're going to select, we should define the costs and benefits, then apply capital busting techniques. So by using capital busting techniques, we can select the projects properly and so that we can maximize the return of the equity shareholders. So if your investment decisions are much more productive and effective, if you want to make your investment decisions much more productive and effective, you must apply several capital busting techniques. Before applying such capital busting techniques, first I must understand what are the cash inflows and what are the cash outflows. That is the first part of this chapter. Okay, let me show you what are the costs and benefits associated with every business or every project, which is nothing but cost benefit. Defining the costs and benefits associated with the project, nothing but defining the cash inflows and outflows of every project. Yes, I'm going to give you 4 steps to understand the costs and benefits, nothing but cash outflows and inflows. Step number 1. My first job is how much money I'm investing in the project, nothing but cash outflows, calculation of cash outflows. See, in every project, I'll invest in 2 areas. One is investment in fixed assets. Second one is investment in working capital. This is my first part of investment. Because without having fixed assets and working capital, I cannot run any business. So I should invest in fixed assets along with working capital. This is my first investment. And in step number 2, I should calculate depreciation. Calculation of depreciation. This is my second step. Depreciation can be calculated either under SLM method or under WDV method. It depends based on the information which is available in the problem. And in step number 3, I must define annual cash inflows related to the project. Because when I am investing huge money in the fixed assets and working capital, what I can do? Annually, I can produce some products. So when such products can be sold out, and from that I can get sales. So I should recover the revenue expenditure. Then I'll get some profits, and from such profits I should recover my investment. Then along with that, I should also calculate cash inflows. So in step number 3, I have to calculate operating cash inflows. Calculation of operating cash inflows. This is step number 3. Sir, how to calculate operating cash inflows? I'll show you. Particulars, year 1 to n, because for the whole life of the project I'm going to get these cash flows. First, you should write the benefit, which is sales. Every year I'm going to get sales. From that, I should deduct the total cost. See, this total cost can be given in different forms. Like, I can write variable cost and fixed cost. This is the first way of giving the expenses. Variable cost and fixed cost. In our context, fixed cost means cash fixed cost. So your total cost can be given in the form of variable cost and cash fixed cost. So if you deduct these two expenses, variable and cash fixed cost, then immediately I'll get PBDT, profit before depreciation and tax. And from this, please deduct the investment portion, which is known as depreciation. Then you'll get profit before tax. Then deduct income tax from it. Then you'll get profit after tax. Add depreciation to it to get CFAT. So CFAT is also known as cash flows after tax. This is cash flows after tax. Cash flows after tax. This is also known as operating cash inflows. Already I have written that name in the heading itself. So this is a way to calculate CFAT or operating cash inflows. Sales minus total cost, variable cost and cash fixed cost. PBDT, profit before depreciation and tax. See, by deducting variable cost and cash fixed cost, I have recovered my revenue expenditure. And after that, I am deducting depreciation. Depreciation means part of fixed assets. So that means you are recovering your capital expenditure from PBDT. After recovering revenue expenditure and capital expenditure, then I'll get profit. But that is before paying income tax. This is PBT. Then from that, please pay your income tax. Then I'll get profit after tax. Then add back depreciation. So why you are adding depreciation? Because depreciation is a non-cash expenditure. So we have deducted such depreciation just to know the taxable profit. So since we have already calculated income tax, so you should add back depreciation. A simple reason why you are adding depreciation, because depreciation is a non-cash expenditure. I have deducted it and then I'll add back after tax. So simply speaking, depreciation is a before tax deduction and after tax addition, and that's what you need to remember. So that I got cash flows after tax. You know, my dear students, this cash flow is loaded with two components. You should remember that. Why? Because cash flow means this is not a profit. There is a lot of difference between profit after tax and cash flows after tax. Profit after tax is the term which is representing profit. Cash flows after tax is not a profit. This is profit plus my investment actually. Profit plus investment. Sir, how it is an investment? Because have you observed one thing? I have added depreciation. Adding depreciation means I'm recovering my investment. Nothing but I'm recovering my part of the investment. So this portion of depreciation is nothing but your investment recovery. So this cash flows after tax is loaded with two important components called, one is my profit, the other one is my investment. So there is a lot of difference between these two terms, profit after tax and CFAT. Profit after tax is pure profit that from that you cannot recover your investment. Cash flows after tax is a larger number that is covering profit along with your investment. So the only term which is able to cover your investment along with profit is CFAT, whereas profit after tax is a pure profit. That's what you need to remember. So this is regarding step number 3. And in step number 4, I should define terminal cash inflow. After completing the project, I'm going to get my terminal cash flow. So that means whatever I have invested in year 0 in step number 1, that will be recovered. That will be recovered fully or partially at the end of the project life. So how I can recover my investment? Let me show you. Calculation of terminal cash inflow. Calculation of terminal cash inflow. There are two components in terminal cash inflow. One is the asset recovery, fixed asset recovery. Nothing but since we have used fixed assets for the whole life of the project, what will happen? I'll get salvage value. So the first part of the terminal cash inflow is salvage value of the fixed assets. salvage value. But the problem is, at the time of selling fixed asset, I must pay capital gain tax if there is a difference between sale value and book value. If it results in capital gain, I should pay capital gain tax. If it results in capital loss, I'll get tax shield, nothing but tax saving on capital loss. So there is a lot of difference. Let me show you the format to calculate the net sale proceeds. Gross sale proceeds, by selling fixed assets, I'll get gross sale proceeds. From that, please deduct your book value of the fixed asset. Deduct book value of the fixed asset. Identify whether this number results in capital gain or capital loss. If it is a capital gain, pay income tax, which is nothing but capital gain tax. If it is a capital loss, please enjoy tax shield. You will get some tax saving. Okay. So this results in capital gain or capital loss. If it is a capital gain, please pay capital gain tax. Capital gain tax. Capital gain tax. If it is a capital loss, you can enjoy tax shield on it. Tax shield on it. So what is the case here? Capital gain tax is an outflow, whereas tax shield is an inflow. Okay. This is capital gain tax, whereas tax shield is an inflow. Anything can happen. So what I should do? Let me write A, gross sale process, B, capital gain tax, C, tax shield. See, anything can happen, only you cannot get, you don't need to pay capital gain tax, and also you can enjoy tax shield. Anything, only one thing can happen. So if it is a capital gain tax, please deduct it from gross sale process to get net sale process. Nothing but A minus B. A minus B. If it is a capital loss, I can enjoy tax shield. There is a difference between capital gain tax and tax shield. Capital gain tax is a tax outflow, whereas tax shield is a cash inflow. If it is a capital gain tax, please deduct it from gross sale process, A minus B. If it is a tax shield, nothing but capital loss results in tax shield, that should be added back to gross sale process to arrive net sale process, A plus C. Okay. Tax shield should be added to gross sale process to arrive net sale process. Capital gain tax should be deducted from gross sale process to arrive net sale process. Only one thing can happen, because either I may get a capital gain or I may suffer capital loss. So if it is a capital gain, you should pay capital gain tax, should be deducted from gross sale process. If it is a capital loss, you can enjoy tax shield, that should be added to gross sale process. Along with that, whatever the money you have invested in working capital, that will be fully realized at the end of the project life. That's what realization of working capital. Realization of working capital. Working capital will be fully realized at the end of the project life. Depreciation is not applicable to working capital investment. This is my terminal cash inflow, TCI. So these are the steps, my dear students, for calculating terminal cash inflow. So now let me show you one thing here. In your study material, they have given you one format for calculating operating cash inflows. Please look at this. Net sales revenue, nothing but sales less sales returns, less cost of goods sold, less general expenses other than interest. So cost of goods sold plus general expenses total gives you total cost. That means the total cost can be given in any form, like COGS plus general expenses, COGS plus fixed cost plus selling and distribution expenses, COGS plus fixed cost plus administration expenses. Like that, they can give you in different forms. The revenue expenditure that is supposed to be deducted from revenue can be deducted in, can be given in any form. So they have given you this form, cost of goods sold and general expenses, whereas I have written what, variable cost and cash fixed cost. In any way, that can be in any form, that should be deducted from revenue to get PBDT. See, in this format, they have deducted depreciation also. So straight away what I'll get, EBIT. Actually, we have never considered interest. You know one thing, for calculating CFAT for investment decisions, generally I don't deduct interest. Generally I don't deduct interest. And I don't need to mention it. So have you observed one thing? In our statement, I've never mentioned interest component here because I don't need to deduct it. Whereas in your study material, they've clearly mentioned EBIT, but they have not deducted it. Have you observed that? EBIT less tax. Instead of deducting interest, they have deducted tax directly. So what will happen? Nothing will happen. They are not considering interest, because interest should not be deducted, because the projects are analyzed from long-term investors point of view, long-term investors includes equity and debt holders. So I'm not analyzing this project only from shareholders point of view. I'm analyzing this project from complete long-term investors including long-term debt. That means bank loans and debentures. So that's why we will never deduct interest component for calculating CFAD in capital budgeting decisions. That's what you need to remember. So less income tax, I got profit after tax, then add depreciation, net cash flows after tax. The same format, but the names were changed here. Okay, and then I can also calculate cash flows after tax from profit of from this formula. CFAT is equal to EBIT into 1 minus tax rate plus depreciation. You please remember this formula. CFAT is equal to EBIT into 1 minus tax rate plus depreciation. Nothing but EBIT means EBD because I don't deduct interest. Into 1 minus tax rate means I'll get profit after tax. Add depreciation, I'll get CFAT. In case if profit after tax is taken from your accounting records. So in accounting records, generally we will deduct the interest component. That means I can enjoy some tax saving also. So if the profit after tax is taken from accounting records, and after calculating profit after tax, generally in accounting records they'll deduct interest and they'll also enjoy tax saving on interest. So because of this reason, your CFAT computation will be completely changed. Have a look at this. PAT plus depreciation, they've added depreciation and they've added interest also. So why they've added interest? Because already they've deducted interest in profit and loss account. Okay. So while adding interest, they've adjusted one tax saving on interest. So the formula is interest amount into 1 minus tax rate. This is a formula. Okay. Remember that. Interest amount into 1 minus tax rate. So if it is taken from accounting records only. So why you have deducted tax saving here? Because by deducting interest in P&L account, obviously we are enjoying tax saving on interest. So what are the tax saving which we have already enjoyed, that should be adjusted here. So logic aside, so logic apart, simply you just focus on the formula only. So if the profit after tax is taken from accounting records, what is the formula? You please write profit after tax plus depreciation plus interest amount into 1 minus tax rate, then I'll get net cash flows after tax. See, this formula will never use in any problem. In most of the problems, 99.99%, in most of the problems, 100 out of 100 problems will be solved by using this previous format only. I will never use the second format. You better remember the first format only, that's my suggestion. Okay. Now, already they have given you terminal cash flow. No, no new points are covered there actually. So all the points are completely covered. Now we understood how to define cash flows. Now let us go for the capital budgeting techniques straight away. These are the important techniques. So the capital budgeting techniques are classified into two parts: traditional and non-discounting techniques, and discounting or modern techniques or time adjusted techniques. Traditional techniques are non-discounted cash flows techniques. Discounted cash flow techniques are time adjusted techniques. These are also known as modern techniques actually. Modern techniques. Okay. Modern techniques. Now, what are the traditional or non-discounted cash flow techniques? Look at the names: payback period reciprocal, payback profitability. Payback profitability is not a capital budgeting technique actually. You just need to calculate profitability after payback period. Average or accounting rate of return. Predominantly speaking, there are only three techniques: payback period reciprocal, average rate of return. If you ask me, there are only two techniques in fact: payback period and ARR. Even payback period reciprocal, which is derived from payback period only. You don't need to learn new things actually. So if you ask me, what are the two important capital budgeting techniques that I need to cover under traditional methods or non-discounted cash flows methods or techniques? Simple. There are only two techniques: payback period, ARR, average rate of return or accounting rate of return. Coming to discounted cash flows or time adjusted techniques, we have several techniques here: net present value, profitability index, internal rate of return, discounted payback period, modified NPV, modified ARR, adjusted present value. All the techniques are clearly given here. Every technique is important, and among these techniques, the very famous techniques are first four actually. Okay. First four: net present value, profitability index, internal rate of return, discounted payback period. The remaining techniques are the derived techniques from the previous techniques. Okay. Yes. Now let us understand one by one, and we will start with the first category of techniques called non-discounted cash flow techniques. Okay, yes, the first one is payback period. Payback period. So what is the meaning of the term payback period? Payback period is a capital busting technique that will calculate the time period within which we can recover our investment. Payback, the term itself is saying what? Payback. Who will pay back? The project. The project will pay back to you because you have invested the money in year 0, that will be paid back by the project to you in how many years? Nothing but the period within which I can recover my investment from the project. So payback means from project's perspective it is paying back to you. So in how many years? Nothing but the period within which I can recover my investment is nothing but payback period. So what is a payback period? It is a time period by which I can recover my investment from the project's cash inflows. So if you see, I'll give you one example to understand it. Understand this. A simple example. A project with a life of 5 years I'm taking here. And I have invested a money of 1 lakh rupees here. So from the future 5 years, I'm going to get 50,000 cash inflow for the whole life of the project. Every year I'm getting 50,000 cash inflow. Now within how many years I can recover my investment of 1 lakh? The timeline is clearly saying within 2 years you can recover your investment. Why? Because 50,000 plus 50,000 is equal to 1 lakh, 100,000. Nothing but I am recovering my investment from this project within 2 years. So my payback period is simply 2 years. So this is a clear problem to understand payback period. So payback period means it is a time period by which I can recover my investment from the future cash inflows. So why you are not taking profits here for recovering investment, and why you are taking only cash inflows? You know one thing, dear students, profits cannot recover your investment. Only cash flows can recover your investment, because cash flows are loaded with two important components called investment and profit. So both of such terms can recover your investment, but not profit only. Okay, that's why for calculating payback period for recovering my investment, nothing but investment recovery period, I will always take cash flows after tax, nothing but operating cash inflows, but I'll never take what? Profit after tax. So profit after tax should not be considered here, a red mark. Profit after tax should not be considered for calculating payback period. You must consider CFAT only. So what is the appropriate term here? CFAT. This is the right term for calculating payback period. Yes. Now for calculating payback period, we have two techniques. We have two situations. Under two situations, the payback period calculation will be completely changed. It is based on the nature of cash flows. If the cash flows are equal, the first case. If the cash flows are unequal, see, if the cash flows are equal, calculating payback period is an easiest task actually. Payback period is equal to initial investment divided by annual cash inflows. This is the formula for payback period if the cash flows are equal. Annual cash inflows. If the cash flows are unequal, I must calculate payback period proportionately. How to calculate payback period. See, this is given wrongly in your study material. Look at the formula for payback period. When the cash flows are uniform, nothing but equal, they have given you payback period is equal to annual cash inflows by initial investment. That's the wrong formula. The formula is initial investment by annual cash inflows. You please correct it. Sorry. Okay. If the cash flows are not uniform, proportionately I have to calculate payback period. I'll give you one example to understand this unequal cash flow situation. See, my investment is 1 lakh. The project life is 5 years with a cash flows pattern like this. The first year investment recovery is 40,000, second year 40,000, third year 30,000, fourth year 25,000, fifth year 45,000. This is the cash flows pattern here. Now I want to recover my investment. I want to calculate payback period. I need to recover 1 lakh rupees investment from the future cash flows. If you see here, by the end of third year, I can recover my investment. But I don't need to wait till the end of third year. Why? Because I just need only 1 lakh rupees. So in this case, payback period should be calculated like this. First of all, you should accumulate the cash flows. So you have to write like this: cumulative cash flows. Cumulative cash flows. Write the cumulative cash flows. 40,000, 40 plus 40, 80,000, 80 plus 30, 1,10,000, 1,10,000 plus 25,000, I'll get 1,35,000, and 1,35,000 plus 45,000, 1,80,000. Now look at the numbers. My requirement is 1 lakh. By the end of first year, I'm not recovering my investment. By the end of second year, no. By the end of third year, I can recover my investment, but there is an excess recovery. I just need only 1 lakh, whereas by the end of third year, I'm getting 1,10,000. So my payback period is in between second and third year. So here you should write like this: investment covered by the end of second year. Investment covered by the end of year 2 is equal to 80,000. So how much balance is required actually? Balance of investment to be recovered. Balance of investment to be recovered. Actually I need 1 lakh. Already by the end of second year, 80,000 has been recovered. So the balance of investment to be recovered is 20,000. But for third year, I'm getting 30,000 cash inflow. But my requirement is just 20,000. So for 1 year period, nothing but for third year, I'm getting 30,000 cash inflow. Then to get 20,000 cash inflow, for how many years I should wait? Less than 1 year only. So therefore payback period is equal to, already I know that 2 years is a recovery period. By that I am getting 80,000. For balance 20,000, I don't need to wait for complete third year. Proportionate year is required. 20,000 into 1 divided by 30,000, proportionate calculation. So you'll get what? 2 by 3, it is 0.667. Nothing but 2.67 years approximately. You can convert this 0.67 years into months, into 12 months, 8 months, 2 years, 8 months. Okay, in simple terms. Okay, even the extra decimal can be converted into days by multiplying with 30 days. So this is a way to calculate payback period in case of unequal cash flows. Just accumulate the cash flows and identify your recovery period. So calculate the payback period proportionately like this. Okay, with this we understood the concept called payback period. Now I am entering into the next area called average rate of return or accounting rate of return. Average rate of return or accounting rate of return. In short form, it is known as ARR. Sir, what is this ARR? Return means profit. Return means profit. Here I have to calculate the profit percentage. Rate means percentage. The rate of profit is nothing but rate of profit percentage. But the profit is always variable number. Because the profit is always variable number, I have to take average number. So nothing but average rate of return means I'm calculating average percentage of profit over the project life. So annually, how much percentage of profit I'm earning. That's what I need to calculate. Okay. Which is also known as accounting rate of return. Why? Because we are always going to take accounting profit here. That's why this is also known as accounting rate of return. See, we have two formulas to calculate this average rate of return. The first method is total investment method. Total investment method. The second method is average investment method. The second method is average investment method. The second method is a famous method. The second method is a famous method, but still you need to understand both the methods. So what is a formula? Simple. The first method, total investment method. Total investment method. Under total investment method, ARR is equal to, whenever you want to calculate the rate of return from any investment, the simple formula is the income plus gain divided by investment. Here also you have to apply the same formula. My rate of, for calculating the rate of return, the average rate of return from the project, I must take the profit in the numerator, which is known as average profit after tax. So why you are taking average profit after tax? Because the profit after tax is a variable number. So I have to take average profit after tax divided by my total investment in year 0. So this is a formula for total investment method. So ARR is equal to average profit after tax by total investment. So what is the formula for average profit after tax? Get the total profit after tax for the entire project life divided by write the life of the project or number of years. Okay, that gives you average profit after tax. Then write the total investment in the denominator so that you can get ARR under total investment method. This is simply a profit percentage on your total investment. Okay, I'm not taking any number because it will take a lot of time. Then I'm taking the next method, average investment method. Average investment method. So under average investment method, the formula will be changed. There is no change in the numerator, average profit after tax only. But in the denominator, you must consider the average investment instead of total investment. Sir, what is average investment? In simple terms, average investment means project beginning investment plus project ending investment divided by 2. Instead of that, they have given you one formula. You should remember that formula. Average investment is equal to half of initial investment, nothing but investment in fixed assets, minus salvage value, bracket close, plus salvage value. That half is not applicable to this salvage value, plus salvage value, plus your working capital investment, So this is a formula for average investment. So what is the formula for average investment? Half of initial investment minus salvage value. Please close the bracket. Such half is not applicable to the second salvage value, plus salvage value plus working capital investment. If you can apply this formula, you can get average rate of return under average investment method. Okay. Now let us go for the next method called payback period reciprocal or payback reciprocal. Payback reciprocal is nothing but the reciprocal of payback period. Payback reciprocal is equal to 1 by payback period. This is a simple formula for payback reciprocal. Just remember that. Okay. Say for example, if my payback period is 4 years, 1 by 4 years, 1 by 4. I'll get 0.25. It is a percentage actually into 100. It says 25%. Payback reciprocal is nothing but the rate of return from the project. This is generally we don't apply this particular formula in most of the cases unless otherwise specifically asked in the examination. So if they are asking you to calculate payback reciprocal, you just simply apply 1 by payback period. Okay. With this we understood the payback reciprocal. Now I'm moving to the next set of techniques called net present value. Actually, we have one more term called payback profitability. So I'll tell you, payback profitability is not a technique actually. Payback profitability means, see, just now we have taken one example. I'll show you that example. By the end of, okay, then let me take the previous example. By the end of second year, I'll be able to recover my investment 100,000 or 1 lakh rupees. After second year, actually this second year is known as what? The second year is known as, it is my payback period. So by the end of second year, I'd be able to recover my investment. After second year, whatever the cash flows that you're getting, 50 plus 50 plus 50, nothing but 150,000 or 1,50,000. This is my profit. This is my profit. Post payback profitability means how much profit I can earn after payback period. Nothing but the sum of cash flows which are generated after payback period are purely representing your post payback profitability. So whatever the cash flows that I'm generating after payback period is purely representing your profit. Why it is a profit? Why? Because by the end of payback period, I'll recover my investment completely. So the cash flows that are generated after payback period are purely representing your profit. Okay. With this, the non-discounting techniques were over. Now I'm moving to the next area called net present value, which is a famous technique, and this is practically applicable for project selection. This is superior over so many techniques. That's why this is very important. Net present value. So what is this net present value? Let me tell you. For every project, I'm going to get some cash flows. Let me take one example to understand this. There is a project with 3 years life, and I'm investing 1 lakh rupees today. In year 0, I'm investing 1 lakh rupees. And for the future 3 years, I'll get 50,000 cash inflow for every year. Now the question is how to calculate this net present value. For calculating net present value, the prerequisite is cost of capital. Cost of capital. Say for example, the cost of capital is 10%. So what is the exact meaning of net present value? The objective of calculating net present value is whether you are able to recover your investment along with your expected return of 10%. Cost of capital is investor's expected rate of return. So you should check it. So net present value is a testing measure or checking measure whether you are able to recover your investment along with cost of capital. If you can recover your investment along with cost of capital, then such project may result in a positive NPV, net present value, positive net present value. If you're not able to recover your return 10% along with your investment, then your net present value may be negative. So the net present value decides whether you can recover your investment along with cost of capital. So there is a process to calculate this net present value. First of all, discount all the cash flows at cost of capital, 10%. At 10% rate of return, at the end of first year, you have to take the present value factor, discount it, 50,000 into 0.909. If you can refer the table, present value factor table, you'll get present value of present value of cash flows. Nothing but 50,000 into 0.909. I got 45,450. Have you observed one thing? My cash flows were reduced here after discounting. What was happened here? Instead of taking 50,000, why you are taking 45,450? What about the balance money? 50,000 minus 45,450. The gap 4,550 is nothing but cost of capital on your investment. That means I'm recovering my cost of capital 10% through discounting. So by discounting, what will happen? I'm discounting what? 10%. Discounting means deducting return, my expected return from the future cash inflow. So I have deducted 4,550 rupees cost of capital from the future cash inflow. So the balance must represent my investment actually. This will help you to recover your investment. Present value of year 1 cash inflow. This is known as present value of year 1 cash inflow. Now, in the similar way, discount your second year ending cash inflow also to recover your cost of capital for 2 years on your investment. 50,000 into, that present value factor at the end of second year is 0.826. If you can refer the present value factor table. So 50,000 into 0.826, I got 41,300. This is my present value of year 2 cash inflow. And now in the similar way, discount your third year cash inflow also. 50,000 into 0.7 909826751. 50,000 into 0.751. I'm multiplying it here. 0.751. 50,000 into 0.751. I got 37,550. After discounting, your cost of capital has been successfully recovered on your investment. And this total present value of cash inflows has a responsibility to recover your investment. So I can say 45,450 plus 41,300 plus 37,550. 1,24,300. If you add all the 3 years cash inflows, you must get 1,50,000. Why you got 1,24,300? Because already on my investment, I have recovered my return called cost of capital 10%. My expected return on my investment has been recovered through discounting. Now, this is your present value of cash inflow. This is your present value of cash inflow. Now, from this present value of cash inflow, please deduct your investment, because you need to recover your investment also along with cost of capital. So, if I deduct 1 lakh rupees from here, then I'll get a positive number called 24,300. This is a positive number. Why? Because already I've recovered my cost of capital through discounting, and also now I have deducted my investment, which is also known as present value of cash outflows. So after recovering cost of capital and investment, whatever the additional value that you're generating is purely representing net present value. This is an additional value which will add some extra value to the shareholders. This is an excess value to the shareholders. This will improvise, maximize the wealth of the shareholders. That's why always I'll select the project with positive NPV rather than negative NPV. This is the true and exact understanding of the term net present value. Now let me show you the formula for calculating net present value. I'll show you the process. Yes. Present value of operating cash inflows. Present value of operating cash inflows plus present value of terminal cash inflow. Terminal cash inflow. Total will be present value of cash inflows. Present value of total cash inflows. Present value of total cash inflows. From this, please deduct your present value of cash outflows. Then the difference will be net present value, NPV, net present value. This is a formula for calculating NPV. Now, dear students, what is the appropriate discount rate for calculating NPV? The appropriate discount rate is cost of capital. That you should remember. The appropriate discount rate is cost of capital. Sorry. The appropriate discount rate is cost of capital. For calculating NPV, which discount rate I must use? Cost of capital. You must remember that forever. Okay. You know, the point is, for calculating NPV, what I should do? First, I should define my initial cash outflows, 0 year outflows, and then I should define my future operating cash inflows along with terminal cash inflows. Discount such cash flows and arrive NPV. Okay. So for calculating, for discounting purpose, you must use cost of capital as the appropriate discount rate. Remember that. Yes. Successfully, we understood net present value. So this particular capital busting technique must be useful for taking decisions. So every capital busting technique must be useful for taking decisions. Even this NPV technique should be useful for taking decisions. If NPV is positive, nothing but greater than 0, then I can accept the project. If NPV is negative, less than 0, I'll reject the project. If NPV is equal to 0, I may or may not accept the project. May or may not accept the project. That's it. This is for NPV. This is NPV decision making. In the similar way, even for ARR also, we have decision making. That means you have to take decisions by using ARR also. Generally, the written ARR should be compared with the cost on your capital, cost of capital. Then if the return is more than cost of capital, then that project can be accepted. If return is nothing but ARR is less than cost of capital, what you will do? You will reject the project, because the return should always be more than the cost of capital, because I am raising capital at higher cost, whereas the return generated from the project is lower. So such project should be rejected immediately. If it is equal to cost of capital, ARR is equal to cost of capital, may or may not. May or may not. Okay, may or may not. Now in the similar way, even the payback period technique should be useful for taking decisions. Payback period. If payback period, see, payback period should always be least. I'll always select the project with least payback period, because my objective of payback period is, my objective of using payback period is early recovery of investment. I'll select the projects with least payback period. So the application of payback period's objective is to recover your investment at the earliest. Okay. So if payback period is less than standard payback period, SPBP. So what is the standard payback period? The management will fix the standard payback period within which you should recover your investment. That means your payback period should always be less than standard payback period. That means the recovery period which is being fixed by management, that should be considered as a standard. So your payback period should always be less than such standard payback period in order to accept the project. If it is more than standard payback period, literally you will reject the project. You should reject the project. Okay. So you should reject the project if it is more than standard payback period. Equal to, you know that if it is equal to standard payback period, may or may not accept. Okay. This is regarding decision making under payback period capital vesting technique. Now with this we understood net present value, the first one ARR, average rate of return, payback period, and then just now we understood net present value. Now I am entering into the next technique called profitability index. The next technique is profitability index. The other names of profitability index are benefit cost ratio, present value index, desirability factor. Desirability factor. Wait. Desirability factor. The famous name is profitability index. Okay. Profitability index and NPV both are similar techniques. The only difference is NPV is a total absolute number, whereas profitability index is a relative measure. I'll show you the formula. Profitability index is equal to present value of cash inflows divided by present value of cash outflows. So how to calculate present value of cash inflows? What about cash inflows? Is it operating at terminal? See, this cash inflow is nothing but operating cash inflow as well as terminal cash inflow. Remember that. And for calculating present value of cash inflows, I must use cost of capital as an appropriate discount rate. The appropriate discount rate for calculating present value of cash inflows under profitability index technique is cost of capital. Appropriate discount rate. Okay. This is my appropriate discount rate. Okay. So what about this profitability index? Say for example, my present value of cash inflows after discounting future cash flows, operating and terminal cash inflows at cost of capital, I got 1,20,000 as my present value of cash inflows, divided by present value of cash outflows is or nothing but your investment, initial investment in year 0. So I've made an investment of 1 lakh rupees. So your profitability index is 1.2. 1.2 means 1.2 by 1. Which means for every 1 rupee of investment that you are investing in the project, you are generating 1.2 rupees of present value of cash inflows. 1.2 rupees of present value of cash inflows. That means after recovering 1 rupee from it, the 0.2 rupees is representing your NPV for your investment of 1 rupee. Okay. So generally, if profitability index is more than 1, then I can accept the project. If it is less than 1, I'll reject the project. If it is less than 1, that means what? I'm not able to recover my investment actually. So this capital busting technique must be useful for taking what decisions. If profitability index is greater than 1, then I can accept the project. If it is less than 1, I'll reject the project. If it is equal to 1, you know that may or may not accept the project. May or may not. See dear students, NPV and profitability index, you have to understand these two techniques simultaneously. Why? Because for both of these techniques, I'm using the same discounted cash flows, no change in it. Present value of cash inflows minus present value of cash outflows is NPV. Present value of cash inflows divided by present value of cash outflows is profitability index. The same discounted cash flows that I am going to use, because the appropriate discount rate for both the techniques is or cost of capital. So for both the techniques, I'm going to use cost of capital as the appropriate discount rate. So my dear students, both NPV and profitability index you should understand simultaneously. So if I can calculate NPV, I can easily calculate profitability index. Okay, so because the same present value of cash flows have to use. Okay, with this we understood profitability index also. Okay, right. Hi dear students, yes, now I'm moving to the next concept in capital budgeting chapter. So in the previous session we understood NPV and profitability index. Now we are moving to the next area called discounted payback period. See, we don't have any specific formula for this particular concept called discounted payback period. Just like payback period, even in discounted payback period also, I have to calculate the time period within which I can recover my investment. But in payback period, we'll consider the future cash flows, CFAT. Whereas in discounted payback period, we must consider the present value of cash inflows for recovery of investment. The present value of cash inflows must be considered. So present value of cash flows means the cash flows discounted at cost of capital. So just like in NPV, whatever the discount rate we've used, cost of capital, even in profitability index also the same discount rate is used. So the same discount rate must be used for calculating discounted payback period. So what is a discounted payback period? It is the time period by which I can recover my investment from the future present value of cash inflows. Nothing but you have to convert the future cash flows into present value terms by using cost of capital as the appropriate discount rate. From such present value of cash inflows, you have to recover your investment. That's what discounted payback period. Let us say how I can do this. First of all, for calculating payback period, what we will do? Generally, for calculating payback period, we'll accumulate the cash flows. For calculating payback period, generally we'll consider the accumulated cash flows. In the similar way, here in discounted payback period also, I have to accumulate the cash flows. Instead of accumulating the regular cash flow, I have to accumulate the present value of cash inflows discounted at cost of capital. So these are the standard columns. Here, present value of cash inflows discounted at cost of capital and cumulative present value of cash inflows. That's what you need to do. Cumulative present value of cash inflows. For example, there are 5 years. 1, 2, 3, 4, 5. The project life is 5 years. And I got present value of cash inflows of 1,13,320, 75,440. I'm just taking random numbers. 44,720 and 55,555. 1,12,222. These are the present value of cash inflows after discounting the cash flows at cost of capital. See, I have arrived this number. I arrived these numbers by using cost of capital as a appropriate discount rate. So whatever the discounted cash flows we are arriving for calculating NPV, the same discounted cash flows can be used here for calculating discounted payback period. Remember one thing, for calculating NPV, profitability index and discounted payback period, the appropriate discount rate is always cost of capital. So the same present value of cash flows can be used for calculating NPV, for calculating profitability index and for calculating discounted payback period also. Okay, whereas for calculating discounted payback period, we always need present value of cash flows for each year separately. Otherwise, I cannot calculate discounted payback period. Say for example, my investment is 2 lakhs. My investment is 2 lakhs. This is my investment. And I have to recover this investment, not from regular cash flows, but from present value of cash inflows. So accumulate these cash flows. 113,320 plus 75,440. 113,320 after adding this number 75,440, I got 188,760. And plus 44,720, I got 2,33,480. See, like that you have to add up to 5 years, just like in payback period. Now, my target investment recovery is 2 lakh rupees. Whereas by the end of second year, I got 1,88,760. So I just need balance money of how much balance money I need? 188,760. If you deduct 188,760 from 2 lakhs, I need 11,240. Whereas for third year, I am getting a present value of cash inflows of 44,720. So my dear students, simply for see, I can write sentences like this: investment covered by the end of year 2 is equal to 188,760. Balance of investment to be covered is equal to the same calculation which is applicable to payback period. The same calculation you can use it here. Okay, balance of investment to be covered, 2 lakh minus 188,760. So balance money is 11,240. See, for 1 year, third year period, I am getting present value of cash inflows of 44,720. For getting 44,720, I need to wait for third year fully. Whereas for getting 11,240, I don't need to wait for full year. I don't need to wait for complete third year. Therefore, discounted payback period is equal to, it's a proportionate computation. 2 years is already decided. And for balance 11,240, you don't need to wait for complete third year. 11,240 into 1 divided by 44,720. Okay. So 11,240 divided by 44,720, I got 0.25. It will be 2.25 years. This is my discounted payback period. Okay. So what is the difference between payback period and discounted payback period? In normal payback period, I'll accumulate the CFAT instead of using present value of cash inflows. So there you'll accumulate the CFAT. So the cumulative cash inflows must be considered for calculating payback period. Whereas in discounted payback period, I must discount the cash flows at cost of capital, and such present value of cash inflows must be accumulated in order to recover your investment. So in this way, I have to calculate my discounted payback period proportionately. So it is always in between 2 years. So you should always take, you have to take proportionate computation here for calculating discounted payback period. Yes, we understood. Now I can go for the next important concept called internal rate of return IRR. Internal rate of return IRR. IRR. Sir, what is IRR? Before understanding IRR, I need to tell you one important point. See, say for example, I am taking 3 years project life. I'll invest some amount of money in year 0. That is my investment. For such investment, what I'll get? I'll get future cash inflows. These are your future cash inflows. All these are what? CFATs. I told you already, your future CFATs are loaded with 2 components. Always. One is your investment component, another one is profit. Profit after tax. Such profit is technically known as internal rate of return. So in every year ending cash inflow, I'll get 2 components. One is investment, another one is IRR. IRR is nothing but the profit percentage, the accurate profit percentage on compounded basis. Okay, investment plus IRR. So in simple words, I can say one thing: the future cash flows are always loaded with 2 important components. One is my investment, other one is IRR, which is nothing but my profit percentage. Okay, now you should calculate this IRR. So how I can calculate this IRR? By discounting. If I discount the future cash flows at IRR rate, automatically this IRR will be removed. So through discounting, the IRR gets removed, and then I'll get what? The present value of cash inflows. Such present value of cash inflows. See, if I discount these cash flows at IRR, what will happen? This IRR will be discounted. This IRR will be deducted through discounting. Then what I'll get? The present value of cash inflows. The balance portion of present value of cash inflows which is purely representing my investment actually, because if I remove IRR from the future cash flows, the balance portion must represent my investment only. Okay, so whatever the present value of cash inflows you are arriving after discounting the future cash flows must be equal to my investment. If I deduct the investment from these present value of cash inflows, then my NPV must be equal to 0. This is the way of understanding. So in simple words, your future cash flows are loaded with two important components. One is investment, other one is IRR. If you discount the future cash flows at IRR, you are discounting the cash flows at IRR means you are removing IRR from CFAT. If I remove IRR from CFAT, then the balance must represent my investment. So the present value of cash inflows that you are getting by discounting all the 3 years cash inflows must be equal to my total investment. There your NPV should be equal to 0. This is the correct way of understanding. Let me show you one example to understand this. A 1 year project life I am taking here for the sake of understanding. I have invested 1 lakh rupees money. And for such investment I got a cash inflow of 1,15,000. I'm going to get a cash inflow of 1,15,000. This is my estimated cash inflow at the end of first year. Now the question is, how much is the IRR here? Simple. See, you can straight away say that, you can simply say that this particular 1,15,000 cash inflow is loaded with two components. One is my investment of 1 lakh rupees. Another one is profit, that is 15,000, and such 15,000 surely should represent IRR. A 15,000 amount here for my investment of 1 lakh rupees must represent 15%. See, prima facie by seeing these numbers, I can surely say that the IRR is 15%. What do you say? So here is your IRR. Now, I want to remove this IRR 15% from 1,15,000. What will happen? Let me show you. The present value of cash inflow. I have to calculate present value of cash inflow. At what rate I am discounting? Not at cost of capital. Remember that I am discounting this cash flow at IRR rate, internal rate of return. So 1,15,000. This is first year ending cash inflow. So I must use 1 by 1 plus R, IRR. Here R means IRR. IRR is 15%, 0.15. Sir, who said it is IRR? Who said 15% is IRR? Because prima facie by seeing these numbers, I can surely say that 1 lakh into 15%, 15,000 profit has been added here, right or wrong? So in that case, I can take 15% straight away. So 1 plus 0.15, this is my IRR. I am discounting the first year ending cash inflow at IRR, power 1, because this is first year ending cash inflow. Now take the number 1,15,000 into 1 by 1.15. I got 1 lakh rupees exactly. So successfully, after discounting the first year ending cash inflow of 1,15,000 at 15% IRR rate, the IRR of 15% has been removed. So after discounting 1 lakh from 1,15,000, 15,000 profit has been successfully removed because I have discounted first year ending 1,15,000 at 15% IRR rate. So such 15% profit element is successfully removed from cash inflow. So I got a present value of cash inflow. Have you observed that this is exactly equal to my investment? Yes, because once after recovering your profit element from the future cash flows, the present value of cash inflows must represent your investment. So I am deducting my investment from here. So I get an NPV of 0. This is what IRR is all about. So if you discount the future cash flows at IRR, the present value of cash flows must be equal to your investment. There your NPV should be equal to 0. That's what the true meaning of IRR. So let me write the sentences here. IRR is the discount rate. It is the discount rate at which the present value of cash inflows, should be equal to my present value of cash outflows or my initial investment. This is also known as initial investment or initial investment. So I can say present value of cash inflows minus present value of cash outflows should be equal to 0. So there your NPV is equal to 0. So what is IRR? IRR is the discount rate at which NPV is equal to 0, or else present value of cash inflows should be equal to my initial investment or present value of cash outflows. This is the true meaning of IRR. So the discount rate at which NPV is equal to 0 is simply known as what? IRR. Just now we have proved actually. Now the task is, how to calculate this IRR. In the examination, they'll ask you how to calculate IRR. So this IRR calculation is dependent on the nature of the cash flows. The nature of the cash flows means the cash flows can be uniform, equal, or non-uniform, nothing but unequal. So if the cash flows are equal, what will happen? If the cash flows are equal, what will happen? And if the cash flows are unequal, what will you do? If the cash flows are unequal. Yes. If the cash flows are equal, I'm going to use a method called annuity. Annuity method. I'm going to use annuity method. Whereas in case of unequal cash flows, I'm going to use trial and error method. These are the two famous methods we must use for calculating IRR. Okay. So look at this IRR. So if the cash flows are equal, annuity method I must use. If the cash flows are unequal, trial and error method you have to use. So under annuity method, how I can calculate IRR? See, in case of if the cash flows are equal, then simply use the annuity method. Please use the annuity method. IRR is the discount rate at which present value of cash inflows should be equal to my initial investment. This method I must use. So you have to write CF80, the cash flows, the equal cash flows that are given in the problem. You have to write such CF80 into, since it is an annuity method, I must multiply this cash flows with annuity factor, or I don't know, n you should write. The life should be written here. That is equal to initial investment. Okay. So the unknown factor here is rate of return only. The remaining factors will be given in the problem. So you have to substitute cash flows after tax, you have to substitute number of years, and you have to substitute initial investment. Then you will get present value of annuity factor from this. Present value of annuity factor from this. R is an unknown number, N is a life, that will be given in the problem. So initial investment divided by annual cash inflows, nothing but CF80 per annum. CF80. So if you substitute these numbers, you'll get some annuity factor. Say for example, let us say present value of annuity factor R, 5 years project life I am taking. My initial investment is 1 lakh divided by my annual cash flows for all the 5 years is 50,000. So my annuity factor will be 2. So you have to trace this factor in annuity factor table. You have to trace this factor in annuity factor table. Trace the factor, trace the present value of annuity factor and the present value of annuity factor table, and calculate IRR accordingly. So this is the way to calculate IRR. So you have to trace this factor in annuity factor. If it lies in between two discount rates, we have to use one method called interpolation. I'll show you. Okay then. So this is what annuity method. So what we have to do, we have to apply annuity method like this. Multiply the cash flows with annuity factor, and that should be equal to your investment. From that you have to arrive annuity factor and trace that factor in the annuity factor table against 5 years or against 10 years. It depends. Okay. Yes. Now, if the cash flows are unequal, trial and error method must be used. If the cash flows are unequal, in case of unequal cash flows, I must use trial and error method. Sir, how to do this method? Under trial and error method, you should guess the IRR rate. Nothing but internal rate of return should be estimated. So a trial should be applied. If it results in an error, then again you should apply another guess rate. So it is purely a guesswork actually. So how I can do this? Under trial and error method, you have to calculate NPV at different guess rates. The guess rate at which NPV is equal to 0 is simply known as IRR, because when the cash flows are unequal, I cannot simply multiply CFID with the annuity factor. I must use guess rates. Calculation of IRR. This is a way to calculate IRR under trial and error method. Write the years and write the cash flows. Use the present value factor at first guess rate and write present value of cash flows. 0 year, 1, 2, 3, 4, 5. 5 years cash flows. In 0 year, you please write initial investment, and for all the 5 years, write the cash inflows and discount these cash flows at first guess rate. Say for example, if it is 10%, if my first guess rate is 10%, I must use 10% guess rate. That means the first 0 year factor is 1. Then for first year, I have to write 0.909, 0.826, 0.751, 0.683, 0.621. These are the factors I must use. So then discount the cash flows. Inflows should be adjusted with outflows in present value terms. Then you'll get an NPV. The target NPV is 0. If it results in positive NPV, then you should go for the next guess rate. Sir, what should be the first guess rate? Generally for the problems, the first guess rate should be the 10% discount rate. If the discount rate is not given, I'll use 10%. Then the second guess rate will be 20% if your first guess rate results in positive NPV. So present value factor at the rate 20%, and then present value of cash flows I have to calculate. So dear students, if it results in, I'm not taking present value factors here, I'm just writing here. You can write present value factors by referring these factors in the table, or else you can calculate it by using present value factor formula 1 by 1 plus r whole to the power of n. If it results in negative NPV, so the IRR lies in between 10 and 20%. So when the IRR lies in between two guess rates, then we can use one method called interpolation. So using interpolation, IRR can be calculated by using the following formula. IRR is equal to L1 plus NPV at L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. This is a way to calculate IRR. So L1 will be first guess rate, L2 will be second guess rate. In our context, L1 is 10%, L2 is 20%. So if you may ask me one question, sir, if 20% results in positive NPV, then what I should do? Then you should apply 30%. So there also, if you get positive NPV, then again you should apply 40%. Like that, you should apply guess rates by taking 10% deviation. Okay. So dear students, now the question is, sir, in the examination, whether they'll give us the discount rates or we should take the guess rates. See, in the main examination, they'll always give you the guess rates. You don't need to guess it actually. Okay. Guesswork is not required from our side. They'll give you the guess rates. They'll give you the possible guess rates. Say 2 to 4 guess rates will be given in the problem. You have to apply such guess rates for calculating IRR. So, okay, in case if the guess rates are not given, my better suggestion is you have to take 10% first guess rate, 20% second guess rate, then you should go for 30%. Mostly between 20 to 30 you'll get the answer. Okay. So this is regarding trial and error method. So under annuity method, you must use annuity factor. So trace the factor in the present value of annuity factor table. There you can get IRR. In case if the factor lies in between two discount rates, say 10 and 11 or 11 and 12, then for 11 and 12 you have to calculate NPV. NPV at 11% and NPV at 12% should be calculated. Then you can apply the same formula called interpolation. IRR is equal to L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. So again I am repeating, under annuity method, if the factor lies in between two discount rates, say for example 11 and 12, then you should calculate NPV at 11% and NPV at 12% and between those two numbers 11 and 12%, use the interpolation, because at 11% you'll get positive NPV and at 12% you'll get negative NPV. So by using this interpolation method, L1 is equal to 11%, L2 is equal to 12%, so that you can calculate IRR very easily. And also you can calculate IRR proportionately, that I've discussed in the classes, actually regular classes. So that's not required, even you can use this formula also. Okay, so with this we understood the concept of IRR. So simply IRR is a profit percentage which is included in the future cash flows. If you discount the future cash flows at IRR by removing such IRR component from the future CFAT, whatever the present value of cash inflows must represent my investment. So present value of cash flow should be equal to investment. There my NPV is equal to 0. That's it for IRR concept. Okay, now so one more point we should cover under IRR. So if nothing but for taking decisions, nothing new here. If IRR is greater than cost of capital, then I can accept the project. Reject if IRR is less than cost of capital. K means cost of capital. If IRR is equal to cost of capital, we may or may not accept the project. So that is a decision making area actually. Okay. With this concept, IRR is over. Now, in your textbook, nothing but the material and the study material also, they have given you one formula for discounted payback period. My suggestion is you please don't follow this formula. That creates a lot of confusion. Instead of that, you please calculate discounted payback period proportionately. That is very easy. Okay. Even the discounted payback period for calculating, after calculating discounted payback period, it should be useful for taking decisions. So discounted payback period must be compared with standard discounted payback period. Your discounted payback period of any project should always be less than standard discounted payback period. Then only we can accept the project. Otherwise, I'll reject the project. Okay. So I can say one thing for decision making: if discounted payback period is less than standard discounted payback period, accept the project. Greater than standard discounted payback period, reject the project. Equal to standard discounted payback period, may or may not accept the project. Yes. Now, let me start with the next concept, modified NPV. Modified NPV. How I can calculate modified NPV? That's our concept. Simple. One, two, three. Say for example, the first year ending cash inflow is 50,000. The second year ending cash inflow is 50,000. The third year ending cash inflow is 50,000. My investment is 1 lakh. How I can calculate modified NPV? For calculating modified NPV, you need two rates. One is the reinvestment rate. Say for example, my reinvestment rate is 10%. Another one is discount rate, cost of capital, which is 15% here. So what I should do? My first job is to convert all the year's cash inflows into terminal year. The first year ending cash inflow must be converted to third year ending cash inflow. So by using which rate I should convert these cash flows into terminal year? By using reinvestment rate. Here the reinvestment rate is 10%. So the first year ending cash inflow of 50,000 can be reinvested for 2 years, second and third year. So the compounded rate should be used here. The compounding factor 1 plus R. Here R is reinvestment rate 0.10 whole to the power of 2. Because the first year ending cash inflow of 50,000 can be reinvested for second and third year. 2 years return should be added here. So as part of conversion, I must always use reinvestment rate as the appropriate compounded rate. So 50,000 into 1.1 into 1.1, I got 1.21. 1.21 into 50,000. This is 60,500. Now convert the second year ending cash inflow into third year ending. So 1 year return should be added here. Again at reinvestment rate. 50,000 into 1 plus 0.10 whole to the power of 1. So this gives me 55,000. Okay. Now coming to third year ending cash inflow, you don't need to reinvest it because the third year ending cash inflow remains third year ending cash inflow only. Power 0, nothing but 1 into 1, 50,000 only. So successfully we have converted all the year's interim cash inflows into terminal year. So sum up all these numbers, 60,500 plus 55,000 plus 50,000. So this is your terminal value, 165,500. This is known as terminal value. Now what I should do? This terminal value should be discounted at cost of capital. So I should convert this terminal value into present value terms by using cost of capital as the appropriate discount rate. So 165,500. Present value of terminal value, TV terminal value 165,500. Since all the cash flows were converted to terminal year, I must use present value factor here. 165,500 into, at cost of capital, please discount it. 1 plus 0.15. Since my cost of capital is 15%, 0.15 power 3, third year ending value it is. So 1 by 1.15, first year, second year, third year, it is 0.6575. So 0.6575 into 165,500. I got 1,08,818. So this is my number minus my initial investment, nothing but present value of cash outflows, that is 1 lakh. So I got an NPV 8,818. This is not a regular NPV, this is known as modified NPV. So how to calculate modified NPV? Convert all the year's cash flows into terminal year by using reinvestment rate as the appropriate compounded rate. So after converting all the year's cash inflows into terminal year by using reinvestment rate, I'll get a terminal value, discount such terminal value by using cost of capital as a discount rate, then we get present value of terminal value and deduct investment from it, then whatever the value you're getting, which is known as modified NPV. Whereas in regular NPV, the calculation is direct discounting. Straight away I'll discount the future cash flows at cost of capital and then I'll deduct my investment, then I'll get NPV. Whereas in modified NPV, you'll convert the cash flows and then discount it. So for conversion, I must use reinvestment rate. For discounting, I must use cost of capital. That's what you need to remember. With this, the concept modified NPV is completed. Then the next concept is modified IRR. The true concept is completely different actually, but in study material, they have given you one formula for calculating modified IRR. I'll show you. See, here is MIRR, modified IRR. What is the formula? Nth root of future value of positive cash flows divided by present value of negative cash flows minus 1. That's what the formula for modified IRR. What is the formula? MIRR, nothing but modified IRR is equal to nth root of future value of positive cash flows divided by present value of negative cash flows minus 1. So this minus 1 is out of nth root. Okay, this is the formula for modified IRR. What is the formula? Nth root of future value of positive cash flows divided by present value of negative cash flows minus 1. See, we have one problem in the study material. For solving this sum, you can refer the study material. Simply convert all the cash flows into terminal year, all the positive cash flows into terminal year by using one of the reinvestment rate, and then calculate present value of negative cash flows. Then apply nth root, and from there if you deduct 1, then you'll get modified IRR. Okay. Actually, the true meaning of modified IRR is completely different. Instead of applying this formula, we have one concept. How I can do modified IRR? Even in the study material, they have given you a big description, and such description is representing this process that I am going to discuss. Okay. Yes. For calculating modified IRR, I have to apply different steps. Step number 1. Okay, wait. 1, 2, 3. I'm not taking any numbers. I'm just taking into marks for understanding. Okay. So what is my first job? Convert all the year's cash flows into terminal year. Just like in modified NPV, convert all the year's cash inflows into terminal year by using reinvestment rate. If reinvestment rate is not available, then try to use cost of capital as a reinvestment rate. convert all the year's cash inflows into terminal year by using reinvestment rate or cost of capital, then get the values. The total will be TV, terminal value. So what I should do? Convert all the year's cash inflows into terminal year by using reinvestment rate or cost of capital as the compounded rate. Once we get terminal value, then you are going to have two values. One is 0 year investment, other one is terminal value. Now, modified IRR is the discount rate, at which the present value of terminal value should be equal to my initial investment. So here in this case, terminal value is a single value, so I must use 1 by 1 plus r whole to the power of n. Present value factor should be equal to my initial investment. So how to calculate this rate of return? Okay, nothing but modified IRR. Generally, we don't use mathematical formula. Instead of that, we'll use present value factor, and I'll trace this factor in the table. Present value factor R comma N, initial investment. Terminal value is a known term, N is known, number of years are given in the problem, initial investment is a known term. The only unknown term in this problem is IRR, rate of return. This is what modified IRR. So by tracing this present value factor in the table, I can get modified IRR. So from this, please calculate present value factor R comma N is equal to investment divided by terminal value that I have arrived in the problem. So you'll get a factor, and this factor should be referred in the table. Trace the present value factor of, say for example, if I get 0.751, then trace the present value factor of 0.751 in present value factor table against n years project life, against n years. And calculate modified IRR accordingly. And calculate modified IRR accordingly. Okay, so trace the factor in the present value factor table against n number of years the project life, and identify the modified IRR accordingly. If it lies in between two discount rates, then you must use interpolation method. That means you have to calculate NPV at those two discount rates and apply interpolation method, then you will get modified IRR. So this is the way to calculate modified IRR. So what is the job? Convert all the year's cash flows into terminal year by using reinvestment rate or cost of capital, get a terminal value, then modified IRR is the discount rate at which the present value of terminal value is equal to initial investment. So I must use discount rate. That discount rate itself is modified IRR. So terminal value into present value factor R comma N should be equal to initial investment. In this equation, TV, terminal value, is a known term because we can calculate that, and then number of years will be given in the problem. Initial investment is a known term, so substitute all the numbers. Then the only unknown term, variable term, is R, and I did calculate the present value factor R comma N. So this present value factor should be traced out in the factor table, present value factor table. If it corresponds to one exact rate, that itself is modified IRR. If it lies in between two discount rates, then I must use interpolation, or I can calculate modified IRR proportionately. There is a process for that. Okay, with this, the concept modified IRR is over. But in the problematic part, I mean, in the study material, they have given you only one problem related to modified IRR, and there they have used this formula, and the method they have applied is, first they have calculated future value of positive cash flows, and then they have calculated present value of negative cash flows. Then they applied this formula, nth root of this number minus 1. So nth root calculation, you know that square root 15 times minus 1 divided by n plus 1 into is equal to 15 times. That formula, that process I have discussed in the chapter time value of money. That process can be applied here also for calculating modified IRR. Okay, with this, the concept modified IRR is over. Yes. Next concept is adjusted net present value. Adjusted net present value. How to calculate adjusted net present value? Simple. There is a formula for calculating adjusted net present value. Adjusted NPV is equal to base case NPV minus issue expenses plus present value of tax saving on interest. Present value of tax saving on interest. First, step number 1, I have to calculate base case NPV. That's my first job. Sir, how to calculate base case NPV? I'll show you. Base case NPV is equal to present value of cash inflows minus initial investment. In this case, for calculating present value of cash inflows, the appropriate discount rate is KE. At cost of equity KE, I have to discount the future cash flows. So for calculating base case NPV, I should discount the cash flows at cost of equity KE. From that, you have to deduct your initial investment. This gives you base case NPV. Now the question is, sir, how to consider this initial investment? Generally, initial investment means the amount that I am investing in year 0. Sometimes they'll give you the investment combination, the financing options. If they give you equity plus debt combination for your initial investment, that means the entire investment is financed out of equity and debt. Say for example, equity 60 crores and debt 40 crores. So which amount you have to consider? See, even though it is financed out of debt and equity, it doesn't matter. I have to take the total of 40 plus 60, it is 100 crores. 100 crores should be considered as your initial investment. So I don't separate equity and debts. So for calculating base case NPV, even though the cash flows are discounted at KE, but initial investment should be considered fully instead of separating that initial investment into debt and equity financing. Okay. Sir, what I should do? Whatever the money which is taken in the problem, nothing but initial investment, should be deducted here from present value of cash inflows after discounting the cash inflows at cost of equity KE. That's your first job. Then the second job is calculate the issue expenses. Calculation of issue expenses. This is your second job. See, sometimes for calculating issue expenses, you must go for backward computation. Why? Because to finance the new project, I need some money. Whereas the issue expenses results in lower amount of money after issuing the money. So because of that reason, I should calculate issue expenses through backward computation. Say for example, if the project cost is 1 lakh rupees. So I need 1 lakh rupees. Whereas issue expenses are 5%. On issue money. So for example, if it is 5%, say for example, if I go for issue of 1 lakh rupees money, 5% will be reduced from as part of issue expenses. So 5,000, after deducting 5,000, I'll get net process of 95,000 only. Whereas my project cost is 1 lakh. So by using 95,000 net process, I cannot finance this project. In such a case, the calculation part will be completely different. Say for example, if the issue amount is equal to 100 minus issue expenses are 5 rupees at the rate 5%, 5 rupees. So the net process will be equal to 95 rupees. So my net process 95 should be equal to 1 lakh rupees. So I have to calculate issue expenses of 5 rupees. So proportionately I have to calculate issue expenses. Therefore issue expenses is equal to 1 lakh rupees into 5 divided by 95. This is a way to calculate proportionate issue expenses through backward computation. Into 5 divided by 95, it will be 5,263. So you cannot simply take 5% on 1 lakh rupees project cost, because the issue expenditure is issue amount is completely different here. So this is the amount of issue expenses. So this is a way to calculate issue expenses when the issue expenses are given as a percentage on the issued amount. Okay. So this is regarding step number 2. Now step number 3. In step number 3, I have to calculate present value of tax saving on interest, which is also known as tax shield on interest. Tax saving on interest, present value of tax saving on interest. The first question is, sir, how to calculate tax saving on interest? First of all, you should know the interest amount computation. See, if the debt repayment is given over a period of time then you have to prepare debt repayment schedule, and accordingly you have to calculate interest for every year separately. Once we get interest, apply tax rate on it, then so that you can get tax shield or tax saving on interest. So the formula for tax shield or tax saving on interest is, for every year you have to calculate tax saving on interest separately if the interest component is changing from one year to another year. So the formula is interest into tax rate. This is a formula for tax saving on interest. Interest into tax rate. Once we get tax saving on interest, converts this tax saving on interest into present value terms. So present value of tax saving on interest, because tax saving on interest is a benefit. Tax saving on interest is a cash inflow. Convert this tax saving on interest into present value terms by using one discount rate called interest rate, KD. Okay. So simply you have to write like this: tax saving on interest into, since we are discounting the tax savings here, if it is generated for 5 to 10 years or 15 years, multiply such tax saving on interest with annuity factor R comma N. So I'll show you. Here is the factor R comma N. Here R means the discount rate. The discount rate is interest rate. Remember that. The interest rate on debt is your discount rate here for calculating present value of tax saving on interest. Present value of tax saving on interest. Sometimes if the debt is given in the form of irredeemable debentures or irredeemable debt, then in that case the interest payment is perpetual, so that you can enjoy this tax saving for perpetual years. In that case you should not multiply tax saving on interest with annuity factor. Instead of that, I must use present value of perpetuity, formula C by R. So for calculating present value of tax saving on interest, I have to use the formula like this: tax saving on interest divided by tax saving on interest divided by interest rate. Interest rate. This is the discount rate. In this way, you have to calculate present value of tax saving on interest. Okay. So these are the steps I must follow for calculating adjusted NPV. So what is the formula for adjusted NPV? Base case NPV. So base case NPV means present value of cash inflows discounted at KE minus total initial investment including equity and debt. Okay. Minus issue expenses. Deduct issue expenses. Sometimes issue expenses can be expressed as a percentage. So you have to calculate issue expenses through backward computation in such a way that my net process must be equal to my project cost. Okay. Then after calculating issue expenses, calculate present value of tax saving on interest. Just now we have discussed tax saving on interest is equal to interest into tax rate. Discount such tax saving on interest with interest rate as the appropriate discount rate. If the tax saving is generated for certain number of years, if it is an annuity, multiply with annuity factor. If it is a perpetuity, for perpetual debt like irredeemable debt, then apply C by R, nothing but tax saving on interest divided by R means interest rate discount rate. Okay, so once we get these numbers, substitute the numbers in this formula. Adjusted NPV, base case NPV minus issue expenses plus present value of tax saving on interest, that gives me adjusted NPV value. With this, the concept adjusted NPV is over. Okay. Hi dear students, so I'm going for the next concept in the chapter capital budgeting. The next concept is ranking conflicts. The next concept is ranking conflicts. Sir, what is the exact meaning of the term ranking conflict? Let us take one example to understand this. I am evaluating two mutually exclusive projects called project A and B, and I have calculated NPV for project A and project B. I got 1,50,000 NPV for project A and 1,20,000 NPV for project B. Whereas IRR for project A is 15% and for project B is 20%. Have you observed one thing here? NPV is preferring project A and it is rejecting project B, whereas IRR is preferring project B and it is rejecting project A. Now, One technique NPV is preferring project A, the other technique IRR is preferring project B. Now which project I should select, whether I should follow NPV or IRR? This is what the ranking conflict between two capital busting techniques, NPV and IRR. So this ranking conflict should be resolved. How I can resolve the ranking conflict? First of all, before resolving the ranking conflict, first identify the reasons behind this ranking conflict. See, the reasons behind such ranking conflict are explained in our material. Now look at the first reason. The first reason is time disparity or cash flow disparity, and the second reason is size disparity, and the third reason is life disparity or unequal lives of the projects. Sir, what is the meaning of the term time disparity or cash flow disparity? Time disparity or cash flow disparity means the pattern of cash flows are different for both the projects. Say for example, if you look at project A and I'm taking 5 years life period, 1, 2, 3, 4, 5. The cash flows are in increasing trend, just like this. 30,000 for first year, 50,000 for second year, 80,000 for third year, 1,20,000 for fourth year, and 1,80,000 for fifth year. Like that I'm getting cash inflows. So the cash flows are in increasing trend for project A. When it comes to project B, the cash flows are in declining trend. 1, 2, 3, 4, 5. So my cash flows for first year are 200,000, 2 lakh rupees, and for second year it is 1,50,000. Third year it is 70,000, then 40,000 and 20,000. Like this I'm getting cash flows. Now have you observed one thing? Project A cash flows are in increasing trend, whereas project B cash flows are in decreasing trend. That means for project A I'm getting lesser amount of cash flows in the initial years and larger amount of cash flows in the later years. Whereas for project B I'm getting larger amount of cash flows in the initial years and smaller amount of cash flows in the later years. So this is what the cash flow disparity between the projects, also known as time disparity, the timing of cash flows. So this is one of the reasons behind ranking conflict between NPV and IRR. So if this is the reason, the first reason, time disparity or cash flow disparity, time disparity or cash flow disparity. Then how I can resolve this ranking conflict? See, look at the sentences here. In case if there is a time disparity, then I have to calculate either modified NPV. In fact, modified NPV and modified IRR should be calculated by using the reinvestment rate. So simply you have to calculate modified NPV and modified IRR for both the projects, then compare such numbers, modified NPV and modified IRR. So based on that I'll select the projects. So you know how to calculate modified NPV and modified IRR, so simply when there is a ranking conflict between the projects arises, then because of time disparity or cash flow disparity, then such ranking conflict can be resolved by calculating modified NPV and modified IRR. We have few problems in the study material, you can see that. So please calculate modified NPV and modified IRR. By that you can resolve the ranking conflict. Okay. You know how to calculate modified NPV and modified IRR. Simply I have to calculate terminal value by using reinvestment rate. Then I should discount such terminal value at cost of capital and deduct investment to get modified NPV. Then I should calculate the modified IRR rate by using such terminal value. The discount rate at which present value of terminal value is equal to my initial investment is nothing but modified IRR. So in that way I have to calculate modified IRR. So that's what they have given here. So this is the first reason behind ranking conflict. The second reason is size disparity. So what is size disparity? Size disparity means difference in investments. Size disparity. Difference in size of investments. Difference in size of investments. Nothing but if you see project A and project B. For project A, my investment is 10 crores. Whereas for project B, my investment is 25 crores. Now, the investments are different for project A and project B. This is also one of the reasons behind ranking conflict. Size disparity, the difference in size of investments between the projects. So, for one project I'm investing lower amount, whereas for other project I'm investing higher amount. So, that investment requirement, when the investment requirement for different projects are different, then automatically the ranking conflict arises. Okay. So here for project A and B, the investment, there is a difference in investment. So this is what size disparity, size of investment difference. So this is also one of the reason behind the ranking conflict between NPV and IRR. So how I can resolve this ranking conflict? By calculating incremental IRR for incremental investment. Look at this. In case of ranking conflict, because of due to size disparity, the ranking conflict can be resolved by using the following steps. Find out the differential cash flows between the two proposals. Calculate the IRR of incremental cash flows. If the IRR of incremental cash flows exceeds the cost of capital required rate of return, then the project having greater non-discounted cash flows should be selected. Nothing but you have to do like this. Say for example, if I am evaluating two projects, project A and project B, and the cash flows are like this from year 1 to 5. The cash flows are like this. For project A, the year 1 to 5 cash flows are every year 5 crores. Whereas for project B, the every year ending cash flows are 12 crores per annum. So now, calculate the incremental investment. Nothing but identify the incremental cash flows. So here is my incremental investment in project B. So if I'm moving from project A to B, how much additional investment I have to invest? 15 crores. For such additional cash flows, additional cash outflows, I'll get an additional cash inflow of how much money? 12 crores minus 5 crores, 7 crores. So for these incremental cash flows, please calculate IRR. And such IRR is known as incremental IRR. Incremental IRR. So if this incremental IRR is greater than cost of capital, then additional investment is viable, nothing but acceptable. Additional investment means investment in project B. So dear students, in case if the ranking conflict arises because of size disparity, immediately identify the differential cash flows. That means the additional cash flows, additional cash outflows and additional cash inflows by moving from the smaller size project to larger size project. So simply for additional investment, how much additional cash inflows I am generating. For such additional cash flows, nothing but incremental cash flows, I have to calculate incremental IRR. If it is more than cost of capital, then accept it. Otherwise, reject such additional investment and go ahead with a smaller size project. Okay, this is regarding the second reason behind ranking conflict, size disparity. And the third one is life disparity or unequal lives of the projects. In case of life disparity means the difference in life of the projects. Difference in life of the projects. Say for example, there are two projects, project X and project Y. Then the life of project X is 10 years, whereas the life of project Y is 15 years. Now, there is a scope for ranking conflict between NPV and IRR. The conflict arises because of life disparity, the difference in life of the projects. This ranking conflict can be resolved simply by calculating one technique called EAB, equated annual benefit, or annualized NPV. This is also known as what? Annualized NPV. Nothing but you have to calculate NPV per annum, annualized NPV. So what is the formula for annualized NPV? Simple, NPV divided by present value of annuity factor R, N. Present value of annuity factor R, N, where R is cost of capital, N is number of years. And this should be calculated for project A, so project X as well as for project Y. Present value of annuity factor R, Y, R, N. So dear students, have you observed one thing here? For project X, the life is 10 years, and for project Y, the life is 15 years. The discount rate remains same. So what is R here? The R is nothing but cost of capital. So simply you have to calculate annualized NPV by dividing such NPV of the respective projects with present value of annuity factor R, N. We have a substitute formula for this. Sometimes that can be asked in the examination with a different word called capital recovery factor. So the other formula for this equivalent annualized benefit or annualized NPV is NPV into capital recovery factor. Capital recovery factor. So what is the formula for capital recovery factor? Nothing new. The above formula only. Capital recovery factor CRF is equal to, capital recovery factor CRF is equal to 1 by present value of annuity factor. That's it. 1 by present value of annuity factor. R is cost of capital, N is number of years. Nothing but if you multiply NPV with capital recovery factor, what I'll get? NPV into 1 by present value of annuity factor R comma N, where R is cost of capital, N is number of years. Nothing but this is the previous formula, NPV by present value of annuity factor. So but in the examination, if they have given capital recovery factor, then immediately multiply such capital recovery factor with NPV without any hesitation. Okay, so this is regarding equivalent annualized benefit or annualized NPV. This particular technique should be applied for resolving the ranking conflict between NPV and IRR if it arises because of life disparity. So I'll select the project with higher annualized NPV. That's it. Okay, this is regarding the third reason. So the ranking conflict between NPV and IRR arises because of time disparity or cash flow disparity, and that can be resolved by calculating modified NPV and modified IRR. And size disparity, nothing but difference in size of investments, that can be resolved by calculating incremental IRR for the incremental cash flows moving from smaller size project to larger size project. So and then the third reason is life disparity or unequal lives of the projects. So in this case I have to calculate annualized NPV or equivalent annualized benefit. The formula is simple: NPV into capital recovery factor or NPV divided by present value of annuity factor. That's it. With this, the ranking conflict concept is completed. Now I am moving to the next concept called capital rationing. Capital rationing. This is our next concept. So what is capital rationing? Capital rationing means, first of all, rationing means short supply of capital. Rationing means short supply. Capital rationing means capital is short in supply. So capital rationing is a situation which is being faced by so many companies while selecting the projects. Nothing but fund constraint. Even though there are most profitable projects available in the market, the firm cannot accept all the projects in the market because of the capital rationing situation. Nothing but the short supply of capital. The capital is not sufficient enough to accept all the projects in the market, because even though such projects are viable projects. In such a case, how to select the projects is our discussion. So when there is a fund constraint, first of all, how to select the projects? First of all, this capital rationing, this short supply of capital is of two types: single period capital rationing, and multi-period capital rationing. What is single period capital rationing and what is multi-period capital rationing? Single period capital rationing means when the capital is short in supply for only one period, that is known as single period capital rationing. If the capital is short in supply for more than 1 year, then that is known as multi-period capital rationing. This is not there in your syllabus. We have only the first case called single period capital rationing. When the fund constraint is applicable only for initial year, nothing but 0 year, for only 1 year, then that is known as single period capital rationing. Under this single period capital rationing, the projects are classified into two types. One is divisible projects, another one is indivisible projects. Divisible projects and indivisible projects. Divisible projects means proportionate investment is possible. Indivisible projects means proportionate investment is not possible. Say for example, I am taking one project A, the investment required is 100 crores, whereas the fund available in my hand is 60 crores. So can I invest 60 crores in this project A, whereas the requirement is 100 crores? No, it is not possible. Either you should invest 100 crores or you should reject it. This is a clear case of indivisible projects. That means a project cannot be divided. A part investment or a proportionate investment is not possible. In this case, such projects are simply known as indivisible projects. The projects cannot be divisible. Okay, in case if I can invest a part of this project A 60 crores and I can earn proportionate NPV accordingly, then in such a case such projects are known as divisible projects. Divisible projects means under divisible projects part investment is possible. That means a proportionate investment is possible and I can earn proportionate NPV. So dear students, the decision making changes based on the nature of the projects. If the projects are divisible, part investment is possible. Indivisible, part investment is not possible. Yes. So in this case, how to select the projects? In case of divisible projects, the selection of the projects is based on profitability index. I'm going to calculate profitability index for every project and I'll select the projects accordingly. In case of indivisible projects, the selection is based on combination of projects. I'll define combinations. Combination of projects that gives higher NPV should be selected. So simply speaking, in case of divisible projects, you have to calculate profitability index of every project, assign ranking. In the order of ranking, you should invest your money. So in case if you have some money at the end of the, after investing in few projects, if you have insufficient money to accept the next project, then proportionate investment is possible for divisible projects. So the selection of the projects in case of divisible projects are purely based on profitability index based ranking. So in the order of profitability index ranking, I have to invest in the projects. That's what divisible projects. Whereas in case of indivisible projects, I don't follow profitability index ranking. I'll simply define as many combinations as possible within the capital spending limit. Nothing but I have some money in my hand, but with that money I cannot accept all the projects. So with that money I have to define as many combinations as possible, and for every combination I have to calculate NPV. So the combination that gives higher NPV should be selected. That's what the combination of projects that gives higher NPV should be selected. This is a case of what? Indivisible projects. So the combinations are required for indivisible projects, whereas profitability index based ranking is required for divisible projects. That's what regarding capital rationing. Okay. So with this, the concept capital rationing is completed. Now let us handle one problem relating to all the capital busting technique. We have one problem which is covering all the capital busting techniques. Problem number 17. Now look at this question. I'm reading the question. A limited company is considering investing a project requiring a capital outlay of 2 lakh rupees. Forecast for annual income after depreciation but before tax is as follows. So the annual income after depreciation, that means after deducting depreciation but before deducting tax, nothing but PBT. After deducting depreciation, what I'll get? PBT. And they are saying but before tax, nothing but before deducting tax. So the given term is PBT, profit before tax. Depreciation may be taken as 20% on original cost, nothing but it is SLM. Okay, and taxation is 50% of net income. You are required to evaluate the projects according to each of the following methods: payback period, rate of return on original investment, rate of return on average investment, nothing but ARR it is. Original investment means total investment, and then average investment means, you know that average investment means half of initial investment minus salvage value plus salvage value plus additional working capital. This is ARR. B and C are representing ARR. D means discounted cash flow method, taking cost of capital as 10%. Indirectly they are asking you to calculate NPV. Net present value index. Net present value index is nothing but profitability index. Internal rate of return, IRR. Modified IRR. These are the requirements. Most of the capital busting techniques are considered here. So I am taking this problem to understand all the capital busting techniques. Now let us go for the solution and your study material. I am taking study material solution here. So since we got PBT, what I should do? Working note. I'm preparing working note here. I have written what the first column is year 1 to 5. Look at the numbers here. Year 1 to 5. So they've given profit before tax for all the 5 years. Deduct tax from it. Nothing but 50% is the tax rate. If I deduct 50% tax from it, I'll get PAT, which is also 50% of PBT. So profit after tax 50% is directly calculated here by applying 50% on PBT. And to that they have added depreciation to get what? Cash flows after tax, PAT plus depreciation. For all the 5 years, CFATs are considered here. Cumulative cash flows are considered here. Why? Because for calculating payback period, I need cumulative cash flows. Discounting factor at 10%, nothing but present value factor at the rate 10%, cost of capital are considered here, 0.9091, 0.8264. These are all present value factors for all the 5 years period. So finally they got present value of cash flows, and they have multiplied cash flows 90,000 with the present value factor 0.9091. I got this present value of cash inflow 81,819. Like that we got present value of cash inflows discounted at cost of capital. So this is present value of total cash inflow discounted at cost of capital. So by that I can calculate few things here. What I can calculate? I can calculate NPV, I can calculate profitability index, and also I can calculate payback period because the cumulative cash flows are available here. And also in the same table they are calculating IRR also. Since the cash flows are unequal, nothing but changing from one year to another year, I cannot use annuity method. I must use trial and error method. Nothing but you should go ahead with the guesswork. So I should take the first guess rate. Then if the NPV is positive, then I should go for the second guess rate. Then I should go for the third guess rate until I get negative NPV or zero NPV. The discount rate at which NPV is equal to 0 is known as what? IRR. So they have discounted the cash flow at 20% also, and they got 2,46,487 present value of cash inflows. Whereas our investment is how much? Look at the question. Our investment is 2 lakh rupees. Whereas the present value of cash inflows discounted at 20% cost of capital rate is 246,487. So again I got positive NPV. Then I should go ahead with the next guess rate, 30%. They have applied 30% discount rate, and they got present value of cash inflows of 2,03,063. Again they got what? Positive NPV. That's why they've taken the next guess rate 32%. So why they have taken 32%? Can I take 40%? Yes, you can take 40% also. That is also right. So they've taken 32% guess rate. At 32% guess rate, they got present value of cash inflows of 1,95,941. 195,941 minus my investment 2 lakhs. That gives me minus 4,059 negative NPV. So the IRR lies in between 30% and 32%. So I should use interpolation method for calculating IRR between 30% and 32%. So in this table they have covered all the points here. They have calculated CFAT cash inflows. They have accumulated the cash flows, cumulative cash flows. This is cash inflow, this is cumulative cash inflow. I need cumulative cash inflows for calculating payback period, and they've calculated present value of cash inflows at cost of capital for calculating NPV and profitability index. They've discounted the cash flows at 20%, discounted the cash flows at 30%, discounted the cash flows at 32%. Ultimately they got negative NPV at 32% discount rate. So I can calculate all the techniques comfortably with the help of this table. First one is payback period method. My investment is 2 lakhs. By the end of second year, I got 1,80,000 recovery, cumulative cash flows. So the balance recovery is 20,000. 2 lakhs minus 1,80,000. So balance for 20,000, I don't need to wait for complete third year. I got 80,000 cash flows for third year. So for 20,000, how many years I should wait? 20,000 into 1 divided by 80,000. That's what they've calculated. Payback period is equal to 2 plus 20,000 into 1 divided by 80,000. See, I've explained this particular payback period technique with the help of an example. The same process you can apply here. You'll get payback period. I got 2.25 years or 2 years 3 months. Then the next one is average rate of return. What is the formula for average rate of return? Under two methods they have calculated here, because the requirement is two methods: original investment method, average investment method. Original investment method is nothing but total investment method. What is the formula? Average profit after tax divided by total investment into 100. Remember one thing, dear students, you should not consider CFAT here. You must consider PAT here. That means my second column, the second column is my requirement, profit after tax. Don't take cash flows for calculating ARR, because ARR is a profit percentage. Okay, profit after tax for all the 5 years, my profit after tax is different. So add all these numbers, 5 years numbers, and get the total divided by number of years. That gives me average profit after tax. That's what they have done. So if you take the average 50 plus 50 plus 40 plus 40 plus 20 divided by 5 years, you must get 40,000 average profit after tax divided by my total investment 2 lakhs. 40,000 by 2 lakhs into 100, I got 20% ARR. Okay. Now the next one is rate of return on average investment. Average profit after tax by average investment into 100. How much is your average investment? Half of initial investment 2 lakhs minus salvage value 0 plus salvage value 0 plus additional working capital 0. So half of 2 lakhs, nothing but 1 lakh. So 40,000 by average profit after tax 40,000 divided by 1 lakh. So I got 40% ARR under average investment method. Now the next one is discounted cash flows method at cost of capital. Nothing but NPV calculation. Just now we got present value of cash inflows at cost of capital, that is 3,08,193, because they are clearly mentioned. They have clearly mentioned the cost of capital rate is 10%. So at 10% discount rate, we got present value of cash inflows of 3,08,193 and deduct your investment of 2 lakh rupees, then I'll get NPV, net present value. Net present value is nothing but the value that is calculated by discounting the cash flows at cost of capital. We got it. Now the next one is profitability index. So what is the formula for profitability index? Present value of cash inflows discounted at cost of capital divided by present value of cash outflows. I already told you, for calculating NPV and profitability index and discounted payback period, the appropriate discount rate is cost of capital. So just now we have calculated present value of cash inflows at cost of capital. The same present value of cash inflows can be used here for calculating profitability index. So 3,08,193 is the present value of cash inflows at discounted at cost of capital divided by my initial investment, nothing but present value of cash outflows is 2 lakhs. So 3,08,193 divided by 2 lakhs, that gives you 1.54 profitability index. That's what profitability index, which is more than 1. So I can accept the project. Since the NPV is positive, I can accept the project. Okay. Now the next requirement is IRR. I already told you we got positive NPV at lowest guess rate of 30%. So lowest guess rate is 10%. Why you are taking 30%? My dear students, lowest guess rate means the guess rate that you have used just before negative NPV. Nothing but I got negative NPV at 32%. So the lowest guess rate is just before 32% guess rate. Nothing but 30% is your lowest guess rate. Don't take 10% lowest guess rate, which will give you IRR, but that is inaccurate and that is not much more. That is not accurate answer. So if you want accurate answer, you must use 30% as the lowest guess rate and 32% as the highest guess rate. So please use here. What is the formula for IRR when it lies in between two guess rates? I must use interpolation method. What is the formula for interpolation method? L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. They have used one formula here. Don't take it. Just follow our formula. So what is the formula? Let me take it. Yeah, they have calculated NPV. That's it. Nothing new here. 2,03,063 minus 2 lakhs. This is NPV at L1 divided by 2,03,063 minus 1,95,941. This is NPV at. Okay, let me do it. Sometimes on the study material they'll give you few wrong answers. Let me do it. IRR is equal to, you know the formula, L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. L1 is lowest guess rate, that is 30%, 0.30 plus NPV at L1. Let me calculate NPV at L1. You know that 2,03,063 minus 2 lakhs, that is 3,063 divided by NPV at L1 is 3,063 minus, you know, the next guess rate 32% results in 2 lakh. Yes, that is 195,941 minus 2 lakhs and I got minus 4,059. Minus 4,059. 4,059. Okay. Into L2 minus L1. 0.3032 minus 0.32 minus 0.30. So solve it, you'll get the answer. So let me do it. 3,063 plus 4,059, 7,122, 0.30 plus 3,063 divided by 7,122 into 0.02. Yes, now 3063 divided by 7122, 0.30 plus 0.00860 plus 0.3. I got 3 0.30860 or 30.86%. This is your IRR, 30.86%. Oh, how much we got it here? $30.86. So same answer we got it. Now modified IRR. See dear students, modified IRR means I must convert all the year's cash flows into terminal year by using reinvestment rate as a compounded rate. The reinvestment rate given in the problem is 10%. Am I right? Look at the question. The reinvestment rate is, yeah, if the reinvestment rate is not given, I must consider cost of capital as reinvestment rate. That's what I've explained. If you remember, either reinvestment rate or cost of capital, whichever is available, I can use that rate as a reinvestment rate. So what they have done, look at the solution. First year cash flow can be reinvested for 4 years. Why? Because there are other remaining 4 years. So for all the 4 years, I can reinvest the first year ending cash inflow of 90,000 at reinvestment rate of 10%, nothing but cost of capital. So this is a compound rate. 1.1 whole to the power of 4 should be multiplied with 90,000. Then I got future value of 131,769. So 90,000 into 1 plus 0.10 cost of capital rate whole to the power of 4 years reinvestment period. I got future value of 1,31,769. The second year ending cash inflow of 90,000 can be reinvested for 3 years at a cost of capital rate of 1.1, nothing at a cost of capital rate of 10%. So 90,000 into 1 plus 0.10 whole to the power of 3, 1.1 whole to the power of 3, 90,000 into 1.1 whole to the power of 3, I got 1,19,790. Like that I should reinvest the cash flow of third year for 2 years, and fourth year cash flow can be reinvested for 1 year, and fifth year cash flow cannot be reinvested. 60,000 remains 60,000. Like that, please calculate the terminal value by converting all the year's cash flows into terminal year by using cost of capital as a reinvestment rate. Okay, so by that I got terminal value of 4,96,359. So now the question is, what is modified IRR? See, that's what they've done here. See, the terminal value is how much? 496,359. Modified IRR is the discount rate at which present value of terminal value should be equal to my initial investment. So my terminal value is 496,359. 496,359 should be multiplied with present value factor, as I told you, or as modified IRR that I don't know, comma 5 years should be equal to my initial investment of 2 lakh rupees. Present value factor r comma 5 years is equal to 2 lakh rupees divided by 4,96,359, and I got 0.4029. Trace this factor in annuity factor table, present value factor table, so that you can get the answer. So they got 2.48. That's not the right way to calculate actually. So let us see the table. The factor should be referred 0.4029. Now look at the present value factor table actually here. You see, I need a present value factor of 0.4029 against 5 years. So against 5 years, I must refer this factor 0.4029. 0.4029. Yes, 10% not possible. 5 years, 4029. Yes, 4029. So here is a factor 402, 4029 or 402. I can consider that approximately. So this present value factor corresponds to 20% discount rate in present value factor table. So I can say the IRR, modified IRR in this context is 20%. So your modified IRR is 20% by referring this present value factor and the present value factor table. So here is your modified IRR. So look at this, even in the study material, they got 20% modified IRR. Yes. Please see annuity table. That's what they told you. So we got modified IRR of 20%. With this problem number 17 this over. So with the help of this problem, we have covered almost every technique in capital busting. Hi dear students, good evening all of you. Our next chapter is cost of capital. Yes. Actually, say for example, if you are investing 1 lakh rupees in a bank and a fixed deposit, if the banker is paying annually 10% rate of interest for your investment, this 10% rate of interest is a return to the investor. It is a return to the investor, and it is a cost to the banker. Sir, why it is a cost to the banker? Because interest is an expenditure to the banker, that is known as cost. So why the banker is incurring cost? Because it is retaining the capital which belongs to so many types of investors. So for such retention, the banker is paying a compensation called interest, which is known as cost. In the similar way, the company is retaining the capital, which belongs to so many types of investors like equity shareholders, preference shareholders, in fact even reserves and surplus also, preference shareholders, debenture holders, bonds, and bank loans, nothing but loans from banks or financial institutions, debentures, bonds, loans from banks or financial institutions or from private lenders also. So for all these sources, the company has to pay some return to the investors. For example, for equity shareholders, it has to pay dividend, equity dividend. Preference shareholders, preference dividend. Debenture holders and bonds interest. Even for loans also, it has to pay interest. All these are returns to the investors and cost to the company. So such cost must be calculated for every source in the company. So since the company is raising several sources like equity, preference, debentures, bonds, loans, for all these sources, the company has to calculate the cost at the beginning of each year. And this cost should be calculated in percentage terms. And this cost should be calculated in annualized terms. Nothing but it is calculated for 1 year period. Okay, annualized terms, it should be calculated in annualized terms. Now, just like that, we have to calculate cost of equity KE, we have to calculate cost of reserves KR, cost of preference share capital KP, cost of debentures, cost of bonds, and cost of loans. All these are simply known as KD, cost of debt. So I have to calculate cost of equity, cost of reserves, cost of preference share capital, and cost of debt. And all these sources cost should be considered as the cost of the respective sources. But the point is, I have to calculate the cost of the total capital. Nothing but I have to calculate the average cost of the total capital. Since my capital comprises of so many sources, and I will never pay same cost to every source. For equity shareholders, the cost is higher, whereas for debt holders, the cost is cheaper, and for preference shareholders, the cost is moderate. But I want to calculate cost of the whole capital that I am raising. Nothing but I have to calculate the average cost of all the sources. So which average I have to calculate? The cost should be calculated by using weights of the respective sources. Nothing but I am going to calculate weighted average cost of capital. What was that? Weighted average cost of capital. So at the beginning of each year, every company must calculate its capital's cost, nothing but the cost of capital, which is simply known as weighted average cost of capital. So before calculating weighted average cost of capital, my first job is to calculate the cost of individual sources. So I should learn how to calculate cost of debt, and then I should learn how to calculate cost of preference share capital. Then I'll move to cost of equity, finally cost of reserves. This is what our job. So if you want to calculate cost at the beginning of every year, see, for every year at the beginning I have to calculate weighted average cost of capital, nothing but I want to know the cost of my total capital. So for calculating this weighted average cost of capital at the beginning of every year, the company first it should calculate the cost of the individual sources. So that's our first job. Now let me go for the first source called debentures. If I can understand the cost of debentures, I can easily apply the same formula set to the cost of loans and cost of bonds. The same formula set is applicable to bonds and loans also. So debentures are classified into two types. One is irredeemable debentures and redeemable debentures. So what is the difference? If you pay perpetual interest, then such debentures are irredeemable debentures. That's why irredeemable debentures are also known as perpetual debentures. Forever you are going to pay interest only, but you'll never pay principal. So principal redemption is not applicable to irredeemable debentures. In case of redeemable debentures, the debentures must be repayable or redeemable after a specified life period that you are mentioning. So such redemption, nothing but repayment of debentures, the principal component of debentures can be redeemed in two forms, either in lump sum, redemption in lump sum, or in installments, redemption in installments. Redemption in installments. So this is what the classification. So for all these situations, I have to calculate cost of debentures. How to calculate that? Let me start with the irredeemable debentures. Irredeemable debentures. One point I need to tell you, for every source, it can be debenture, preference share, equity share, I have to calculate cost under two circumstances. One at the time of fresh issue. The second one is for the existing instrument, financial instrument like debenture, preference shares and equity shares. Existing instrument means after issuing such source, from second year onwards that becomes an existing instrument. So I have to calculate cost at the time of issue, and then I have to calculate cost at the beginning of each year after the first issue. Okay, nothing but I have to calculate cost at the beginning of first year, at the beginning of second year, at the beginning of third year. Like that I have to calculate cost at the beginning of each year. Only for first year, it's a case of fresh issue. From second year onwards, it will be the cost of existing instrument. So why you are saying this? Because for fresh issue, I'll always use net profits as a denominator base. Whereas for existing instrument, I'll consider market price. Because after issue, every financial instrument like debentures, bonds, shares, preference shares, equity shares, all these financial instruments will be listed in Indian stock exchanges like BSE and NSE, and those are going to be traded. So we can see some price for such instruments, and such price as a basis for calculating the cost of every source, cost of debentures, cost of preference shares and cost of equity shares from second year onwards, okay, after the issue. So for this reason, I have to calculate cost under two circumstances. In case of fresh issue, for the first time. In case of fresh issue, what is the formula for cost of debentures? Simple. Cost of debentures KD is equal to, I have to write the money that I am receiving in the denominator, because for this loan only, for this money only, I am paying cost. The cost should be written in the numerator, nothing but, see, in shortcut form I am going to write it NP. So what I'm going to pay? Interest. But for this interest, I'll enjoy some tax saving. Why? Because interest is a tax deductible expenditure. So Income Tax Act allows the interest expenditure on debt as an allowable expenditure. So since you are deducting such interest, since you are deducting this particular interest portion while calculating taxable profit, you can save some tax liability. Because if you raise equity, such dividend, if you raise preference share capital, such preference dividend payment are not tax deductible expenditure. So I cannot enjoy tax saving by paying preference dividend and by paying equity dividend. But by paying interest, I can reduce my tax liability. Such saving is a benefit. Interest is a cost. tax saving is a benefit. So tax saving on interest can be calculated by multiplying interest with tax rate. So take the common term I out of it, then I'll get I into 1 minus T by NP. This is the formula for cost of debentures, irredeemable debentures in case of fresh issue. So what is the formula? Interest after deducting tax saving. That's why this is known as after tax interest. After tax interest means interest after deducting tax saving. So I into 1 minus T is your cost divided by my net profits. That gives me cost of debentures at the beginning of the first year. So that's my cost, the annual percentage cost. Okay, this is an annual percentage cost. In the similar way, after 1 year, I have to calculate cost of debentures even for existing instrument also, in case of existing instrument. In case of existing instrument, what is the formula? Cost of debentures KD is equal to same numerator I into 1 minus T only, but in the denominator, instead of taking net process, I must consider market price of the debenture. So just like this, first year, for first year, I should consider net process, because at the time of fresh issue, I'll receive net profits, and then at the end of first year, my cost will be I into 1 minus T, interest after deducting tax saving. But from second year onwards, for calculating cost of debentures at the beginning of second year, I must use market price here rather than net profits. So at the end of second year, the cost is I into 1 minus C. There is no change in it, but I have to consider market price. So for existing instruments, always the denominator is market price but not net process. Only for fresh issue, I must consider net profits. The question is how to calculate net process. I'll explain. So my dear students, in these two formulas, I means interest amount on the single debenture face value. Okay. T is income tax rate. NP means net profits. Sir, how you can calculate net profits? Let me show you how to calculate net profits. Simple. Every debenture can be issued either at face value or at premium or at discount. If you are issuing debentures at premium, add premium to that particular face value to get issue price. If you are issuing such debentures at discount, deduct such discount from face value in order to get issue price. So face value, add or less premium or discount. If it is a premium, add it. If it is a discount, deduct it. Then you're going to get issue price. From this issue price, please deduct issue expenses like flotation cost, underwriter's commission, and brokerage. Sorry. My dear students, the issue expenditures can be given in any form like flotation cost, underwriter's expenses, underwriter's commission and brokerage. Generally, these three expenses are expressed as a percentage on issue price or face value. It depends. So these issue expenses must be applied on face value or issue price, whichever is higher. So based on the information, if issue price is more, apply issue expenses percentage on issue price. If face value is more, then apply issue expenses percentage on face value. Why? Because sometimes my issue price may be discounted price. In that case, the issue price is low, whereas face value is higher. 100 is face value, issue price is 90 after deducting 10% discount, just like I'm taking example. So in that case, on which price I must apply issue expenses? Say for example, if the issue expenditure flotation cost is given as a percentage, that is 5%. So without mentioning anything about it, so such 5% must be applied on face value or issue price, whichever is higher. So after deducting issue expenses, I'll get net profits. This is the way to calculate net profits. So I'm not explaining these terms called flotation cost, underwriter's commission, brokerage, because it kills time. So since it's a fast track class, just follow the format. So net profits, face value, add premium or less discount, then I'll get issue price minus issue expenses, flotation cost, underwriter's commission, brokerage, and net process. So successfully we understood every term. With this, irredeemable debentures cost computation is completed. Now I'm moving to the next area called redeemable debentures. Yes. Even for redeemable debentures also, there are two cases. In case of fresh issue and in case of existing instrument. What are the formulas? Simple. In case of fresh issue, cost of debentures KD is equal to I into 1 minus T is a common term. In addition to that, I must add one term called RV minus NP by N whole divided by RV plus NP divided by 2. It's a shortcut formula for calculating cost of debentures in case of fresh issue, redeemable debentures. So I into 1 minus T plus RV minus NP by N. So my dear students, this I into 1 minus T is a known term. So why you are taking the second term, RV minus NP? Say for example, I am issuing debentures at 100 rupees, whereas redeeming the debentures at 110. That means I am taking 100 rupees from the debenture holder, whereas I am repaying 110 rupees at the time of redemption. That means additionally I am paying premium at the time of redemption. So how much additional money I am paying? 10 rupees. 110 minus 100. 110 rupees I am repaying, whereas 100 rupees I am getting from the debenture holder. I am receiving from the debenture holder. Additionally, I am paying 10 rupees premium cost divided by, say for example, if the life of such debentures, because these debentures are redeemable debentures, so these debentures will carry some life. So the life of such debentures are 10 years. So if I write 10 years here, 110 minus 100, 10 rupees divided by 10 years. So per annum premium cost to the company is 1 rupee. This is a premium cost perception. In the similar way, sometimes the redemption value can be less and net process can be more, and that can be a benefit to the company. So this can be happened also. So my dear students, my suggestion is, instead of interpreting this particular formula, you better follow the formula strictly. Okay. So why you are taking the denominator term? Nothing but I'm receiving net process, I'm redeeming some value, I'm taking average of these two numbers. So net process at the beginning of the at the time of issue and redemption value on redemption date. So these two, the average of these two numbers must be considered for calculating cost of debentures. See, this is not a mathematically derived formula. It is just an approximate, it is just a formula for approximate answer. You don't get accurate answer, but still it is an acceptable answer for getting full marks. Okay. Now this is for fresh issue. So now the questions are, what is I? I means interest. T means income tax rate as usual. So what is RV? Redemption value at the time of redemption. NP means net process as usual, N is life of debentures. Life of debentures means number of years. This is for fresh issue. In case of existing instrument, same formula. Instead of writing net process, please write market price. So formula will be I into 1 minus T plus RV minus MP by N whole divided by RV plus MP divided by 2. Nothing but instead of taking what net process, I'm taking market price of debentures. This is for existing instrument. So we understood fresh issue and we understood existing instrument. So with this, redeemable debentures cost computation is over. So successfully we have completed debentures cost computation. So what about redemption installment? IRR concept must be applied. Also known as YTM method. This is not there in your syllabus actually, so not an issue. So my dear students, let us go for this next source called preference shares, cost of preference shares. So before going for cost of preference share, one more point I want to tell you regarding redemption value. Unless otherwise specifically stated in the problem, I should always assume that RV means redemption value, which is always equal to face value. If there is no information in the problem, what I should do? RV is equal to par value or face value. If there is an information like premium, that means there is a specific point in the problem, the debentures are redeemable at a premium of 10% or at a premium of 20% or at a premium of 15%, then consider such redemption value by adding such premium. So if there is no information in the problem, I should always assume that redemption value is equal to par value. Now let me go for the next source called cost of preference shares. Before going for calculating cost of preference shares, let me tell you one important point. Whatever the preference dividend you are paying on preference shares for every year, that is not a tax deductible expenditure. In fact, this is an appropriation. So you cannot enjoy tax saving on preference dividend. So we have applied I into 1 minus T for cost of debentures computation, but here I am not going to apply preference dividend into 1 minus tax rate. So why you are not taking preference dividend into 1 minus tax rate? Because preference dividend is not an allowable expenditure under the provisions of Income Tax Act. So I don't get tax saving because of preference dividend. So don't multiply PD with 1 minus tax rate. That's what the important point you should keep in mind while calculating cost of preference shares. So here also I'm going to classify these preference shares into two types: irredeemable preference shares and redeemable preference shares. And redemption in lump sum is a case that I am going to handle, nothing new here. Now let me start with the first area called irredeemable preference shares. Just like in debentures, here also I am going to classify the two situations, two circumstances. One in case of fresh issue, other one is in case of existing instrument. In case of fresh issue, nothing new, the same formula set that I am going to use, but instead of using I into 1 minus T, I am going to use preference dividend. So what is the formula for cost of preference share capital? If you ask me, the formula is same, nothing new. In the denominator, I'll take net process only, but in the numerator, instead of taking I into 1 minus T, I must consider preference dividend. That's it, nothing new here. Okay. In case of existing instrument, what you need to consider? In case of existing instrument, you know, dear students, for existing instrument, what you'll write? Substitute the term net profits with market price. That's it. So KP is equal to preference dividend divided by MP. MP means market price of preference shares. Market price of preference shares. PD means preference dividend. In the previous formula, MP means market price of debentures. Here, I should apply market price of preference shares. Okay. This is for irredeemable preference share capital. Let me go for the next area called redeemable preference share capital. The same formula set that I am going to use, nothing new here again. In case of fresh issue and in case of existing instrument, recollect the previous formula. The same formula is applicable here also. Just instead of taking I into 1 minus T, I'll take PD. So KP, cost of preference share capital, KP is equal to, instead of I into 1 minus T, I'm taking preference dividend into preference dividend plus RV minus NP by N, the same formula, divided by RV plus NP divided by 2. Nothing new here. So what about these terms? PD means preference dividend. RV means redemption value of preference shares. NP means net profits on issue of preference shares. N means life of preference shares. That's it. Okay. So what about existing instruments? Substitute the term market price in the place of what? Net profits. Nothing new. In case of existing instrument. In case of existing instrument, what I'll do? KP is equal to preference dividend plus RV minus MP by N whole divided by RV plus MP divided by 2. That's it. So what about MP? Market price of preference share. That's it. So this is regarding cost of redeemable preference share capital. That's it. Now, dear students, let us understand few more formulas which are given in your study material by applying dividend tax actually. So every formula is covered except one additional formula that I need to explain. What was that? This one. Actually, have you observed this formula? I plus RV minus NP by N whole, for such whole term I'm multiplying 1 minus tax rate. So why you are multiplying for whole term? Actually, I should write I into 1 minus T plus RV minus NP by N. That's what the original formula. Why you are taking why you are multiplying this 1 minus tax rate with a whole numerator term? See, this is one of the assumption. Generally, interest is tax deductible expenditure. Sometimes if the RV minus NP difference, premium is also a tax deductible expenditure. Nothing but premium is a cost to the company. So for example, I'm raising 100 from the debenture holder, whereas I'm repaying 110. That means additionally I'm paying 10 rupees cost. And if such cost, that cost is known as what? Premium cost at the time of redemption. If the income tax department allows such premium cost as one of the expenditure annually, then I can take such premium cost as an expenditure, and also I can take such premium cost for considering tax saving. That means even for premium payment also I'll get tax saving. Premium into tax rate, nothing but tax saving. So for the second term also I must multiply RV minus NP by N into 1 minus tax rate. That's what you need to apply actually. But in majority cases I'm not going to use this formula. That means I'll always try to apply the first formula only, into 1 minus C plus RV minus NP by N whole divided by RV plus NP by 2. For the entire numerator term, I am not going to multiply 1 minus tax rate. But they have given one formula in case, if at all, if you can find any problem in the examination, like even the premium which is payable by the company is tax deductible. If you can find such point, then you should change the formula. Instead of multiplying such 1 minus tax rate with I only, you should also multiply such 1 minus tax rate with the second term called RV minus NP by N. So the formula will be changed completely. I into 1 minus tax rate plus RV minus NP by N into 1 minus tax rate whole divided by RV plus NP by 2. Hopefully you cannot find such kind of problems. Hopefully. Now this is one more point. Now I need to explain this term called amortization of bond, nothing but valuation of bonds, and then I need to explain cost of convertible debentures. I'll explain, no issue. Let me handle the next areas called cost of preference share capital. I've explained every formula here, but before going for that, I need to give you one important term called dividend tax. In case if you can see the dividend tax in the problem, then the formula will be slightly changed. What will happen? Look at the formula. This is your regular formula. PD plus RV minus NP by N whole divided by RV plus NP by 2 for redeemable preference shares. I know that when dividend tax is not considered. In case when dividend tax is considered, what will happen? The formula will be slightly changed. Instead of writing preference dividend, please write preference dividend into 1 plus dividend tax. That means I am adding dividend tax to my preference dividend. I am increasing the first term, nothing but I am adding what? Preference dividend tax to preference dividend component. That is my cost. Why? Because the company itself has to pay what? Preference dividend tax. Along with preference dividend payment, the company has to pay additionally preference dividend tax. So you should add preference dividend tax to your preference dividend, nothing but PD plus PD into DT actually. So if you take the common term out of it, PD into 1 plus DT, where DT is dividend tax, preference dividend tax. The second term remains same, RV minus NP by N. And numerator, there is no change, RV plus NP by 2. So this formula is applicable only when the dividend tax is considered. Okay, nothing new here. So the same terms they have given here. And also you should understand one important term called computation of dividend tax. So how I can calculate dividend tax? Let me tell you few important points here. First of all, the tax rate can be given on dividend. The regular tax rate can be given on the the regular tax rate which is applicable on dividend can be given, normal tax rate. Along with that, they'll give you surcharge. So surcharge, if the surcharge percentage is given in the problem, that should be calculated on tax on dividend. And if the education cess and secondary and higher education cess are given in the problem, then those two percentages should be applied on regular tax rate plus surcharge. Sir, I'm not understanding this point. How you can explain this? Let me show you one solution for understanding this point. Now look at one of the illustration which is given in the study material. I'll straight away explain this point. Tax. If tax on dividend is 12.5%, surcharge is 2.5%, education cess is 3%. Calculate the cost of preference share capital. You should not add 12.5 plus 2.5 plus 3. You have to calculate this dividend tax in a different way. Now, let us see the dividend tax. 12.5% is the regular tax rate which is given in the problem. Surcharge should be applied on 12.5%. 12.5 into 2.5%. I got 0.3125. Have you observed it? 3%, actually 2.5% of 12.5, that is 0.3125. This is the second part. Okay, surcharge part. And the third part is education cess is 3%. Education cess 3% should be applied on the first tax rate, dividend tax rate plus surcharge rate. So nothing but 12.5 plus I got 0.3125 surcharge. So 12.5 plus 0.3125 into 3%. So I got 0.384375, nothing but approximately 0.3844. So like that you have to apply. So again I'm repeating, surcharge should be applied on the first tax rate 12.5%, and then education cess should be applied on tax rate plus surcharge. So like that you have to calculate dividend tax actually, and such dividend tax should be substituted in the formula, so that you can get answer. Okay, this is regarding dividend tax application. Now the same application is applicable to irredeemable preference shares also. So the regular formula is preference dividend by net process or preference dividend by market price for existing instrument when dividend tax is not considered. If the dividend tax is considered, the formula will be slightly changed. So PD into 1 plus dividend tax divided by net proceeds for fresh issue or market price for existing instrument should be considered. So this is a formula I must apply if dividend tax is considered. Okay, then fine. Now I need to explain two more concepts for debentures. See how to calculate the value of the bond. For calculating value of the bond, I need two things actually. One is the future cash flows, and expected interest rate, which is also known as expected yield on the bond. Expected interest rate. This is not the actual interest rate on bond. This is expected interest rate of investors, also known as expected yield. So the future cash flows from every bond depends upon the nature of the bond. If the bond is a redeemable bond, I'll get the cash flows in two forms. One is interest cash flows for every year, interest per annum, interest cash flows for every year, and redemption value on redemption. Sometimes this redemption value can be made in lump sum redemption. At the time of redemption, you may get the complete value, or this redemption value can be done in installments form also. So if it is given in installments form, such installments and interest should be added every year, and you have to define future cash flows accordingly. So I'll show you one problem. So how to calculate value of the bond? Define the future cash flows and identify the expected interest rate or expected yield. Discount these future cash flows at this expected interest rate or expected yield on the debentures or bonds, so that I'll get value of the bond. So what is the meaning of the value of the bond? Present value of future interest and principal cash flows derived from the bond, discounted at investors expected interest rate or invested expected yield. That's it, investors expected yield. Okay, so that's what the value of the bond. So simply discount the future cash flows like interest and principal redemption at investors expected interest rate or expected yield. We have one problem related to this particular concept also. Let me show you. Here is the problem. See, X Limited is proposing to sell a 5 years bond of 10,000 at 10% rate of interest per annum. The bond amount will be amortized, nothing but will be repaid. Amortized means repaid equally over its life. That means 10,000 by 5 years. Every year, if you buy this bond, every year you'll get 2,000 rupees principal redemption along with interest. What is the bond's present value for an investor if he expects a minimum rate of return of 6%? So this 6% is a discount rate. Now look at the points here. First year, what is your cash flow? I will get interest on my principal amount of 10,000. 10,000 into 10%. 1,000 rupees is the first cash flow at the end of first year. Along with that, I'll also get what? The principal redemption annually, because I'm getting equal amortization every year. So 10,000 principal that I have invested for 5 years period, every year this particular company, nothing but who is this? X Limited is giving me 2,000 rupees principal along with interest of what? 1,000. 2,000 plus 1,000, my total cash flow is 3,000 rupees. Have you observed one thing here? Interest and payment of principal are given here. Now what about second year? See, for second year, I don't get interest on complete 10,000 rupees because I am getting principal redemption at the end of first year of 2,000 rupees. For balance amount only, 8,000 rupees only, I'll get interest. So 8,000 into 10% interest, 800 rupees is my amount of interest plus the principal redemption 2,000, 2,800 is my cash inflow for second year. Like that, I must define cash flows for all the 5 years, and these cash flows, interest and principal redemption, should be discounted at investors expected rate of return called 6% rate which is given in the problem, 6%. So at this rate only I have to discount the cash flows. So how to discount the cash flows? Simple, 1 by 1 plus r whole to the power of n. 1 by 1 plus r means 0.06. For first year cash flow, 1 by 1 plus 0.06 whole to the power of 1 should be used. For second year, 1 by 1 plus 0.06 whole to the power of 2 should be used. And those factors must be multiplied with the respective cash flows. See, here they have given you an equation. Instead of this, you can use the table like this. Just simply calculation of value of the bond. I'll give you the format only. I'm not going to calculate the value of the bond. You have to take the columns like this. Here, cash flows. Already we have defined interest and principal redemption as cash flows. Write the present value factors at 6%. 1 by 1 plus 0.06 is equal to first year factor, is equal to second year factor. Like that, calculate the present value factors. Multiply these two numbers so that you will get what? Present value of cash flows. So 1, 2, 3, 4, 5. Just now we have defined all the year's cash flows. Write the cash flows here. Okay. Write the present value factors here. Multiply these two numbers. Multiply these two numbers so that you will get what? The present value of cash flows. This will be your value of the bond. In the simple table, I can calculate value of the bond instead of using that particular equation. Okay. This is regarding value of the bond. We understood. Now, let me go for the next concept called cost of convertible debentures. Cost of convertible debentures. Sir, what is a convertible debenture? Convertible debenture means the debentures will be converted into certain number of equity shares at the discretion of the investor on redemption date. Generally, for redeemable debentures, what we will do for debenture holders, I am going to repay the principal at the time of redemption either at par value or at premium value. This is what going to happen for redeemable debentures. But for for convertible debentures, what will happen? Instead of giving cash to the debenture holders on redemption, we are going to give shares to the debenture holders, which is decided at the time of the issue itself. So how I can decide that? Simple. Every debenture will be converted into certain number of equity shares. Say for example, each debenture will be converted into 10 shares. So 10 shares will be issued for every debenture on conversion date. So what will happen? The formula will be changed here. For convertible debentures, how to calculate cost of debt? Cost of debentures, nothing but debentures means convertible debentures. The same formula that I have used for calculating cost of redeemable debentures, the same formula I am going to apply here. I into 1 minus T plus RV minus NP by N whole divided by RV plus NP by 2. No change in any term. All the terms are same except the red mark term called RV. RV I must define because at the time of redemption I am not giving the principal in the form of cash. I am giving their investment in the form of shares. So the value of shares are completely different because share values will change from one year to another year. Always the share price will grow. So the redemption value is a pure computation. So I must use one formula here. The formula for redemption value is number of shares for each debenture. Number of shares for each debenture on conversion date into the market price of the respective share at the end of the nth year, nothing but at the time of redemption. Okay. For example, every debenture is converted into 10 number of shares and on nth year, the price of the share at the time of redemption is 15 rupees. So I am going to give them 150 rupees worth of shares to the debenture holders. This is their discretion. They can choose the principal in the form of cash or they can get the shares and they can sell these shares in the market and then they can get their money. That's their option. From my point of view, how to calculate this redemption value? How to calculate this redemption value in case of convertible debentures? So the redemption value can be calculated like this: number of shares for each debenture on conversion into MPN. Now MPN means nth year ending market price. N means life of convertible debentures. Now there is a formula for MPN. What is the formula for MPN? MPN depends on how the share price is growing. So generally the share price will grow on compounded basis. The formula is MP naught into 1 plus Z whole to the power of N. This is a formula for MPN. Say for example, I want to calculate 5th year ending price, and today's share price is, say for example, it is 10 rupees share price. 1 plus G, the growth rate applicable to the share price is 15%, 1.15. For how many years, sir? 5 years. 5th year ending share price I want to calculate. Simple, 1.15. 5th year ending factor I need it. It's a compounding factor. 1 year, 2 years, 3 years, 4 years, 5 years. It is 10 into 2.011357. Multiply this number with 10 rupees. I got 20.11. This is my redemption value of the shares. Nothing but redemption value of the debentures. So, sorry, this is my share price at the end of 5th year. If you multiply this 20.11 with 10 shares, the answer will be changed. Say I've taken another example. Don't confuse. So don't get confused actually. So 20.11, 10 into 20.11 means 201.11. This is the redemption value of debentures, convertible debentures. Okay. See, this is a random example. And this one is a separate number which I have calculated separately. Okay. So don't get confused actually here. Now dear students, with this we understood cost of convertible debentures. The only point is redemption value computation. That's what you need to understand. Now let us go for the next area called cost of equity shares. Dear students, expecting fixed future like preference dividend and interest payment is so easy. Whereas for equity shares, the payment of dividend is variable. So based on variable future expectation, calculating cost of equity shares is a cumbersome work and difficult task. Because of this reason, we have several approaches for calculating cost of equity shares. The first approach is dividend by price approach. Second approach is earnings by price approach. Third one, dividend by price plus growth approach. This is a very important approach. Very important approach. Next approach, earnings by price plus growth approach. And then the next approach is realized yield approach. And finally, capital asset pricing model. This is very important approach. Capital asset pricing model, shortcut CAPM. Okay. So these are the approaches we need to discuss. Let us start with its dividend by price approach. So CAPM is also a very important approach actually. This is also a very important approach. Let me start with the first approach called dividend by price approach. For every source, I must consider two circumstances, in case of fresh issue and in case of existing instrument. So in case of fresh issue, the formula for cost of equity K is, there is no change. For debentures computation, I have taken I into 1 minus T by net process. For preference shares, PD by net process. Here also I am going to take in the denominator net process only. But in the numerator, I don't take I into 1 minus A. I don't take preference dividend. I'll take DPS, dividend per share of equity shareholders. Okay, this is for fresh issue, nothing new. Net process means net process on issue of equity shares. In case of existing instrument, KE is equal to DPS by MP naught. You must mention MP0. That is very important. Okay. Cost of equity KE is equal to DPS by MP naught. This is for dividend by price approach. So what is DPS? Dividend per share. What about MP naught? Current market price per share. That means the market price of the share today in year 0, not at the end of first year. In year 0 itself, today itself. Okay. This is regarding cost of cost of equity in case of fresh issue and in case of existing instrument. So for fresh issue, I must use net process. For existing instrument, I must consider MP naught. Okay. Now let me go for the earnings by price approach. Simple. Instead of taking dividend per share, I must consider earnings per share. That's it. Nothing new. Here also the two circumstances in case of fresh issue and in case of existing instrument. In case of fresh issue, what will happen? Simple. KE is equal to cost of equity. KE is equal to, instead of taking dividend per share, I must consider earnings per share. EPS by net process. In case of existing instrument, what will happen? In case of existing instrument, KE is equal to cost of equity. KE is equal to earnings per share divided by market price MP naught. So instead of taking net process, I am taking current market price per share MP naught. This is what for existing instrument. So the same formula I have applied, but instead of taking net process or instead of taking dividend per share, I have taken what? EPS, earnings per share. See, these two theories are more or less same. There I am taking dividend per share, 100% dividend distribution. Here also I am taking earnings per share. The perception is changed. Here also I am taking EPS. There also I am taking EPS. But the point is, that is about distribution. This is about earnings. So based on the requirement which is asked in the examination, you have to apply the formula accordingly. But in most of the cases, the next theory that I am going to discuss is very important. That is dividend by price plus growth approach. Dividend by price plus growth approach. This is an important theory. Very important theory. Very important approach you have to understand. So here also, see, before going for this, actually, I must say one thing. Under this theory, the dividends will grow. For how many years, sir? Forever. For indefinite period, up to infinite period, the dividends will grow. But the growth rate is always constant. That is what the important point you must remember. G is always constant here. Okay, remember that. Now, here also, I am taking two circumstances in case of fresh issue. Cost of equity KE is equal to, the notations will be slightly changed. No change in the denominator, net process only for fresh issue. But in the numerator, instead of taking constant dividend per share, I must consider dividend per share at the end of first year, DPS1. Additionally, I must add growth. Okay, G. In case of existing instrument, what will happen? Just write the formula. Cost of equity KE is equal to, this is very important actually, I must write fully. Cost of equity KE is equal to DPS1 by, instead of net process, I must consider market price today, today's market price, MP naught plus growth rate is quite common. Growth rate is quite common. MP naught plus G. Okay. So this is a very important formula. You must remember forever until you qualify final. Okay. So DPS1 by MP naught plus Z. Even from this formula, I am going to define one more formula called MP naught actually. See, KE minus G is equal to DPS1 by MP naught. Then from this, MP naught is equal to DPS1 by KE minus C. Actually, from this formula only KE is defined, but just I am taking for the sake of understanding MP naught from this formula. So what is MP naught? Today's price, DPS1 by KE minus C. Sir, what is this DPS1 by KE minus C? I'll explain. First, let me define the terms one by one first of all. First, where DPS1 is equal to dividend per share at the end of first year. How I can get this? Add growth rate to your last year dividend, which is known as DPS naught. DPS naught into 1 plus Z power 1. That gives me DPS1. Generally I don't mention d power 1 actually. I'll write dps not into 1 plus z. If I write power 1, I'll get dps 1. If I write power 2, I'll get dps 2. If I write power 5, I'll get dps 5. If I write power n, I'll get what? Dps n. So I can calculate dps n at the end of any year, simply by multiplying last year dividend dps naught with 1 plus z power n. Okay. Here I need dividend per share at the end of first year. So the formula will be dps naught into 1 plus z. Power 1 is obvious. No need to say that. Okay. Now, you know that KE means cost of equity. MP naught means current market price per share. MP naught means current market price per share. And G is equal to growth rate. G is equal to growth rate. This is a multiplication of two factors called B into R, where B is retention ratio, how much profit you are retaining of equity shareholders. Say for example, if we got earnings after tax which belongs to equity shareholders of 100 crores, and out of that I paid equity dividend of 40 crores. So how much profit I am retaining? 60 crores. This is what? Retained profit. Okay, or retained earnings. Now look at the point here. Out of 100 crores profit which belongs to equity shareholders, how much profit I have retained? 60 crores. This is nothing but 60%. This 60% is known as what? Retention ratio. So let me write it clearly. Retention ratio. Retention ratio. So what about this R? R means return on equity. Return on equity. So how to calculate return on equity? Simple. Profit after tax by equity. Profit after tax by equity. This is a formula for return on equity. This is nothing but the profit percentage on my equity fund. Okay. Rate of return on equity. So if you can multiply these two factors, I'll get growth rate. Okay. So what is the formula for growth rate? B into R, where B is retention ratio. This is simply profit after tax minus equity dividend. Profit after tax minus equity dividend divided by profit after tax. Okay. Or I can say retained profit divided by profit after tax. This is a formula for what? This is a formula for growth rate. Okay. So with this we understood all the terms for dividend by price plus growth approach. Okay. Yes. Now I can go for realized yield approach. Sir, what is this realized yield approach? You know, dear students, realized yield approach is nothing but the return that I have earned in the past. Realized means past tense. That means the realized yield. Yield means return. So whatever the return that you have realized in the past, that should be expected as equity shareholders expectation called KE for the next year. That means the past return as an equity shareholder, whatever we have earned, the same return if you can expect in the future, that is what cost of equity. So I am calculating cost of equity KE by taking past as a basis. Such past is nothing but the realized yield, and that return should be expected in the future. Nothing but this cost of equity KE calculation is nothing but calculation of IRR. So I have to calculate IRR by taking past few years cash flows. So compounded growth rate, compounded yield should be calculated. Accordingly, the same rate will be cost of equity KE. So I'll explain that part when we are handling the study material. Yes. Now let me go for the next theory called capital asset pricing model. I'll explain this realized yield approach when we are going for the study material. Capital asset pricing model. This is an important theory. Shortcut term is CAPM, a famous name, CAPM, capital asset pricing model. So what is this model? This model is saying how much return every investor should expect for a given level of risk. But they are classifying this risk. Who are classifying? Actually, this method has been developed by Sharpe, William Sharpe. And Mr. Sharpe says risk is classified into two parts: systematic risk and unsystematic risk. So what is systematic and what is unsystematic risk? Systematic risk means the risk which is unavoidable. The risk which is unavoidable. Actually, this is unavoidable. which is applicable to every company in India, like inflation rate fluctuations, foreign currency rate fluctuations, GDP fluctuations, and then interest rate fluctuations, and government tax rate fluctuations. So if there is a change in any macroeconomic factor, that will affect every company's share returns. So that this is what the risk which arises because of external factors called macroeconomic factors. Whatever the risk which arises because of external factors called macroeconomic factors, that's what systematic risk, that is unavoidable. Any investor in the world should face a systematic risk which is not diversifiable. That means by putting my money in different company shares, I cannot avoid this risk, and that's why this is non-diversifiable risk. Non-diversifiable risk. Non-diversifiable means, diversification means investing in more than one company shares. Investing, if you invest your money in different companies' securities, your risk will be eliminated through diversification. So a portfolio, if you invest in more than one company shares, that means you are forming a portfolio, group of securities you are buying. So if one company is giving loss, the other company will give you profit. The abnormal gain from one company will be adjusted against abnormal gain from other company, so that you will get minimum return. So you can avoid risk through diversification. That means by putting your money in different company securities, by investing your money in different company securities. That's what diversification. Even though by going for diversification, you cannot avoid systematic risk which arises because of what? Inflation rate fluctuations, foreign currency rate fluctuations. Like that, there are some factors, macroeconomic factors. Those factors affects every company in India, that is unavoidable. Whereas unsystematic risk is that portion of total risk which can be avoided through diversification. Every investor can avoid unsystematic risk. Why? Because unsystematic risk is company specific, firm specific, which is based on the inefficiency of the company. So this part of risk can be eliminated by putting my money in different type of securities. So if I can invest my money in different company securities, I can eliminate this portion of risk. So but still I cannot eliminate systematic risk. And Mr. Sharp says, don't expect additional return or premium for this unsystematic risk, because that can be avoided through diversification. Expect premium only for systematic risk, which is measured with beta. Okay, which is measured with what? Beta. So this unsystematic risk is also known as diversifiable risk. That means through diversification, I can eliminate this portion of risk, diversifiable risk. The risk will be eliminated through diversification by investing in different company securities. The portion of risk that is not diversifiable is systematic risk, which is known as non-diversifiable risk. And this systematic risk, for this systematic risk only, you must expect premium return for the company shares, which is measured with what? Beta. So under CAPM, they have defined one formula called cost of equity KE is equal to RF plus beta into RM minus RF. This is what the formula. So what is RF? The risk-free rate of return that you can earn from Indian treasury bills. The risk-free rate of return that you can earn from Indian treasury bills. Every investment in India is risky except one instrument which is being issued by Government of India. Any bonds issued by Government of India or treasury bills are the best examples of risk-free asset. The return that you can earn from such Government of India bonds or risk-free, Government of India bonds or Indian treasury bills are the best examples for risk-free rate of return or risk-free return or risk-free rate of return. And this beta is systematic risk. Just now I have explained. It's a factor which ranges between like less than 1, more than 1 or equal to 1. Your beta can be equal to 1, more than 1 or less than 1. Whereas RM is known as return on market portfolio. Return on market portfolio. Market portfolio means it is nothing but Sensex portfolio or Nifty portfolio. So whatever the return that you can earn from the market portfolio, the best portfolio which is comprising of top 30 securities in Sensex or top 50 securities in Nifty, if you can take the average return of such portfolio, market portfolio, that is known as return on market portfolio. This is also known as average market return. That means I am taking the average of top 30 companies return in the Sensex. Average market return. So RM means average market return or return on market portfolio, and RF, you know that. So I'll tell you one more point. Beta, yeah, I have explained beta point and already in the chapter risk and return, so I don't need to explain this part. So finally, what is the formula for cost of equity KE under CAPM? See, RF plus beta into RM minus RF. That is what the formula for cost of equity KE. And also, I need to tell you one important point. RM minus RF, which means what? RM minus RF means market risk premium. This is known as market risk premium. That means the risk premium that you can earn by moving from risk-free asset to market portfolio. This part of market risk premium can be earned by facing a beta called one time actually. So that's okay. Just remember the formula. RM minus RF means market risk premium. Sometimes this can be known as average market risk premium. Average market risk premium. See, you may be confused between these two terms called average market return and average market risk premium. You should be very cautious while handling these two terms. Just by saying average term, you should not write RM. Okay. Why? Because RM means average market return. If in the examination, if they have given you this particular term called average market risk premium, you should not write RM because that is market risk premium. So read the sentence very carefully, and that is clearly saying what average market risk premium. That means I have to consider RM minus RF. That's what the point here. Okay. So with this, we understood cost of equity KE computation under CAPM, RF plus beta into RM minus RF. Yes, thank you. Hi dear students, good evening all of you. Now let us continue with the chapter cost of capital. In the previous session, we understood cost of equity under capital asset pricing model. Now let us go for the next model, next calculation of the next source, cost of retained earnings. Here is the source, cost of retained earnings. You know, for cost of retained earnings, we have several formulas here actually. Cost of retained earnings. See dear students, retained earnings is the money which belongs to equity shareholders. So whatever the cost which is applicable to equity, the same cost must be applied to cost of retained earnings. So this is first method actually. Method 1, under method 1, cost of retained earnings is nothing but cost of existing equity KE. So here is the formula, cost of retained earnings KR is equal to cost of existing equity KE. This is what the formula. So cost of retained earnings KR is equal to cost of existing equity KE. This is method 1. Under method 2, you can see two components actually. One is if the personal tax rate and brokerage rate or brokerage or commission rate, actually you can see here commission and brokerage, both the terms are considered as C here. Okay, if the personal tax rate and brokerage or commission are given, then the formula for cost of retained earnings is different actually here. So here under method 2, KR is equal to KE into 1 minus TP or personal tax rate or marginal tax rate into 1 minus C into 1 minus C. So this is the formula for cost of retained earnings in case of the personal tax rate and brokerage or commission rates are given here. So look at the formula here in the study material or in our material. KR is equal to KE into 1 minus T into 1 minus C. KE is cost of equity, T is marginal tax rate or personal tax rate, whereas C is commission or brokerage rate. Okay, these are the terms you should apply you should substitute. That means these terms should be available in the problem. If you can substitute these terms in the formula, then you can get cost of retained earnings. So this is first method, and the second method is nothing but cost of retained earnings KR is equal to cost of existing equity KE. We have written the first method as second method and second method as first method. It doesn't matter. Actually, first you should remember this formula as method 1. Cost of retained earnings KR should always be equal to cost of existing equity KE. In case if these terms are specifically given in the problem, you have to apply this formula. Okay, so this is regarding cost of retained earnings. Now let us apply these formulas to one of the few problems in the study material. There are 2 problems in the study material. Now look at this formula. A firm's KE return available to shareholders is 10%. Cost of equity KE is 10%. The average tax rate of shareholders is 30%. This is TP, personal tax rate or marginal tax rate, and is expected that 2% is brokerage and that the shareholders will have to pay while investing their dividends in alternative securities. So for example, instead of retaining the funds, if you distribute the profits to the equity shareholders, they can invest their money, their dividend in other securities. So that they have to pay 2% brokerage cost. That's what they have given here. What is the cost of retained earnings? Since the personal tax rate of shareholders and brokerage rate are given here, I must apply method 2 formula. Nothing but cost of retained earnings KR is equal to KE into 1 minus T into 1 minus B. Here B means brokerage rate. Okay. So where KE is equal to rate of return available to the shareholders, that is 0.10 or 10%, and tax rate is 30% and brokerage rate is 2%. So here is the calculation. KR is equal to 10 into 1 minus 0.5 personal tax rate and 2% is brokerage rate. So 10 into 0.5 into 0.98. I got 4.9%. This is what cost of retained earnings. So you can calculate this cost of retained earnings by using method 2. Okay. Now look at 24th problem. This is a different problem actually. We don't have any problem relating to this particular, we don't have any formula relating to this problem, but they have given a separate formula in the problem itself. So this is a copy paste problem actually, but still you have to understand this problem. There is a chance that this type of questions can be asked in the examination also. Nowadays, in most of the cases, I have to apply this formula only. Cost of retained earnings KR is equal to KE into 1 minus T into 1 minus B. But unfortunately, they have not removed this particular problem, which is based on the old formula actually. So still you have to remember this formula also. See, this is another formula for cost of retained earnings KR. The formula is K into 1 minus TP minus brokerage rate. This formula is applicable if the opportunity cost of shareholders are given here. See the expected return of, so let me read the question. AKS Limited retains 10 lakh rupees out of its current earnings. So this is what the retained earnings 10 lakhs. The expected rate of return to the shareholders if they had invested the funds elsewhere is 10%. This is the opportunity cost of equity shareholders capital K. The brokerage rate is 2% and shareholders comes in 30% tax bracket. What is the calculate the cost of retained earnings? Cost of retained earnings KR is equal to K into 1 minus TP minus brokerage rate. That is what the formula you have to apply here. This is another formula which is, we don't have any formula like this in our regular description actually. See, they have covered only 2 methods and this particular formula was not covered actually. So, but still you have to remember this formula. So KR is equal to capital K into 1 minus TP minus brokerage rate. Now look at K, opportunity cost is 10%, personal tax rate is 30%, and whereas the brokerage rate is 2%. So 10 into 1 minus 0.3, that comes to 7%, minus brokerage rate 2%, I got 5%. So alternative computation, don't see it, just follow the first method itself. Okay. With this, we understood cost of retained earnings. Now let us go for the next area called weighted average cost of capital computation. So what is weighted average cost of capital? Just now, actually at in the introductory part, and I have explained one important component called cost of capital. The cost of capital is nothing but the weighted average cost of all the sources. So that's what the importance of this chapter. I need to calculate weighted average cost of capital. As part of that, I have calculated cost of debentures, cost of preference shares, cost of equity, cost of retained earnings, and again I have applied several methods, CAPM, etc. like that, right? See, after calculating all these sources cost, what is my next job? My job is to calculate weighted average cost of capital. For calculating weighted average cost of capital, I need two components actually. One is the weights of every source, the weights of each source, the weights of each source, and the second component is cost of each source, nothing but cost of debentures, cost of preference shares, cost of equity, the cost of specific source, cost of each source or cost of specific source. This is K, and this is weight, which is also known as proportion or weight, okay, in simple terms. Okay, now these weights can be taken from book values, or these weights can be taken from market values also. That's why these weights are classified into two types: book value weights and market value weights. Book value weights and market value weights. Okay, the question is how to calculate these weights, sir? See, book value weights means I have to take the numbers from books. Okay, nothing but capital structure values from the balance sheet. Market value weights means I have to consider the market value of every source from the stock market. So it can be calculated like this: market value of each source is equal to number of units into market price per unit. So what is unit here? The unit can be equity share, the unit can be preference share, the unit can be debenture. Say for example, if you are calculating market value of equity, the formula is number of equity shares into market price per share. If you are calculating market value of preference shares, number of preference shares into market price per preference share. Like that, you have to calculate market value of every source, and then you have to calculate weights of the sources based on market values. So book values means generally book values will be given in the problem itself. You don't need to calculate it, like equity share capital face value, preference share capital face value, debentures face value, retained earnings have to take. Okay, like that. By taking those values, if you can calculate weights, then such weights will be book value weights. So that's how to calculate weighted average cost of capital. Let me give you one format for calculating weighted average cost of capital. Calculation of weighted average cost of capital. In simple terms, these are the columns. Source, nothing but equity, preference, debentures, like that. Amount, how much money you are taking, how much amount you are taking. Is it market value weight or book value weight? Proportion, or this is also known as weight, proportion or weight. And cost of specific source, nothing but cost of capital of every source, the cost of each source. Weight into cost of capital. This gives me weighted average cost of capital. Say for example, if I am taking equity share capital, retained earnings, preference share capital and debt. So write the amounts here. Okay, write the amounts here based on the values given in the problem. Such values can be book values, such values can be market values. Say for example, if this amount is 1, this is 2, this is 3, this is 4. I have to take total. This is my total of all the sources. 1 plus 2 plus 1 plus 2 plus 3 plus 4. Okay. Then I should go for proportions, the proportion of every source. Multiply these proportions with respect to sources cost, which we have calculated. First of all, my job is to calculate cost of every source. After calculating cost of every source, then I will calculate weighted average cost of capital. Multiply these two numbers. Nothing but third column into fourth column gives me last column. That is my answer actually. Weight into cost of capital. So this total is your KO, overall cost of capital, also known as weighted average cost of capital, KO. Okay, this is the way to calculate weighted average cost of capital. Here is the format. Okay, now See, we are going to handle one problem relating to this concept weighted average cost of capital that covers every source cost computation also. Look at 26th problem. I'm taking study material directly. 26th problem I'm taking here. Okay. Here is the question. 26th. Okay. Asian Limited has the following capital structure: rupees in lakhs, equity share capital 100 lakhs with a number of shares of 10 lakh shares. So the number of shares are 10 lakh shares. The total capital is 100 lakhs. So 100 by 10 simply. You'll get what? 10 rupees face value. Face value of equity share is 10 rupees. 12% preference share capital is 10 lakhs. And number of shares are 10,000 shares. So 10 lakhs by 10,000 shares. So the face value of preference share is 100 rupees. Retained earnings 120 lakhs. 14% debentures of 70 lakhs with a debentures of 70,000. So I can write 70 lakhs divided by 70,000. I got 100 rupees per debenture. And 14% term loan is 100 lakhs. Totally the money is 400 lakhs. The market price per equity share is 25. MP naught. The next expected dividend per share is 2 rupees. That is DPS 1. Next expected dividend means next year expected dividend DPS 1. And it is expected to grow at a rate of 8%. G is 8%. The preference shares are redeemable after 7 years at par. This is not PER, that is at par, nothing but the redemption value is par value, and are currently quoted at 75 rupees per share. That is market price per preference share. Debentures are redeemable after 6 years. So debentures are also redeemable debentures at par. So this is par value, and their current market price of the quotation is 90 rupees per debenture. So the market price per debenture is also 90 rupees. So the tax rate applicable to the firm is 50%. Now what I should do? I can calculate weighted average cost of capital here by using book value weights as well as by using market value weights. Let me show you how I can do this. Under book value method, the first computation, then under market value method, and that is the second computation. Before showing the solution, I need to tell you one important point. You can use book value weights or market value weights, but it doesn't matter to calculation of cost of every source. So while calculating cost of every source, I don't consider whether I'm taking book value weights or market value weights, because for both the weights the cost remains same. So there will be no change in fourth column. There will be no change in fourth column. What is fourth column? Cost of capital column. So that is always same. Whether you take book value weights or market value weights, the cost of capital column remains same. Okay. So then what I should do, sir? Simple. Identify the weights. That's it. So the only changing terms are weights, but not the cost of each source. So how to calculate costs of each source? Regularly. So whatever the formulas we have discussed, the same formulas should be applied here. So the only thing you have to consider is whether the source is fresh issue or existing instrument. If it is a fresh issue, I must consider net process. Existing instruments, market price should be considered. Okay. So here is the first part. Cost of equity. What is the formula for cost of equity? DPS 1 by MP naught plus G. See, DPS 1 means expected dividend per share actually. So DPS 1 is how much? 2. Expected dividend per share DPS 1 2 by market price per share 25. You don't need to multiply 100 here itself. Okay. 2 by 25 plus growth rate 8%. You know that 2 by 25 means it is 8%. 8 plus 8. 16%. You can write like that. You don't need to multiply into 100. Actually, you can straight away calculate the percentage. 2 by 25 percentage symbol. That gives you 8%. 8 plus 8, 16%. So what is the formula for cost of equity KE? DPS 1 by MP naught plus C. DPS 1, 2 divided by MP naught, 25 plus G, 8%. I got cost of equity 16%. The next source is cost of preference share capital. Actually, we understood two formulas for calculating cost of debentures and for cost of debentures. For cost of preference shares, we have two formulas, one for irredeemable, another for redeemable preference shares. Just now we understood that these preference shares are redeemable preference shares, so that I can apply the second formula called preference dividend plus RV minus NP by N whole divided by RV plus NP by 2. Since the market prices are given here, I should not write net process here actually. I must write market price. But in the study material, they have written net process instead of market price. You better change it so that gives you better clarification. Okay, so what is the formula for cost of retained earnings? Preference dividend plus RV minus MP divided by N whole divided by RV plus MP divided by 2. So instead of net process here, you must write MP. MP is market price. Now you know that, my dear students, preference dividend is 12%. Yes, 100 is the face value of preference share. I've calculated, if you remember, 100 into 12% preference dividend 12 rupees divided by, plus RV redemption value at par 100 minus market price of preference shares are 75 rupees. So the preference shares are traded at 75 rupees. The quotation price in the stock market is 75 divided by life of preference shares 7 years. Whole divided by 100 plus 75 by 2. So after calculating this, we got 17.8%. You know how to calculate this portion, right? Now let me explain the second part, cost of debentures. Actually, we have discussed two formulas, irredeemable, redeemable. But for redeemable debentures also, I've given you two formulas. In the study material itself, they have given two formulas. Applying 1 minus tax rate to whole term, I and RV minus NP by N, and applying into 1 minus tax rate only for interest. But here in the calculation part, they have taken 1 minus tax rate multiplying factor for both the terms. That means interest as well as RV minus NP by N. So if you can see here, cost of retained earnings KR is cost of debentures KD is equal to, what is the formula? It is simply I plus RV minus MP, because it's an existing instrument. MP by N whole divided by RV plus MP divided by 2. Whole the term should be multiplied with 1 minus tax rate. So here is your interest component, 100 into face value 100 into interest rate 14% debentures. So I got 14 rupees interest here, plus RV redemption value at par 100 minus market price of debentures. So don't write net process here, you better write market price. So market price of debentures are 90 rupees divided by life of debentures 6 years, whole divided by 100 plus 90 divided by 2. That whole term should be multiplied with 1 minus tax rate into 1 minus 0.5. Don't apply 1 minus tax rate only for 14. You should also apply that 1 minus tax rate also for 100 minus 90 by 6. So if you can compute this part, you'll get 8.24, some odd number, that will be 8.25% approximately. Okay. And you know, dear students, for calculating cost of term loans, processing charges, etc., see, if these terms are not given, like processing charges related to term loan, or if there are no adjustments relating to net process, I'll always take one shortcut formula called I into 1 minus T, interest rate into 1 minus tax rate. So the formula is KTL, cost of term loan, is equal to I into 1 minus T. I can also write KD also. Okay. So interest rate into 1 minus tax rate. This is a shortcut formula when the net profits are exactly equal to the face value that I am raising. Okay, nothing but the amount that, if I am raising some amount, if I am receiving the same amount, that means the net profits are equal to the face value of amount that I am issuing, then I can use this shortcut formula I into 1 minus T. So for term loans, we don't have any adjustments regarding net process. So I am taking the shortcut formula interest into 1 minus tax rate. Sir, can I use other formula? You better use this formula only. This gives you answer very easily. Okay. KD is equal to 14% into 1 minus 0.5. I got 7%. 14 into 1 minus 0.5. I got 7%. This is cost of term loans. So successfully we have calculated cost of every source. Now I can calculate weighted average cost of capital by using book value weights, weighted average cost of capital by using market value weights. Let us handle the first part of the question, weighted average cost of capital by using book value weights. Now look at the columns, sources of finance. You better write source, and then book values, nothing but amount rupees, and weights proportion, weights or proportions, nothing but the third column, and finally fourth column, cost of capital, specific cost, and last column, proportion into cost of capital or weight into cost of capital. So you please understand there are 5 sources here: equity share capital, 12% preference share capital, retained earnings, 14% debentures, 14% term loan. Sir, why we have not calculated cost of retained earnings? You can write We don't have any personal taxes and flotation costs here. I mean, brokerage, whether brokerage rate or commissions are, I mean, these two numbers, these two terms are not given in the problem. So I can take cost of retained earnings KR is exactly equal to cost of existing equity KE, method 1 in our discussion. Okay, as per study material, that is method 2. Okay, so I can write cost of equity as cost of retained earnings. You can see here 16% and 16%. They have taken 16 for cost of equity and cost of retained earnings. Now they have written what the amounts, book values. So what are the book values? Whatever the numbers given in the problem, those are book values. So 100 lakhs, 10 lakhs, 120 lakhs, 70 lakhs, 100 lakhs. You can see these numbers in the problem itself and calculate the proportions. Let us calculate proportions one by one. First one, 100 lakhs divided by 400 lakhs. So I got a total of 400 lakhs. You can check that one also. See 100 plus 10 plus 120 plus 70 plus 100. I got 400. So the first source cost is 100 divided by 400. It will be 25%, nothing but 0.25. And 10 divided by 400, it will be 2.5%, nothing but I can write like this: 10 divided by 400 is equal to 0.025, and 120 divided by 400, I got 0.3. So like that, you have to calculate the proportions. The condition should be the proportions total should be equal to 1. In case if the proportions totals are not equal to 1, you may not get accurate answer. You better round off one of the proportion, and ultimately you must get the total of all the proportions should be equal to 1. And write the cost of every source. Just now we have calculated cost of every source: 16, 17.8, 16, 8.25, 7%. We have arrived all the numbers. Okay. And in these numbers, I need to tell you one important point. Cost of retained earnings KR is exactly equal to cost of existing equity KE, that is 16%. So I have written 16% for equity, 16% for cost of retained earnings. Now multiply the cost of every source with the proportions, so that I'll get what? Proportion into cost of capital. The last column will be weighted average cost of capital. In this context, my cost of capital KO is 12.439. This is under book value weights. So what about market value weights? Under market value weights, your job is to calculate your job is to calculate market value of every source. But while calculating market value of every source, there is a problem with retained earnings, or whether I should consider retained earnings or not. My point is, please calculate market value of equity. Generally, your market value of equity is a big number which is loaded with 3 components. Generally, if you ask me, conceptually, your market price is loaded with, your market value of equity is loaded with 3 components. One is your face value of equity share capital. The second one is retained earnings. The third one is the additional value which is added to the shares because of NPV, net present value. So your market value of equity is loaded with all these values. But I will consider the market value of equity is loaded with only 2 components. One is the face value of equity. The other one is retained earnings. So what I should do? First, I'll calculate market value of equity. Then I'll split that amount into equity share capital and retained earnings in the ratio of book value of equity share capital and retained earnings. That's what my job. So here is the book value of equity share capital and retained earnings. Have you observed the numbers? My equity share capital is 100 lakhs. My retained earnings are 120 lakhs. In which ratio there? The numbers are here. 100 is to 120. That's what the ratio. So you don't need to solve it. Just 100 is to 120. That's what the ratio of book value of equity share capital and book value of retained earnings. In that ratio only, I must split this market value of equity into equity share capital and retained earnings under market value weights. So even under market value weights, I'll write retained earnings. But such values are based on market value of equity, not the book values. Okay. Now let me calculate total market value of equity shares. 10 lakh shares are here. Every share price is 25. So 25 is the market price. 10 lakh shares into 25. I got 2 crore 50 lakhs market value of equity. Now split this amount into market equity share capital and retained earnings in the ratio of book value of equity share capital and retained earnings. Now look at the ratio here. 100 is to 120. Ratio between equity shares and retained earnings. 100 is to 120. They've solved the ratio. Instead of that, we can write 100 plus 120, 220. 100 by 220, 120 by 220. That's what, that is more than enough. But they've solved it. 5 is to 6. That's okay. Now, 5 by 11 is equity share capital. 6 by 11 is retained earnings. Market value of equity. 2 crore 50 lakhs into 5 by 11. I got 1 crore 13 lakhs 63,637. Say out of market value of equity, I've taken what? The market value of equity. Out of market value of equity, I have taken the face value of equity share capital. So nothing but 2 crore 50 lakhs into 5 by 11, I got market value of equity, and then I should take another number called market value of retained earnings. See, these words are not appropriate actually. I must write equity value, retained earnings value. So market value of retained earnings, how to get it? Out of 2 crore 50 lakhs, how much is the retained earnings value? 6 by 11th part. So 2 crore 50 lakhs into 6 by 11th part, I got 1 crore 36 lakh 36,363. You can calculate it and check it. So these numbers I am going to take for calculating weighted average cost of capital under market value weights. Here are the columns. The first column source, the second column market values. I'm not taking book values here, I'm taking market values. And then the third column is weights or proportions and cost of every source. And finally weights into cost of capital. So write all the sources: equity share capital, 12% preference share capital, retained earnings, 14% debentures, 14% term loan. Have you observed one thing? I've written retained earnings also, even in market value weights, but I don't take retained earnings which is given in the problem. I'll take the market values that I've calculated just now. Okay, now substitute the numbers. First look at market value of equity share capital: 1 crore 13 lakh 63,637 and 1 crore 36 lakh 36,363. These are the market value of equity share capital and market value of retained earnings. Now let us go for preference share capital, debentures, term loans. Now debentures, preference shares. How many preference shares are there actually? The preference shares are 10,000 preference shares. Market price per preference share is 75. So it will be 7,50,000. 7,50,000. That's what the number we have written here, 7,50,000. In the similar way, number of debentures. The debentures are 70,000 debentures. The market price of each debenture is 90 rupees. So I got 63 lakhs. Here is the market value of debentures. So we have written market value of preference shares, market value of debentures, equity is over. So the only term remaining is term loan. Generally, since the term loans are not traded in stock markets, I'll take the face value as, or the book value as a market value. So you should not ignore this. So you must write term loans also, and the value is 100 lakhs. The book value remains. The book value is nothing but market value. So successfully we have written all the values, all the market values. Now take the proportions. So these numbers are different from the previous numbers. The previous numbers are book values, whereas these numbers are market values. So whatever the weights you are going to get, such proportions are calculated based on market value. So these proportions are also known as market value proportions or market value weights. The proportions or weights that are calculated by taking market values are simply known as market value weights. Now multiply these proportions with the specific cost of every source. So sir, what cost I should consider? The same cost which you have considered in the previous problem. So the same cost I have to write here. So the cost of every source into weights, that gives me what? Weighted average cost of capital, 12.75% based on market value weights. That's it. So with this we understood how to calculate weighted average cost of capital, and also we have covered all the sources cost computation. That's it. Okay. Yes. I need to explain one last formula in this chapter: growth rate. G formula. Actually, G is equal to B into R. This is one formula. We have another formula actually. This G is equal to B into R. I'm going to cover this part under the chapter dividend policy actually. So that's why I have not explained this part, because there is a model called Gordon growth model that will be covered under dividend policy or dividend policy chapter actually. Yes. Now then we'll check the study material. We have one formula which we need to cover. Here is the one. average method, growth rate can be calculated by using this formula. G is equal to nth root of d naught by dn minus 1. Okay. Actually, this means it's a compounded growth rate actually. Current year dividend, today's dividend D0 is equal to few years back dividend, nothing but n years back dividend. This is not future dividend. Dn means n years back dividend. N years back dividend into 1 plus z whole to the power of n. So over the period of these n years, what is the growth rate? You have to apply that. So I need average growth rate that I got or that I have achieved in the past few years. So if you multiply the last, n years back dividend with growth rate of all the past few years or n number of years, then I'll get what today's dividend. That's what the understanding here. So from this only they have defined this formula. D0 divided by dn is equal to 1 plus z whole to the power of n. Then 1 plus z whole to the power of n is equal to d0 divided by dn. Then 1 plus z is equal to nth root of d0 by dn. Then g is equal to nth root of d0 by dn minus 1. This is what the formula for growth rate. Okay. So how to calculate nth root? You know that square root 15 times minus 1 divided by n plus 1 into is equal to 15 times. That gives you nth root of any number. Okay. This is a way to calculate growth rate. So you just remember the formula, that's more than enough. Okay. This is for calculating average growth rate. Okay. With this, the chapter cost of capital is completed. Now I can enter into the next area called capital structure. See, under this chapter, my objective is to identify the best capital structure. Actually, structure means the structure of capital here. Structure means the proportion or weight of every source. So, the objective of this chapter is to define the best capital structure in such a way that the shareholders' wealth, market price per share should be maximized. This is what the objective of this. This is what the objective of the chapter capital structure. My objective is to maximize the shareholders' wealth. So in such a way that I should fix the capital structure. So if there are several alternative capital structures available, which alternative capital structure I must choose? The alternative capital structure that maximizes my market price per share must be chosen. Okay. So say for example, the fund that I need for accepting the projects can be procured, can be raised from several sources. The combinations are based on my financing decision, which is nothing but capital structure decision. I can raise my capital in three alternative ways. These three are three alternative capital structures. So what are these alternative capital structures? Say for example, in alternative capital structure, I want to raise 50% equity and 50% debt. And in alternative 2 capital structure, I want to raise 70% equity and 30% debt. Whereas in alternative 3, I don't want to raise debt, I want to raise 100% equity. These are the three alternative capital structures through which I can raise my required fund. Only one out of these three alternatives should be chosen. So which alternative I must consider? That's what this chapter is all about actually. The alternative capital structure that maximizes your market price per share should be taken. Okay. Any capital structure you are choosing, that doesn't matter to your sales, variable cost, contribution and EBIT. Up to EBIT, the number remains same for every capital structure. So I can start with EBIT actually. Why? Because say for example, if you need 100 crores fund, so out of 100 crores fund, if you go with the alternative 1, you'll raise 50 crores equity, 50 crores debt. If you go with alternative 2, you'll raise 70 crores equity, 30 crores debt. If you go with alternative 3, you'll raise 100 crores equity. Any alternative you're choosing here, it doesn't matter. You'll raise 100 crores, you'll invest 100 crores, you'll get same sales, same expenses, variable and fixed costs, you'll get same operating profit EBIT. The EBIT remains same for any alternative capital structure. It won't change, but the interest, taxes, preference dividend, number of shares will change based on the alternative capital structures. So, my dear students, I must start with EBIT for every alternative capital structure here. From these numbers, I have to deduct interest. Then I'll get EBT, earnings before tax. Then I'll deduct income tax, so that you will get earnings after tax. So we'll get earnings after tax. If we have preference share capital here, you better deduct preference dividend also, PD. Then finally we'll get earnings available to equity shareholders, earnings available to equity shareholders, or this is also known as profit after tax and after deducting preference dividend. PAT and PD means profit after deducting tax and after deducting preference dividend. This is the profit which belongs to equity shareholders, which is to be divided with number of equity shares to get EPS. Number of equity shares, so that I'll get EPS A by B. Once we get EPS, then for every alternative capital structure, we are going to have one ratio called PE ratio. It changes from one alternative capital structure to another alternative capital structure. PE ratio is the ratio of market price per share to earnings per share. So that will be given in the problem. Then multiply this EPS with PE ratio to get market price per share. That is C into D. I'll explain this PE ratio later. Just understand that EPS into PE ratio gives me market price per share. So I'll choose the alternative where my market price per share is maximum. Say for example, if the market price per share is maximum under alternative 1, then I'll go ahead with alternative 1. That means I'll raise 50% through equity, 50% through debt, because my market price per share is maximum. Okay. So this is the way to calculate market price per share. EBIT minus interest, EBT less income tax, EAT minus preference dividend, earnings available to equity shareholders are profit after tax and profit after tax and after deducting preference dividend. That is to be divided with number of equity shares. I'll get EPS, that is to be multiplied with PE ratio to get market price per share. So the simple formula for market price per share is EPS into PE ratio. So I'll give you the ratio, PE ratio. My dear students, PE ratio is nothing but price to earnings ratio, price earning ratio, nothing but market price per share to earnings per share ratio. Okay, from this formula I can calculate market price per share, that is EPS into PE ratio. Okay, right. For calculating EBIT, sometimes I must use one formula called return on capital employed. Return on capital employed. See, on your capital employed, on your total capital, how much return you're earning. That's what the concept it is. Return on capital employed, also known as return on investment. Return on investment, shortcut ROI actually. See, my dear students, return on capital employed or return on investment, ROCE or ROI, is equal to, write your capital employed in the denominator, capital employed, the total capital that you are employing in the business, equity, preference, debt, everything, all the long term sources must be considered here. Okay, and in the numerator I must write EBIT. EBIT is the profit which belongs to all the long term investors, nothing else. Okay, after recovering variable and fixed costs, I'll get EBIT. So whatever EBIT you are getting, that belongs to all the long term investors, equity, preference and debt holders. So return on capital employed or return on investment is equal to EBIT by capital employed. This is a formula actually. Say for example, if I invested 100 crores capital which is in the business, and I got 20 crores EBIT from this capital employed annually, so my return on capital employed is 20%. Okay, so sometimes the return on capital employed can be given in the problem. From that you may need to calculate EBIT. See, from this formula you can calculate EBIT very comfortably. So EBIT is equal to, the simple formula is capital employed into return on capital employed. Sometimes it can be written as ROI, return on investment. This is a formula you must remember for calculating EBIT if the capital employed and return on investment are given in the problem. Okay, so what is the formula for EBIT? EBIT is equal to capital employed into return on investment or return on capital employed. Okay, this is what the formula for EBIT. Yes. So we understood the terms. Now I need to write the formula for capital employed. So what is the formula for capital employed? Capital employed is equal to equity share capital plus reserves and surplus plus, also known as retained earnings, plus preference share capital plus long term debt. So what are the long term debt sources? Nothing but long term debt means it includes debentures, bonds and loans. Okay, and loans. This is what the formula for capital employed. Okay, so we understood the formula for capital employed. So successfully we can calculate EBIT if you know the capital employed. Sometimes in the problem they'll ask you to calculate capital employed, then you have to calculate EBIT from it, and then finally after calculating EBIT you are supposed to calculate market price per share under several alternative capital structures, and after that you have to choose the alternative capital structure where your market price per share is maximum, because ultimate objective of choosing best capital structure is to maximize the shareholders wealth. Wealth is represented with market price per share. Okay, market price per share. So successfully we understood the first part, and then I'm moving to the next area called EBIT indifference point or EPS equivalency point. So what is this EBIT indifference point or EPS equivalency point? Generally, if you take two alternative capital structures, let us say 50% equity, 50% equity and 50% debt. In alternative 2, I am taking 70% equity and 30% debt. Okay, these are the two alternative capital structures. If you calculate EPS for these two alternative capital structures, generally for alternative 1 you may get higher EPS, and for alternative 2 you may get lower EPS. That's the point here. So if you take some amount of EBIT, if you calculate EPS for these two alternative capital structures, you don't get same EPS. But the point is, if you change the EBIT, EPS will change. If you again change your EBIT, EPS again will change for these two alternative capital structures. But at one level of EBIT, the EPS of alternative 1 will be equal to EPS of alternative 2. And that amount of EBIT level is nothing but EBIT indifference point or EPS equivalency point. So, which means generally for two alternative capital structures, you can choose any amount of EBIT, you will get different EPS. But at a certain amount of EBIT, at a certain level of EBIT, the EPS of both the alternative capital structures will be equal. Such point is known as EBIT indifference point or EPS equivalency point. So it is the level of EBIT. It is the level of EBIT. Level means amount. The amount of EBIT. It is the amount of EBIT at which the EPS of alternative 1, the EPS of alternative 1 will be exactly equal to the EPS of alternative 2. So how to get EPS of alternative 1? Simple. EBIT, from EBIT, please deduct interest, then you'll get EBT into 1 minus tax rate, I'll get EAT, minus preference dividend, I'll get earnings available to equity shareholders, divided by number of equity shares. This gives me EPS of alternative 1. It should be equal to the same term. It should be equal to the same term, nothing but EBIT minus interest into 1 minus tax rate minus preference dividend divided by number of equity shares. This is what the equation you must use for calculating indifference point. See, after writing this equation for alternative 1, from alternative 1 capital structure, please write the interest amount, please write the tax rate, please write the preference dividend amount, please write the number of equity shares from alternative 1 capital structure. Then after that, from alternative 2 capital structure, please write interest amount, tax rate, preference dividend amount, number of equity shares. The only unknown variable is EBIT. This is what you need to solve. So from this equation, you'll get every number except EBIT. So after solving this equation, you're going to get one number called EBIT. At this level of EBIT, the EPS of these two alternative capital structures will be equal. And that particular level of EBIT is known as what? EBIT indifference point or EPS equivalency point. Hope you got it right. EPS equivalency point. So This equation will assist you to calculate the level of EBIT at which EPS of two alternatives capital structures will be equal or one and the same. Okay. So with this we understood EBIT indifference point or EPS equivalency point. Now I am moving to the next area called financial break-even point. So what is this financial break-even point? Financial break-even point means the amount of EBIT at which the equity shareholders profit is equal to 0. This is a simple way of understanding. See, break-even point means what? No profit, no loss. From whose point of view you are taking this financial break-even point? We have general break-even point that defines the relationship between sales and profit. That means the level of sales at which profit is equal to 0. There the profit is EBIT. But I am not defining regular break-even point, operating break-even point here. I am defining financial break-even point from equity shareholders point of view. So from this, from when you are evaluating or when you are calculating financial break-even point from equity shareholders point of view, you have to calculate the amount of EBIT at which the equity shareholders profit is equal to 0. Nothing but earnings available to equity shareholders. Let me write it. It is the level of EBIT at which earnings available to equity shareholders will be equal to 0. It will be calculated for every alternative capital structure separately. It is not between two alternative capital structures. It will be calculated for each alternative capital structure separately. What will be calculated? Financial break-even point. Financial break-even point should be calculated for each alternative capital structure separately. So at this financial break-even point, nothing but it is the level of EBIT at which the earnings of equity shareholders must be equal to 0. So how to get earnings of equity shareholders? Earnings available to equity shareholders means EBIT minus interest into 1 minus tax rate. EBIT minus interest means EBT into 1 minus tax rate means EAT minus preference dividend. Earnings available to equity shareholders should be equal to 0. So from this, please define EBIT minus interest into 1 minus tax rate is equal to preference dividend. EBIT minus interest is equal to preference dividend divided by 1 minus tax rate. Preference dividend divided by 1 minus tax rate. So EBIT is equal to interest plus preference dividend divided by 1 minus tax rate. This is a formula for financial break-even point. Say for example, in the examination, if they are asking you to calculate financial break-even point, what you need to calculate? You need to calculate EBIT amount. So calculate financial break-even point means you have to calculate EBIT amount. EBIT formula, financial break-even point EBIT is equal to, I said what? Financial break-even point EBIT is equal to, a simple formula you must remember, interest plus preference dividend divided by 1 minus tax rate. This is the derived formula from this. Nothing but this is the level of EBIT at which the earnings available to equity shareholders is equal to 0. Simply take one alternative capital structure, write the interest amount, write the preference dividend amount and write the tax rate and you will get financial break-even point. This is a very comfortable computation. You can understand it very easily. Okay. Whereas for calculating EBIT indifference point, always you need two alternative capital structures. Whenever you want to solve EBIT indifference point, you need two alternative capital structures. And I should write this equation for alternative 1 and for alternative 2. And I should substitute the numbers. Then only I'll get EBIT level where the EPS of alternative 1 and alternative 2 are one and the same or equal. Okay. So please don't get confused between these two concepts called EBIT indifference point and financial break-even point. Financial break-even point will be calculated for every capital structure separately, whereas EBIT indifference point, for calculating EBIT indifference point or EPS equivalency point, I need two alternative capital structures like alternative 1 and 2 or alternative 2 and 3 or alternative 1 and 3 like that. Otherwise A and B capital structures, B and C capital structures or A and C capital structures. Sometimes the EBIT indifference point may not exist. That means if you, after solving these equations, you may not get the answer. That means the LHS and RHS terms gets cancelled. In such a case, you have to write like this. EBIT indifference point doesn't exist between alternative 2 and 3 capital structures or alternative 1 and 3 capital structures. So that means Every time you may not get the answer EBIT number for calculating EBIT indifference point. In that case, you have to write like this: EBIT indifference point doesn't exist between these alternative capital structures. That can also happen in the problems. Okay. With this, we understood the first part of the capital structure, that is calculation of market price per share by using PE ratio, and we understood return on capital employed, and then we understood what EBIT from return on capital employed, and also we understood how to calculate capital employed. And after that, in the second part, we understood EBIT indifference point, and in the third formula, we understood financial break-even point. Okay, the next formulas and the next concepts I'll discuss in the next session. Bye. Hi dear students, good evening all of you. Now I'm continuing with the chapter capital structure. The first part of the chapter is over. In that part we understood how to calculate market price per share under different alternative capital structures, and after that we understood how to calculate EBIT indifference point or EPS equivalency point, and thereafter we understood financial break-even point. So now I'm moving to the next area called capital structure theories. Capital structure theories. Yes, we have several capital structure theories we need to understand. The first theory is net income approach. Next one, net operating income approach. And traditional theory or traditional approach. The next one is Modigliani and Miller approach without taxes. Then the next theory is same theory with taxes. Modigliani and Miller approach with taxes. Yes. See, in all these theories, we need to understand one important point called whether the changes in the capital structure, can affect the value of the firm or not. This is the question. Whether this changes in capital structure can affect the value of the firm or not. See, my dear students, some of the theories said capital structure changes will affect the value of the firm, and some theories said capital structure changes cannot affect the value of the firm. So we have to understand all these theories. I mean those theories which are relevant and those theories which are irrelevant, not for the examination, from capital structure perspective. So whether capital structure is relevant or irrelevant from the for calculating the value of the firm or not. That's what our discussion is all about. See, the changes in the capital structure happens because of changes in the financing decision. So the ultimate thing is whether this financing decision can affect the value of the firm or not. So before going for that, I need to give you few important points called changes in the capital structure means change in debt equity mix, because every capital structure is loaded with debt fund and own fund. Debt equity mix is a first area. So whenever I'm changing capital structure, that means I'm changing debt and equity mix. Can it affect the value of the firm or not? The value of the firm. See, this value of the firm can be calculated by using a simple formula called EBIT divided by KO. earnings before interest and tax, that is the profit which belongs to all the long-term investors, divided by KO. This KO means overall cost of capital, the expected return of all the long-term investors. So the numerator term is long-term investors profit and denominator term is their expected rate of return. So if you can capitalize their expected profit at their expected rate of return, then I'll get value of the firm, EBIT by KO. Yes. Now the question is whether this changes in debt equity mix can affect the value of the firm or not. Actually, this EBIT is always constant. That's what our assumption. EBIT is always constant at any level of capital structure. So even though I'm changing capital structure, it won't affect my EBIT actually. But the question is whether this KO will change or not with the change in the debt and equity proportions and the capital structure. So if I'm changing the debt and equity mix, can it affect KO or not? See, my dear students, if KO changes, the value of the firm will change because EBIT is always constant. If KO is not changing, then automatically the value of the firm remains constant. Say for example, if I take 10 crores EBIT and I'm taking 10% cost of capital, then the value of the firm will be 10 divided by 10%, I'll get 100%. So I'll get 100 crores. So this is my value of the firm when my cost of capital is 10%. I'm just changing the cost of capital KO. I'm reducing cost of capital 10 crores by 8%. When I'm decreasing the cost, obviously it should increase the value of the firm because when cost of the fund is decreasing, the value of the firm should increase. So let us take it. 10 crore divided by 8%. I got 125 crores. And if I increase the cost of capital from 10% to 12%, it will decrease my value of the firm. Yes, 10 divided by 12%. I got 83.33 crores. So you must understand one thing here. There is an inverse relationship between cost of capital and value of the firm. So whenever the cost of capital is increasing, the value of the firm is decreasing, and cost of capital is decreasing, value of the firm is increasing. So that's what the relationship between cost of capital and value of the firm, inverse relationship. Now the question is, if this KO is constant, then automatically the value of the firm will be constant. The question is whether this changes in debt equity mix can change the cost of capital or not. That's what our discussion is all about. In all this series, I'm going to discuss whether this KO is a constant number or variable number. That's what our discussion is all about. Now, as part of that, we have to understand all these theories. So some of the theories says KO is constant. Some of the theories says KO is a variable number. It changes with the change in the debt equity mix. So we have to understand every theory to know whether these financing decisions can affect the value of the firm or not. Yes, the first theory is net income approach. Net income approach. Yes. Under this approach, see, every theory must be understood with the help of two-dimensional axis. With the help of two-dimensional axis, and I am taking degree of financial leverage on x-axis, DFL, that is nothing but percentage of debt in my capital structure, and cost of capital on y-axis. Cost of capital on y-axis. So net income approach says, say for example, this origin point is 0% debt, and this is 20% debt and 80% equity, 40% debt and 60% equity, 60% debt and 40% equity, 80% debt and 20% equity. So on x-axis, I am taking percentage of debt, nothing but percentage of debt in my capital structure. So if I am moving forward or if I am moving rightwards on x-axis, that means I am increasing the proportion of debt in the capital structure. If I am moving upward, so that means my cost of capital is increasing. Okay, any cost that you are taking. So NI approach says, by changing the debt and equity mix, that means by increasing the proportion of debt in the capital structure, KD is constant. Cost of debt is constant, interest rate is constant, KE is also constant. Generally, whenever the debt proportion is increasing in the capital structure, equity shareholders' expectation will increase because of increase in risk. But this theory is taking cost of equity KE is always constant even though you are increasing the proportion of debt in the capital structure. So KD and KE are both are constant. So what it indicates, see, I'm adding debt component to my capital structure by removing the equity component, because at origin point I'm using 100% equity and I'm not using even a single rupee of debt. But when I'm moving rightwards on x-axis, that means I'm removing equity, the most costliest source, and I'm adding debt, the cheapest source, that generally decreases the cost of capital. Why, sir? See, by removing the costliest source from the your capital structure and by adding the cheapest source into your capital structure, generally what will happen? The cost should decrease. Why, sir? Because the cheapest source proportion is increasing here and the costliest source proportion is decreasing here. So automatically our cost of capital gradually decreases, KO. So what this theory says, KD, KE are constant, whereas KO decreases because by adding the cheapest source to our capital structure, that automatically reduces cost of capital, because I am removing the costliest source and adding the cheapest source. So automatically that implies cost of capital, KO, is decreasing. So this theory says KD and KE are constant at any level of capital structure, at any level of debt equity mix, whereas KO will gradually decrease by adding more and more debt to our capital structure. So that's what this theory says. And this theory gave you some valuation process. So how I can calculate the value of the firm under this theory. So there are some steps I must follow for calculating the value of the firm. Step number 1, first of all, I must prepare one statement called EBIT minus interest. I'll get EBT. Taxes are not applicable under this theory, so I can take EAT or earnings available to equity shareholders. So under this theory, any taxes are not applicable, either corporate taxes or personal taxes. So this is my step number 1, EBIT minus interest, EBT. I got EBT or EAT or EAESH. Now step number 2. Under step number 2, I am going to calculate value of equity and value of the firm. Calculation of value of equity and value of the firm. So value of equity is equal to, write the profit which is available to equity shareholders, nothing but earnings available to equity shareholders, and write their expected return on a denominator, KE. EAESH divided by KE gives us value of equity. And to this value of equity, add value of debt. Add value of debt. So debt value, if I add debt value, I'll get value of the firm. Sometimes this debt value can be calculated by using interest divided by KD. Mostly the debt value will be given on the problem itself, you don't need to calculate it. But if there is a requirement, write interest amount under numerator and divide that number with interest, expected interest at KD, then you'll get value of debt. And this gives me value of the firm. So value of equity plus value of debt gives us value of the firm. So EAESH divided by KE plus value of debt, I got value of the firm. And in step number 3, I have to calculate cost of equity, cost of capital, KO. Calculation of overall cost of capital, KO. Overall cost of capital, KO, is equal to, simple, once you get value of the firm, use that value of the firm for calculating overall cost of capital, KO, EBIT divided by value of the firm. This is the formula for overall cost of capital, KO. So what is the formula? EBIT divided by value of the firm. This is a formula for overall cost of capital, KO. So that's it. It's all about net income approach. Now let me go for the next theory, net operating income approach. Try to understand the essence of every theory. Net operating income approach. So this is NOI approach. So here also I'm going to take same two-dimensional axis, x-axis, y-axis. See, under this theory, you have to take like this. KD is always constant. See, on x-axis it is DFL, it is cost of capital. The cost of capital on y-axis. $20, $40, $60, $80, like that. Okay, same assumptions. By changing the debt equity mix, your KD is always constant, the expected interest rate. But this time, KE will increase. The KE will increase. Why, sir? Because you're taking some advantage associated with the use of debt. Why? Because by usage of debt, what I'm getting? I'm adding the cheapest source to my capital structure. So automatically that reduces cost of capital. Whatever the benefit you are enjoying from debt capital, that will be taken over by equity shareholders. That nothing but, since the debt proportion is increasing in the capital structure, that increases the financial risk of equity shareholders. So their expectation will increase, KE will increase. Nothing but the advantage associated with the use of debt, nothing but the cheapest source cost of the cheapest cost of the cheapest source cost of the cost of the cheapest source debt, the benefit which you are deriving from uses of debt capital, that can be taken over by equity shareholders. So that increases cost of equity KE. So what will happen, sir? See, this will result in KO constant number. Why, sir? Why the KO is constant? Because I'm getting benefit from debt capital by adding it. So whatever the benefit I'm taking, that will be taken over by equity shareholders. That means proportionately KE is increasing. So the exact sentence is, the advantage associated with the uses of debt will be exactly offset or adjusted by increase in the cost of equity KE, so that there will be no change in the cost of capital KO. So the cost of capital KO remains constant. So this is what net operating income approach says. So KD is constant, KE is increasing because the financial risk is increasing, but KO remains constant. Why, sir? Because the benefit which is derived from debt will be taken over by equity shareholders, will be adjusted or offset by cost of equity KE, thereby cost of capital KO remains constant. So under this theory, at any level of capital structure, my KO is constant. That means your value of the firm will be constant. That's what this theory is saying. Okay. So here also I should understand the valuation. The valuation. Step number 1. EBIT minus interest. Same calculation. Earnings available to equity shareholders. Taxes are not applicable here. And in step number 2, this time I am going to calculate value of the firm first, then I'll deduct debt value from it, I'll get value of equity. Calculation of value of the firm, I'll capitalize the value of the firm as a whole, value of the firm and value of equity. So what will happen? Simple. Value of the firm is equal to EBIT divided by KO. This is the formula for value of the firm. EBIT divided by KO. The formula for value of the firm is EBIT divided by KO. From this, please deduct value of debt. Value of debt. Then I'll get value of equity. Value of equity. So value of the firm minus value of debt, I'll get value of equity. This is step number 2 under net operating income approach. And step number 3, you need to calculate cost of equity. Calculation of cost of equity. So how to calculate cost of equity? Simple formula. KE, cost of equity KE is equal to earnings available to equity shareholders divided by value of equity. So once we get value of equity, from that please calculate cost of equity KE. That's it. KE. So this is regarding NOI approach, net operating income approach. Now I'm moving to the next area called traditional approach. See, I'll show you the traditional approach because actually here is the theory. Look at the theory, traditional approach. Look at this chart. We don't have any specific valuation process. Whatever the valuation process which is applicable to net income approach, the same valuation process is applicable to traditional theory also. You don't need to understand valuation process separately for this theory. So just look at this graph. So what this theory is saying? This theory is divided into 3 stages. Stage 1, stage 2, stage 3. Look at this graph. Under stage 1, this theory is saying both KD and KE are constant. Under stage 1, both KD and KE are constant. That's what this theory says. Up to one stage, KD and KE are constant. Since KD and KE are constant, KO, this term, I mean this line is representing KO. This KO will gradually decrease. But you cannot enjoy that benefit forever. You will enter into stage 2. Up to stage 1, KD, KE are constant, thereby KO decreases. But up to after a certain level of leverage, nothing but by adding more and more debt, this benefit you cannot enjoy continuously. So after certain point of leverage, financial leverage, after adding some amount of, some additional amount of debt, you cannot enjoy this benefit. You'll cross this point. What will happen? You'll enter into second stage. Under this second stage, the KE will increase, whereas KD will be constant. So again KD will be constant, but KE will increase. It starts increasing. Since KE is increasing, whereas KD is constant, automatically the term KO remains constant. It is not it is nothing but net operating income approach. So under second stage, you are entering into net operating income approach, and in the first stage, you are in net income approach. So under first stage, what is happening here? Both KD and KE are constant. KO is decreasing. But in second stage, KE is increasing. KD is constant. Automatically KO remains constant. But after this point, what will happen? Both KD and KE, these two numbers will increase just like this. The extended line KD. So the interest rate and equity expectation, these two numbers will gradually increase. Thereby your KO will also increase. That's what this stage 3. This is stage 1. This is stage 2. And this is stage 3. So these are the 3 stages actually. Okay. So it is just a description actually. So I'll just consolidate the points. Up to stage 1, both KD and KE are constant. KO decreases. In second stage, KE will increase, KD will be constant, thereby KO remains constant. In third stage, both KD and KE are increasing, thereby KO will increase. That's what traditional theory is talking about. Nothing but, you just remember the points only. We don't have any specific valuation process for this. Whatever the formulas we are following under net income approach, the same formula set is applicable for this theory also. But the only factors are KD and KE. KD and KE factors are the most important factors in this theory, because these two numbers will change actually. Okay, right. With this we understood traditional theory also. Now I am entering into the next theory called Modigliani and Miller approach. A very important theory. Modigliani and Miller approach without taxes. Without taxes. See, these members, Modigliani and Miller, the famous economists, and they are saying two firms identical in all respects. Two firms identical in all respects. One is a levered firm, which is using leverage, financial leverage. Another one is unlevered firm, which is not using financial leverage. That's why that is known as unlevered firm. Unlevered means no leverage. Identical in all respects. That means the same business line, same business risk, same total fund, same total assets, same profitability. Everything is same except for capital structure. One is using debt, other one is not using debt. Levered firm is using debt, unlevered firm is not using debt. That is the only difference. Just because of that, you should not expect two different values for these two firms. That's what Modigliani and Miller says. That means the value of levered firm and unlevered firm must be equal. That's what these people Modigliani and Miller are saying. And they proved it with the help of a theory called arbitrage. That's our last discussion. So I'll just say you what that particular theory is saying. So first of all, let me explain the propositions that we need to cover under this Modigliani and Miller approach without taxes. They have given you two propositions, proposition 1 and proposition 2, both in tax, without taxes theory and with taxes theory. And both the theories we need to understand two propositions. Let me explain the proposition 1 under Modigliani and Miller approach with taxes, without taxes theory. See, under proposition 1, they are talking about the value of levered and unlevered firm. Just now I told you both the firm values are equal, and that's what we need to write. Value of levered firm will be equal to value of unlevered firm. So what is the formula? The formula is very simple. that will be equal to EBIT divided by KO. Value of levered form will be equal to value of unlevered form. Both the form values are equal. The formula is very simple. EBIT divided by KO, where KO is equal to KE of unlevered form. KE of unlevered form at equilibrium level. Equilibrium level means both the form values should be equal at that level. So at equilibrium level, whatever the KE which is applicable to unlevered form, the unlevered form KE becomes the KO of unlevered form. Why? Because when there is no debt, the KE becomes KO. So whatever the KO which is applicable to unlevered form, that KO should be used for calculating value of levered and unlevered form. So here KO means KE of unlevered form. That's it. Yes, this is proposition 1. And in proposition 2, you need to understand how to calculate cost of equity KE. Of which firm, sir? Not unlevered firm, because for unlevered firm KE should be given in the problem itself. So I just need to calculate KE of levered firm. So what is the formula for KE of levered firm? KE of levered firm is equal to regular formula, earnings available to equity shareholders divided by value of equity. That's it. Earnings available to equity shareholders divided by value of equity. So just now we understood how to calculate value of equity, EA/ESH by KE. From that only you can define KE is equal to EA/ESH divided by value of equity. So if you can understand one formula from that formula, you can write the other formulas also. We have another formula for calculating cost of equity KE of levered firm. KE of levered firm is equal to, this is a shortcut formula, KO of unlevered firm plus KO of unlevered firm minus KD into debt by equity. Just remember this formula. That's it. That's more than enough. See, this formula is applicable only when the percentages are given. So what is the formula for KE of levered firm? KO of unlevered firm plus KO of unlevered firm minus KD, interest rate, into debt by equity. Sometimes this ratio can be given directly in the problem. So that ratio must be used for calculating KE of levered firm. So this is the second formula for calculating cost of equity KE of levered firm. These are the two propositions you need to understand. Proposition 1, value of levered firm and value of unlevered firm both are equal, which is equal to EBIT by KO. But KO is nothing but cost of equity KE of unlevered firm at equilibrium level. And in proposition 2, we understood KE of levered firm. We don't need to calculate KE of unlevered firm. That should be given in the problem itself. So KE of levered firm, regular formula, earnings available to equity shareholders divided by value of equity. And I have another formula in terms of percentage. KE of levered firm is equal to KO of unlevered firm plus KO of unlevered firm minus KD into debt by equity. This is regarding Modigliani and Miller approach without taxes. Under this theory, sometimes they may ask you to calculate value of equity of levered firm. Once we get value of levered firm, if you remove debt value from it, you'll get value of equity. So I can write that formula also here. That is not a proposition. You can calculate that very easily. Value of equity of levered firm is equal to value of levered firm. This is total value of levered firm. From that, please deduct value of debt. So why should I deduct value of debt? Because levered firm is loaded with debt value. If you remove that debt value, the balance must represent value of equity. Of which firm? Levered firm. That's it. Yes, right. Now I'm moving to the next area called same theory, Modigliani and Miller approach with taxes. With taxes. So if corporate and personal taxes are applicable to companies, what will happen? M&M is saying a different perception. Actually, they are giving a different perception. See, according to them, here also I am going to define two propositions which were given by Modigliani and Miller. Modigliani and Miller says if taxes are applicable to companies, the value of levered firm slightly more than value of unlevered firm because of the tax saving benefit which is being enjoyed by levered firm only by paying interest to the debt holders. So how it would happen? Let me show you. Value of unlevered firm. First you should define value of unlevered firm. Remember one thing, whenever the corporate taxes are applicable, levered firm and unlevered firm values both are not equal. First, you must define value of unlevered form. From that value, I can derive value of levered form. The formula is EBIT into 1 minus tax rate divided by EBIT into 1 minus tax rate divided by KO. Nothing new here. For unlevered firm, EBIT is nothing but EBT. So interest, because interest is 0. EBT into 1 minus tax rate means EAT or EAESH divided by, for unlevered firm, KO is nothing but KE. That means this is nothing but EAESH divided by KE. So that gives you value of equity. For unlevered firm, since it is using only equity, value of equity becomes value of unlevered firm. So this that means even by writing the formula called EAESH by KE for unlevered firm, I can calculate value of unlevered firm. So the second way of understanding of this formula is earnings available to equity shareholders divided by KE. I can use the second formula also or first formula. In both the cases, I'll get value of unlevered firm. Now the point is, what about the value of levered firm, sir? This value of levered firm is slightly more than value of unlevered firm because of the tax saving which is being enjoyed by levered firm only by paying interest on debt. Why? Because interest on debt is a tax deductible expenditure. I can enjoy some tax shield or tax saving on interest payment. That will be generated for future years. For how many years, sir? For perpetual years. And if you can capitalize that value into present value terms, then you can add some extra value to levered firm, and that cannot be enjoyed by unlevered firm. So this is all a conceptual understanding. You better understand the formula. That's more than enough. So what is the formula for value of levered firm? Value of unlevered firm plus an additional value should be added. So what is such additional value? The present value of perpetual tax savings which you can enjoy in the term future years. For how many years? Perpetual years. So what is the formula? Debt into tax rate. See, there is a background reason behind this, and we don't need to recollect that point. And remembering this formula is more than enough. So what is the formula for value of levered firm? Value of unlevered firm that you have calculated previously plus debt into tax rate. This is regarding proposition 1. And you know how to calculate value of equity of levered firm. The same previous formula you can apply here also. Value of equity of levered firm is equal to value of levered firm minus debt value of debt. Then that gives you what? Value of equity. I'm not writing that formula. I'm moving to the second proposition. Second proposition under Modigliani and Miller approach with taxes. Under proposition 2, you need to write one formula called cost of equity KE and cost of capital KO. So because you are following M&M with the taxes theory, see, under with the taxes theory, since the values of both the firms are not equal, KO should not be equal for both the firms. If KO is same for both the firms, value should be equal. So here the values are different. So because the values are different, KO should be different. So because of this reason, I must define KE and KO of levered firm. So for unlevered firm, you don't need to calculate KE and KO because KE will be given. KE should be given related to what? Unlevered firm. That KE becomes KO. Then only I can handle unlevered firm value. Once that is over, I can move to levered firm value. So the point is, the discussion is purely about levered firm especially. So for calculating value of levered firm, I have calculated value of unlevered firm. In the similar way, for levered firm, I need to calculate KO, KE. Let me write the formulas first of all. Cost of equity KE of levered firm is equal to previous formula only. Earnings available to equity shareholders divided by value of equity. That's it. So how I can calculate EAESH? Nothing but EBIT minus interest, EBT minus tax, EAT, which is EAESH. And if you can write that number here, divided by value of equity, that gives you cost of equity KE of levered firm. We have another formula for this. KE of levered firm is equal to KO of unlevered firm plus KO of unlevered firm plus KO of unlevered firm minus KD into debt by equity. Up to this the regular formula. It is a regular formula, but in addition to this, you must multiply one factor tax rate into 1 minus tax rate. This is the formula. Okay. The same previous formula. Additionally, I'm multiplying one factor 1 minus tax rate. Okay. With this, we understood KE of levered firm. And also, you must define KO of levered firm. So, what is the formula for KO of levered firm? I'll show you. KO of levered firm. KO of levered firm is equal to EBIT into 1 minus tax rate divided by value of levered firm. This is a formula for KO of levered firm. So KO of levered firm is equal to EBIT into 1 minus tax rate divided by value of levered firm. So these are the two propositions you must remember. With this we understood M&M with taxes theory. Okay then. We have one more theory. Arbitrage process only. So how this arbitrage process works? Just now I told you two firms identical in all respects except for capital structure cannot command two different values. That means unlevered firm and levered firm. These two firm values should always be equal. In case if these two firm values are not equal, we can bring the values of these two firms into equal position or equilibrium position by using a process called arbitrage process. How this happens? Levered firm, say for example this levered firm is overvalued firm. That means the share prices are at higher value. The share prices are at higher value. Overvalued firm, this is an overvalued firm. This is an undervalued firm. That means unlevered firm is undervalued. So what will happen, sir? See what is happening here. One firm security prices are at lower level, that is unlevered firm, whereas the other firm, levered firm, security prices are at higher price. See, investors will switch their investment holding from overvalued firm to undervalued firm under arbitrage process. That means since these two firms are not in equilibrium position, not in equal position, the investors will take the advantage of this inequilibrium situation. That means they'll sell their equity in overvalued firm and they'll buy the equity on undervalued firm. What will happen? Slowly the demand for levered firm reduces and share prices will reduce, and slowly the demand for unlevered firm rises because there are more buyers and less number of sellers. Then automatically because of high demand the prices will increase. So the overvalued firm prices will decrease, gradually the firm value will decrease. The undervalued firm gradually increases because of increase in share prices. So one is decreasing, other one is increasing. At one point of time these two firm values will be equal. These two firm values will be equal, and this equal position is known as equilibrium point. This is equilibrium point. At this equilibrium point both levered firm value and unlevered firm values will be equal. That means value of levered firm is equal to value of unlevered firm at this equilibrium point. This is what going to happen. Sometimes the reverse position may happen. That means the firm which is not using leverage, unlevered firm may be overvalued firm and levered firm may be undervalued firm. And in that case what will happen? The same thing will happen. The buyers will shift their holding from unlevered firm to levered firm. That means the buyers will sell their equity in unlevered firm. The investors will sell their equity in unlevered firm, and by using such process they are going to buy the equity in levered firm. What will happen? Gradually the demand for unlevered firm reduces, the demand for levered firm will increase. So the unlevered firm value gradually decreases and the levered firm value gradually increases. So at one point of time again equilibrium position will happen. So my dear students, in both the ways it will happen. So either the levered firm can be overvalued and unlevered firm can be undervalued, or the levered firm value can be undervalued and unlevered firm value can be overvalued. The ultimate thing is in arbitrage process investors will shift their holding from overvalued firm to undervalued firm. Such overvalued firm can be levered firm or unlevered firm. Such undervalued firm can be levered firm or unlevered firm. It depends. Ultimately, you must shift your holding from overvalued firm to undervalued firm. That's what this arbitrage theory is all about. Okay. So we understood the arbitrage process actually. This arbitrage process is introduced by Modigliani and Miller. So with that, with the help of that theory only, they proved that the value of levered firm and value of unlevered firm should always be equal. Even though such firm values are not equal, you can bring the values of these two firm values into equilibrium position by using a process called arbitrage. That's what we understood in arbitrage process. Yes. So dear students, these formulas you must remember, and if you can apply these formulas in the examination, you can easily handle the problems also. So I'll try to handle few problems relating to these theories along with the first part of this chapter. Then we can move to the next chapter. Okay. So before going for the other chapter, before going for the problems, I need to tell you one important point. In all these theories, there are some assumptions that you should follow. The first assumption is taxes are not applicable. The second assumption is whatever the money you're raising through debt, such process must be used to buy back the equity. In case if you're raising the money through equity, such process must be used to repay the debt capital. So what is happening here, sir? If you raise debt, you'll buy back equity. If you raise equity, you'll repay debt. That means you are not increasing the fund, you're just changing the capital structure. Rising equity means I'm increasing the owner's fund and decreasing the debt fund. Rising debt means I'm increasing the debt fund, risky fund, and I'm reducing what ownership fund. So this is what happening here. The capital structure will change, but not the total fund. The total fund remains constant. The total assets remains constant. The profitability EBIT is always constant. Business risk is also same. There is no change in it. Okay. These are the important assumptions in this theory. In all these theories, taxes are not applicable. So capital structure change, but not the total assets change. There will be no change in the total assets or total fund. So all the remaining, all the things are same. Business risk is same. Total assets are same. EBIT is same. All the things are same. The only difference is what capital structure changes. Okay. This is what the assumptions you must remember under all these theories. Except for one theory, M&M approach with taxes. Here only I'm going to apply taxes. For remaining all the theories, in all the theories I'm not going to apply corporate taxes or personal taxes. Yes. So with this we understood the introductory part of the capital structure. Then we can move to the problems of this chapter. Then I'll start with the next chapter. Okay. Thank you. Good evening everyone. Now in today's session, let us handle the problems related to capital structure. I'm going to handle two problems here. Now please look at illustration number 3 in your study material. I'm just reading the question. The existing capital structure of XYZ Limited is as follows. Equity share capital 40 lakhs with a face value of 100 rupees each. Retained earnings 10 lakhs. 7% debentures 25 lakhs. So you please check it whether how much is your capital employed. 40 lakhs plus 10 lakhs plus 25 plus 25. That is 100 lakhs. The total capital employed is 100 lakhs. The existing rate of return on the company's capital is 12%. Right now, your return on investment is 12% and the income tax rate is 50%. The company requires a sum of 25 lakh rupees to finance an expansion program for which it is considering the following alternatives. So we need 25 lakhs additional sum to finance an expansion program. Nothing but we are planning to invest. We are expanding our project. For that, I need 25 lakh rupees additional fund. So to raise such additional fund of 25 lakh rupees, we have three alternatives here. We are evaluating three alternatives. Alternative 1, issue of 20,000 equity shares at a premium of 25 rupees per share. So 20,000 into premium of 25 rupees per share means face value is 100, 25 rupees premium. It will be 125. I got 25 lakhs. That's enough. Issue of 10% preference shares for the entire 25 lakh rupees money. Or issue of 8% debentures for the entire 25 lakh rupees money. So I can raise this 25 lakh rupees either through equity or through preference or through debentures. So it is estimated that P ratio in cases of equity, preference shares, debentures financing would be 20, 17 and 16 respectively. So the P ratios under the three alternative financing modes are given here, 20, 17 and 16. Which of the above alternative would you consider to be the best? See, I'll choose the alternative where my market price per share is maximum. How to get market price per share? For all these three alternatives, after expansion, I have to calculate EPS, and such EPS must be multiplied with respect to PE ratios. So already the PE ratios were given here. So I just need to calculate EPS. Then once we get EPS, if you multiply EPS with PE ratio, then we'll get market price per share. So here is the calculation. We have three alternative plans here. Plan 1 equity, plan 2 preference, plan 3 debentures. See, in any alternative, my total capital remains same. So my EBIT should be same. How much is your existing EBIT? You know, you got 12% return on investment on your existing capital employed. Yes, your capital is 100 lakhs and your return on investment is 12%. You can see here, your capital is 100 lakhs, existing return on investment is 12%, 100 lakhs into 12%. So I'll get EBIT, my existing EBIT is 100 lakhs into 12%. It will be 12 lakhs. This is my existing EBIT. And they are saying we can earn the same rate of return on additional funds also. So whatever the additional fund you are raising, on such additional fund you can earn same rate of return. See, the additional sum that I am investing is 25 lakh. So since we are expanding the same project, we can earn same rate of return. That is not given here. So I am assuming that the same return which you are earning on the existing project, the same return you can earn even for expansion fund also. So 25 lakh rupees into 12%. So for additional fund, I'll get extra EBIT. So this is my existing EBIT actually. This is my existing EBIT. Add additional EBIT. This will be 25 lakh rupees into 12%. The additional fund I'm investing is 25 lakhs. On that I'm getting 12% return. 25 into 12%. So this gives me 3 lakhs. So my EBIT after expansion is 15 lakhs. This is my EBIT after expansion. That's it. So now that's what we have written here. EBIT after expansion is 15 lakhs. So here is a calculation. So that EBIT is 15 lakhs after expansion, existing EBIT plus additional EBIT. Now for all these three alternatives, whether you go with the equity or preference or debentures, ultimately I am going to raise additional 25 lakhs. On such 25 lakhs I am going to get 3 lakh rupees extra EBIT. So already we are earning 12 lakh rupees EBIT. Additionally you are going to get 3 lakh rupees EBIT because you are expanding. So your EBIT after expansion is 15 lakhs. Your existing EBIT will be continued plus additional EBIT is 3 lakhs. Totally you are going to get 15 lakhs. So that's what we have taken here. EBIT after expansion is 15 lakhs. Less interest. First of all, whenever you are deducting any commitment, you should consider existing commitments along with additional commitments because I am raising additional fund. Interest, existing interest. See, we are using 7% debentures of 25 lakhs. 25 lakhs into 7% interest, it will be 1,75,000. That's your existing interest applicable to all the three plans. Additional interest is applicable only for third plan because I am raising additional fund through debt only under alternative 3. So for such additional fund of 25 lakh rupees, I am raising 8% debentures. I am raising 8% debentures here. So take this rate 8%. So simply 25 lakh rupees into 8%, it will be 2 lakhs. Such 2 lakh rupees is applicable only for plan 3. So if you deduct interest from EBIT, you are going to get EBT. Total interest should be deducted from EBIT. I'll get EBT 1 minus 2. Less tax 50%, I'll get profit after tax. Then I have to deduct preference dividend, existing preference dividend. Your existing preference share capital is 25 lakhs. On that you are paying 9% preference dividend. It is 2,25,000 applicable for all the three plans. Every existing commitment should be applicable to all the three plans. Only additional commitment should be applicable based on the alternative that you are raising the fund, through which you are raising the fund. So preference dividend is existing preference dividend. It is 2,25,000 applicable for all the three plans. But additional preference dividend is applicable only for plan 2 because I am raising additional fund through preference shares for plan under plan 2 only. So plan 2 is saying 10% preference shares. So I am raising 25 lakhs. 25 lakhs into 10%, it will be 2,50,000. That's what my preference dividend. Yes, we have deducted preference dividend here. 2,50,000. Then after deducting preference dividend, we are going to get equity earnings, nothing but earnings available to equity shareholders. We are popularly this term is known as earnings available to equity shareholders, EAESH, which is also known as equity earnings. Equity earnings means earnings of equity shareholders. So this is to be divided with number of equity shares. You know, shares, when you are writing shares, you should be very careful. See, existing shares are 40,000 equity shares. 40 lakhs by 100. 40,000 equity shares. Additional shares are applicable only for plan 1. Under that plan, I am raising 20,000 additional shares. So 40,000 plus 20,000. So you are going to get total number of shares of 60,000 after expansion. This particular 60,000 additional shares, this particular 60,000 total shares are applicable only for plan number 1. For all the remaining 3 plans, for all the remaining 2 plans, I am going, my number of shares outstanding are 40,000 only. So here are the number of shares. Number of shares 60,000 for plan 1, whereas for plan 2 and plan 3, my shares are 40,000 only because I am not raising additional fund through equity under plan 2 and plan 3. Divide this equity earnings with number of equity shares outstanding, then you will get EPS. Equity earnings divided by number of shares, 7 by 8, I'll get EPS. Now we got EPS. Multiply this EPS with PE ratio given in the problem itself. See, already we have PV ratios here, PE ratios here, price earning ratios here, 20, 17 and 16. Substitute the same ratios here. Multiply EPS with PE ratio because market price per share MPS is equal to EPS into PE ratio. So 9 into 10 EPS into PE ratio gives me market price per share. I got highest market price per share under alternative 1. Under alternative 1. So I can take alternative 1 only actually. So I am going to choose alternative 1. That means I am going to raise my additional fund of 25 lakh through equity only because my market price per share is maximum under alternative 1. With this, problem number 3 is completed. Now I can go for 7th problem that covers the theories, capital structure theories. 7th problem. Here is a problem. See, look at the problem here. Yes. Company X and Company Y are in the same risk class and are identical in every fashion except that the Company X is uses debt while Company Y does not. So that's saying Company X is a levered firm, Company Y is an unlevered firm. The levered firm, that means the Company X, has 9 lakh rupees debentures carrying 10% rate of interest. Yes. Both the firms earns 20% before interest and taxes on their total assets of 15 lakhs. So if from both the firms we are earning same profit, 15 lakhs into 20%, I'll get 3 lakh rupees EBIT. So for both the firms, EBIT is equal to 3 lakhs. Assume perfect capital markets, rational investors and so on, and a tax rate of 50% and capitalization rate of 15% for an all equity company. So they've given two types of information here. One is the tax rate applicable. The tax rate applicable to the company is 50%. And also the capitalization rate for all equity company. The capitalization rate of all equity company is KE. That itself is KO. The KE of levered firm is, the KE of unlevered firm is given here. All equity firm is unlevered firm. So for unlevered firm, they've given KE. Have you observed that? This is KE. For unlevered firm, they've given KE. And this KE becomes the KO of unlevered firm. Why? Because for an unlevered firm, KE is nothing but KO. Yes. Now, look at first question. Compute the value of firm X and firm Y using net income approach. But taxes are applicable here. Remember that we have taxes here. Under net income approach, what is going to happen? NI approach assumes no taxes generally. Since the tax rate is given in the problem, we have to work out of NI approach. So, under NI approach, we have to consider taxes. Accordingly, we have to calculate the values of the firms. Actually, I have to calculate value of firm X and firm Y. How to calculate value of the firm under NI approach? Under NI approach, my first job is to calculate value of equity. The formula is EA ESH divided by KE. Once we get value of equity, add value of debt, then we'll get value of the firm. That's a simple computation. Computation of value of firm X and Y using NI approach. Firm X and Y, You see, value of the firm is equal to market value of equity plus market value of debt. That's what the terms given here, market value of equity plus market value of debt. First, write the EBIT of both the firms, deduct interest from it. Already, you know that for firm X, we have debt of 9 lakh rupees with an interest rate of 10%. So 90,000 is the interest component. Deduct interest. We got PBT for both the firms. For firm Y, since there is no debt, interest is 0. So I have taken EBIT as EBT, 3 lakh rupees. Less income tax 50%. Generally, the tax rate need not be given in the problem for calculating value of the firm under NA approach. Once it is given, please deduct it without any hesitation. Now, tax rate is 50%, deduct 50% from it. I got earnings of equity shareholders, also known as what? EA, ESH. This is 1,05,000 and 1,50,000. Divide this number with cost of equity KE. Actually, KE is given for an unlevered firm 15%. So, what about firm X? See, for firm Y, they have given KE of 15%. What about firm X? Actually, they have taken 15%. Why like that, sir? Because NI approach assumes that cost of equity is KE. Cost of equity KE is always constant at any level of debt equity mix. That means whether the firm X and Y are using debt or not, it doesn't matter. For both the firms, cost of equity KE is same. That's what NI approach says. NI approach assumes that cost of equity remains constant whether you use debt or whether you are using debt or you are not using debt. It doesn't matter. So accordingly, since for unlevered firm we are taking 15% KE, the same KE is applicable for firm X also. Why you are taking same KE? Because X is using debt. It doesn't matter. Two firms are identical in all aspects. The capital structure can never change KE under NA approach. That's why the KE of unlevered firm Y can be taken as a KE of levered firm X. Okay, as per NA approach, I am not talking about Modigliani and Miller approach. Okay. Now divide this earnings of equity shareholders with KE. Then you will get value of equity, capitalized value of equity. So 1,05,000 divided by 15%, I got 7 lakh rupees capitalized value of equity for firm X, and for firm Y it is 10 lakh rupees. Now once we get capitalized value of equity, what is my next job? Add value of debt. See, we have debt value for X only 9 lakhs, add it, and I got 16 lakhs value of the firm for firm X, whereas firm Y it is 10 lakhs. That's it. With this point 1 is completed. Now go for second point. Compute the value of each firm using the net operating income approach. So how I can do this? Simple. The same calculation I can do, but the point is, once the taxes are applicable to net operating income approach, I need to tell you one important point. Generally, either for NI or NOI or even for traditional approach also, taxes are not applicable. But once the taxes are applicable, the NOI approach becomes Modigliani and Miller approach with taxes. I can say one thing, M&M approach with taxes is an extension of NOI approach if you apply taxes to NOI approach. So the rule is, if you apply income tax rate to the NOI approach, that theory changes its name. It will become M&M approach with taxes. So if you have any problem in the examination, and if they are asking you to calculate value of the firms under NOI approach by giving income tax rate, you must assume that that approach is not NOI approach, that approach is Modigliani and Miller approach with taxes. So here, if you observe, you need to calculate value of each firm using NOI approach. In case if the tax rate is not given here, then I must use the regular process called value of the firm EBIT by KO, then deduct value of debt, then we'll get value of equity. That is the way to calculate valuation of the firms under NOI approach. But here I'm not going to use such formulas which were given in NOI approach. I'm going to use Modigliani and Miller approach with taxes, because taxes are applicable here. 50% taxes are applicable here. So since the tax rate is applicable here, then I must use M&M with taxes theory. So what is the formula for value of firm under M&M with taxes? Value of unlevered firm is equal to EBIT into 1 minus tax rate by KO. I told you already, KO or KE both are same. See, EBIT into 1 minus tax rate. Yes, EBIT for both the firms is 3 lakhs into 1 minus tax rate, 1 minus 0.05. This is not 0.05, my dear students. This is 0.5 actually. See, this is a wrong number. This is 0.5. Okay. Divided by, what about KE of unlevered firm? See, KE of unlevered firm is nothing but KO. I can write KO or KE. Both are same here. Because KO of unlevered firm is nothing but KE. KE of unlevered firm. KE and KO both are same for unlevered firm. So, I have taken divided by 15%. This is 3 lakhs into 1 minus 0.5 divided by 15%. Then you'll get what? 1,50,000 divided by 15%. You'll get 10 lakh rupees. This is value of unlevered firm. Once we get value of unlevered firm, I can easily calculate value of levered firm X. What is the formula? Value of unlevered firm plus debt into tax rate. See, this is debt into tax rate. You must use like this, debt into tax rate. So how much is your debt? Debt is 9 lakhs into tax rate 50%. 4,50,000 rupees. Additional value will be added for levered firm. 10 lakhs plus 4,50,000. I got 14,50,000. This is my value of levered firm. Yes, but the second point is over. Now go for third point. Using NOI approach, calculate overall cost of capital KO for firm X and Y. I have to calculate KO of firm X and Y. You know, if you remember, KO of levered firm and KO of unlevered firm. Actually, under M&M with taxes theory, you don't need to calculate KO of unlevered firm because that itself is KE. KO of unlevered firm is equal to KE of unlevered firm. But you need to calculate KO of levered firm. So what is the formula of KO of levered firm? I told you already. EB18 into 1 minus tax rate by value of the levered firm. I can use that formula. But here, they have calculated the value by using weighted average cost of capital. We are not going to use that formula. Let me show you how I can do KO of levered firm. First of all, let me calculate KO of unlevered firm. KO of unlevered firm is Y limited is nothing but KE of unlevered firm. That is equal to 15% as there is no debt. Yes. So you don't need to calculate KO of unlevered firm. Now coming to KO of levered firm, how I can do that? I told you already, KO of levered firm is equal to, we have a simple formula for this, that is EBIT into 1 minus tax rate by value of levered firm. Value of levered firm. Yes. How much is your EBIT? My EBIT is 3 lakh rupees. I told you already it is 3 lakhs. Yes. Is it 3 lakhs? Let me check it once. Yes. EBIT is 3 lakhs into 1 minus 0.5 divided by value of levered firm. Just now we got it 14,50,000. 14,50,000. So apply this 1,50,000 divided by 14,50,000. I got 10.34%. This is your answer. So they have calculated like this. They got 10.31% approximately. This is the right answer. You can calculate cost of capital KO of levered firm like this also. This is much accurate answer actually. Okay. So instead of following this formula, instead of following this process, you can write this formula and get full marks. Okay. With this point 3 is over. Now go for fourth point. Which of these two firms has an optimal capital structure according to NOI approach? Actually, look at the point here. Out of two firms, firm Y seems to have optimum capital structure, and as it has lower cost of capital, higher value of the firm. Firm Y, unlevered firm. Look at unlevered firm Y. The value of unlevered firm is 10 lakhs. How about cost of capital KO? KO of unlevered firm is 15%. Whereas KO of levered firm is 10.34%. Out of two firms, firm Y seems to have optimal capital structure as it has lower cost of capital and higher value of the firm. Firm Y, actually, under which approach they asked you this question? Which of the two firms has an optimal capital structure according to NOI approach? See, this interpretation is wrong actually. Why? Because for firm X, we got least cost of capital KO, 10.34%, whereas for firm Y, it is 15%. So when compared to firm Y, firm X has least cost of capital KO and also the value of the firm is higher. The value of the firm is 14,50,000. So which firm you should prefer? It is firm X actually. Out of two firms, it is not firm Y, it is firm X. Seems to have optimal capital structure as it has lower cost of capital and higher value of the firm. This is a wrong term. Actually, it is not firm Y, it is firm X. You please change it. But this seventh problem is over. Yes. Successfully. We have another concept called financial break-even point and EBIT indifference point. I am going to cover that particular concept and related problems under the chapter leverages. I am moving to the next area called leverages. Let me start it. New chapter, leverages. So what is the exact meaning of the term leverage? Leverage, it is simply a measure of risk. It is a measure of risk. For measuring such risk, leverage is going to establish the relationship between two variables. It is going to establish the relationship between two variables. That means the change in one variable can affect the change of other variable. So how one variable can affect the how one variable can affect the value of other variable. That's what we are going to establish with the help of leverage. See, the leverage is a measure of risk, and this particular risk is of two types: operating risk, also known as business risk. The next one is financial risk. So in simple terms, leverage is a measure of risk which is going to establish the relationship between two variables. If there is a change in one variable, how it is going to affect the change in other variable. That's what we are trying to establish, the relationship between two variables changes with the help of what the concept called leverage. See, since it is a measure of risk, such risk is classified into two types. One is the business specific risk, business risk or operating risk. The other one is financial risk, which is related to capital structure. So the combination of these two factors decides my total risk. Now, this business risk or operating risk is nothing but variability of EBIT, operating profit variability. Financial risk is nothing but variability of shareholders profit, EPS, variability of EPS. Okay, so my dear students, the point is this business risk or operating risk is measured with a leverage called operating leverage. Operating leverage is a measure of operating risk or business risk. Financial leverage is a measure of financial risk. Financial leverage is a measure of financial risk. And combined leverage is a measure of total risk. Combined leverage is a measure of total risk. Combined leverage is a measure of total risk. Now, dear students, we need to understand all these three leverages so that I can complete this particular part. If we can solve few problems related to this chapter, then this chapter will be over. We have few formulas here. First of all, the first one is degree of operating leverage. Degree of operating leverage. DOL. Yes. This is going to establish the relationship between sales and EBIT. Sales minus variable cost, contribution minus fixed cost, then I'll get EBIT. So the relationship between sales and EBIT can be established with the help of a leverage called DOL. DOL will establish the relationship between sales and EBIT. How it is going to establish the relation between sales and EBIT? Say for example, let me write the formula for DOL first of all. Degree of operating leverage is equal to percentage change in EBIT divided by percentage change in sales. Also known as, the other formula is, or contribution divided by EBIT. So DOL is equal to percentage change in EBIT divided by percentage change in sales, or contribution divided by EBIT. Say for example, if the percentage change in EBIT is 50% divided by percentage change in sales is 25%. So what is happening here? For 25% change in sales, my EBIT is changing by 50%. Then that results in 50 by 25, it will be 2. So my degree of operating leverage is 2. This 2 indicates, this particular 2 number indicates for every 1% change in sales, EBIT changes by 2%. That's what the interpretation of the term degree of operating leverage. So this degree of operating leverage is trying to establish the relationship between sales and EBIT. So for every 1% change in sales, how much percentage of EBIT is going to be changed? That can be calculated by using what degree of operating leverage. Here my degree of operating leverage is 2, which means for every 1% change in sales, my EBIT changes by 2%. That means if sales increases by 1%, EBIT increases by 2%. If sales decreases by 1%, then EBIT decreases by 2%. That's what the interpretation of the term degree of operating leverage. So why there is a magnifying impact on EBIT? When sales changes by 25%, EBIT should be changed by 25% only. Why there is a more percentage change in EBIT? This is because of the existence of the company's existence of the fixed cost and the company's cost structure. Actually, our cost structure is loaded with two components: variable cost and fixed cost. Variable cost will exactly varies along with what sales. So there will be no change in percentage change in contribution, percentage change in sales. Both of these numbers will be equal. The percentage change in contribution will always be equal to percentage change in sales, because my variable cost changes proportionately along with what sales change. Whereas my fixed cost remains constant. Even though my sales is changing, my fixed cost remains constant. Since it is constant, it will have a magnifying impact on percentage change in EBIT. Due to this reason, generally, if sales increases by small amount of percentage, whereas your EBIT is going to be increased by more percentage. So there is a huge magnifying impact on percentage change in EBIT whenever there is a change in sales. This is because of what? The existence of the company's fixed cost and the capital structure. So I can say one thing: this degree of operating leverage, the magnifying impact on percentage change in EBIT, arises due to the existence of fixed cost in the company's cost structure. So I can say one thing: more fixed cost, more degree of operating leverage, because more magnifying impact. Low fixed cost, low magnifying impact. So fixed cost is the reason behind what? DOL. High fixed cost, high DOL. Low fixed cost, low DOL. Moderate fixed cost, moderate DOL. If there is no fixed cost, no DOL, that means the percentage change in sales and percentage change in EBIT both are same. That's what regarding degree of operating leverage. I am moving to the next area called degree of financial leverage. DFL. See, this is going to establish the relationship between EBIT and EPS. Less income tax, I'll get earnings after tax minus preference dividend, then we'll get equity earnings, which is also known as earnings available to equity shareholders, divided by number of equity shares, then we'll get EPS. This degree of financial leverage is going to establish the relationship between EBIT and EPS. DFL. So DFL establishes the relationship between EBIT and EPS. So what is the formula for DFL? DFL, degree of financial leverage, is equal to percentage change in EPS divided by percentage change in EBIT. Percentage change in EPS divided by percentage change in EBIT. Or the other formula is EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. This is the second formula: EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. In case if your capital structure is not loaded with preference share capital, this becomes 0. So your formula will be very much simplified: EBIT by EBT. I can use EBIT by EBT if your capital structure is not loaded with what? The preference share capital. I can use simple formula EBIT by EBT. But you must use this formula EBIT by EBT minus preference dividend divided by 1 minus tax rate in case if your capital structure is loaded with preference share capital. My suggestion is you better remember this formula only. Why? Because in the examination they may give you preference share capital in the capital structure. You may forgot this particular formula. You may apply EBIT by EBT. That becomes wrong. That means you'll get a wrong answer. So you must remember this formula only in case if your capital structure is not loaded with preference share capital, you better substitute preference dividend is equal to 0. Then you will get answer very easily. So whenever I ask you the formula of a degree of financial leverage, you must remember this formula only. EBIT by EBT minus preference dividend divided by 1 minus tax rate. Remember this formula only, my dear students, not the regular formula EBIT by EBT. Okay, that is very safe for you. Okay, now the point is, say for example, the percentage change in EPS is, the percentage change in EPS is 75%, whereas the percentage change in EBIT is 50%. So what will happen? 75 by 50. It will be 1.5. Sir, what is this 1.5? This means for every 1% change in EBIT, for every 1% change in EBIT, EPS changes by 1.5%. So here I'm trying to establish the relationship between EBIT and EPS. For every 1% change in EBIT, my EPS changes by 1.5%. Which means, for example, if your EBIT increases by 1%, EPS increases by 1.5%. If your EBIT decreases by 1%, EPS decreases by 1.5%. That's it, my dear students. Nothing new here. So what is the difference between operating and financial leverage? Financial leverage establishes the relationship between EBIT and EPS, whereas operating leverage establishes the relationship between sales and EBIT. Now, why this DFL arises? DFL arises because of the fixed financial commitments like interest on debt and preference dividend on preference share capital. If you don't have fixed financial commitment funds like debt and preference share capital, then your DFL will be equal to 1. That means the percentage change in EBIT and percentage change in EPS both are equal. So in that case, DFL will be equal to 1. So my dear students, DFL arises because of the existence of the debt and preference share capital in the company's capital structure. If you can remove debt and preference share capital from your capital structure, then your DFL will be equal to 1. That means your financial risk is equal to 0. There will be no financial risk at all. Okay, there will be no financial risk in case if you can remove debt and preference share capital from the capital structure. So my dear students, I can say one thing here. DFL is a measure of financial risk. DFL will be more if your debt is more. DFL will be less if your debt is less. So degree of financial leverage is highly dependent on how much extent of debt you are using in the company's capital structure. If debt is more, high DFL. If debt is less, low DFL. If there is no debt, no DFL. No DFL doesn't mean DFL is equal to 0. DFL is equal to 1. That means the percentage change in EBIT and percentage change in EPS both are equal to both are equal, and then you'll get DFL is equal to 1. So with this we understood degree of financial leverage. Now I'm moving to the next area called degree of combined leverage. DCL. So what it indicates? DCL means it is simply establishes the relationship between sales and EPS directly. Sales to EPS relationship is DCL. So the formula for DCL is percentage change in EPS divided by percentage change in sales directly. Okay, percentage change in sales. The second formula is contribution divided by EBT. Contribution divided by EBT. I can also rewritten this formula as DCL is equal to DOL into DFL, operating and financial leverage. DOL means what? Contribution by EBIT. DFL means what? Actually this is EBT minus PD by 1 minus tax rate. This is EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. Extended formula. So if you can cancel these two terms, what will happen? I'll get contribution divided by EBT minus preference dividend divided by 1 minus tax rate. This is the formula of a degree of combined leverage. So you can calculate degree of combined leverage simply by multiplying two numbers DOL and DFL. That's enough. Okay. Now we understood degree of combined leverage successfully. So what it is trying to say? If there is a change in sales, how it would affect EPS change? That's what the relationship between sales and EPS that can be established, that can be measured with a leverage called degree of combined leverage. Say for example, if I can apply the previous numbers here, DCL is equal to DOL is 2, DFL is 1.5. It will be 2 into 1.5. 2 into 1.5 means it is 3 actually, right? So what is this 3? For every 1% change in, I got DCL is equal to, right, DFL is 1.5. This means for every 1% change in sales, EPS changes by 3%. So that means for example, if your sales increases by 1%, EPS increases by 3%. If sales decreases by 1%, EPS decreases by 3%. That's what DCL is all about. Okay. With this, we understood degree of combined leverage. Now, we can go for the problems directly with the help of this background. Go for 11th problem. Here is the question. I'm reading the question. The ABC Limited has the following balance sheet and income statement of information. Assets, net fixed assets, current assets, total assets 19 lakhs. Liabilities, equity share capital 8 lakh rupees with a face value of 10 rupees each. That means 80,000 equity shares. 10% debt 6 lakh rupees. That means the interest component is 60,000. Retained earnings 3,50,000. Current liabilities 1,50,000. Total liabilities 19 lakhs. Income statement sales minus operating expenses including 60,000 depreciation. My dear students, 60,000 depreciation is a fixed cost. That means out of 1,20,000, 60,000 is fixed cost. Balance 60,000 must be your variable cost. So EBIT, less interest, EBT, less taxes, earnings after tax. Generally, whenever we are preparing income statement, I must split this operating expenses into variable and fixed. Then only I can get contribution and EBIT separately, so that I can calculate all the leverages. So now look at the question. Determine degree of operating, financial and combined leverages at the current sales level. If all operating expenses other than depreciation are variable costs. So other than depreciation, all other operating expenses are variable costs. That's what they're saying. So my dear students, so this 60,000 depreciation is a fixed cost. Balance 60,000 operating expenditure is a variable cost. Now I'm going to redefine this income statement. I have to prepare income statement again actually, but still they have not prepared income statement. You better prepare income statement. Sales minus variable cost 60,000. I'll get contribution minus variable minus fixed cost 60,000 depreciation. Then you'll get EBIT. From this point onwards, your income statement remains same. Okay. Now, what is your degree of operating leverage? The formula of a degree of operating leverage is contribution by EBIT. How to get contribution? 3,40,000 sales minus variable cost of 60,000. I got contribution of 2,80,000 divided by EBIT. My EBIT is 2,20,000. So I got it is 1.27. Yes, degree of operating leverage is 1.27. DFL. Since we don't have preference share capital here, I can say that the formula for DFL is EBIT by EBT. EBIT 2,20,000. EBT, just now we got it. EBT is 1,60,000. It is 1.375. Yes, DCL is equal to DOL into DFL. DOL is 1.27 into DFL is 1.37. So 1.27 into 1.37. 1.74625. That is 1.75 DCL. Now look at point B. If total assets remains at the same level, but sales increases by 20% and sales decreases by 20%, what will be the earnings per share in the new situation? So if your total assets remains at the same level, if sales increases by 20% and sales decreases by 20%, so but your total assets remains same level, remains at same level. When your total assets are at same level, your total fund remains same, your debt and equity remains same. But earnings per share under new situation should be calculated here. See here, sales volume increases by 20%. First alternative. Under alternative 1, if your sales increases by 20%, existing sales is 3,40,000 into 120%. It will be 4,08,000. If sales decreases by 20%, what will happen? You have to apply 80% on sales. 3,40,000 into 80%. 272,000. Variable cost will be proportionally changed. My previous variable cost is 60,000. When your sales increases by 20%, your variable cost will be increased by 20% into 120%. It will be 72,000. When your sales decrease by 20%, your variable cost will be decreased by 20%. That means 60,000 into 80%. It is 48,000. Deduct it. Then you'll get contribution minus fixed cost. Minus fixed cost. How much is your fixed cost? There will be no change in fixed cost even though there is a change in sales. So 60,000 remains fixed cost. Remains the same fixed cost. Deduct it, EBIT less interest. Interest cost is also constant. My interest component is 6 lakhs into 10%, 60,000. Deduct it. Even though there is a change in sales, it won't affect your interest component also. I got EBT less income tax rate. The same tax rate, applicable tax rate is how much percentage? You please calculate it. 56,000 divided by 1,60,000. My tax rate is 35%. Apply 35% tax on this number. 2,16,000 into 35%. It is 75,600. The same tax rate is applicable for second amount also. Deducted earnings after tax, which is nothing but earnings of equity shareholders, because we don't have any preference share capital here. Divide that number with number of equity shares. My dear students, there is no change in interest, no change in number of equity shares, because my total assets remains same, my total fund remains same, my equity and debt remains same, number of shares are same, total interest remains same. Remember that. So number of equity shares are 90,000 and 80,000. Actually the capital is 8 lakhs, divided by face value 10. I got 80,000 equity shares. Even though there is a change in sales, it doesn't affect your number of shares outstanding, and it doesn't affect interest component because my total assets remains same. So that is indirectly saying what? There is no change in the capital, there is no change in the total assets. Okay, so that your interest and number of shares are same. So I got EPS, earnings of equity shareholders divided by number of equity shares. We got EPS. With this, what? Problem number 11 is completed. Nothing new here. Now you please go for 12th problem. This is an important sum, very important sum. Now I'm just reading it. A firm's sales, variable cost and fixed cost amounts to 75, 42 lakhs and 6 lakh rupees respectively. Sales, variable cost and fixed costs are directly given in the problem. It has borrowed 45 lakh rupees at 9% rate of interest, and its equity share capital total 55 lakhs. Yes, 45 lakh rupees debt fund, 55 lakh rupees equity fund. Total capital employed is 100 lakhs. 45 plus 55. There is no other fund I am using here. Okay. Yes. And also your interest rate on debt capital is 9%. What is the firm's return on investment? The formula for return on investment is EBIT by capital employed. I know that my capital employed is 100 lakhs. I just need to calculate EBIT. How to get it? Sales minus variable cost contribution minus fixed cost EBIT. So that's what they've tried to calculate. Sales minus variable cost minus fixed cost. And they got EBIT of 27 lakhs here. Okay. Now I just need to calculate return on investment. What is the formula for return on investment? EBIT by capital employed. You know, my capital employed is 100 lakhs. Yes, equity plus debt. Okay. So EBIT by capital employed. 27 lakhs EBIT divided by capital employed 100 lakhs. I got 27% return on investment. Now what about second point? Does it have favorable financial leverage? So what is this favorable financial leverage? First of all, let me tell you one important point. Financial leverage means debt. Financial leverage means debt. So debt will be favorable only when this debt is able to provide some extra return to the equity shareholders. So every firm is using debt only to provide additional return to the equity shareholders. That's a fact you must understand. How a debt can provide extra return? This is a liability side fund. You know that debt is a liability. Yes, and I have raised this debt at a rate of 10%. Example I'm taking here. Say for example, I have raised a debt of 1 lakh rupees. And I'm going to invest this debt of 1 lakh rupees to earn a return on investment of 20%. Now, this debt 1 lakh rupees is going to earn 20% return. Let me take another number. This debt is going to earn 30% return on investment, whereas I am going to pay 10% interest only. So, this debt is generating 30% return. From that, you have to pay 10% interest. So, balance margin of 20% from debt will be passed on to the owners of the company. They are equity shareholders. So equity shareholders are getting some extra return due to uses of debt. Why? Because I'm raising debt at lower cost. Nothing but the interest rate is cheaper. Whereas the return which I'm going to generate from this debt is very high. The return on investment from the debt fund is very high. Whereas the cost that I'm going to pay to the debt holders is very low. So the return over cost of debt, nothing but interest rate, is nothing but the extra return which is generated from debt. So return on investment is 30%. Interest rate that I am paying is 10%. Whatever the excess margin 20% that I don't need to pay to the debt holders, that extra return will be enjoyed by equity shareholders only. So here you can understand one thing here. This debt is a favorable source when it is able to provide some extra return to the equity shareholders. That means if your return on investment, the business return is more than the interest rate on debt. If ROI is greater than interest rate on debt, then debt is a favorable source. If ROI is less than interest rate on debt, then debt is an adverse source to the company. If ROI is exactly equal to interest rate, there is no uses of debt in the company's capital structure. So my dear students, now the question is, when this debt becomes a favorable financial leverage? Actually, financial leverage means debt. I said what? Favorable financial leverage. So that means when will you consider this financial leverage as a favorable number? Financial leverage means debt. I said what? Debt is a favorable source. Debt becomes favorable source only when the return on investment, the business return, is more than the interest rate on debt. So if ROI is greater than interest rate on debt, then debt becomes a favorable financial leverage. This becomes a favorable financial leverage. In case if this return on investment is less than interest rate on debt cannot provide extra return to the equity shareholder, then this particular debt becomes an unfavorable financial leverage to the shareholders. So that's what you need to remember. So what is favorable financial leverage? If ROI is greater than interest rate on debt, then the debt becomes a favorable financial leverage. Okay. Now look at this point. Yes, the firm has favorable financial leverage as its return on investment is higher than interest rate on debt. Yes, we got 27% at ROI, whereas interest rate on debt is 9%, which is more than interest rate. So my dear students, this debt is a favorable financial leverage here. Okay, the firm has favorable financial leverage, that means favorable debt. That debt is a favorable source here. Okay, now look at point C. If the firm belongs to an industry whose assets turnover is 3, does it have a high or low asset leverage? Actually, assets turnover formula is sales by total assets. You know that the sales value is 75 lakh rupees here, whereas your total assets are not given here. I can take the total capital as total assets. That means the total capital 45 plus 55, 100 lakhs is my total assets. So what is the formula for total assets turnover ratio? Sales by total assets. That's what you need to calculate. Sales is 75 lakhs, total assets 100 lakhs. 75 lakhs divided by 100 lakhs, I got 0.75. See, 0.75, you should not mention any number here, rupees or something else. 0.75 is a ratio, it's a multiplier, or I can say it's a number without any unit. Okay, so 0.75, what it exactly means? 0.75 means 0.75 divided by 1. That means for every 1 rupee of asset I'm using in the business, for every 1 rupee of asset that I'm using in the business, I'm generating 0.75 rupees of sales. That's what the literal interpretation of the term assets turnover. So my assets turnover ratio in the company is 0.75. That means for every 1 rupee that I'm using in the business, for every 1 rupee that I'm investing in the assets, I'm able to generate 0.75 rupees of sales. Whereas the industry's assets turnover ratio is 3 times. That means the industry is generating 3 rupees of sales for every 1 rupee of usage of assets in the business, whereas I am just generating 0.75 rupees. So now my firm has high or low asset leverage. My firm has low asset leverage. That means I am generating lower amount of sales for every 1 rupee of asset that I am investing in the business. So the conclusion is it is lower than industry's average. So I can say that the firm has low asset leverage. You can write that sentence also here. The firm has low asset leverage. But this point C is over. Now go for point D. What are the operating, financial and combined leverage? That's a simple task. Operating leverage, contribution by EBIT. Financial leverage. Good evening everyone. In the previous session, we are in the middle of the problem number 12. Due to some technical issue, I stopped in between. So now let me go ahead with point number D. What are the operating, financial and combined leverages of the firm? You know, operating, financial and combined leverages are nothing but DOL, DFL and DCL. DOL is equal to contribution by EBIT. DFL is equal to EBIT by EBT. And combined leverage is equal to DCL is equal to contribution by EBT. So these are the 3 formulas, regular formulas. They've applied here and we got the answers. Sales minus variable cost contribution by EBIT. EBIT by EBIT minus interest means EBT. So the formula is EBIT by EBT. Combined leverage is contribution by EBT. So we got operating, financial and combined leverages. Alternatively, I can calculate combined leverage by multiplying operating leverage with financial leverage. Yes, we got it. Now, look at point E. If the sales drops to 50 lakhs, what will be the new EBIT? My previous sales is 75 lakhs. If it drops to 50 lakhs, what will be the new EBIT? Just need to prepare income statement. Sales revenue 50 lakhs. Previously, my variable cost ratio is how much? Actually, I have to calculate variable cost ratio. My variable cost is 42 lakhs. So, which is 56% is on sales. So, the variable cost ratio is 56%. The formula for variable cost ratio is variable cost by sales. So, if your variable cost ratio is 50%, even though your sales is decreasing, your variable cost ratio remains same. So, I can apply same 56% variable cost ratio on the new sales of 50 lakhs to get my variable cost. So, 50 lakhs into 56%, it is 28 lakhs. If you deduct this variable cost, I'll get contribution. 50 minus 28, 22 is your contribution minus fixed cost. There will be no change in fixed cost even though there is a change in sales. So I can use the same fixed cost of 6 lakhs. So I got EBIT of 16 lakhs. This is my requirement. So my new EBIT will be 16 lakhs if the sales drops to 50 lakhs. And point F, at what level will the EBIT of the firm will be equal to 0? So at what level of sales the EBIT of the firm will be equal to 0? That's what the requirement actually. At what level of sales the EBIT of the firm will be equal to 0. I can go ahead with the backward computation. See, look at the numbers here. Your target number is 0 EBT. Now interest, the interest is always constant. I can use same interest cost. So the interest component is 45 lakhs into 9%. It is 4,05,000. Through backward computation, if you can add interest to EBT, you will get EBIT. Okay, so 4,05,000 plus 0, I'll get 4,05,000 EBIT. Then if you can add fixed cost to EBIT, you'll get contribution. So 4,05,000 plus 6 lakhs, I'll get 10,05,000. That's my contribution. If I can add variable cost to this, then I'll get revenue, sales revenue. See, I'll do this. Numbers, sales, okay, sales is your requirement, minus variable cost, it is your contribution, minus fixed cost, the number will be EBIT. So just now we got EBIT of 4,05,000 actually. If I deduct interest also, I'll get EBT. The target EBT is 0. Since your target EBT is 0, there will be no change in interest cost 4,05,000. So EBIT will be 4,05,000. Your fixed cost is 6 lakhs. So through backward computation, I'm doing this computations. I'm arriving contribution here. 4,05,000 plus 6 lakhs, I got 10,05,000. This is my contribution, 10,05,000. The thing is, I have to calculate sales, but I know that the variable cost ratio is 56% on sales. If variable cost ratio is 56% on sales, then automatically 100 minus 56, the contribution ratio will be 44%. The contribution ratio will be 44%. You know that the contribution is 10,05,000. From that you can calculate sales. Contribution by sales is equal to 10,05,000. Wait. Contribution by sales is equal to 44%. Then sales is equal to 10,05,000 divided by 44%. From this I can calculate my required sales. It will be 22,84,090. So it should be your answer. Look at the number 22,84,090.90. That means 22,84,091. This is your required sales in order to get EBT of 0 number. So through backward computation, you can arrive this figure sales value. Simply, it's a backward computation. So if you can add interest to EBT 0, target EBT 0, you will get EBIT. Then add a fixed cost, then you will get contribution. Then from contribution, you can easily calculate sales value because you know the variable cost ratio. The balance ratio will be contribution ratio. So from that equation, I can easily calculate sales value. Yes, we got it. Now the next problem is related to capital structure. Actually, this is related to financial break-even point and EBIT indifference point. Look at this 13th problem. Excel Limited is considering 3 financing plans. The key information are as follows. The total fund to be raised is 2 lakhs. Financing plans ABC. See, under plan A, I can raise 100% equity, and under plan B, I can raise 50% equity and 50% debt, and under plan C, I can raise 50% equity and 50% preference. So we have 3 plans here: plan A, plan B, plan C. Cost of debt is 8%, that is interest rate on debt. The cost of preference shares is 8%, that is preference dividend rate on preference share capital. The tax rate is 35%. Equity shares of the face value of 10 rupees each will be issued at a premium of 10 rupees per share. That is, the issue price of equity share is 20 rupees. Expected EBIT is 80,000. Determine for each plan earnings per share, financial break-even point. It is very easy for you to calculate EPS for all these 3 plans. See, under plan A, I am going to raise 2 lakh equity. Under plan B, 1 lakh equity, 1 lakh debt. Under plan C, 1 lakh equity and 1 lakh preference share capital. My issue price is 20 rupees for equity share. Now, look at this statement. Determination of EPS of plan A, B and C. See, I've written EBIT here. See, they have taken EBIT here. 80,000 is expected EBIT. Deduct interest under plan B, because we have debt component 1 lakh into 8%. That is 8,000 interest. I've deducted it. EBT less tax rate 35%. I got EAT minus preference dividend. So you know preference dividend is applicable only for plan C. See, 1 lakh into 8%. That is also the same rate, right? So 8% preference dividend you have to deduct. Then I'll get earnings of equity shareholders. So that is to be divided with number of equity shares outstanding. Then so how to get number of equity shares outstanding? Simple thing. See, for plan A, I'm raising 2 lakhs equity. 2 lakh by 20 rupees issue price. The number of shares outstanding for plan A will be 10,000. Whereas for plan B, I'm going to raise 1 lakh equity only. 1 lakh by 20, 5,000 shares required to be issued. And under plan C, you're supposed to raise 5,000 number of equity shares, because amount that is to be raised to equity is 1 lakh rupees only. Okay. So the amount that is to be raised to equity should be divided with issue price of 20 to get number of shares outstanding. So earnings of equity shareholders under plan A is 52,000 divided by 10,000 shares. 5.2 is my earnings per share. 46,800 is the earnings of equity shareholders under plan B. This is A, this is B, this is C. Divided by number of shares are 5,000. I got 9.36 EPS. Like that for plan C also. So we got higher EPS under plan B actually. Okay. Now with this we have completed point number 1, earnings per share. Now what about second part of the question, point number 1, financial break-even point. I told you already the financial break-even point formula is EBIT is equal to interest plus preference dividend divided by 1 minus tax rate. Interest plus, that is the first term, plus preference dividend divided by 1 minus tax rate, second term. See, look at the formulas here. Financial break-even points for plan A, B and C. Plan A, actually financial break-even point for plan A is 0. Why sir? Because interest 0, preference dividend is 0. So because we don't have any preference share capital and debt capital for plan A. So for plan A, financial break-even point EBIT is equal to 0. And for plan B, it is financial break-even point EBIT is equal to interest plus preference dividend divided by 1 minus tax rate. For plan B, preference dividend is 0. So EBIT should be equal to interest. My interest component is 8,000. This is not 80, 00. It is 8,000 rupees. This is my financial break-even point for plan B. What about plan C? Interest is 0, whereas preference dividend is 8,000. That is to be divided with what? 1 minus tax rate. 1 minus 0.35. I'll get 8,000 divided by 0.65. So that will be 12,308. So the financial break-even point for plan A is 0. Plan B is 8,000. Plan C is 12,308. You please simply apply the formula. You'll get the answer. And now let us go for the indifference point between plan A and plan B. You have to calculate indicate if any of the plans dominate and compute the EBIT range among the plans for indifference. You have to calculate EBIT range among the plans for indifference, nothing but EBIT indifference point. I have to calculate indifference point between plan A and B, plan B and C, and plan A and C. That's what my requirement is. Now look at the requirements A and B, B and C, and A and C. I'll do this calculation for A and B. The same computation is applicable for plan B and C and plan A and C also. Let me do it. So plan A and B. How I have to write the formula EBIT minus interest into 1 minus tax rate minus preference dividend of plan A divided by number of equity shares should be equal to the same term EBIT minus interest into 1 minus tax rate minus preference dividend divided by number of equity shares. That's what your requirement is. Now substitute all the numbers except EBIT, because EBIT is a variable number, you have to calculate it. So EBIT, and I have to calculate that EBIT minus interest. So for plan 1, for plan A, the interest is nil, into 1 minus tax rate, 1 minus 0.35, minus preference dividend is nil, divided by number of shares for plan A is 20,000 shares. Sorry, it is 10,000 shares. It is 10,000 shares. Should be equal to the same term but with different numbers. EBIT minus interest for plan A, plan B is 8,000 into 1 minus 0.35 minus preference dividend is nil, divided by number of shares of 5,000. If you can solve this equation, you can easily arrive the number. 5,000 2 times will be, and it will be 2 times of 10,000. So I'll get 0.65 EBIT should be equal to 0.65 EBIT minus 8,000 into 0.65. It will be 5,200. 0.65 EBIT divided by 2. Okay, now from this you have to calculate your EBIT. Okay, so 0.65 EBIT should be equal to 0.65 into 2. It will be 1.3 EBIT. 1.3 EBIT minus 52,000 into 2, 1,04,000. So 1.3 minus 0.65, so it will be 1,04,000 divided by 0.65. I'll get 1,60,000. So my indifference this 60,000. Let me check it once. Actually, this is not 52,000. This is 5,000. 0.65 into 8,000. It is 5,200. It is 5,200. Sorry. Then the numbers will be changed. This is not 1,04,000. This is 1 lakh. This is 10,400. 10,400. From this 10,400 divided by 0.65, I'll get 16,000 EBIT indifference point. So for between plan A and B, my indifference point is 16,000. So what it means? If you can take 16,000 EBIT, calculate EPS for plan under plan A and plan B, you'll get same EPS. You please try to calculate EPS for plan A and B by taking 16,000 EBIT. You'll get the same EPS under both the alternatives. That's what the importance of this indifference point between plan A and plan B. So we understood indifference point between plan A and B. In the similar way, between B and C and A and C, how to calculate. Sometimes both LHS and RHS terms may be cancelled. In that case, indifference point doesn't exist. See, thus indifference point between plan B and C is indeterminate. That means I cannot determine this. So my dear students, sometimes between plan B, sometimes between two plans, you may not calculate indifference point. That means LHS term and RHS term gets cancelled. In that case, what will happen? You have to write like this: indifference point doesn't exist between these two plans. Or you can write, this is indeterminate. Okay, indeterminate means I cannot determine the indifference point between these plans B and C. So this will also happen. Here for plan B and C, we don't have indifference point. Whereas for plan A and C, I got an indifference point of 24,615. You must use this equation. This is the important equation I must apply for calculating EBIT indifference point. Okay. With this, we understood 13th problem. Now we can enter into the new chapter called dividend policy. Let me enter into the chapter. Okay. Here is the chapter dividend policy, dividend decisions and dividend theories. Actually, dividend decisions simply. The objective of this chapter is simple: whether this dividend decision can affect, whether it can affect the wealth of the firm or not. Wealth means value. Actually, you cannot simply say it can affect the value of the firm or wealth of the firm, because there are two types of opinions here. Some people said dividend decisions can affect the value of the firm, or wealth of the firm, and some people said it cannot affect the value of the firm. The first set of theories are simply known as theories of relevance. That means the dividend decisions are relevant for value of the firm. And the second set of decisions are simply known as theories of irrelevance. That means the dividend decisions are completely irrelevant for what? The value of the firm. So, the first set of theories are Walter model and Gordon model. The second set of theory is Modigliani and Miller approach. The same persons which we have discussed under the chapter capital structure. Modigliani and Miller approach. So we have to understand these two set of theories. Along with this series, we also have other theories called Lindner model. So we should also understand those such theory also, calculation of expected dividend per share. Now let me handle the first set of theories, that is the theories of relevance. Under that, I am covering the first area called Walter's model. Walter is simply giving one conclusion. When the company is earning profit of equity shareholders, it can distribute the profits or it can retain the profits. So what to do? Whether I should distribute the profits or retain the profits? Walter says, if R is greater than KE, you better retain the profits. If R is less than KE, you better distribute the profits. That's what the conclusion of Walter. R is greater than KE. So what is R and what is KE? R means the rate of return that can be earned by the company by investing its funds in the business or projects. KE means the expected return of equity shareholders, cost of equity KE. So what Walter is saying? Walter is saying a simple sentence. If the return from the projects are more than the cost of equity KE, you better retain the profits of equity shareholders and reinvest in the business to earn more and more profits. Why? Because the business projects are generating higher return when compared to the expected return of equity shareholders. So if R is greater than KE, it is better for the company to retain the profits in order to increase the value of the share. And if R is less than KE, since the firm is not able to provide the return which is being expected by equity shareholders, it is better to distribute the profits and don't retain even a single rupee of profit which belongs to equity shareholders. That's what Walter says. So a firm can maximize its value per share if it can distribute its entire profits to the shareholders in case if the R is less than KE. So these are the two conclusions which were given by Walter. Now my dear students, this Walter has given one formula for calculating the value of the share. Under Walter's model, The formula for MP naught is D by KE plus R into E minus D by KE whole divided by KE. So what is D? Where D is equal to dividend per share. R is equal to the rate of return. K is equal to cost of equity. Okay. And coming to E is equal to earnings per share. Earnings per share. But this, all the terms are covered. This is the formula which is being given by Walter. MP naught is equal to dividend by KE, dividend per share divided by KE, plus R into E minus D by KE whole divided by KE. Okay, there is a huge background about this formula. Actually, there is a huge background behind this formula. I'm not explaining such part because that is purely conceptual. You better go ahead with the formula itself, because application of formula is very important to get more and more marks. Okay, so you better remember the formula. MP naught is equal to D by KE plus R into E minus D by KE whole divided by KE. So what Walter is saying, Walter has given some optimum dividend payout ratios. Optimum payout ratios means the best payout ratio which can maximize the value per share, because ultimate target of every decision is to maximize value per share. So I'm taking here the optimum payout ratios that were given by Walter. If R is greater than KE, the firm can maximize, I'll do this. The optimum payout ratio will be, 0%. That means if R is greater than KE, you better don't distribute any amount of profits to the shareholders. The payout ratio should be 0%. If your payout ratio is 0%, then you can maximize the value per share. %0 payout ratio can maximize the value per share. So what is the optimum dividend payout ratio if R is greater than KE? 0%. That means don't distribute any amount of profit. If R is less than KE, since a firm is not able to generate better profits which can satisfy the equity shareholders, then immediately you better distribute 100% of profits to the shareholders. 100% payout ratio can maximize the value per share. Can maximize value per share. If R is equal to KE, the dividend policy is completely irrelevant. The dividend policy or the dividend payout ratio cannot affect. The dividend payout ratio cannot affect the value per share. It cannot affect the value per share. Okay. That's it. So these are the payout ratios which were given by Walter. Let me handle one problem related to this concept so that we can close this at the earliest. Here is the first theory, Walter's model. Yes. Look at this question. This is covering so many points. From the following data, calculate the value of an equity share of the following three companies according to Walter's model when dividend payout ratio is nil, 25%, 50%, 75% and 100%. So when the dividend payout ratio is nil, 25%, 50%, 75% and 100%, what could be the value per share, value of an equity share? Name of the companies: X Limited, Y Limited, Z Limited. Observe the rate of return and cost of equity. Internal rate of return R, cost of capital K, nothing but cost of equity KE, and earnings per share for all the firms were given. What conclusions do you draw? First of all, look at X Limited. R is greater than KE for X Limited, R is less than KE for Y Limited, R is equal to KE for Z Limited. For all these payout ratios, I have to calculate market price per share for X Limited, Y Limited and Z Limited. Statement showing for valuation of each equity share according to Walters model. You know the formula for price per share under Walters model. D by KE plus R into E minus D by KE whole divided by KE. See, you can apply the formula which I have given to you. So now, dividend payout ratio. For X Limited, since R is greater than KE, what should be the optimum dividend payout ratio? So first of all, dividend payout ratio for X Limited, Y Limited and Z Limited. Yes, actually these are the situations actually. The terms were given. Earnings per share 10. For X Limited, earnings per share is 10 and R is equal to 15%, KE is equal to 10%. R by K is given here. I am not going to take this. Now, for Y Limited, earnings per share is 10, R is equal to 5% actually and KE is equal to 10%. For Z Limited, earnings per share 10, R and KE both are same, that is at 10%. You please don't consider R by K because we will apply the formula as per our understanding. When dividend payout ratio is nil, if the payout ratio is nil, what will happen to all the three firms? When payout ratio is nil, earnings per share becomes dividend per share. Dividend per share will be 0. When dividend payout ratio is nil, dividend per share will be nil. For all the firms, DPS is nil. When dividend is nil, what will happen? D by KE, the first term becomes 0, plus DR into E minus D by KE. So if I can take here, first firm X Limited, D by KE, that means 0 by KE means 10% plus R into E minus D by K. The rate of return is 15% here. Okay, 15% into E earnings 10 minus D 0 divided by KE 10% whole divided by 10%. This is for the first firm. The first firm X Limited. Let me calculate it. 15% into 10. 1.5 divided by 10% divided by 10%. I got 150 rupees share price. Yes, we got 150 share price here. In the similar way for Y Limited and Z Limited also. In the similar way. Okay. Now, when the dividend payout ratio is 25%, I'll do it for X Limited. Actually, they have calculated dividend per share. Earnings per share is 10 into 25% dividend payout ratio. I got 2.5 DPS. 2.5 by KE plus R into E minus D by KE whole divided by KE. Let me do it for X Limited. MP naught is equal to D by KE. See, 2.5 divided by 10% plus R into E minus D by KE. 15% into earnings per share 10 minus dividend per share 2.5 divided by KE whole divided by KE. So you please solve this so that you can calculate market price per share for X Limited when the dividend payout ratio is 25%. Yes, 2.5 by 10% and 10 minus 2.5 into 15% divided by 10% divided by 10%. So I got 137.5 rupees share price. You please do it in your own way. You don't need to follow the study material computation every time. 137.5. I got it. In the similar way for Y Limited and Z Limited. Now, my dear students, if you can take dividend payout ratio 50%, the same computation is applicable. 75%, 100%, everywhere the computation is same. The point is, you please look at firm Z Limited. Since R is equal to KE, when R is equal to KE, the dividend policy cannot affect the value of the share. That means for any payout ratio for Z Limited, your share price must be equal. You please check it once. When the dividend payout ratio is 0, my share price is 100 under Walters model. When the dividend payout ratio is 25%, I got the same 100 rupees. 50% dividend payout ratio 100. 75% payout ratio 100. And 100% payout ratio 100. So for Z Limited, why we got the same share price, same market price per share under Walters model, under the different payout ratios? Why, sir? Why? Because the dividend payout ratio is completely irrelevant to the firm, is completely irrelevant to the value of the share. In case if R is equal to KE. So when return on investment is equal to cost of equity KE, the dividend policy is completely irrelevant according to Walters model. Yes, we understood Walters model. Comments and all, you please read it. You can easily say that the conclusions which were given by Walters will be covered under comments. Okay, comment section. Now let me go for the next theory. Gordon model. Under Gordon model, the same conclusions were given by Gordon also. When the firm is earning profits, it has two options. One, to retain the profits. The other one is to distribute the profits. The same logic was given by Gordon also. If R is greater than KE, you better retain the profits. If R is equal to KE, you better distribute the profits. Okay, that's what the conclusions given by Gordon actually. And according to Gordon, the share price can be determined by using this formula. MP0 is equal to EPS into 1 minus B by KE minus BR. This is a formula where EPS is equal to expected earnings per share. Expected earnings per share. B is equal to retention ratio. K is equal to cost of equity. That's a known term to everyone. Whereas R is equal to rate of return. And I need to tell you one important point. B into R is nothing but growth rate. That means the growth rate is a multiplication of retention ratio and rate of return. B into R. So the formula for MP0 is EPS into 1 minus B by KE minus BR. Where EPS is expected earnings per share, B is retention ratio, KE is cost of equity, R is rate of return, BR is growth rate. Okay. See, my dear students, 1 minus B is also known as 1 minus B means 1 minus retention ratio. So what is 1 minus retention ratio? 1 minus retention ratio means dividend payout ratio. Dividend payout ratio. So if you can simply understand this term 1 minus B, which is clearly saying I am dividend payout ratio. So 1 minus B is nothing but dividend payout ratio. If you can multiply dividend payout ratio with EPS, I'll get DPS. DPS by KE, BR means G. So DPS by KE minus G. That's what the understanding. Nothing but, this is nothing but dividend growth model. Under dividend growth model also, the formula for MP0 is DPS 1 by KE minus G. So the same formula I'm applying here. That's why the Gordon model is also known as growth model. Okay. Now, actually, even Gordon is saying same thing. If R is greater than KE, by retaining more profits, you can maximize the value per share. If R is less than KE, by distributing more profits, we can maximize value per share. Okay, that's what the Gordon is saying. So you must remember this formula for application. Let us handle one problem related to this concept also, Gordon. Yes. Here is the Gordon model. From the following data, calculate the value of an equity share of each of the following three companies according to Gordon model when dividend payout ratio is 25%, 50% and 100%. It's the same formula set actually for the, and I'm taking the same, I'm taking different returns, X limited, Y limited, Z limited, RKE earnings per share are given here. What conclusions can you draw? First of all, you know the formula E into 1 minus B by KE minus BR for calculating share price of the company. Let me take X limited, earnings per share is 12, R is 12%, cost of equity, K is 10%. Okay then, and for Y limited earnings per share 12, KE 10%, R is 8%, and for Z limited earnings per share is 12, KE 10%, R is 10%. Now let me apply the formula when the dividend payout ratio is 25%. When the dividend payout ratio is 25%, I can calculate 1 minus B. 1 minus B means actually, you know one thing, dear students, the dividend payout ratio, just now I told you, 1 minus B is nothing but dividend payout ratio. So what are the dividend payout ratio? What are the dividend payout ratios that were given in the problem? I can take these dividend payout ratios as 1 minus B. That means already we have 1 minus B here. Okay. 1 minus B is 25%. Or you can take retention ratio from dividend payout ratio, because if the dividend payout ratio is 25%, that means the retention ratio is the balance percentage 75%. So instead of that, you better take this 1 minus B directly and you can solve the problem very comfortably. But they have taken B directly here. See, 12 is my earnings per share, 1 minus B. Since the dividend payout ratio is 25%, retention ratio B will be 75%. 75% means 0.75. 1 minus 0.75. Divided by K is 10% and R is 9% actually. K minus BR. B into R. B means what? 0.75. Means R means what? R is 12%, 0.12. So 0.75 into 0.12, I got 0.09. That's what they have written here. Okay. So 12 into 0.25 divided by 10 minus 9%, nothing but 1%. I got 300 rupees. This is what my share price. Okay. For Y Limited also you can do like this, and for Z Limited also you can do like this. Okay. Now go for the next payout ratio. If my payout ratio is 50%, yeah, I'll take 50% payout ratio. If my dividend payout ratio is 50%, then my retention ratio will be 50%. That means B is equal to 0.5. Do the go with the computation just like in the previous computation. B is 50%, so B into R is 0.5 into 0.12, 0.06. Substitute the numbers here. EPS 12 into 1 minus B. B is retention ratio 0.5 divided by KE minus BR. KE is cost of equity 10% minus BR. B into R. Just now we got it 0.06. So if you can substitute the numbers, you can get the answer. 12 into 0.5 divided by 0.04. I got 150 rupees share price. Okay. Now, even for zero payout ratio also, zero retention ratio also, you can calculate like this. The same formula. That's it. See, B is the retention ratio. B means retention ratio. 1 minus B means 1 minus retention ratio. That is dividend payout ratio. Or I can write like this. B is equal to 1 minus dividend payout ratio. Retention ratio B is equal to 1 minus dividend payout ratio. You better write that formula also without any confusion. So B is equal to 1 minus dividend payout ratio. 1 minus dividend payout ratio. You can write this formula also for better retention. Okay, for better understanding. Okay. Now you need to observe one thing here. For Z Limited, since R is equal to KE, what was happened here? The share price is 120 when my payout ratio is 25%. My share price is 120 again when my payout ratio is 50%. My share price is 120 again when my share price is 100%. So what is the conclusion? The dividend policy is irrelevant for valuation of the share. That means the value per share remains constant if R is equal to KE, even under Gordon model also. Even under Gordon model, if R is equal to KE, the dividend policy is irrelevant. If R is greater than KE, the share price can be maximized. The share price can be maximized by retaining more and more profits, and by distributing lesser amount of profits. If R is less than KE, the company can maximize the value per share by distributing more profits and by retaining lesser amount of profits. Even you can check the numbers here. See, if R is greater than KE, here the context is R is greater than KE. When I am following 25% payout ratio, I got 300 rupees share price. When I am following 50% payout ratio, I got 150 rupees share price. When I am following 100% payout ratio, I got 120 rupees share price. What is happening here? When I am distributing lesser amount of profits, that means when I am retaining much profit, that means 75% retention, I got highest price. When I am retaining lesser amount of profits, 50% only, I got lower share price. When I am retaining nothing, my share price is reduced to least price of 120. That means I can maximize the value per share from 120 to 150 and 150 to 300 rupees by reducing the payout ratio and by retaining the profits. Nothing but the retention ratio. And by increasing the retention ratio, I can maximize the value per share. That's what your observation actually. The same logic is applicable to Y Limited also, reverse computation actually. That means since your R is less than KE, so I can maximize value per share by distributing more profits. So since for that reason only, for 25% payout ratio, I got 75 rupees share price. For 50% payout ratio, I got more share price, 100 rupees. And with 100% payout ratio, I got highest share price of 120. So I can maximize value per share even under Gordon model. When R is less than KE, by distributing more and more profits, I can maximize value per share. If R is equal to KE, the dividend policy is irrelevant. The share price remains constant. With this, we understood Gordon model also. Yes. Now the next model is Modigliani and Miller approach. Modigliani and Miller, these people are always against the world. If we are saying something, they'll say no. Okay. So that's why they are under second set of theories of irrelevance. These two persons are saying the dividend policy is completely irrelevant for the valuation of the firm. That means the value of the firm remains constant even though the firm is paying dividend, or the firm may pay dividend or may not pay dividend. It doesn't matter to the value of the firm. That's what Modigliani and Miller says. So, and they proved it with the help of empirical derivation actually. I'm going to give you few formulas under M&M approach actually. P0 is equal to current share price, and they are taking holding period of 1 year. So we have to consider 1 year cash flows. If you can discount such 1 year cash flows at investors expected return of cost of equity KE, so you can calculate value per share. So D1 is the first cash flow I can receive at the end of first year. Since I'm taking 1 year holding period, I can sell my share at the end of first year at a price of P1, market price per share at the end of first year. P0 is current share price. I'm calculating current share price by discounting 1 year cash flow because my holding period is 1 year. So dividend 1, DPS 1, the expected dividend at the end of first year, this is my first cash inflow, and sale value of share price at the end of first year, that's my second cash flow. I have to discount these two cash flows at my investors expected rate of return, cost of equity KE. So divide by 1 plus KE, 1 by 1 plus R, whole to the power of 1, 1 by 1 plus KE, whole to the power of 1, that I don't need to write. So if I can discount 1 year cash flow at cost of equity KE, then I can calculate value per share. That's what the formula for share price under Modigliani and Miller approach, P0. Here the holding period is 1 year. So what is the formula for P0? Current share price, D1 plus P1 divided by 1 plus KE. This is regarding first formula. And also, these two persons, Modigliani and Miller, proved that the current value of the firm and the future value of the firm remains unaffected by dividend payout. That means the company may pay dividend or it may not pay dividend. It doesn't matter. The current value of the firm remains constant. The future value of the firm remains constant. They proved it with the help of arbitrage process and also empirical derivation actually. Now we have one formula set for calculating current value of the firm, and then I can calculate future value of the firm with the help of some computation actually. So let us understand the first part of the area, current value of the firm. How to calculate current value of the firm? We have a formula set for calculating current value of the firm. Let me show you. Here is the formula set. Look at the formula. Here is the formula. NP0 is equal to M plus N into P1 minus I plus C divided by 1 plus KE. I'll write the same formula. NP0 is equal to M plus N into P1 minus I plus E divided by 1 plus KE. So first of all, what are these terms actually? N is equal to current number of shares outstanding. N is equal to current number of shares outstanding. M is equal to number of new shares to be issued. Number of new shares to be issued at the end of first year actually. P0 is equal to current market price per share, today's share price. P0 is equal to current share price, current market price per share. P0. P1 means market price per share at the end of first year. At the end of year 1. Okay, and you know that yes, I is equal to investment amount, nothing but capital expenditure. Investment amount at the end of first year, also known as capex, capital expenditure. And E is total earnings at the end of first year. Total earnings. Total earnings. This is what the formula for NP naught. Sir, what is this NP naught? You please understand one thing here. N means current number of shares outstanding. P naught means current share price, current market price per share. So if you can multiply current number of shares outstanding with current market price per share, what will get? I'll get current market value of the firm. Current market value of the firm. So what is this NP naught? Current market value of the firm. Have you observed one thing? In this equation actually, we don't have a term called dividend. So the current market value of the firm remains unaffected by dividend payout. Why? Because this formula is missing one term called dividend. So your payment of dividend doesn't matter to this current market value of the firm NP naught. If you can substitute these numbers, you'll get current market value of the firm. Whether you pay dividend or not, your current market value of the firm should be equal. You will get same current market value of the firm. I need to prove it with the help of one problem actually. Okay. Let me show you. See, we have a problem here. I'll explain it. Yes, Bangabasi Limited belongs to a risk class for which an appropriate capitalization rate is 10%. See, this is KE. It currently has outstanding 2000 equity shares of 100 rupees each. See, dear students, this is N. And the share price is 100 rupees. This is P naught. The firm is contemplating the declaration of dividend of 8 rupees per share. Declaration of dividend of 8 rupees per share at the end of the current financial year. This is D1. It expects to have a net earnings of 20,000. This is E. And as a proposal for making a new investment of 24,000. This is I. Show that under Modigliani and Miller assumptions, the payment of dividend does not affect the value of the firm. Let us calculate value of the firm first of all. And that's what they've done here. P naught, current share price 100. P1, market price of the share at the end of the year. That is, you have to calculate it actually. Okay. That's what your first job. D1 is expected dividend per share at the end of first year, 8 rupees. Cost of equity K is 10%, also known as cost of capital. Number of shares outstanding at the beginning of the year, 2000. N, small n. Small n means current number of shares outstanding. They have taken delta n. Instead of this, we have taken M, small m. Number of additional shares to be issued. Number of new shares to be issued. E means earnings of the company, 20,000. I means, this is I, total amount required for investment, 24,000. Now, my first job is to calculate P1. So, how to calculate P1? The formula for P1 is dependent on whether you are paying dividend or not. Under both the cases, I have to calculate price per share at the end of first year. P naught is equal to P1 plus D1 divided by 1 plus KE actually. Okay. Valuation of the firm when dividends are paid. So, P naught is 100. P1, I have to calculate that. D1 is 8 rupees. Divided by 1 plus KE, 0.10. If you can solve this equation, you get price per share at the end of first year 102. That's a simple equation. When the company is not declaring dividend, what will happen if dividends are not paid? If dividends are not paid, P naught is equal to the same formula I have to apply actually here. The same formula. My P naught is 100. That is equal to dividend. P1 is, I have to calculate that. D1 is 0 because I am not paying any dividend. Divided by 1 plus 0.10. So, I will get P1 is equal to 110 rupees. This is my price per share at the end of first year if I am not paying any dividend. If I am paying dividend, the share price will be 102. Okay. Now, the requirement is I have to calculate current market value of the firm when dividends are paid, when dividends are not paid. Okay. You better do one thing. We'll do our own computations actually here. So the formula is NP naught is equal to current market value of the firm, NP naught is equal to the first term, M plus N. How many number of additional shares to be issued? That's what the first question. Actually, you have to calculate that. That's a big question. Number of new shares to be issued. How many additional shares we are issuing here? 2000. Sorry. This is dependent on one important factor actually. First, you have to calculate that. It's part and parcel of presentation. They've done in their own way. We need to do our own computations. Before applying this formula, I have to calculate small m, number of new shares to be issued. That's what your first requirement. Calculation of future market value of the firm and number of new shares to be issued. Under two situations, I have to do this. Particulars, if dividend is paid, if dividend is not paid. So what I have to write? First, you have to write investment amount. My investment amount is let me write it. My investment amount is 24,000. 24,000 under both the cases. $24,000 under both the cases. From this, you please deduct retained earnings. How to get retained earnings? Because my investment should be financed out of retained earnings first of all. How to get retained earnings? First, identify your earnings. Your earnings are 20,000 rupees. My earnings at the end of first year is 20,000. 20,000 in both the cases. When dividends are paid, when dividends are not paid. From that, you please deduct your dividend payment. Less dividend. For how many shares I am paying dividend here? For current number of shares only, I have to pay dividend. For current number of shares, see, at the end of first year, I will pay dividend only for old number of shares, but not for additional shares. 2000 into, my dividend is 8 rupees. 2000 into 8. 2000 into 8. It will be 16,000. So if I pay 16,000 dividend, my retained earnings will be 4,000 when dividends are paid. When dividends are not paid, the dividend payment will be 0. So retention will be 20,000. So I should prefer retained earnings first of all for financing my new investment at the end of first year. Then the balance must be raised through equity. Amount to be raised through fresh equity. How much amount must be raised to fresh equity? 24,000 minus 4,000, it is 20,000. 24,000 minus 20,000, it is 4,000. So after retained earnings deduction, whatever the money I need for financing my new project should be raised to fresh equity. It is to be divided with the price at the end of first year, P1. See, I got 102 if dividends are paid, and I got 110 if dividends are not paid. That's what we have done. So amount to be raised through fresh equity should be divided with share price at the end of first year, because at this price only I am going to issue fresh equity shares. So number of new shares to be issued, nothing but small m. So 20,000 by 102. I got 196.078. You have to consider fractions only as per the assumptions of M&M. 4,000 divided by 110. It will be 36.36 shares. 3636 shares. So plus, this is small m actually. Current number of shares outstanding. Current number of shares are, let me check it. I think it is 2000. Current number of shares are 2000 shares. Add these numbers. 2000, 2000. 2196.078 shares. 2036.36 number of shares. Total number of shares outstanding at the end of first year, which is to be divided with share price at the end of first year. Market value of the firm or market value of the equity at the end of the year. How to get it, sir? Simple. Multiply these number of shares, total number of shares outstanding, with share price at the end of first year, 102, 2196.078 into 102. I got 2,24,000. This is my future market value of the firm. 2036.36 number of shares outstanding into 110. So 110 into 2036.36. Here also I got 2,24,000. Have you observed one thing? My future market value of the firm at the end of first year is same. It is equal whether I am paying dividend or not. So I may pay dividend or I may not pay dividend. The future market value remains same. And also I should prove whether the current market value of the firm is same or not. See, I need small m here. Okay, you must remember these numbers: 2196.078 and 2036.36 total number of, 196.078 and 36.36 small m numbers actually here. Okay, these numbers must be considered here. Look at the numbers under this formula. P1 102, value of the firm, P1 102, 2000 plus 2000 by 102, that's what we got it actually, minus I 24,000 plus E 20,000 divided by 1 plus 0.10. You please do this number, you'll get some current market value of the firm, that is equal to 2 lakhs. Just do it. 102 into 2000, I got some total number of shares actually, 2196.078, 2196.078 plus minus 24,000 plus 20,000 divided by 1 plus 0.10. You please do this number. 2196.078 into 102 minus 24,000 plus 20,000 divided by 1.1. I got 2 lakh rupees current market value of the firm. So I got some current market value of the firm when dividends are paid. You will get the same current market value of the firm when dividends are not paid. You please try the same formula, but this time small m means you have to consider 36.36. That means n plus m should be 2036.36. By taking these numbers, you can calculate current market value of the firm. But you remember one thing, P1 is 110, not 102. You will get same 2 lakh rupees current market value of the firm. That means even the current market value of the firm remains constant whether you pay dividend or not. It doesn't matter. Okay. So with this, we understood Modigliani and Miller approach. You better follow my way of calculation. That is so easy. Okay. So this is regarding 21st problem. So we understood Modigliani and Miller approach successfully. Yes. And also we have dividend discount model. You see, my dear students, dividend discount model is nothing but discounting of future dividends. I can calculate share price when constant dividends. Under constant dividends, P0 is equal to constant dividend per share divided by cost of equity. This formula will give me the share price today's share price. In case if dividends are growing, the formula will be changed. The formula will be DPS 1 by KE minus Z. The first formula is applicable for constant dividends. The second formula is applicable for dividends which are following constant growth rate. That means they're growing dividends. Okay. DPS 1 means expected dividend per share at the end of first year. The formula is DPS naught into 1 plus Z. Here DPS, you don't need to give any notation. DPS means expected dividend per share without any growth, because the dividend per share is always constant. Okay. And here is the formula, constant dividend growth rate. So the formula is D1 by KE minus C for calculating current share price. See, instead of remembering this formula, you better follow the process for non-constant growth rate situation. See, for under non-constant growth rate situation, the share price can be calculated in a phased manner. So that is covered under the chapter cost of capital actually. Yes, we have one more theory and that will be covered in the next session. Thank you. Good evening all of you dear students. In the last session, we understood several theories in dividend policy. Now, we have one more theory under dividend policy, that is Lindner's model. You better follow my formula instead of the formula which is given in the study material, because that is little bit confusing actually. The terms are not clear. So I am giving you the clear formula under Lindner's model. See, Lindner developed a formula for calculating expected dividend per share for the next year by observing the dividend trend of several corporates. So, this formula is very famous because it is taking the realistic things actually. It is taking some realistic assumptions. So, as per Lindner's model, what is the formula for expected dividend per share for the next year? The formula is DPS1 is equal to DPS0 plus EPS1 into target payout ratio minus DPS0 into adjustment factor AF. So every term is very clear, where DPS0 is equal to last year dividend per share, and EPS1 is equal to expected earnings per share at the end of year 1. And this term AF is nothing but adjustment factor based on the sustainability of the earnings in the future. This is adjustment factor. Okay. So this is a formula for DPS1 as per Lindner's model. So what is the formula? DPS0, EPS1 into target payout ratio, DPS0 plus EPS1 into target payout ratio minus DPS0 into adjustment factor. Actually, if you found any problem in the examination paper, they'll give you DPS0 and they'll give you EPS1 and target payout ratio. Then finally they'll give you adjustment factor. So you are supposed to calculate DPS1. That's not an issue. But sometimes they may give you DPS1 and DPS0 and everything except adjustment factor. So you are supposed to calculate adjustment factor. Sometimes they may ask you to calculate target payout ratio by giving all the remaining terms. So you better remember this formula, that is more than enough. Okay. And please try to define every term clearly. DPS0 last year dividend per share, EPS1 next year expected dividend per share at the end of first year. AF is adjustment factor. Target payout ratio means the dividend payout ratio which they are following. Okay. This is regarding DPS1 as per Lindner's model. So with this we understood all the theories in dividend policy. Now I am entering into the next chapter, ratio analysis. This is what the new chapter, ratio analysis. See, in our context, ratio means financial ratio. So I have to define several financial ratios by taking financials from financial statements. Financial statements means trading and profit and loss account and balance sheet. So I have to take several financials from balance sheet and trading and profit and loss account. Then I must define financial ratios. The question is, why should I define financial ratios? Because I should analyze such financial ratios. So what is the objective of analyzing financial ratios? See, by defining several financial ratios, after analyzing such financial ratios, we'll be able to we'll be able to assess the financial strengths and weaknesses of the company. So the ultimate objective of analysis of all the financial ratios by taking the financials from the financial statements is simply to assess the strengths and weaknesses of the firm. So how to assess the financial strengths and weaknesses of the firm? By defining several financial ratios. Sir, can we assess the financial strengths of and weaknesses of the firm merely by seeing the financial statements? The financial statements may not give you the true picture of the company in terms of performance in several aspects. That's why we are supposed to define financial ratios. See, in every ratio, there will be a numerator and denominator, x by y. Say, for example, I have defined one ratio called x by y. There should be a numerator and denominator. But the point is, whenever you are defining the financial ratio, there should be a meaningful relationship between numerator and denominator. So, accordingly, all the ratios are classified into several types. The ratios are liquidity ratios, solvency ratios, also known as capital structure ratios. Solvency ratios or capital structure ratios. And we have activity ratios, nothing but sales related ratios. And finally, profitability ratios. Apart from these set of ratios, we should also discuss about coverage ratios, and also we need to discuss about valuation ratios. Valuation ratios are part and parcel of profitability ratios only, nothing else. Okay. Now let me start with the first area called liquidity ratios. The first area is liquidity ratios. Sir, what is the objective of defining liquidity ratios? To know the liquidity position of the company. The question is, what is liquidity position? Liquidity position means the ability of the firm to meet its current liabilities, like creditors and outstanding expenses. The ability of the firm to meet its current liabilities out of the available current assets. So we should test the ability of the firm to meet its current liabilities as and when they become due out of the available current assets, not out of current fixed assets, because I cannot sell my fixed assets to meet my current liabilities. So in order to meet our current liabilities, how much worth of current assets I am maintaining? So if you are maintaining sufficient worth of current assets, then your liquidity position is strong. If you are not maintaining sufficient worth of current assets, then your liquidity position is weak. So in order to test the in order to test the liquidity position of the company, we have to define several liquidity ratios, and as part of that, the most important ratio is current ratio. You should remember this ratio very carefully. The formula for current ratio is current assets divided by current liabilities. That's it. CA by CL, current assets by current liabilities. Say for example, if my current assets are 200 crores and if my current liabilities are 100 crores, then the ratio is 2:1. That means for meeting 1 rupee current liability, I am maintaining 2 rupees worth of current assets. This is a sufficient worth of liquidity that the company is maintaining, because for meeting 1 rupee liability, current liability, we are maintaining 2 times of current assets. Even if you can realize 50% of current assets, you can meet your current liabilities. So the ideal ratio of current ratio is 2:1. Remember that. So what is the formula for current ratio? Current assets by current liabilities. That's it. Now I am moving to the next area called quick ratio. Quick ratio, also known as liquid ratio. Liquid ratio. So what is the formula for quick ratio or liquid ratio? Again, I am testing the ability of the firm to meet its current liabilities, but this time not out of current assets, it's out of quick assets. The quick assets are also known as liquid assets. The quick assets are also known as liquid assets. So the formula is very simple. Quick assets or liquid assets divided by current liabilities. This is what the formula for quick ratio or liquid ratio. I am not changing the current liabilities denominator term. I am just changing the numerator term. Under current ratio, I am taking current assets, whereas under quick ratio, I am taking quick assets or liquid assets. The question is, sir, what is quick asset? See, quick assets are the assets which can be quickly realizable. What assets are quickly realizable? Other than stock, every current asset is quickly realizable. That means if you remove stock from current assets, Then the balance current assets are quick assets. And also you are supposed to deduct one more non-regular item called prepaid expenses. This is prepaid expenses. So what is the formula for quick assets? Current assets minus stock minus prepaid expenses, and that gives you quick assets. And also I can write this quick assets as debtors plus cash and bank balances. This is one more formula for quick assets. Okay, so we understood quick ratio also, or liquid ratio. So the next ratio is defensive interval ratio. Defensive interval ratio. The formula is liquid assets divided by projected daily cash expenses. Projected daily cash expenses. So this is what the formula for defensive interval ratios. Liquid assets divided by projected daily cash expenses. You know the term liquid assets, which are nothing but quick assets. Projected daily cash expenses. How to get projected daily cash expenses? Just calculate the annual expenditure, annual operating expenses, nothing but I can say COGS plus operating expenses for the year divided by number of days in a year, nothing but 365 days. So then I'll get projected daily cash expenses. So from this you can define the ratio. Say for example, my liquid assets are 30 crores and my projected daily cash expenses 365 crores is my total expenditure divided by 365 days. So my daily cash expenses are 1 crore per day. So this gives me, say for example, it is 30 crores and 365 crores rupees. Rupee cancel, crore cancel, 365 cancel. I'll get 30 days. So it's a time period actually. Okay, it's a time period. Projected daily cash expenses. Oh, actually the defensive interval ratio we have calculated and I got 30 days. So what it exactly means? See, in 1 year period, I am going to incur 365 crores expenditure, cost of goods sold and other operating expenses, whereas I am maintaining 30 crores worth of liquid assets. So with this available liquid assets, for how many days I can run my business very smoothly, even though I am not having any kind of sales. So without resorting to further sales, for how many days I can run my business smoothly, I can run my operations smoothly. See, for 30 days, I can run my operations smoothly because I am maintaining 30 crores worth of liquid assets. In case if I am maintaining 40 crores liquid assets, I can run my business for 40 days very smoothly. So this is regarding defensive interval ratio. Defensive interval is a time period, which means for how many days you can run your business very smoothly without resorting to further sales. That's what defensive interval ratio. Yes, we understood all the liquidity ratios. Now I'm moving to solvency ratios or capital structure ratios. So before going for solvency ratios or capital structure ratios, I'll give you few terms which are very important. So from the balance sheet, I have to define such ratios: fixed assets, current assets, and we have equity share capital plus reserves and surplus, and we are going to have preference share capital, long term debt, current liabilities. Okay, these are the liability side items, and assets are fixed assets and current assets. From these numbers, you are supposed to define several terms. The first one is capital employed. Capital employed or long-term fund. If your capital employed is loaded with long-term fund only, then the formula will be equity share capital, all the long term sources must be considered here. Equity share capital plus reserves and surplus plus preference share capital plus long term debt. This is the formula for capital employed or long term fund. Okay, yes. From assets side, I can define the formula: fixed assets plus current assets, add all the assets minus current liabilities, then you will get capital employed or long term fund. Nothing but I'm adding what? All the total current assets. From that, if I remove these current liabilities, whatever the value I'll get, that is the sum of all these three sources: equity, preference and debt, long term debt. So my dear students, this is a formula for capital employed or long term fund: equity share capital plus reserves and surplus plus preference share capital plus long term debt, or fixed assets plus current assets minus current liabilities. And I can define one more ratio: equity or proprietors fund or shareholders fund. If I say equity or proprietors fund or shareholders fund, equity means which includes equity shareholders fund as well as preference shareholders fund. If I say proprietors includes equity shareholders and preference shareholders. If I say shareholders, equity shareholders and preference shareholders must be considered here. So the formula is equity share capital plus reserves and surplus plus preference share capital. That's it. This is what equity or proprietors fund or shareholders fund. That's it. From asset side, I can write this formula as fixed assets plus current assets minus current liabilities minus long term debt. If you remove all the current liabilities and long term debt, then I'll get equity or proprietors fund or shareholders fund. And I need to define one more formula: equity shareholders fund, exclusive equity shareholders fund. So you should not include preference share capital here. The formula is equity share capital plus reserves and surplus. That's it. Equity share capital plus reserves and surplus only. And you can write the formula from asset side also: fixed assets plus current assets minus current liabilities minus long term debt minus preference share capital. That gives me equity shareholders fund. So these are the formulas you must remember while defining all the capital structure ratios. Now let me define one by one. The first ratio is debt equity ratio. So what is the formula for debt equity ratio? We have two formulas here. The first formula is long term debt by equity, LTD by equity. So long term debt by equity, this is the first formula. That means I am taking only long term debt. Say for example, if my long term debt is 200 crores and my equity is 100 crores, the ratio is 2:1, which is an ideal one actually. For every 1 rupee of bonus fund, I am maintaining 2 rupees of loan fund. Okay, this is what the debt equity ratio. So out of total fund, 2/3 is long term debt, 1/3 is equity. So this is what the ratio. So whenever we see the ratio between long term debt and equity, nothing but debt equity ratio, I can split my capital employed into long term debt and equity in this ratio 2:1. 2/3 is long term debt, 1/3 is equity. Like that, based on the ratio, I can define the amount of long term debt and equity. Okay, so the ideal ratio which is widely accepted by every company is 2:1. Generally, the debt equity ratio should not be more. That means I should not maintain excess debt and I should not maintain 10:1 or 15:1 ratios. So your debt equity ratio should be in an optimum manner. It should not exceed 2:1. That is a maximum acceptable debt equity ratio. Okay, I can also define this debt equity ratio like this: total debt divided by equity. So what is this total debt? See my dear students, total debt in this context means total debt is equal to long term debt plus current liabilities. So I am taking current liabilities also into consideration. Okay, I am taking current liabilities into consideration along with long term debt. So this is another formula for debt equity ratio. You should also remember this formula. So what are the two formulas? Debt equity ratio, the most famous formula is long term debt by equity, and the second formula is total debt by equity. Total debt means which includes current liabilities. Okay, now the next ratio, better go for the formulas which are given in your study material. Follow the order. Yes, the next ratio is capital gearing ratio. So what is the formula for capital gearing ratio? The formula is common stockholders equity divided by fixed cost bearing funds. So what is this common stockholders fund? Capital gearing ratio is equal to equity shareholders fund, nothing but common stockholders fund divided by long term debt plus preference share capital. You better remember this formula. This is more than enough. So equity shareholders fund divided by long term debt plus preference share capital is a formula for capital gearing ratio. Say for example, if your equity shareholders fund is 200 crores and long term debt is 100 crores, preference share capital is 100 crores. The ratio is 1:1, which means for every 1 rupee of fixed cost bearing funds, nothing but long term debt and preference share capital, the company is maintaining 1 rupees of owners fund, nothing but equity shareholders fund. Okay, this is regarding capital gearing ratio. What is the formula for capital gearing ratio? Equity shareholders fund divided by long term debt plus preference share capital. So what is equity shareholders fund? Equity share capital plus reserves and surplus. Okay, and also I must define one more ratio. Out of my total assets, say for example, if I am maintaining 1000 crores worth of total assets, I have equity for financing and also I am maintaining long term debt and current liabilities. Say for example, if equity is 400 crores and long term debt is 400 crores, current liabilities is 200 crores, 1000 crores is my total fund. Say out of 1000 crores, 400 crores is taken from equity, proprietors fund. Equity is nothing but proprietors fund. So from this I can define one ratio called proprietary ratio. Proprietary ratio. So what is this proprietary ratio? Simple. Proprietors fund divided by total assets. My proprietors fund is 400 crores. So what is this proprietors fund? Proprietors fund is nothing but equity. This is also known as equity. So I am maintaining 400 crores worth of proprietors fund divided by 1000 crores. So 40% it is, which means 40% of total assets are financed out of proprietors fund or equity fund. Okay, 40% of total assets are financed out of proprietors fund. What about balance 60%, which is financed out of liabilities? Just financed out of liabilities. So what is this liabilities? Outside liabilities, which we call it as simply as liabilities. Okay, I can say this is total liabilities. I'm not including equity here. Okay, so my next ratio is total liabilities to total assets. So what is this total liabilities? Total liabilities to total assets means I will get one. No, here total liabilities means which is excluding equity. Okay, total liabilities to total assets. The formula is total liabilities divided by, within brackets, excluding equity divided by, I can say total outside liabilities divided by total assets. This is one more ratio I can define. From the above numbers I can say total liabilities are 600 crores. So what is this total liabilities? Total liabilities means total debt, nothing but long term debt plus current liabilities. Here total liabilities means long term debt plus current liabilities, all long term loans along with debentures and all, and also I must consider current liabilities, and that gives me total liabilities. 600 crores divided by total assets 1000 crores, it is 60%, which means 60% of total assets are financed out of total liabilities or total debt. Okay, which includes long term debt and current liabilities. That's it. So here is the formula set. We understood total liabilities to total assets ratio, and also we understood capital gearing ratio, proprietary ratio. So all the solvency ratios were covered here. Okay, now we can go for activity ratios. That's our next set of ratios. Activity ratios or turnover ratios. Okay, The next set of ratios are activity ratios or turnover ratios. See, all these ratios are sales based ratios. Let me define. The first ratio is capital turnover ratio. Formula is net sales. Net sales means sales minus sales returns divided by capital employed. You know that capital employed means debt and equity. Capital employed means debt plus equity, long term debt plus equity. Okay, this is my capital turnover ratio. For example, my sales of 5,000 crores and my capital employed is 1,000 crores. This is 5 times. It should be expressed in terms of times. There is no unit for this, which means for every 1 rupee of capital that I am using in the business, I am generating 5 rupees of sales. That's what capital turnover ratio. Okay. Now, let me define another ratio, fixed assets turnover ratio. Fixed assets turnover ratio. The formula for fixed assets turnover ratio is sales divided by nothing but net sales divided by net fixed assets. Net fixed assets means fixed assets minus depreciation. So, for example, my net fixed assets are 3,000 crores and my sales is 5,000 crores and my net fixed assets are 2,000 crores, which means 2.5 times, if I am not wrong. That means for every 1 rupee of money that I have invested in net fixed assets, I am generating 2.5 rupees of what? Sales. This particular ratio indicates how efficiently and effectively I am utilizing the organizational resources called fixed assets. If I can utilize fixed assets properly, I can generate more sales. So, the higher ratio indicates better profitability of the company. Okay, because more sales generates more profit. And also we have another ratio called total assets turnover ratio. The same interpretation is applicable here also. Total assets turnover ratio means sales divided by total assets. Sales divided by total assets. That's it. So here also the same interpretation is applicable. For every 1 rupee of money that I have invested in total assets, how much sales I am generating here. Okay, that's what total assets turnover ratio is indicating. So capital turnover ratio, net sales by capital employed. Fixed assets turnover ratio, net sales by net fixed assets. Total assets turnover ratio, net sales by net total assets. That's it. Okay. Yes. Now, I can also define one more ratio called working capital turnover ratio. What is the formula for working capital turnover ratio? The same logic. Sales divided by working capital. Okay, sales divided by working capital. This particular ratio should be maintained at optimum level actually. You should not maintain higher working capital turnover ratio or lower working capital turnover ratio. The working capital turnover ratio must be at an optimum level, just like how we are maintaining working capital level. You should not maintain excess working capital or lower working capital. You should maintain optimum working capital. This particular ratio and working capital management are interrelated. Okay. Now, I'm going for the next area called current assets and current liabilities based turnover ratios. The first one is stock turnover ratio. This is also known as inventory turnover ratio. Stock turnover ratio or inventory turnover ratio. The formula is cost of goods sold divided by average stock. Cost of goods sold divided by average stock. Average stock of finished goods. Remember that. So, for example, if my cost of goods sold is 5,000 crores and I am maintaining average stock of 500 crores. So, 5,000 by 500, it will be 10 times. So I am rotating my average stock for 10 times. I am selling it and I am producing it. Again I am selling it, I am producing it, like that. My stock is rotated for 10 times on an average based on the availability of average stock of 500 crores. This is what stock turnover ratio or inventory turnover ratio. I can define stock velocity or inventory velocity by using stock turnover ratio. Stock velocity or inventory velocity is equal to 365 days or 12 months or 52 weeks, depends, because I can calculate the velocity in terms of days or in terms of months or in terms of weeks. Based on the situation, you must apply the formula divided by stock turnover ratio. Stock turnover ratio. This is what the formula for stock velocity or inventory velocity. Now we understood stock turnover ratio and inventory velocity or stock velocity. Now I am moving to the next area called debtors turnover ratio. Debtors turnover ratio. The formula is credit sales divided by average debtors. And I can also rewritten this formula as credit sales divided by average accounts receivables. This is the formula for debtors turnover ratio. Credit sales by average debtors. Nothing but how many times I am rotating my debtors. Selling, collection. It is happening for certain number of times, and that is what debtors turnover ratio. From that I can define one more term called debtors velocity. The formula for debtors velocity is 365 days or 12 months or 52 weeks divided by debtors turnover ratio, DTR. Debtors turnover ratio. See, the previous stock velocity and debtors velocity are representing how speed you are moving the stock out of the godown while selling. Within how many days you are selling your stock. That's what stock velocity. It will be expressed in number of days. Say for example, if I get 30 days stock velocity, that means within 30 days I am removing the stock from my godown in the form of sales. Okay. Whereas debtors velocity means how speed you are collecting your receivables. Say for example, if my debtors velocity is 60 days, that means I am collecting my entire receivables within 60 days. Again I will sell it, and again my debtors will be generated, and again such debtors will take another 60 days. These debtors will be rotated. Okay. Such rotations are nothing but what? Turnover. Now I am moving to the next area called creditors turnover ratio. The formula for creditors turnover ratio is credit purchases divided by average creditors. Average creditors means opening creditors plus closing creditors divided by 2. Average debtors means opening debtors plus closing debtors divided by 2. Average stock means opening stock plus closing stock divided by 2. Remember that. And also I can rewritten this formula as credit purchases divided by average accounts payables. Okay. This is regarding creditors turnover ratio. How many times the creditors are rotated throughout there? Nothing but paying to, if you can pay off your creditors, again you can buy the raw material on credit basis. Like that it will be rotated. Okay. Then the next thing is creditors velocity. How speed you are paying your payables. The formula is 365 days or 12 months or 52 weeks divided by CTR, creditors turnover ratio. How speed you are paying your payables, that's what creditors velocity. Okay, with this all the turnover ratios were completed. You can see all the ratios were covered. Debtors velocity is also known as debtors collection period. Creditors velocity is also known as creditors payment period. I need to say you, debtors velocity is nothing but debtors collection period. This velocity is also known as what? Debtors collection period. And this creditors velocity is also known as creditors payment period. Creditors payment period. Okay, that's it. Yes. Now show your ratios in the study material. Every ratio is covered. turnover ratios, nothing else to cover. I can go for the next set of ratios called profitability ratios. Yes. The next set of ratios are profitability ratios. Now see this. And also we have to understand expenses ratios also. Okay. Now let me start with one by one. First one, sales related profitability ratios. Profitability means the ability of the firm to earn profits. That's what profitability ratios. How I can assess the ability of the firm to earn profits? By defining several ratios. The first one is sales related profitability ratios. Gross profit to sales ratio. The formula GPR, gross profit divided by, this is nothing but gross profit divided by net sales. Sales less returns. Okay, gross profit by net sales. See, this particular ratio's importance is how much gross profit we are, at what rate we are generating the gross profit after recovering our cost of goods sold. So say for example, if your gross profit ratio is 30%, that means 70% is representing what? Cost of goods sold. Okay. A higher gross profit ratio indicates a lower cost of goods sold or huge sales, or it is representing better selling price also. Okay. Net profit ratio, net profit by sales. You know that net profit means profit after tax. Okay. Generally net profit means profit after tax. Sometimes it can be taken as PBT also. And sometimes they can use another formula called EBIT into 1 minus tax rate. But in most of the cases I'm going to use profit after tax or profit before tax. So what is the formula for net profit ratio? Net profit by sales. So if my net profit ratio is 10%, say for example, then the form that indicates what? I'm generating 10% of sales as profit, net profit, finally after recovering cost of goods sold and other operating expenses. Then the next ratio is operating profit ratio. So what is the difference between net profit ratio and operating profit ratio? In operating profit ratio, I'm not going to take net profit. Instead of that, I'm going to take EBIT. EBIT is representing operating profit. Operating profit means I'm going to consider operating revenue sales and I'll deduct operating expenses like COGS and admin and selling and distribution expenses, or else I can say variable and fixed costs. I'm not going to deduct any losses on sale of fixed assets and investments, or I'm not going to include any profits on sale of fixed assets and investments. Other income should not be included. That means purely you have to consider sales, operating revenue. Purely you have to deduct operating expenses like cost of goods sold, administration expenses, selling and distribution expenses. No losses related to asset sale and investment sale. No profits related to asset sale and investment sale. And also no other non-operating incomes should not be included here. So my EBIT is my pure operating profit. This is regarding operating profit ratio. Generally when the firm is wanted to know about the true performance, operating performance of the company, it should calculate operating profit ratio but not net profit ratio. Net profit ratio is an overall performance by considering all the transactions. Okay. Now coming to expenses ratios. See, we have several expenses. Cost of goods sold to sales ratio, COGS by sales. Now, whenever I am writing sales, net sales must be considered. Operating expenses ratio. The formula is operating expenses by sales. My dear students, operating expenses means all the expenses in profit and loss account are not operating expenses. Only admin and selling and distribution expenses are operating expenses. Okay, so that's why we have taken what? Administration expenses plus selling expenses divided by net sales. This is my operating expenses ratio. So what is the formula for operating expenses ratio? Look at point E, operating expenses by net sales. And if you can elaborate that term operating expenses, I must consider administration expenses and selling expenses. They have given two formulas. One formula is enough. B and C are interrelated. Nothing but operating expenses are administration and selling expenses in P&L account. You should not consider any other expense. Administration expenses ratio, administration expenses by net sales. Selling expenses ratio, selling expenses by net sales. That's it. Now, return on investment. Now I am moving to the profitability ratios. Return on investment. We have several formulas related to return on assets and return on net assets, return on capital employed, return on invested capital, return on equity. These are the ratios we have to understand. Now one by one, let me start. Return on assets. So what is the formula for return on assets? Return on assets means EBIT into 1 minus tax rate divided by total assets. This is EBIT into 1 minus tax rate. That means the profit after deducting tax. Operating profit after deducting tax divided by total assets. This is post-tax return on assets. If you want to calculate pre-tax return on assets, don't deduct tax, remove it. That means you have to consider EBIT only. EBIT by total assets. So return on assets means after tax return on assets and before tax return on assets. Post-tax return on assets, pre-tax return on assets. Post-tax return on assets means EBIT into 1 minus tax rate divided by total assets. Pre-tax return on assets means EBIT divided by total assets. Don't deduct tax. Okay. So this particular ratio indicates the rate, the profit percentage on your total assets before tax as well as after tax. Now return on net assets. Return on net assets is nothing but instead of taking total assets, I can also take net assets. So the same terms, pre-tax, post-tax, EBIT into 1 minus tax rate, EBIT only. So what is the difference? We have a difference here. Here net assets means total assets minus current liabilities. Previously total assets means fixed assets plus current assets, all the total assets. You should not deduct current liabilities. If you deduct current liabilities, then such assets are known as net assets. Then the formula will be changed. Return on net assets means EBIT into 1 minus tax rate by total net assets. EBIT by total net assets. Instead of taking total assets, you better write total net assets, so that you can differentiate the previous formula and this formula. Okay. Yes, this is regarding return on assets. Now I can move to the next area called return on capital employed. So what is this return on capital employed? On your capital employed, how much return you can earn, how much profit you can earn. My dear students, return means profit. Remember that. Okay, return means profit. Which profit you are taking is a matter here. Capital employed. I said capital employed means debt plus equity. Here debt includes long-term debt plus current liabilities. That's what they said actually. So look at the point here. Capital employed is the sum of debt, which includes long-term debt and short-term debt, nothing but current liabilities, and equity. So if you take long-term debt and short-term debt, nothing but current liabilities, along with equity, this particular term is capital employed. See, this is capital employed. Whereas I have given you one formula. In that formula, I have not included what current liabilities, but they are taking here this debt plus equity capital employed, including what current liabilities, nothing but short-term debt. So post-tax return on capital employed, for calculating post-tax return on capital employed, I must consider EBIT into 1 minus tax rate divided by capital employed means which includes current liabilities also, nothing but what total debt plus equity. If you can calculate post-tax return on capital employed, the formula is very simple. Pre-tax return on capital employed, the formula is very simple. EBIT by debt plus equity. That's it. Okay. So my dear students, after tax or post-tax return on capital employed means EBIT into 1 minus tax rate by debt plus equity. Debt includes long-term debt and current liabilities. If you want to calculate after tax return on capital employed, before tax return on capital employed, don't deduct tax from EBIT. So the term will be EBIT divided by capital employed means debt plus equity. Debt includes long-term debt and current liabilities. That's it. Now return on invested capital. This is a new formula, but nowhere we are going to use this formula, but still there is a chance for the new question in the examination. Return on invested capital. They're taking invested capital in a different way. Invested capital means capital employed, whatever the number we have calculated earlier, equity plus debt. Debt means long-term debt plus current liabilities. Capital employed is a number which is calculated by using what? Debt plus equity. From that you have to deduct cash and cash equivalents and goodwill. So please deduct cash and cash equivalents and goodwill from it. Then you will get what? Invested capital. So what is this invested capital? Invested capital means the money which is truly invested in assets like land and buildings, plant and machinery, furniture and fixtures, stock, debtors. Whatever the money which you are maintaining in the form of cash and in the form of goodwill, and those two numbers are not invested capital. Invested capital means what? The tangible fixed assets and then the tangible current assets apart from cash and bank balances. Okay. So this is regarding invested capital. So you must deduct long-term debt plus equity. From that you have to deduct what? Goodwill and cash equivalents. So on such invested capital, if you calculate return on capital employed, return on invested capital, the formula is very simple. Post-tax return, EBIT into 1 minus tax rate by debt plus equity. Pre-tax return, before tax return, EBIT by debt plus equity. But while taking this debt plus equity, I must deduct what? Cash and cash equivalents and goodwill. Okay, this is a separate formula actually. Now the next one is return on equity, owner's equity. So return on equity means what? Their profit after tax. Whose profit? Shareholders' profit divided by their investment, equity. So their investment, the profit divided by their investment, that gives you what? Return on equity. Say for example, if equity is 100 crores and their return is, I mean nothing but profit after tax is 25 crores. The percentage will be 25%. Okay. I want to tell you one important point. This return on equity can be calculated in two ways. One from total shareholders perspective, other from equity shareholders point of view only. Say for example, return on equity from equity shareholders point of view only. If you take this number, then I must write this formula: profit after tax minus preference dividend divided by equity shareholders fund. This formula is calculated exclusively from equity shareholders point of view. This is ROE. I can also calculate return on equity from total shareholders point of view. That means shareholders means both equity and preference shareholders. In that case, I don't deduct preference dividend from profit after tax. Then I'll take profit after tax divided by equity. Here equity includes what? Equity share capital plus reserves and surplus plus preference share capital. Okay. Already I've given you this formula. This is the formula actually. Okay. That's it. This is regarding return on equity from shareholders point of view. Yes. All the turnover ratios, return based, I mean the profitability ratios were completed, but we have valuation and payout ratios. That's what we need to understand. I'll show you. Yes. The first one is price earning ratio. It is the ratio of market price per equity shares to earnings per share. Say for example, if my market price per share is 100 and earnings per share is 10, this is 10 times. There is no unit for PE ratio. It is a multiplier. That means for your earnings per share, the price is 10 times. The market price per equity share is 10 times of earnings per share. That's what PE ratio. So so the term itself is saying the formula price earning ratio, price to earning ratio. Price means market price per share, earnings means earnings per share. So price earning ratio is market price per share divided by earnings per share. Then the next ratio is market value to book value per share ratio. Nothing but market value per share divided by book value per share. The question is, what is market value per share? Whatever the value per share which is traded in Indian stock markets, that is what market value per share. What about book value per share? Book value per share means equity share capital plus reserves and surplus divided by number of equity shares. That gives you what? Number of equity shares. That gives you book value per share. So what is the formula for book value per share? Equity share capital plus reserves and surplus divided by number of equity shares. That gives you book value per share. So say for example, the share price, the market value per share is 100 rupees, whereas the book value per share is 25 rupees. It is 25 rupees. So as per books, the share price is representing 25. Equity share capital plus reserves and surplus divided by number of equity shares, whereas the share price which is traded in Indian stock markets is 100 rupees. So it is 4 times. 4 times means for 25 rupees book value per share, the trading price is 100 rupees. That means your market is responding 4 times of your book value of equity. Okay, that's what market value to book value ratio. So market value to book value share ratio means market value per share, market price per share divided by book value per share, which share? Equity share. The next one is Tobin's ratio, Q ratio. Tobin's Q ratio means market value of all assets divided by replacement cost of the assets. That's what the formula. Take the market value of all of your assets, nothing but your business value, value of the business, divided by estimated replacement cost of the assets. If you can replace all of such assets immediately, how much cost you need to incur? That's what replacement cost of the assets. Say for example, my market value of the assets is 5,000 crores. Divided by estimated replacement cost of the assets is also 5,000 crores. The ratio is 1. 1 is an ideal ratio. If it is more than 1, the value of the assets are overvalued. If it is less than 1, the market value of the assets are undervalued. Generally, your Q ratio should be equal to 1. If Q ratio is more than 1, which means what? The market value of the assets are more than replacement cost of the assets, that represents overvaluation of the assets. If market value of the assets are less than replacement cost of the assets, then the ratio will be less than 1. That indicates what? Your market value of the assets are less than replacement cost of the assets. That indicates undervaluation of the assets. Okay, this is regarding Tobin's Q ratio. And the next one is dividend payout ratio. So out of your earnings, how much percentage of profit you are distributing in the form of dividend? Say for example, my earnings per share is 10 rupees. Whereas the dividend that I am distributing is 4 rupees. That means 40% of dividend I am distributing here. That's what the payout ratio or dividend payout ratio. The formula is dividend per share divided by earnings per share. In simple terms, the formula is DPS by EPS. This particular ratio indicates the percentage of earnings that you are distributing in the form of dividend. So here 40% of dividend is distributed in the form of dividend. If you are distributing 40% of earnings in the form of dividend, then balance 60% is representing retention ratio. Retention ratio. So what is the formula for retention ratio? 1 minus DP ratio, nothing but dividend payout ratio. 1 minus dividend payout ratio is 0.40, or this can be written as 0.60 or 60%. That's it. Okay. Yes, we understood. Now the next one is dividend yield ratio. Dividend yield means the percentage of dividend that I am earning on my investment of shares in the company. So I cannot buy the share at book value per share. Generally, every investor can buy the share at a market value per share. So write the market value per share or market price per share in the denominator and write the dividend per share in the numerator. DPS by MPS is the dividend yield ratio. That's a percentage. Say for example, I purchased one of the company share at 100 rupees and I got a dividend of 10 rupees at the end of the first year. So I got 10% yield on my investment. That's what dividend yield. So what is the formula for dividend yield ratio? Dividend yield ratio is equal to dividend per share divided by market price per share. That's it. So with this we understood valuation and payout ratios also. We have two other ratios which we need to cover. One is debt service coverage ratio. Another one is fixed charges coverage ratio. Let me tell you, fixed charges coverage ratio is nothing but EBIT by interest. Here is the formula. Income before interest and tax means EBIT. EBIT divided by interest is the formula for fixed charges coverage ratio. EBIT divided by interest. Okay. EBIT divided by interest. Say for example, our profit is 1000 crores, whereas interest that I am paying is 200 crores. So 5 times as fixed charges coverage. So for paying interest, the company is earning 5 times of interest as a profit. Okay. Now the next one is debt service coverage ratio. This is very important actually. Debt service coverage ratio. So what is the formula for debt service coverage ratio? I'll write it here. DSCR, debt service coverage ratio, is equal to earnings available for debt service. Earnings available for debt service divided by interest plus installment. This is a formula. Installment of the loan. Okay. So what is the formula for earnings available for debt service? You must remember this formula. Earnings available for debt service is equal to, I'll give you simple logic. Actually, I'll get profit after tax, net profit as my profit. But while calculating this net profit after tax, I have deducted non-cash expenses. And also I have deducted some non-operating losses. And also I have deducted interest also. Income tax also deducted. Add those items which are not involving any cash outflow. In that case, I'll add interest. So interest involves cash outflow. Why you have added that number? I'm trying to cover interest and installment, and further I'm searching for earnings available for servicing my debt. Earnings available for debt service means what? Servicing of debt is nothing but payment of interest and payment of installment. For paying interest and installment, how much earnings are available in the company? So for that, I'm calculating the available earnings to pay interest and installment. While calculating the earnings available for interest and installment payment, you should not deduct interest. But while calculating profit after tax, already since I have already deducted interest component for calculating profit after tax, so whatever the deducted interest should be added to profit after tax in order to calculate what earnings available for debt service. So since I am covering interest here, I should not consider it before tax. After deducting interest profit, I must consider profit, or I must consider profit before deducting interest. Okay. So since we have deducted interest already, I should add back that portion of profit, that portion of interest. Okay. Profit after tax plus interest plus, and also I must add back non-cash expenses, nothing but depreciation and amortization of amortizations, non-cash expenses. So why you are adding non-cash expenses? Because depreciation, why you are adding non-cash expenses? because depreciation and amortizations never involves any cash outflow. Such portion of fund will be available for paying what? Interest and installment. Okay. And also I must add back one more item called non-operating losses. So non-operating losses means loss on sale of fixed assets and loss on sale of investments. So loss on sale of fixed assets and loss on sale of investments, and those transactions never involves any cash outflow out of the company. So such portion of fund will be available in the company itself. So this is the formula for earnings available for debt service. What is the formula? Profit after tax plus interest plus non-cash expenses plus non-operating losses. Okay. Yes. Say for example, my earnings available for debt service is 5,000 crores. Divided by, I need to pay an interest amount of 100 crores and installment amount of 2000 crores. Then the ratio will be 5000 by 2100. It will be 2.38. Generally, debt service, if debt service coverage ratio is 2 times, which is a better ratio, more than 2 times means you are maintaining better earnings to cover your interest and installment, to serve the interest and installment payments. Okay, nothing but I can service it comfortably by paying interest and installment because my earnings available for debt service are sufficient enough. Okay, so this is a formula for debt service coverage ratio. Earnings available for debt service divided by interest plus installment. Earnings available for debt services, profit after tax plus interest plus non-cash expenses like depreciation and amortizations. Amortizations means write-off of goodwill and patents, and write-off of fictitious assets like preliminary expenses, and discount on issue of debentures written off like that. Okay, and non-operating losses means loss on sale of fixed assets and loss on sale of investments. That's it. Okay, with this we understood debt service coverage ratio. Yes, every ratio is covered here. All the ratios are covered. You can see here. But in some of the textbooks relating to this capital gearing ratio, you can see the reverse ratio. That means fixed cost bearing funds divided by common shareholders equity. But in the CMS study material, they have given capital gearing ratio in a different way. Okay. There are no standards for defining these ratios actually. You can define your own ratio based on your interpretations. That's why this is a limitation of ratio analysis. Some companies may define their own ratios in their own way. I may define my own ratios in my own way. I cannot compare my ratio with other companies' ratios. Generally, our company's ratios will be compared with industry's average to know the company's performance. But while comparing these ratios, the other ratios may not be compatible with our ratios because I have defined in my own way. The other companies may define their ratios in a different way. So in that case, comparison is a difficult task here. Okay. So generally, this ratio analysis is useful for trend analysis also. That means for comparing my ratios with the previous year's performance of my company. And also I can compare my ratios with other companies for trend analysis, and for comparison purpose with the industry. This ratio analysis is very much useful, but there is a limitation for non-standardized form. That means there are no specific standards for defining these ratios. Okay. That's regarding all the ratios. You better revise all the ratios before going for the problems, because remembering these formulas are very important for solving the problems. But in the problems, you may face one situation. That means you may find a few formulas which were not given in the study material, but still you are supposed to solve that sum. That means they'll give you few ratios in the problem based on their requirement. That means for solving the sum, conveniently they'll change the formulas. Accordingly, you must write the ratios. You should not question the ratios which are given in the problem. You have to follow those formulas accordingly without comparing such formulas with your known formulas which were given in your study material. So the problem is because there is no standard for defining the ratios. So that means you may find new ratios in the examination problems also. That means you don't need to define the ratio. They'll give you the ratio. You should not question it. Just solve it. Okay. This is regarding ratio analysis, financial ratio analysis. Actually, the chapter name itself is financial ratio analysis. Okay. So, okay, fine, my dear students. In the next session, I'm going to solve few problems related to all these ratios. Okay, you better try to read the content and the study material, the theory content also, for better understanding. Why? Because the interpretations are very important in this chapter. We have another chapter related to this ratio analysis. In that chapter, we are going to understand the trend of the company for several years, and also we'll compare our company's performance with other companies. So, and also we have other formulas in this chapter, and I'll cover those formulas at in the end of the chapter. Nothing but after solving few problems. Okay, right. Okay, dear students, bye. Thank you. Hi, dear students. Good evening, all of you. Yes, in today's session, let us handle few problems related to ratio analysis. Illustration number 8. Look at the problem. The capital of A Limited is as follows. 10% preference shares of 10 rupees each 3 lakhs. Equity shares of 10 rupees each 8 lakhs. So number of equity shares are 80,000. Additional information, profit after tax at 35%, 2,70,000. Depreciation is 60,000. Equity dividend paid is 20% on equity share capital. So your equity dividend paid is 20% on equity share capital. Equity share capital is 8 lakhs. 8 lakhs into 20%, that is 1,60,000 equity dividend. Market price per equity share is 50 rupees. You are required to compute the following, showing the necessary workings: dividend yield on the equity shares, cover for the preference and equity dividend, earnings per share, and price earning ratio. These are the requirements. Now look at the first requirement. The requirement is dividend yield. The formula for dividend yield on the equity share is DPS by MPS. Already the market price per share is available here. I just need to calculate dividend per share. So dividend per share is equal to dividend paid. Actually, how much dividend we paid? 1,60,000 divided by number of equity shares. It is simply 80,000 shares. So 1,60,000 by 80,000 shares. It is 2 rupees dividend per share. So 2 divided by DPS by MPS is 50. 2 by 50. That comes to 4% dividend yield. And next one is cover for the preference and equity dividend. Cover for the preference and equity dividend means preference dividend coverage ratio and equity dividend coverage ratio. Preference dividend coverage ratio formula is profit after tax by preference dividend, and equity dividend coverage ratio formula is earnings available to equity shareholders divided by equity dividend. So coming to preference dividend coverage ratio, profit after tax divided by preference dividend. You know, the preference share capital is 3 lakhs. On that, preference dividend rate is 10%. 30,000 is preference dividend. Profit after tax is simply, it is 2,70,000. So 2,70,000 divided by 30,000 preference dividend. It is simply 9 times preference dividend coverage ratio. Coming to equity dividend coverage ratio. The formula is very simple. Profit after tax minus preference dividend. Nothing but earnings available to equity shareholders divided by dividend for equity shareholders at current rate of 2 rupees per share. Actually, look at the dividend per share. Yes, already we have calculated dividend per share as 2 rupees. And 2 rupees into how many number of shares? 80,000 number of shares. 80,000 into 2, it is 1,60,000. And we have calculated equity dividend also. You can take 1,60,000 directly by applying dividend rate of 20% on equity share capital. So this is my equity dividend. So out of 2,70,000, already we paid 30,000 preference dividend. So the balance is 2,40,000. That is the earnings which belongs to equity shareholders divided by equity dividend as simply 1,60,000, and that comes to 1.5 times. Okay. So 240,000 divided by 160,000 is 1.5 times. Exactly 1.5 times it is actually 2,40,000 divided by 1,60,000, and that comes to 1.5 times. Yes. With this, dividend coverage ratios are completed. And coming to the next ratio, earnings per share. It is very simple. Earnings available to equity shareholders divided by number of equity shares. Yes, 2,40,000 is my earnings of equity shareholders divided by number of equity shares 80,000. So 240,000 divided by 80,000, that comes to 3 rupees per share. This is EPS. And P ratio, price earning ratio, market price per share divided by earnings per share. That is a formula. MPS by EPS. My MPS is 50, EPS is 3 rupees. So 50 by 3, it is 16.67 times. Calculate it. 16.67 times. But this problem number 8 is completed. Nothing new here. Now go for the illustration number 9. I'm solving this problem just for the sake of understanding only. We are handling these two problems. So you have to solve as many problems as possible. Okay. The following are the ratios relating to the activities of X Limited. Debtors velocity is 3 months. Stock velocity is 8 months. Creditors velocity is 2 months. Gross profit ratio is 25%. Gross profit for the year ended 31st December 2021 amounts to 4 lakhs. Closing stock of the year is 10,000 above the opening stock. Bills receivables amounts to 25,000. Bills payable is 10,000. Find out sales, closing stock and sundry creditors. These are the requirements. First of all, let me tell you one important point. debtors velocity. First of all, what is this debtors velocity? 3 months actually. The formula for debtors velocity is, yes, debtors velocity. Actually, we know the gross profit amount of 4 lakhs and we know the gross profit ratio. From that, you can calculate sales first of all. GP by sales is equal to GP by sales is equal to 25%, and out of that I know the number GP, then sales is equal to what? GP by 25%. The GP gross profit is 4 lakhs divided by 25%, and I'll get 4 lakhs divided by 25%, that is 16 lakhs. So I got sales value first of all. Comfortably we got sales value here, and determination of sundry data. The next thing is I have to calculate closing stock and sundry creditors. Actually, before going for that, let me calculate sundry debtors. So for calculating sundry debtors, first I need to use this debtors velocity 3 months. Debtors velocity 3 months means it is nothing but the formula for debtors velocity is 12 months divided by DTR, debtors turnover ratio. So DTR is equal to debtors turnover ratio is equal to 12 months divided by 3 months, and I got 4 times. So my debtors turnover ratio is 4 times. Now look at this, debtors turnover ratio is 4 times. The formula for debtors turnover ratio, credit sales by average debtors or average accounts receivables. Since we don't have any opening and closing balances here, I can use closing debtors and closing bills receivables. So we have already we got the credit sales actually, that is 16 lakhs. The entire sales I'm assuming as credit sales. So credit sales divided by, I have to write accounts receivables. Accounts receivables means debtors plus bills receivables. Already we know the number, bills receivables 25,000. So the balance must be closing debtors. So that's why they've written the formula like this. Debtors turnover ratio is equal to credit sales divided by closing debtors plus bills receivables. Both of these terms are simply known as accounts receivables. So the common term is accounts receivables, which includes debtors and bills receivables. And out of that, I know the number bills receivables. So credit sales divided by, that debtors turnover ratio is 4 times. 16 lakhs divided by 4 times. That comes to 4 lakhs. Out from the 4 lakhs, I have to deduct bills receivables. So if you deduct bills receivable of 25,000, the balance is 3,75,000, and that is my closing debtors. Yes, that's it. The similar way you can calculate creditors also, sundry creditors. So for calculating sundry creditors, I must use creditors velocity. So what is the formula for creditors velocity? Creditors velocity is equal to creditors velocity is equal to creditors velocity is equal to 12 months divided by CTR, creditors turnover ratio. And we got, actually we have creditors velocity of 2 months here. So from that you can calculate creditors turnover ratio is equal to 12 months by 2 months, and that comes to 6 times. That's it. The formula for creditors turnover ratio. So what is the formula for creditors turnover ratio? Simple. Credit purchases divided by average creditors or average accounts receivables, average accounts payables. So the original formula is credit purchases divided by accounts payables or average accounts payables. Accounts payables is a broad term which covers creditors and bills payable. Yes, I need to calculate credit purchases first of all. How I can calculate credit purchases? Look at the numbers here. We have sales and gross profit here. If you adjust gross profit from sales, then the balance will be cost of goods sold. From the cost of goods sold, if you can adjust closing stock and opening stock, you can get purchases. Why? Because the formula for COGS is opening stock plus purchases minus closing stock. So from this, purchases is equal to COGS plus closing stock, COGS plus closing stock minus opening stock. So we know the number cost of goods sold actually here. Sales minus GP. Sales is 16 lakhs. Out of that, 25% is cost of goods. Sorry, GP. So 75% is cost of goods or 12 lakhs. 12 lakhs plus closing stock minus opening stock. Closing stock minus opening stock differences. Closing stock of the year is 10,000 above the opening stock. That means closing stock minus opening stock is 10,000. So 12 lakhs plus 10,000. I got 12 lakh 10,000. That's what my credit purchases. Okay. So your credit purchases is simply 12 lakh 10,000 actually. COGS plus closing stock minus opening stock. See here they have taken 12 lakhs. The 12 lakhs is COGS actually. Any information regarding creditors turnover ratio? See, this is the wrong number actually. You're supposed to take 12 lakh 10,000, but they have taken 12 lakhs. See here, they have calculated purchases, credit purchases of 12 lakh 10,000, but they have substituted 12 lakhs in the formula. So this is a wrong computation. The formula is 12 lakh 10,000 divided by creditors plus bills payable, that is 10,000. Yeah, already we have bills payable here. The problem, the bills payable is 10,000. So that is equal to 6 times. Yes, creditors turnover ratio 6 times. Already we have calculated that. So from this, creditors plus 10,000 is equal to 12 lakh 10,000 divided by 6. That is 2 lakh 1,667. So deduct 10,000 from it. I'll get 1,91,667. Yeah, their answer is right, but the substituted number is wrong actually. 191,667. This is 12 lakh 10,000. I think that's a printing mistake. 12 lakh 10,000. Okay, that's it. So in the similar way, what we have calculated debtors and now we have calculated creditors. And what about the next thing? I need to calculate closing stock. How to calculate closing stock? Simple. You know the stock turnover ratio here. They have given stock velocity. What is the formula for stock velocity? It is 8 months actually. Stock velocity is equal to 12 months divided by stock turnover ratio. And that is 8 months. Okay. 12 months divided by stock turnover ratio is stock velocity. So from this, stock turnover ratio is equal to 12 months divided by 8 months, and that comes to 12 by 8, that is 1.5. So your stock turnover ratio is 1.5 times. Since your stock turnover ratio is 1.5 times, from that you can calculate cost average stock. Stock turnover ratio is equal to cost of goods sold by average stock. You know the formula. Sales minus GP is cost of goods sold. I got 12 lakhs divided by average stock. I don't know the amount of average stock, but I know the stock turnover ratio of 1.5 times. So stock turnover ratio 12 lakhs divided by 1.5 times, and I got 8 lakh rupees average stock. So what is this average stock? Opening stock plus closing stock divided by 2. So opening stock plus closing stock divided by 2 is equal to 8 lakhs. Opening stock plus closing stock is equal to 16 lakhs. This is one of the equation. Already we know that closing stock minus opening stock is 10,000. That is one of the equation. So by solving these two equations, I can get closing and opening stock. So 1 plus 3, otherwise subtracting 1 from 3. By subtracting 1 from 3, closing stock gets cancelled. I'll get what? 2 opening stock. That is equal to 16 lakh minus 10,000. I got 15 lakh 90,000. Opening stock is 7 lakh 95,000. If you can substitute that number in the above equation, you'll get closing stock also 8 lakh 5,000. That's it. So successfully we got closing stock also. Like this, you have to solve as many problems as possible in ratio analysis. See, you should try to identify the breaking ratio. Generally, it starts with a number. So if you, whenever you want to solve any problem related to ratio analysis, you should start with the ratios along with one number. Without having a number, by solving two equations, or by solving two ratios, you cannot get any answer. So always try to identify the numbers in the problem, then relate such number with one of the ratio. then try to define an equation or try to solve that ratio, so that you can get other numbers also, like current assets, current liabilities. If you know the current ratio, link that number with what? Net working capital, current assets minus current liabilities. If you know the gross profit ratio, link that number with what? Gross profit amount. Okay, otherwise cost of goods sold amount, like that. The amount that those are given in the problem should be compared with one of the related ratios, so that you can break as many ratios as possible, and you can prepare financial statements also. Okay. Yes. Now I'm moving to the next area called funds flow statement. Actually, we have two other areas in this particular chapter. I'll explain that portion at the end of the chapter. At the end of the chapter, funds flow statement or cash flow statement. So with this, we understood one of the part in tools for financial analysis, that is ratio analysis only. We need to analyze two other areas. I'll explain those parts later. Okay. Now the next chapter, funds flow statement. Yes. What is this funds flow statement? First of all, fund means working capital. Flow means changes. So this is simply a statement which shows the changes in working capital. Change means either increase or decrease. Either increase or decrease. So this is a statement which shows the changes in nothing but what? Increase or decrease in working capital in one accounting year. In one accounting year. So we have to identify this change in one accounting year or one financial year. So funds flow statement means the statement which shows the changes in the flow of fund or changes in the flow of what? Working capital. So change means either increase or decrease in the working capital from one accounting date to another accounting date, from one balance sheet date to another balance sheet date. So we should identify those transactions which are the reason for changes in working capital and present such transactions in this particular statement called funds flow statement. So there ends the matter. So in this particular funds flow statement, we have to understand several formats. We have to understand several formats like funds from operations, funds flow statement, funds flow statement, and finally statement showing changes in working capital. Statement showing changes in working capital. These are the three important areas which we need to understand. This particular funds from operations can also be prepared with the help of an account called profit and loss adjustment account. So with this account also we can prepare funds from operations. First, let us understand the statements, then I'll go for the account also. Okay. Yes. Let me write the statement. Before going for this, first, you please try to identify the items in your balance sheet. Under liability side, we have equity share capital, reserves and surplus, preference share capital, debentures, and LTL, long-term loans. Okay. And in asset side, we have fixed assets and current assets. In between, we have another asset called investments. And in liability side, we have current liabilities also. That's it. Now look at the numbers. I'm going to prepare one statement called funds flow statement first of all. That's my first statement. Funds flow statement. Then I'll explain funds from operation. Funds flow statement. In a funds flow statement, you can see two items called sources and applications. Sources means those transactions which will increase working capital. Applications means those transactions which will decrease working capital. So first I'll write sources, then I can write applications. So let me identify the sources first of all. Then after that I'll write applications also. So what are the sources? Any transactions that increases working capital is a source. I said what? Any transaction that increases working capital is a source. So here look at the items on the balance sheet. Don't touch this current assets and current liabilities part. Just focus on these items and try to identify the transactions which will increase working capital, nothing but the source. Now, equity share capital. So equity share capital becomes a source if you can issue equity share capital, fresh equity share capital, because that increases cash. Preference share capital issue can increase your cash balance, that increases your current asset. That is also one of the source. So issue of equity share capital, issue of preference share capital, issue of debentures, long-term loans, further loans can increase your cash balance, that increases your working capital. And also sale of fixed assets and sale of investments. Sale of fixed assets and sale of investments, that will also increase your cash balance, current asset, that increases your working capital. First of all, source means any transaction that increases my current asset is a source, or any transaction that increases my working capital is a source. So you should identify those transactions which will increase your working capital, that becomes your source. I said working capital but not cash. So cash is also one of the component of working capital, but apart from cash, sometimes there is a chance of increasing your debtors or increasing your stock balance or like that, or there is a possibility for reduction current liabilities. These transactions will increase your working capital in any way. So cash need not always be one of your source. So apart from cash, the other components like debtors and stock and reduction current liabilities increases your working capital. So such transactions becomes one of your source. So I said sources. Source means any transaction that increases working capital. Okay, that increases working capital. Don't take only cash here. Okay, because I'm not preparing cash flow statement. I'm preparing what? Funds flow statement. In funds flow statement, I'm very much concerned about what? The fund. Fund means working capital. A source means increasing working capital. Okay. Now, let me write all those transactions here. Issue of equity share capital. This is my amount column. Issue of preference share capital. Issue of debentures. Long-term loans. Long-term loans, sale of fixed assets, sale of investments. These are all your sources. Apart from this, we can write other sources called two other sources. One is funds from operations, and I have to calculate these funds from operations with the help of a format. And I should write one more transaction called non-operating receipts. That means any receipt which is generated out of your operations, not from operations. Apart from operations, you may get other receipts also. Those receipts are known as non-operating receipts. Examples are interest and dividend received on investments. Example, these are just examples. Or other miscellaneous receipts also apart from operating business activities. Okay. Interest and dividend received from investments. This is one of the example for non-operating receipts. So these are the sources, my dear students. Issue of equity share capital, issue of preference share capital, issue of debentures, long-term loans, sale of fixed assets, sale of investments, funds from operations, non-operating receipts. Then after that, you please write applications by giving some space for the sources, because you need to write the balancing figure based on the situation. Based on the situation, you can write the balancing figure. Sometimes you may get balance, sometimes you may not get balance. I'll tell you why it is like that. Then I'm writing applications here, B, applications. So what is application? Application means any transactions which reduces my working capital, which decreases my working capital. So I have to write all the transactions under application side if such transactions results in decreasing of working capital or reducing of working capital. Okay. So what are the applications? Now again, look at the balance sheet items from liabilities to asset side. Now go for the equity share capital. If you buy back equity, it reduces cash, reduces working capital. If you redeem preference share capital, it reduces cash, reduces working capital. Redemption of debentures reduces working capital. Repayment of long-term loans reduces working capital. Purchase of fixed assets reduces cash and reduces working capital. Purchase of investments reduces cash and reduces working capital. So I'm writing applications now, one by one from liability side. So the first transaction is buyback of equity. Buyback of equity. Buyback of equity share capital. Redemption of preference share capital. Redemption of debentures. Repayment of term loans. Repayment of term loans. Purchase of fixed assets. Purchase of fixed assets. Purchase of investments. Purchase of investments. That's it. Purchase of investments. And you should write few other transactions, like two important transactions. One is payment of tax. Payment of tax. Income tax payment. Okay, this is income tax payment. And payment of dividend. Payment of dividend. Okay. And also you can write one more transaction called non-operating payments. Any non-operating payment, you can write it here. That's it. So these two are out of the box transactions. Payment of tax and payment of dividend. And then one more item is non-operating payments. Okay. So now look at the applications: buyback of equity share capital, redemption of preference share capital, redemption of debentures, repayment of term loans, purchase of fixed assets, purchase of investments, payment of income tax, payment of dividend. Payment of dividend means it can be final dividend or interim dividend. Non-operating payments. Okay. Yes. Now, these sources will increase the working capital and these applications will reduce the working capital. Generally, these transactions should be written for one accounting period. That means from one balance sheet date to another balance sheet date. So, write all the transactions under sources side. I mean, if such transactions occurred in one accounting period, and get the total. Say, for example, I got a total of 1,50,000 rupees under sources side. Whereas under application side, I got a total of 1,30,000. What is happening here? During one accounting year, we have received 1,50,000 amount of sources and we applied 1,30,000 rupees towards all these transactions, towards all these items. So what is the result? End result or net result? Since the sources are more than applications, we got more source, so that increases of working capital. So when sources are more than applications, it results in increase in working capital. Balancing figure comes under application side. Increase in working capital. The balance is 20,000 here. Okay, I can write into marks. Okay, this is my balancing figure. Vice versa. Sometimes the applications can be more and sources may be less. Say for example, my sources are, yes, the same number I'm taking here, 1,50,000. Same number I'm taking here, 1,50,000. But my applications are much more than sources. My applications are 1,70,000. Now look at the numbers. The applications are more than source. 1,70,000 is more than my sources. So that results in decrease in working capital. So from opening working capital, my working capital gets reduced. So what will happen when your applications are more than sources? It results in decrease in working capital. Balancing figure comes under sources side. Decrease in working capital, it's a balancing figure. It's a balancing figure. That's it. Okay. So this is regarding funds source statement, my dear students. Now I can go for funds from operations. where to start it is. Actually, you should know the transactions in profit and loss account so that you can prepare funds from operations very comfortably. I'm not touching trading account. I've started with profit and loss account. It starts with gross profit. It starts with gross profit. Write the transactions to admin expenses, to selling and distribution expenses. These two are operating expenses actually. Then write the non-cash expenses. Write the non-cash expenses. Sir, what are the examples of non-cash expenses? Depreciation and amortizations. Amortizations means amortization of intangible assets and fictitious assets like P&L account debit balance and good preliminary expenses debit balance like that. Okay. So the examples of non-cash expenses are depreciation is the first example. Then amortizations, all your amortizations like write-off of goodwill and write-off of patents and write-off of copyrights, intangible assets, and write-off of fictitious assets. Nothing but write-off of what? Preliminary expenditure debit balance, discount on issue of debentures debit balance. All these are what? Debit expenses debit balances, which comes under miscellaneous expenses not written off head. And such balances are known as fictitious assets, comes under asset side of the balance sheet. Along with that, I can write non-operating expenses and losses in your P&L account. So what are the examples of non-operating expenses and losses? Non-operating expenses best example is premium on redemption of debentures and premium on redemption of preference share capital. The best example of non-operating expenses is premium on redemption of debentures and preference share capital. Okay. What are the best examples of non-operating losses? The best examples of non-operating losses are loss on sale of fixed assets and loss on sale of investments. That is another example. There is another example for non-operating losses. So loss on sale of fixed assets is first example. Loss on sale of investments is second example. So non-operating losses. So if you are selling asset or investment, since that is not your operating activity, the main operating activity is purchasing the raw material and manufacturing the products and then I'll sell it. So say selling the finished product and generating the profit or loss as an operating profit or operating loss. Whereas by selling fixed assets investments, that's not my operating activity. That is my non-operating activity because I'm not here to sell my fixed assets and investments. So any profit or loss which is generated during the course of what? Selling fixed assets and investments, such profit or loss must be considered as non-operating profits or non-operating losses. So losses, non-operating losses, best example, loss on sale of fixed assets, loss on sale of investments. Yes. Then I can write interest, finally income tax, finally we'll get net profit, profit after tax. This is my profit after tax. Under credit side of the profit and loss account, I have to write one important transaction called non-operating incomes and gains. Non-operating incomes and gains. Sir, what are the best examples of non-operating incomes? Non-operating incomes means incomes generated from our investments which are not meant for business activities. Actually, if you have any surplus fund, you might have invested that fund in one of the company shares or debentures or one of the money market instrument. You may buy some of the investments if you have surplus fund. So from such surplus fund, if you are generating any income, and earning income is not your objective on the investments, because since you have surplus fund, you might have invested that fund in one of the investments. So whatever the income which you are earning from such investments is your non-operating income. Why? Because the objective of the company is not to earn such income. The objective of the company is to earn profits by selling products. So whatever the income that you're generating from investments is simply known as what? Non-operating incomes. Examples of non-operating incomes are interest received, dividend received on our investments as the best examples of what? Non-operating incomes. And coming to non-operating gains, just now I have explained, any gain or profit which is generated by selling fixed assets and investments is your non-operating profit. Already I have explained the logic. Okay. Now with this, we have completed P&L account. Now I'm moving to profit and loss appropriation account. See, after P&L account, every company will prepare profit and loss appropriation account. Why? Because I have to appropriate profits and I should transfer some of the profits to reserves and I should distribute some of the profits to preference and equity shareholders in the form of dividend. Then finally, I should maintain some balance. And that's what profit and loss appropriation account, right? Yes, profit and loss appropriation account. I'm writing here by net profit brought down. By net profit brought down here. 2. I have to write the transactions one by one. What are the transactions? By net profit brought down. 2. First, I should appropriate preference dividend. That's my first transaction. Second appropriation is proposed dividend. This is my second appropriation. Proposed dividend means whatever the dividend that you're appropriating for equity shareholders, that's your proposed dividend. That's the dividend of equity shareholders. This is the second appropriation. After appropriating proposed dividend, then I'll transfer some of the profits to any reserves. Few reserves are specific reserves. Few reserves are meant for what? Statutory purpose. So, general reserves. Generally, those are free reserves. And then I'll write the balance under profit and loss appropriation account. That is profit and loss account credit balance. Okay. This is the end of the story. So now from this statement, I have to prepare funds from operations. See, actually, all the transactions under P&L account credit side are representing your sources. All the debit side transactions are representing applications subject to some adjustments. So from this profit and loss account and profit and loss appropriation account only, we can prepare funds from operations. You better remember the format. That's so easy. That's better for you. But my objective is to explain the logic behind that particular format. So I'm preparing funds from operations now from this profit and loss account. See, this balance carried down is known as profit after tax and after appropriations. Yes, already we got profit after tax in P&L account. After that, we did what? All the appropriations like proposed dividend appropriation, preference dividend appropriation, proposed dividend appropriation, and we have transferred some amount of profits to reserves. Some of the reserves are free reserves, some of the reserves are specific reserves. And finally, we got this balance. This balance is simply known as what? Profit after tax and after appropriations. Yes. And from that particular term only, we have to start our funds from operations statement. PAT and appropriations. Profit after tax and after appropriations. Yes. This is my net source actually, the final source. But now what I'm going to do is, see, while arriving this profit after tax and after appropriations, I've debited, nothing but I've deducted some non-cash items and some non-operating items. Now I'm going to add back those transactions which were debited in the form of non-cash item or in the form of non-operating expenses. So why you're adding now? Why? Because those transactions never results in cash outflow or those transactions are non-operating. My objective is to calculate funds from operations. When I'm trying to calculate funds from operations, I should not deduct non-operating applications. And I should not deduct non-cash applications. Why? Because non-cash transactions means that such transactions never involves any cash outflow. Example, depreciation. Depreciation never reduces working capital, but still such transaction was debited in your P&L account. So I'm going to add back those transactions. Either those are non-cash or those are non-operating. So those transactions I'm going to add back if such transactions were debited. Now let me start with one by one. Add. So what is the first transaction? Reserves. Transferred reserves never involves any cash outflow. That's just merely an appropriation. No, that's not an application. So transfer to reserves is the first transaction. Just add it. Then after transfer to reserves, what I should do? The next transaction is proposed dividend. So why you're adding proposed dividend and preference dividend? Yes, you should add back proposed dividend and preference dividend also. Why? Because those two are non-operating transactions. Add proposed dividend and preference dividend. In most of the problems, you can never see preference dividend in the format. Why? Because the information may be not available I'll explain one problem. Then you can understand why we are ignoring preference dividend. You better add back preference dividend if that is available. Okay. So add proposed dividend and add preference dividend. Now, with this P&L appropriation account is closed. Now go ahead with profit and loss account. We have income tax here. Income tax is the non-operating expenditure. So add it back, which is known as provision for tax. In fact, the money which is debited in P&L account is provision for tax, but not payment of tax actually. There is a difference between provision for tax and payment of tax. Why? Because the provision which is created in the current year will be paid in the next year. The provision which is created in the previous year should be paid in the current year. Okay. That part I'll explain later. Provision for tax is next edition, since that's a non-operating expenditure. And then I'll go for interest. Actually, in most of the cases, I don't consider interest because payment of interest, identifying payment of interest is a difficult task. So we'll ignore interest. In case if interest calculation is certain, that should be added back. That should be added back. So, but in most of the problems, you can never see interest application. So just ignore it. Now, I'm just moving to the other items. Admin and selling and distribution expenses should not be added because those two are cash items, cash transactions, and operating expenses also. Okay. Now I can add non-cash expenses because those are non-cash. And I can add non-operating expenses and losses because those are non-operating. So non-cash and non-operating should be added back. Okay. So I'm trying to add it here now. Non-cash expenses. You know the examples of non-cash expenses: depreciation and amortization of goodwill, patents, preliminary expenses, etc. Okay. And then the next item is non-operating expenses and losses. Non-operating expenses and losses. You know the examples of non-operating expenses. Non-operating expenses are premium on redemption of debentures and premium on redemption of preference share capital. Non-operating losses examples are loss on sale of fixed assets and loss on sale of investments. With this, all additions were completed. Now we have to deduct some of the credit side items. We have only one item to deduct because that is non-operating incomes and gains. So while calculating funds from operations, if there is any addition in the form of credit in the profit and loss account, that should be excluded from funds from operations. Why? Because while calculating funds from operations, non-operating incomes and gains should not be included in FFO. So since already we got this number, profit after tax and after operations, this number is loaded with what? The credit side items and P&L account. So whatever the number which is credited, which is added, should be excluded. Okay. So what was that? Minus non-operating incomes and gains. Minus non-operating incomes and gains. You know that non-operating income, best example is interest received and dividend received on investment. Non-operating gains means gain on sale of fixed assets and gain on sale of investments. So non-operating incomes and gains should be excluded or should be deducted. So finally, I'm going to get funds from operations. This is my funds from operations. Yes. With this, we have completed funds from operations format. Now look at the format. Funds from operations. Profit after tax and after appropriations. Add transfer to reserves. Proposed dividend. Preference dividend. Provision for tax. Non-cash expenses. Non-operating expenses and losses. Add it, then deduct non-operating incomes and gains. Then we'll get funds from operations. Okay. So what is the next task? See, preparation of statement showing changes in working capital. I'll prepare the statement. I'll explain that particular statement and the problem directly. Why? Because there is no complication for preparing statement showing changes in working capital. That's a simple statement to prepare. Okay. But before going further, I need to explain two transactions very particularly. One is provision for tax. Another one is proposed dividend. Before explaining these two transactions, I want to tell you one important point. See, in funds flow statement, I'll write those transactions which are the combination of non-current and current, or current and non-current account. That means generally our account combinations are of three types: current account and current account transactions, the second one is non-current account and non-current account transactions, the third one is non-current and current, vice versa, current and non-current both are same. So your transactions are generally the combination of these three only. Okay, first combination, current and current account. So what are the current accounts and what are the non-current accounts? All long-term items are non-current accounts, and all short-term items, nothing but current assets and current liabilities, are the current accounts. Okay. So current assets, stock, debtors, cash and bank balances; current liabilities, creditors, provision for tax, proposed dividend, outstanding expenses, all these are what? Current accounts. So what are the non-current accounts? Rest of the items: fixed assets, investments, long-term investments, equity share capital, reserves and surplus, preference share capital, debentures, long-term loans, all these are what? Non-current items. So my dear students, if your transaction is a combination of current and current account, don't write such transaction in the fund source statement. If your transaction is a combination of non-current and non-current account, don't write such transaction in the fund source statement. If your transaction is a combination of non-current and current, please write such transactions in the fund source statement, either in sources or in applications. The question is, sir, please tell me the examples of current and current account combination. Simple: collection from debtors. The entry is what? Bank account debtor to debtors account. Bank account is a current account, debtors account is a current account. Don't write such transaction in the fund source statement. Payment to creditors. Creditors account debtor to bank account. Creditors account is a current account, bank account is a current account. Don't write such transaction in the fund source statement. Now look at the second combination, non-current and non-current combination. See, non-current combination means, say for example, I purchased fixed assets by issuing debentures. What is the entry? Purchase of fixed assets by issuing debentures means fixed assets account debtor to debentures account. Fixed asset is a non-current account, debenture is a non-current account. That will never have any impact on your working capital change. Again, conversion of debentures to equity share capital. Entry: debentures to equity share capital account. Simple. Debenture account is a current non-current account. Equity share capital is a non-current account. Don't write such transaction in the fund source statement. Like that, if any transaction is a combination of non-current and non-current, so you should not write such transactions in the fund source statement. So current and current account combination should be ignored while preparing fund source statement, and non-current and non-current combination should be ignored while preparing fund source statement. Only those transactions which are the combination of non-current and current account, which are going to have an impact on your working capital changes. So what are the best example? Have issued equity share capital. What is the accounting entry? Bank account debtor to equity share capital account. Bank account is a current account, equity share capital is a non-current account. What will happen? Issue of equity share capital increases current asset, increases working capital. Increases current asset, increases working capital. Cash will be increased. Issue of debentures increases cash, increases current asset, increases working capital. Long-term loans borrowed, that increases cash balance, increases current asset, increases working capital. Fixed assets sold, increases cash balance, increases working capital. Bank account debtor to fixed asset account. Like that, bank account is a current account and fixed asset account is a non-current account. So the combination of non-current and current will increase my working capital, or it may decrease my working capital also. Redemption of debentures. Debentures account debtor to bank account. Debentures is a non-current account, bank is a current account. So debentures is a non-current account, bank is a current account. That reduces my cash. Redemption of debentures reduces my cash, reduces my current asset, reduces my working capital. So like that, you can see so many transactions which are the combination of non-current and current. Such transactions either decreases our working capital or increases our working capital should be written in the statement called fund source statement. If such transaction increases your working capital, that will be your source. If such transactions decreases your working capital, that will be your application. So only you have to write the transactions which are the combination of non-current and current in the fund source statement. Yes. Now the question is, sir, that's okay. What is the accounting entry for payment of tax and payment of dividend? Payment of tax and payment of dividend are written in the fund source statement. Have you observed it? Payment of tax and payment of dividend are considered in fund source statement. What is the accounting entry for payment of tax? Payment of tax accounting entry, simple entries: provision for tax account debtor to bank account. Provision for tax is a current liability, current account. Bank account is a current account. So this transaction is a combination of current and current, but still have written the transaction in the fund source statement. Payment of dividend entry. Proposed dividend account is not a bank account. Proposed dividend account is a current account. Bank account is a current account. Again, this is a combination of current and current. Current and current combination transactions should not be written in the statement of funds flow statement. Should not be written in the statement of funds flow statement. So why you have written? Why you have written these two transactions? These two transactions are specific transactions. You should be consider these transactions separately in the funds flow statement. Why? Because I want to show these payments, and for better disclosure relating to payment of tax and payment of dividend, though these items are a combination of current and current, still you have to consider these two transactions as non-current and current combination. How that is possible, sir? I'm going to take one assumption. Even though provision for taxation and proposed dividend are current liabilities, still for the sake of better disclosure to show the payment of tax and payment of dividend in the form of funds flow statement to the users of financial statements, I'm going to take one strict assumption. Provision for taxation and proposed dividend as a non-current liabilities. So why like that? Actually, these two are current liabilities, but still for better disclosure purpose, I'm taking provision for taxation and proposed dividend as non-current liabilities. That means what is the entry? Payment of tax. Now, and based on your assumption, previously this is a current liability. Now, based on our assumption, this is non-current liability. This provision for taxation, proposed dividend, these two are non-current liabilities. So let me write the entry. Payment of tax, provision for taxation account added to bank account. Now change it. Now this time provision for tax is a non-current liability, non-current account. Bank is a current account. So this is a combination of what and what? Non-current and current combination. Now again, payment of dividend. What is the combination? Proposed dividend account added to bank account. Generally, proposed dividend is current liability, but based on our assumption, proposed dividend is a non-current liability. So non-current account added to bank account. Non-current account added to current account. So this is a combination of non-current and current. So based on our assumption, these two transactions are the combination of non-current and current. So take this assumption strictly. Provision for taxation and proposed dividend are considered as non-current liabilities, so that I can write these two transactions in the funds flow statement. That's it. So this is one more important point you should remember. Okay. Now, successfully we understood provision for taxation and proposed dividend treatment. So what is the treatment? Remember that. Prepare provision for taxation and proposed dividend accounts and add back the current year provision for taxation and the current year provision for tax and proposed dividend in funds from operations. So the current year provision which is created for tax and the current year appropriation which is created in the form of proposed dividend should be previous transaction. Provision for taxation and proposed dividend. The current period appropriation of proposed dividend and the current period created provision for tax should be added back to profit after tax and after appropriations for calculating what? Funds from operations. For calculating funds from operations. What is the next thing? Whatever the numbers which you have added, those are the provisions created and profits appropriated in the form of proposed dividend during the current financial year. So during the current financial year, you are going to pay tax and dividend. Income tax payment and income tax payment and dividend payment. Those two are the applications in the funds flow statement. So payment of tax and payment of dividend should be considered as applications in the funds flow statement. So what is the final conclusion? If you are taking provision for taxation and proposed dividend as non-current liabilities, then add back current year provision for taxation, current year appropriation of proposed dividend in funds from operations, and consider payment of tax and payment of dividend as an application in funds flow statement. That's it. So what is the second assumption? We have another assumption also. Instead of taking provision for taxation and proposed dividend as non-current liabilities, you can also take another assumption called provision for taxation and proposed dividend can be considered as current liabilities also. So what I should do then? If you consider provision for taxation and proposed dividend as current liabilities, don't add back current year provision for taxation and current year appropriated proposed dividend in funds from operations. These two transactions must be ignored here. Should not be add back. Should not add back these two transactions. And also you should not write payment of taxation, payment of dividend here, because that's a combination of current and current. So then what I should do? Don't consider those two transactions here in FFO or FFS, funds from operations or funds from statement. Right away consider those two current liabilities, provision for taxation and proposed dividend, in a statement called statement showing changes in working capital. That's a separate statement. This is purely based on assumption. I'll explain while handling the two problems. Okay. Yes. This is regarding funds from operations and funds from statement. So in the tomorrow's session, I'm going to explain the problematic part relating to funds from statement. Thank you. Yes, good evening all of you dear students. In the previous session, we understood the format of funds flow statement along with funds from operations. Now let us solve the problems related to funds flow statement from the study material. Look at illustration number 12. I'll tell you the approach to handle this problem, because there is an approach to handle this kind of problems that are like funds flow statement or cash flow statement. So I'll tell you, I'm going to handle this problem in 3 phases. Phase 1, I'm going to prepare working notes by taking assets and liabilities along with adjustments. And in phase 2, I'm going to prepare funds from operations and funds flow statement. Then finally, the last statement is statement showing changes in working capital. Okay. Now, let me read the question. The following is a balance sheet of Gamma Limited for the year ended 31st March 2021 and 31st March 2022. We have share capital and liabilities 2021-22, 2 years balance sheets are given here. Share capital, general reserve, capital reserve. Look at the item profit on sale of investment. This capital reserve is created by selling the investment. So on sale of investment, we got some profit, and such profit was credited to capital reserve. Okay. This is regarding capital reserve account. And profit and loss account credit balance, 15% debentures, accrued expenses, creditors, provision for dividend, provision for taxation. Let me take the numbers here. Share capital, general reserve, capital reserve, profit and loss account credit balance, 15% debentures, accrued expenses, creditors, provision for dividend, provision for taxation. This is the situation. And coming to assets, fixed assets less accumulated depreciation, net fixed assets. We have long-term investments at cost, stock at cost, debtors, net of provision for doubtful debts of 45,000 and 56,250 respectively for 21 and 22 respectively. Bills receivable, prepaid expenses, miscellaneous expenditure. Okay. Out of these transactions, out of these assets, you can see stock to prepaid expenses. These are your current assets. Miscellaneous expenditure is a fictitious asset. Yes. And we have some adjustments A to F. I'll read every adjustment based on the requirement. Prepare a funds flow statement. Statement of changes in financial position on working capital for the year ended 31st March 2022. Okay, this is your requirement. Yes. See, there is a mistake in the problem. I'll correct it. Just look at the numbers. Up to general reserve, everything is okay. Share capital and general reserves, balances are clearly given without any problem. But from capital reserve onwards, the numbers were jumbled actually. See, this dash that is not minus actually, that is dash. That means capital reserve, profit on sale of investments, on the balance sheet date of 2021, it is nothing, nil, dash. And then for 22, we got capital reserve credit balance of 11,250. So this profit and loss account credit balance is 1,12,500. That's what this number 1,12,500 is not capital reserve credit balance. Capital reserve credit balance for 21 is nil, dash. For 22 it is 11,250. Okay. So 1,12,500 is capital reserve actually. Sorry, 1,12,500 is profit and loss account credit balance actually. Okay. This 1,12,500 is not capital reserve, that is profit and loss account credit balance. Then what about capital reserve balance? Nothing, nil, dash. So 15% debentures is 3,37,500. Accrued expenses 11,250. Creditors 1,80,000. Provision for dividend 33,750. Provision for tax 78,750. And remaining numbers are clearly given. Okay, remaining numbers are in order, no issue with that. So just like this. 112,500 is belonging to this number, and this one, this one, this one, this one, and this one. Okay, so accordingly see the numbers. No confusion, just the numbers are jumbled. I'm taking the numbers here. Now let us handle one by one. Now look at the first asset, first balance called fixed assets account. See here the fixed assets are given at cost and accumulated depreciation is given separately. And we have net fixed assets also. And there are some adjustments relating to this point A. That's it, point A only. Okay. Apart from that, no other adjustments were given. Now let me solve this. Let me solve this. I'm taking the material here. Yes. Problem number 12. See, when assets are given at cost, you should maintain fixed asset account at cost along with provision for depreciation account. So please open the fixed assets account. Fixed assets account at cost. Here is the balance. And write the balances. Opening balance to balance brought down. And closing balance by balance carried down. Yes. Now, what are the opening balances? The opening balance is 11,25,000. The closing balance is 13,50,000. Okay. And also you should open another account called provision for depreciation account, which is nothing but accumulated depreciation account. Provision for depreciation account by balance brought down. Opening balance 2,25,000. 2,25,000. And closing balance 281,250. Now let us read the sentences, the adjustments. Okay. The adjustment is saying what? During the year 2021-22, fixed assets with a net book value of 11,250, accumulated depreciation of 33,750 was already provided on it, was sold for 9,000. This is the sale transaction. Okay. This is the sale transaction. So first adjust this sale transaction, the provision for depreciation account and fixed asset account. Whenever the asset is sold, then immediately related provision for depreciation which is provided on it should be transferred. So actually we are selling one asset with a net book value of 11,250. On that already we have provided a depreciation of 33,750. So the depreciation which is included in 2,25,000, the amount of 33,750 related to sold asset must be transferred to fixed asset account first of all. The amount is 33,750. Reduce this balance. Why? Because we are selling this asset, so you don't need to maintain this balance for further years. So transfer the provision for depreciation related to sold asset to the fixed asset account. So by provision for depreciation account. Provision for depreciation account. And that balance is 33,750. So relating to sold asset, we have transferred the depreciation, the corresponding depreciation. So what to do next? So after transferring provision for depreciation, now write the sale entry. So out of 11,25,000, already we have provided 33,750 related to sold asset. So the book value of the asset is 11,250. So I think the cost of the asset will be 11,250 plus 33,750. The cost of the asset is 45,000. On that already we have provided 33,750 provision for depreciation. So this 11,25,000 is loaded with the sold asset which costs 45,000. On that already we have provided 33,750. We are reducing it. That means the adjustment, this 33,750 is adjusted against the cost of the asset. So from this 45,000, we are adjusting this 33,750. The balance is your book value, which is 11,250. And we are selling such book value of the fixed asset for how much value? 9,000. So for sale entry, it is by bank. Bank account dot to fixed asset account. In fact, the bank account dot to fixed asset account dot to, bank account dot to fixed asset account is a regular entry. When we are selling the asset on loss basis, nothing but while selling, if we are facing loss, then the entry will be bank account dot to loss on sale of fixed asset account dot to fixed asset account. In case if you are getting profit, what is the entry? Bank account dot to fixed asset account to profit on sale of fixed asset account. So here I'm selling the asset for 9,000 rupees, whereas the book value of the asset is 11,250. So 11,250 minus 9,000. So this is 9,000 sale value. The balance is loss on sale of fixed asset, and that is 2,250. But this sale transaction is closed. Instead of writing by loss on sale of fixed asset, you can also write by P&L account. Okay. So generally, when the assets are maintained at cost, you should close two accounts, fixed asset account and provision for depreciation account. While closing these two accounts, you should focus on important balances like this. In provision for depreciation account, look at the opening and closing balances and identify any transfer of provision for depreciation related to sold asset under debit side. Once it is transferred, close this account. It should be closed. In case if you get any balance, that should be the current year provision. So add this number 281,250 plus 33,750, 3,15,000. Whereas I got a credit side balance 3,15,000 minus 225,000, 90,000. So this is, it should be your current year provision for depreciation by P&L account balancing figure. This is my current year provision for depreciation. I can write by P&L account or I can write by depreciation account also. It depends. Okay. So this is your current year depreciation. But this depreciation provision for depreciation account is closed. Now look at the fixed asset account. See, you have opening balance, closing balance, and sold transaction is completed. Generally, in fixed asset account at cost, we are going to have these transactions. Along with opening and closing balances, there will be a sale entry under credit side. There will be a purchase entry under debit side. That's it. Sale and purchase. If you have any discarded asset, then that will be another transaction that comes under credit side. Okay. So, my dear students, look at this. Look at these transactions. Already the sale transaction is closed. So, I should close this account. If it is not closed, if you get any balance on the debit side, that should be a purchase. So look at the number 11,25,000. I'm just closing it. Get the total under credit side 13,50,000 plus 2,250 plus 9,000 plus 33,750. It's 13,95,000. And here also it is 13,95,000. And we got some debit side balance. Got some debit side balance. The balancing figure 13,95,000. So the balancing figure is 13,95,000 minus 11,25,000. It's 2,70,000. This is your current year purchases to bank balancing figure. So with this, fixed asset account is closed. So successfully we have closed fixed asset account and provision for depreciation account. Now go for the next account. Long-term investments account. Investments account is your next account. Yes. Write the opening balance to balance brought down. That is 2,02,500. And write the closing balance by balance carried down. And that is also 2,02,500. Now read the adjustment. See, look at point B. During the year 2021-22, investments costing 90,000 was sold and also investments costing 90,000 were purchased. For purchase, you can write the direct entry. So we purchased 90,000 worth of investments. So investments account debit to bank account 90,000. And you should write the sale transaction. But while writing the sale transaction, you should recognize the profit or loss. See, investments costing 90,000 was sold. So we have sold 90,000 cost of the investment. That doesn't mean that the sale value of the investment is 90,000. Actually, if you look at the capital reserve account under the liability side of the balance sheet, there is a capital reserve with zero opening balance, but we have a closing balance of 11,250. That's a credit balance, and within brackets they have mentioned clearly this credit balance is created out of profit on sale of investments. That means the 90,000 cost of the investments was sold with a profit of 11,250. So the sale value must be 90,000 plus 11,250. I'm just adding profit to the cost. So the sale value is 1,01,250. So you should write by bank account not the cost. You should write cost plus profit, 90,000 plus 11,250, and I got 11,250. This is 1,01,250, and you should write the profit under debit side to profit and loss account. I'm just transferring profit to profit and loss, sale of investments to profit and loss account. That is 1,250. Sorry, 11,250. 11,250. Now, same logic is applicable here also. For investments account, we have sale transaction, we have purchase transaction. Once sale and purchase are over, you can close this account called investments account. So, generally in investment account, you can never see depreciation adjustment. Why? Because investments are generally shown at cost. So, just close this account. It should be closed. 2,02,500. This is excess 0. Two lakh 2,500 plus 90,000 plus 11,250. I got 3,03,750. Here also you must get the same number. 2,02,500 plus 101,250. Same number. So with this, investments account is closed. So fixed asset account, accumulated depreciation account, long-term investments accounts are closed. Stock, debtors, bills, receivables, bills, prepaid expenses. All these are current assets. For current accounts, you don't need to prepare accounts. You don't need to prepare working notes also. And miscellaneous expenditure will be adjusted under FFO, funds from operations. We have opening balance of 16,875 and we have closing balance of 11,250. That's a fictitious asset. The debit balance was reduced. The debit balance is reduced actually here. So that reduction is clearly representing we have written some portion of miscellaneous expenditure in the profit and loss account. So this transaction is required while preparing FFO. Okay. This transaction, this item is required while preparing FFO. Remember that. And remaining stock, debtors, bills receivable, prepaid expenses comes under statement showing changes in working capital. Okay. Now with this asset side transactions were closed. Now go for the liability side. We have a share capital of 6,75,000 and a closing balance of 7,87,500. What was happened? It is clear. The share capital has been issued. So that's the source. So any adjustment, just go for the adjustments relating to share capital, because sometimes you can see the bonus issue or rights issue, and accordingly I should write those transactions in the account, and accordingly such transactions should be considered in funds flow statement, because only those transactions which are resulting in increase in working capital or decrease in working capital should be considered in funds flow statement. Sometimes you can see increase in the share capital account due to bonus issue. Bonus issue never rises additional cash balance. That never increases the cash balance. That is just the capitalization of what reserves and surplus to share capital. So you'll just convert free reserves to share capital. That's what bonus issue. So bonus issue can never increase the source. So that's not a transaction should be considered in funds flow statement. So whenever you're preparing share capital account, you must see the adjustment. See, we don't have any adjustment here. Relating to share capital. That means the difference in share capital, the increase in share capital balance is purely representing issue of equity share capital for cash or bank. Okay, that's a clear source. General reserve, capital reserve is closed. You don't need to prepare any account for that. General reserve comes under FFO. I must consider this general reserve and profit and loss account credit balance while preparing funds from operations. Generally, general reserve and profit and loss account credit balance, these two credit balances must be considered while preparing funds from operations. So we have another account called 15% debentures with an opening balance of 3,37,500 and a closing balance of 2,25,000. So the balance got reduced. That indicates that debentures were redeemed. And look at the transactions. That means adjustments. You should be very careful while adjusting these transactions. Debentures were redeemed. Retired means redeemed at a premium of 10%. So we have redeemed debentures at a premium of 10%. Now, just prepare debentures account. Yes, debentures account. This is 15% debentures account. Say I'll prepare working notes only. Then I'll show you the transactions and the funds from operations and funds flow statement directly, because these working notes are very crucial. Since it's a liability, it's a credit, it shows some credit balance. By balance brought down, I have a debentures balance of 337,500. Okay, 3,37,500 and a closing balance of 2,25,000. Just check the transactions once. See, debentures opening balance 337,500, closing balance 225,000. Yes, these debentures were retired at a premium of 10%. See the difference in debentures balance. The opening balance is 337,500. The closing balance is 225,000. Difference is 1,12,500. That's the face value of debentures which were redeemed. So, and this is made at a premium of 10%. The redemption is made at a premium of 10%. Then you should write to bank account along with premium. 1,12,500 into 1,12,500 into 110% along with premium into 110%. This will be 123,750. So that 11,250 excess money that you're paying as a premium, that should be adjusted under credit side by premium on redemption of debentures, and that is 11,250. This premium is an expenditure which is generally debited to profit and loss account unless otherwise specifically stated. Sometimes the premium can be shown under asset side of the balance sheet as an expenditure balance. That means instead of debiting this premium to P&L account, that can be shown under the asset side of the balance sheet. Okay. So unless otherwise specifically stated, I always assume that this premium should be debited to profit and loss account. Already debited to profit and loss account. Okay. Now let us close this account. It must be closed without any adjustment because we have taken the balancing figure. So 123,750 plus 225,000. This is 348,750. Here also we have to take 348,750. And take the numbers 3,500 plus 11,002. That is 348,750. With this debenture account is closed. Yes, accrued expenses creditors, both are current liabilities. Now go for the provision for dividend account. Provision for dividend account. So I'll always assume that provision for dividend, proposed dividend and provision for taxation are the current, non-current accounts. Accordingly, we must prepare accounts. We should prepare working notes for that. By balance brought down, to balance carried down. Yes. Provision for dividend. Yes. See the balances here. Look at the provision for dividend. The opening balance of provision for dividend is 33,750. Closing balance is 38,250. 33,750, 38,250. Yes. Now, so look at the adjustments related to proposed dividend or provision for dividend. Just go for the adjustments. Yes. Proposed dividend. The proposed dividend for 2021 was paid in 21-22. Nothing but I need to tell you one important point. Generally, the appropriated proposed dividend for the last year will be paid in the current year. The appropriated proposed dividend of the current year will be paid in the next year. That's why this opening balance is appropriated. This is the appropriated proposed dividend of the last year, which will be paid in the current year to bank account. 33,750. So whatever the closing balance that you're seeing on in the account, this closing balance must be appropriated in the current year P&L account. So by P&L appropriation account or simply P&L account, that is 38,250. So that your account will be closed. 38,250 plus 33,750. So 72,000 is your total balance. So what is the entry here? See, whatever the opening balance that you're seeing in the proposed dividend account, That opening balance is the appropriated profit in the last year. So that was appropriated in the last year, and that will be paid in the current year. And if you can see the closing balance in the proposed dividend, the such closing balance is the current year appropriation, which is yet to be paid, that will be paid in the next year. That's why we are seeing this balance here, because if it is paid, you can never see the balance here. Okay. So what is the conclusion? If there are no adjustments related to proposed dividend, I always assume that the opening should be paid in the current year to bank account. The opening balance should be written as to bank account, and closing should be considered as current year appropriation by P&L appropriation. So these two are related. So the opening should be to bank, the closing should be by P&L. Okay. If you have any adjustments related to payment or appropriation separately, first you should write the transaction. The balancing figure can be current year payment. The balancing figure under credit side can be current year appropriation. So if current year appropriation is given, then you should write by P&L account. Then accordingly, bank to bank will be your balancing figure. If the payment is given in the problem, then you should write to bank account. Then the balancing figure under credit side will be by P&L appropriation account. Okay. So if there is no other information, then I always assume that the opening should be paid, the closing should be appropriated. Same logic is applicable to provision for tax also. Yes, provision for tax account. By balance brought down. Provision for tax account by balance brought down 78,750. To balance carried down 85,500. Okay. See, do you have any adjustments in this regard? Yes, we have point D here. In point D, they said what tax of 61,875 was paid for 2021. So the last year tax was paid in the current year to bank account. How much tax was paid? Actually, this opening provision is representing last year. This provision is related to last year profit that should be paid in the current year. So there is a, you know that the previous year tax liability should be paid in the assessment year. The assessment year, I mean, every assessment year is the previous year for the next assessment year. So this assessment year tax liability should be paid in the next year. Actually, nothing but what the current year tax should be paid in the next year. The last year tax should be paid in the current year. But provision should be created in the previous year. Okay. So let me tell you one thing. This 78,750 is the opening balance of provision for tax account. This was created in the previous year. This is created in the previous year. The provision is created in the previous year. So we have a final tax liability of 78,750, which is supposed to be paid in the current year. But due to some adjustments, even though we have created 78,750, we have to pay only 61,875 here as per the information given in the problem. Then you should write to bank account 61,875. You are supposed to pay 78,750, but they said what? You have to pay 61,875 only, because based on the adjustment. In case if this particular adjustment is not given, then what I should do? Don't write this number. Just to bank account, the opening should be paid. The closing should be provided in the current year actually. So you have to write the opening balance as to bank, nothing but that's your current year payment. The closing balance is assumed to be provided in the current year P&L account. So you have to write by P&L account 85,500. If this number is not given, okay, this number is not given. If the number is given, then you should not write opening as paid, closing as provided. You have to take the balancing figure 61,875 plus 61,875 plus 85,500. I got 147,375. 147,375. Here also 147,375. 147,375 minus 78,750. The balancing figure is 68,625. This is my current year provision by P&L account. This is created in the current year. Okay, by P&L account 68,620. So in case if this payment is not given, what I should do? Simple. Write to bank. Nothing but the opening balance is paid. Two banks 78,750. Write by P&L. Nothing but closing balance 85,500. The same logic which we have applied to proposed dividend applicable here also. The same is applicable here also. What I should write? The opening is provided in the last year. The opening provision for tax is provided in the last year. That should be paid in the current year to bank. The closing is provided in the current year. So you should write by P&L account. So opening paid, closing provided. Opening to bank, closing by P&L. That's it. No information is given. But here we have a payment information. So you should write the payment. The closing balance will be by P&L account. Hope you got it. With this, provision for taxation, proposed dividend accounts for closed. And we have one adjustment in that is point E. During the year 21-22, bad debts of 15,750 were written off against the provision for doubtful debts account. Actually, you don't need to prepare account for this adjustment because this is related to current account. I'll take the current account balances directly in the statement called statement showing changes in working capital. Successfully, we have considered every adjustment and also we have taken every asset and every liability into consideration, non-current account and non-current account without touching what? The current accounts. Okay. Now, let us go for FFO, funds from operations. I'll straight away show you the statement of FFO, funds from operations. Generally, it starts with what? Profit after tax and after appropriations. So how to get profit after tax and after appropriations? If you can see the balance in your balance sheet, the profit and loss account opening balance is 1,12,500. The closing balance is 2,25,000. The closing balance is 2,25,000. Opening balance is 1,12,500. So the difference should be 225,000 minus 1,12,500. See, the balance which is shown under the asset side or liability side of the balance sheet, the profit and loss account credit balance which is shown under the liability side of the balance sheet is clearly representing profit after tax and after appropriation account. That's a profit after tax and after appropriation balance actually. Okay, because only after appropriations you can take that balance into balance sheet. So my dear students, this difference of 1,12,500 increase in profit and loss account credit balance is clearly representing current year profit after tax and after appropriations. That's what they've taken here. Profit after tax and after appropriation by taking the difference between profit and loss account credit balance opening and closing. I got 1,12,500. Now let us write one by one all the transactions. And you should follow our format. What is our first transaction? The format transfer to reserves. That's our first transaction. We have transferred some reserves. We have transferred some amount of profits to general reserve. Look at general reserve account. Opening balance 225,000, closing balance 281,250. 281,250 minus 225,000, and the difference is 56,250. That's what the transfer to general reserve from profit and loss appropriation account should be added. And so, can I take capital reserve? Only such reserves which were created out of profit and loss account or profit and loss appropriation account should be added back here. You should not take all the reserves. Only those reserves which were created from profit and loss appropriation account should be considered here. General reserve is generally created out of profit and loss appropriation. Whereas they have clearly mentioned what the capital reserve is created out of profit on sale of investments that was not created out of profit and loss appropriation account. If it is debited in P&L appropriation account, should be added. If it is not debited in P&L appropriation account, should be ignored. So I'm not taking this capital reserve account here. Then apart from that, we don't have any other reserve. So the transfer to general reserve is over. Now go for proposed dividend. Yes, we have a proposed dividend which is appropriated in the current year. Look at proposed dividend account. Yes, how much is the proposed dividend which is appropriated in the current period? 38,250. The amount which is debited in P&L appropriation account or P&L account. That's it. Okay. 38,250 is the current year appropriation. Then that should be added back. Look at the transaction proposed dividend, yeah, or provision for dividend 38,050. Yes, that was added. And then next one. After proposed dividend, you must consider preference dividend. Do you have preference share capital here? Do you have preference share capital here? Yes, we don't have any preference share capital here. So no addition. So after that, I must go for what? The next transaction is provision for tax. I must add back provision for tax. The current year provision should be added back. So how much is the provision for tax which is created in the current year? So look at the provision for tax account. The current year provision for tax is 68,625, which is debited in P&L account. Should be added back. 68,625. Yes. Then after provision for tax, what is our next entry? After provision for tax, our next entry is non-cash expenses. That is depreciation and amortizations. Look at the depreciation account. Nothing but provision for depreciation account. The current year depreciation which is provided. in the provision for depreciation account is 90,000. That's a non-cash expenditure. Please add it. Depreciation is 90,000. Don't stop with that. And you should also check what the intangible assets which were written off in the P&L account, or else if you can see any fictitious asset which is written off in the profit and loss. See, write-off of intangible assets and write-off of fictitious assets must be added back here. Look at the balance sheet. Do you have any intangible assets like goodwill, patents, copyrights? No. On the top of the balance sheet, we don't have any intangible assets, but you can see the fictitious assets, that is miscellaneous expenditure, not written off. I told you already this particular item should be considered in funds from operations. So the opening balance is 16,875, whereas the closing balance is 11,250. Since it is a debit balance and not an asset, the debit balance has reduced. That means that is purely written off in P&L account. So 16,875 minus 11,250. The gap is 5,625. That means the miscellaneous expenditure debit balance is successfully written off to the extent of 5,625 in the profit and loss account. So what are the money which is written off in the P&L account? That particular miscellaneous expenditure written off is nothing but write off of fictitious asset that comes under non-cash expenditure, should be added back here. So the under non-cash expenses. Look at the transaction here. Look at the transaction. Miscellaneous expenditure written off 5,625. Yes, added. So non-cash expenses were closed. Now go for non-operating expenses and losses. So what are the non-operating expenses? Premium on redemption of debentures, premium on redemption of preference shares are the best examples of non-operating expenses. Do you have any premium on redemption of debenture which is debited in P&L account? Yes, we have a premium of 11,250. If you remember, if you want to show me, you want to see this, look at the debentures account. There you have written premium on redemption of debentures of 11,250, and that is supposed to be debited. That was already debited in P&L account. Should be added back here under the head non-operating expenses. So we have successfully added premium on redemption of debentures also. We don't have any preference share capital. No need to consider. So non-operating losses is our next item. So while writing non-operating losses, you have to consider loss on sale of fixed assets, loss on sale of investments. Yes, we have sold some fixed assets and investments, but by selling fixed assets, we suffered a loss. Yes, we suffered a loss, and that was debited in P&L account actually. Fixed assets by loss on sale of fixed assets, that is 2,250. That should be added back here. 2,250 loss on sale of fixed assets. Investments were sold but with the profit, so you don't need to add back such item. So along with this, I mean after this we don't have any adjustments to adjust here. Non-operating expenses and losses were closed. Add it. Then after that, don't stop it, because you should also deduct one item called non-operating incomes and gains. Do you have any items like interest received and dividend received on investments which were created in P&L account? We don't have any such adjustments here. Interest received and dividend received on investments. Then go for non-operating gains. That means profit on sale of fixed assets and profit on sale of investments. That is the sale of fixed asset, but that resulted in loss. That is the sale of investments. Yes, that results in profit, but that was not created in P&L account. Instead of that was created in what? Capital reserve account. You should add back, you should deduct gain on sale of fixed assets or gain on sale of investments only if such transactions created in P&L account. And the problem, they have specifically mentioned that the gain on sale of investments was created to capital reserve account instead of creating to P&L account. So that means you don't need to deduct such portion, nothing but you don't need to deduct that particular item, gain on sale of investments, from this FFO, from this profit after tax and after appropriation account. Okay. In case if such adjustment is not given, I might have assumed that such profit is created in P&L account, should be deducted here. Okay, that should be deducted here. But they have clearly mentioned what such profit is created to capital reserve account, not created to P&L account. Since it is not created to P&L account, no need to deduct it. Okay. So no non-operating incomes and no non-operating gains. So there are no deductions here. We have only additions here. So successfully we got funds from operations of 384,750. That's it. FFO is over. Now I can go for funds flow statement. Funds flow statement is our final statement. Funds flow statement. Yes, here is the statement. Go for the transactions. So whenever you're writing the transactions in the funds flow statement based on our format, you should always check whether all the working notes were successfully prepared or not. Because from the working notes only I can take the numbers. Sometimes I can take the numbers directly from the balance sheet if there are no adjustment, if there are no complications. Now let me write the first transaction. The sources. The first source is issue of share capital based on our format. I'm just following our format. Issue of share capital. Issue of share capital. Look at the transaction. Under the sources, can you see the transaction called issue of share capital? Yes. Increase in share capital is nothing but issue of share capital. That is the difference between opening and closing balance of share capital. Opening and closing balance of share capital is 787,500 minus 6,75,000, and that resulted in 1,12,500. Yes. No adjustments are applicable here. Yes. Now the next transaction is issue of debentures. Yes. There is a redemption of debenture. We don't have any issue here. Next. Issue of preference share capital. No preference share capital. No issue. Long-term borrowings. Look at the loans. We don't have any loans here. Okay. Sale of fixed assets. Yes, we have sale of fixed asset. Fixed assets was sold for yes. Let me go for the asset account. The fixed assets was sold for 9,000 and investments were sold for 1,01,250. These two transactions must be considered here. Sale of fixed assets. Sale of fixed assets. Sale of fixed assets 9,000. Sale of investments. And then sale of fixed assets and sale of investments. After that, I must consider funds from operations 384,750. Non-operating receipts, interest received, dividend received. Such type of transactions are not given here. So with this, we have written all the sources. Now go for the applications. What is the first application? Purchase of fixed assets. Do you have any purchase of fixed assets here? Go for the fixed asset account. Yes, we have purchased 2,70,000, and also we have purchased some investments also. Purchase of investments 90,000. So now see the transaction. Purchase of fixed assets. Purchase of fixed assets. That's the first transaction. Purchase of investments. Yes, we have written that. Actually, we should start with redemption of preference share capital. We don't the first transaction is buyback of equity. No buyback of equity. Redemption of preference share capital is not applicable here. Redemption of debentures. Actually, the next thing is redemption of debentures. Debentures were redeemed along with premium 1,12,500. You can see the debentures account along with premium 1,23,750. I hope we have written that number 1,23,750. Premium was written separately. Instead of that, you can write both the numbers collectively by writing redemption of debentures along with premium 112,500 plus what 11,250, and the value is 123,750. So redemption of preference share capital, no redemption of preference share capital. Redemption of debentures we have taken here. Purchase of fixed assets and purchase of investments we have taken. Yes. First one, redemption buyback of equity, no buyback of equity. Second one, redemption of preference share capital, no preference share capital, no redemption. Redemption of debentures along with premium, yes, we have taken. Purchase of fixed assets we have taken. Purchase of investments we have taken. Now payment of tax, income tax payment and dividend payment. Payment of tax and payment of dividend are considered here by seeing this accounts payment provision for tax account, payment of tax, provision for dividend account 61,875, provision for dividend account 33,750. Yes. Now see this payment of tax 61,875, payment of dividend 33,750. What about the transactions? See, payment of tax is over, payment of dividend over. Non-operating payments, rarely you can write the transaction. Most of the cases you can never see such transaction, non-operating payments. So we have completed all the adjustments, we have prepared all working notes, we have prepared FFO, and now we are finalizing this funds flow statement. We have written sources and we have written application. See, this statement is clearly saying what the sources are more than applications. That's why we got a balancing figure under application side, and that's what 28,125. That is increase in working capital. You can take the total. This is more total. Right, by writing this total here, I'll get a balancing figure of increase in working capital of 28,125. FFS is over. Okay. Now, the easiest statement to prepare is statement showing changes in working capital. What are the standard columns? Particulars, year 21, 22, two balance sheet dates. Write the current assets, stock, debtors, bills receivables, prepaid expenses. Already I told you, these are your current assets. Debtors means net debtors. That means debtors after deducting provision for bad and doubtful debts. Don't consider those adjustments which were given in the problem. Just ignore it. Just consider net debtors. Yes, we have written opening and closing balances here, 21, 22 balances. And also the current liabilities. We have only two current liabilities, accrued expenses and creditors. Sir, we have provision for tax and taxation, proposed dividend also. Why you are not taking those two balances here? Because we assumed that those two items are what? Those two items are non-current accounts. That's what our assumption. That's why we have adjusted those two items in FFO and FFS. Okay. So we have only two current liabilities, accrued expenses and creditors, opening and closing balances. Now write the current liabilities total, write the current assets total, calculate working capital, net working capital for 21, 22. Net working capital means current assets minus current liabilities, A minus B. A minus B. This is 343, 125 opening working capital, 343, 125 closing net working capital. That's the wrong balance actually. Let me check it. 666,000 minus 343, 294, 750. And that is 371, 250. So your working capital is increased minus 343, 125. The gap is 28,125. This is my increase in working capital. So successfully, we got an increase in working capital of 28,125. The rule is whatever the balance you're getting in funds flow statement, either increase or decrease in working capital, should be matched with the balance that you're getting and this statement showing changes in working capital. I got a balance of 28,125, increase in working capital in statement showing changes in working capital. This number must be matched with what the number which we got it in what the statement called funds flow statement. In funds flow statement, I got 28,125. Yes, the same number we got it in statement showing changes in working capital. Then only your solution is absolutely right. Okay, but this we have completed this particular 12th problem. You can go for other problems also. Yes, with this the chapter FFS is over. Yes. Yes, the next chapter is comparative common size financial statements and trend analysis. The three terms you must remember: comparative, common size, and trend analysis. Comparative financial statements, common size financial statements, trend analysis. Three components here. Okay, we have three formulas for these three items called comparative financial statements, common size financial statements, and trend analysis. In all these three areas, I'm going to take financial statements 2 years, the previous year and this year. Okay. Yes. Now, dear students, in this chapter, we can see lot of interpretations. You better go ahead with the formulas first of all, so that you can calculate the basic part of the solution. Then try to identify the comments and the problems so that you can easily understand. So I'll try to give you the formulas part, and I'll explain how we are calculating. Okay. So now the first area of this chapter is comparative financial statements. See, while comparing financial statements, what I'll do, I'll take this formula. Just go for this part only. Go for the third point. This is very important. Okay. Showing increase or decrease in value in terms of percentage. What is the formula? Increase or decrease amount divided by amount in the past period. So from last year to this year, how your component is increasing or decreasing, whether it is increasing or decreasing. Write that increase or decreasing amount in the numerator divided by amount in the past period, nothing but the base amount. Okay. Then calculate the percentage under which analysis? Comparative financial analysis. Okay. So under comparative financial analysis, the first formula I must remember is increase or decrease amount of the components of the financial statements divided by amount in the past period in the financial statements. Okay. Then under common size financial statements, I need to check the common size of every item in the financial statement. So common size of under common size financial statements, I'll take the same numbers in the current year actually. Investments divided by total assets, current assets divided by total assets, fixed assets divided by total assets. That means I'll take every component of asset side, like fixed assets. And out of such, by taking such fixed assets, I'll try to calculate the percentage of such fixed assets on the total assets. Then I'll try to calculate the total current assets on the total assets. The percentage of current assets on the total assets. The percentage of fixed assets on the total assets. The percentage of share capital on the total assets. The percentage of equity, proprietors fund, the percentage of proprietors fund on the total liabilities. The percentage of share capital on the total liabilities. The percentage of debt capital on the total liabilities. The percentage of current liabilities on the total liabilities. Like that, I'll take the total in the denominator and the respective component in the numerator. Then I can calculate the common size of every component, the proportion of every component in the balance sheet or in the income statement out of the total. Okay. This is the formula that you should remember. This is the second formula you must remember under common size statements. So what is the formula? Investments by total assets, current assets by total assets, fictitious assets by total assets. If it is liability side is classified as what? Proprietors fund, long-term loan, current liability showing individually and in total in the denominator. So then percentage of each liability to total liability. The percentage of each liability to total liability. The formula is what? Each liability divided by total liability. This is called, is calculated accordingly like asset side. So just like asset side, on the liability side also you have to calculate every component percentage. Then that is what common size statement analysis. I'm not talking about analysis. This is just mere computation. Okay. Even in income statement also, we classified the items like sales, COGS, operating expenses, net profit, interest, tax, earnings after tax. Every component should be expressed as a percentage of sales. Who is the hero in the income statement? Sales. So sales should be in the denominator and every component in the numerator, because the expenses and losses, everything should be recovered from what? Sales only. So in the numerator, I'll write what? Cost of goods sold, cost of goods sold, admin expenses, selling and distribution expenses, interest cost, income tax, like that. Every component should be written in the numerator, the individual components in the numerator, and in the denominator, I'm going to take what? The sales value. Okay. This is your second area. Second formula you must remember. Again, I'm repeating. See, dear students, under comparative financial analysis, the formula is increase or decrease in the amount divided by amount in the past period. So what in the second formula, just now we have discussed. Okay, the individual components of asset side liabilities divided by total assets or total liabilities. That's it. If it is an income statement, I should take the expenses or losses divided by what? The sales. Now the third formula is trend analysis. This is third formula, trend percentage. Trend percentage or trend ratio. The formula is value of each item in the financial statements of any period divided by value of same item in the financial statements of the base period. Say for example, in the last year, my fixed assets balance is 1 lakh, and in the current year, my fixed assets balance is 1,25,000. So my fixed assets are increased. So this year, this is current year, this is previous year. So compared to previous year, my fixed assets percentage is 1,25,000 divided by 1 lakh. So 125%. So this year my fixed assets balance is 125% of the previous year balance. That's what the trend formula. So the trend ratio is what? The value of each item in the financial statements of any period, the current period, divided by value of the same item in the financial statements of the base period. So you must take what? The the value of each item of the current year financial statements should be compared with the value of the same item in the previous year. Okay. So simply current year balance divided by previous year balance. That's what the formula you must remember. What is the formula? Trend ratio. Trend ratio is equal to current year balance sheet item divided by previous year balance sheet item. The same item you have to consider. Okay. That's what trend ratios. In that way I can calculate trend ratios. Now let us apply the formulas. See, illustration number 1. From the following income statement, prepare common size statement and also interpret the results. I'm not going for the interpretation because that's a big part. Okay. Just I'll try to give you how to go for the calculation part. Okay. See, under common size statement, what is the formula? This is the formula. The individual item divided by total. Individual item divided by total. That's what the formula you have to apply here. Net sales, COGS, gross profit less other operating expenses, operating profit less interest on long-term debt, profit before tax. Yes. Now, what is the main component here? Sales. So I'm going to calculate every item. COGS by sales, gross profit by sales, other operating expenses by sales, operating profit by sales, interest on long-term debt by sales for last year and this year also. You see, common size statements for the year ended 31st March 2021 and 22, 2 years. Net sales is 100%. Out of such 100%, cost of goods sold is how much percentage? Yeah, but just calculate it. COGS is 5,70,000. 5,70,000 divided by 10,50,000, and I got a percentage of 54.28%, approximately 54.3%. In the similar way for 2022 also, 47.8%. So like that you have to calculate gross profit ratio for 21 and 22, other operating expenses by sales for 21 and 22, operating profit ratio for the 21 and 22, interest on long-term debt for 21 and 22, like that. Every formula, we are applying the same formula here. Individual item divided by total item for the respective year only. Okay. See, by seeing these numbers, we can go for few interpretations actually. See, look at the transactions here. Last year, my COGS percentage is 54.3%, whereas this year, 47.8%. So I was able to reduce my cost of goods sold to up to some extent. Might be my purchase price of the raw material is reduced, or my wages cost is reduced, or my some of my variable overheads were reduced. Because of this reason, I got some reduction in the cost of goods sold as a percentage of sales. Thereby, I got some extra gross profit ratio. Last year, my gross profit ratio is 45.7%, whereas this year is 52.2%. So my gross profit is improved because of reduction in what cost of goods sold. Like that, you have to write your own interpretation by seeing the comments. Okay. So you can see some comments here. You can write your own comments also. It is based on your understanding. Okay. Yes, this is regarding common size statements. Yes, common size statement is over. Now I can go for comparative statements. So here also this is common size statements. I'm not taking it. Common size, common size. We should go for comparative statements. Here is the comparative income statement. Look at the problem. The following are the income statement of A Limited for the year ended 31st March 2021 and 22. Net sales minus cost of goods sold, gross profit less admin expenses, selling expenses. We got operating expenses total, and then if we deduct this operating expenditure from gross profit, we got operating profit. Then add back other incomes and deduct other expenses. Then we'll get profit before tax less income tax, profit after tax. Yes. Now what is my job? I should go for comparative analysis. That's what they're saying. Prepare a comparative income statement and comment on the performance of A Limited. First of all, you should go for the formula in the comparative statement. What is the formula? Increase or decrease amount. Comparative financial, under comparative financial analysis, increase or decreasing amount divided by amount in the past period. For every item, just try to calculate the increase or decrease in the amount. So I'm taking numbers here. Last year net sales 1,70,000. This year 1,90,400. Amount of increase or decrease. Plus is increase, minus is decrease. My sales is increased by 20,400. 20,400 divided by last year number, base number 1,70,000. So it has been increased by 12%. Sales is increased by 12%. Go for cost of goods sold. It has been increased by 15,000. How much percentage it is increased? 15,000 divided by base number 1,05,000. Last year is base number. Okay. That is 14.3% is increased. So like that, you have to calculate every percentage. Gross profit is increased by 8.3%. Administrative expenses increased by 13.33%. Advertisement expenditure is increased by 33.33%. Other selling expense increased. And then total selling expenses increased. Operating expenses increased. Operating profit increased. And other incomes increased. Other expenses decreased. The only expenditure which is reduced here is other expenses. On what? The other expenditure last year 6,800. This year 4,800. It is reduced by 2,000. Reduced by 29.4%. Like that. Some of the expenses, most of the expenses were increased. And mostly your sales is also increased here. So finally, your profit after tax is successfully increased by 106.3%. The last year it is 3,800. Now this year it is 7,840. So there is a huge increase in your net profit by 106.3%. Okay. And accordingly, they have given some comments. You should, if you can read such comments, you can easily understand. Simple, increase or decrease in each item divided by the base period item, nothing but last year item. That gives you the percentage increase or decrease in the respective items. This is what comparative income statement analysis. Okay. The last one is trend analysis. Here is the formula for trend ratios. The trend ratio means what? This year item divided by last year item. That's it. This year item divided by last year item into 100. That gives you trend ratio. Compute the trend ratios from the following data and comment. 19, 20, 21, 22, 4 years numbers were given here. Cost of material consumed, labor costs, other expenses, cost of sales, profit and sales are given here. Computation of trend ratios. 18, 19, 19, 20, 20, 21, 21, 22. Cost of material consumed. See, the first year numbers are all 100%. So calculate the ratios. Now for 1920, material consumed 2,50,000. It has increased. 2,50,000 divided by base year, last year number. This year number divided by last year number. Divided by 2 lakhs, that is 125%. Now go for the 2021. 2 lakhs is a material consumption. Last year is 2,50,000. 2 lakhs by 2,50,000. That is 80%. No, actually not like that. Take the first year as a base year. and write the numbers for the future, but remaining years by taking the first year as the base year. 2 lakhs by 2 lakhs, 100%. And then what? For 22, 1,80,000 divided by the base number 2 lakhs. This is 90%. So the first year is a base number. Remaining all the years are the rest next year numbers. How the cost is increased. Okay. How the cost is increased, how the revenue is increased, just like that you have to calculate. So I'm taking base year as 18, 19. Remaining all the years are the future numbers. So this is your denominator. Okay. This is your denominator. Remaining all these are what? Numerators. Yes. Labor costs. Last year, 1,50,000, 1920, in the year 1920, sorry, 1819, my labor cost is 1,50,000. For 1920, it is 1,50,000, 100%. For 2021, it is 2 lakhs. 2 lakhs by the base year is 1,50,000. 133.33%. Yes. And what about the year 922? 1,25,000 divided by 1,50,000. It is 83.33%. Like that, you have to calculate trend ratios by taking one of the year as a base year. That is generally the first year. Okay. So like that, you can calculate the percentage for other expenses, cost of sales, profit and sales also. Sales is 112.5% for the 1920, 93.8% for 2021, 100% for 21-22. Okay. This is regarding trend ratios. Okay. Yes, with this, the comparative common size financial analysis of financial statements and trend ratios or trend analysis is over. Okay. Yes.